Morning, everyone. So it's really amazing and a privilege always to come and present at Round the Clock Trader. And I'm sure that some of you have already met me live there as well. I've seen you in my talks as well that I've done over there. So today morning is going to be all live trading. Okay, I think most of you already know me. You have come to our live trading week, come to our conferences, come to our talks. For those of you who don't know me, I'm the founder of Master the Markets, Elite Traders Conference, and the Traders Open Day. Just to give you a very quick brief of who we are, I don't want to take too much time because I just want to show you the action that's happening actually in the live trading markets. That's all the disclaimers over there. That's me to put a face to my name. I started off as a scientific researcher just to show you that. Didn't work out, went to make it happen. The three main things about our company: transparent track records, research-backed systems, and open door support. Find out more about us at masterthemarkets.net. All I just want to tell you, there will be interactive exercises today for you to win an opportunity to come and see us live at Traders Base Camp when you purchase a T-kit at 50% discount. Okay, right. So I just want to show you this at the moment. Stops to cash is the strategy that I'm going to be teaching you today. But before that, I just want to show you some stuff live in the markets as it's going on. Now, firstly, I must do mention that all this live trading, this is one of the main unique points about our company, because not only all our systems and strategies are research backed, but we also trade in real time as well, and we publish all those videos on our YouTube channel. Okay, so we'll be posting a link on our YouTube channel that you can also subscribe to. And not only that, I mean, if you want to follow us live and watch our videos anywhere, anytime you are traveling, then we have this WhatsApp group that we have that you can join, and you can basically watch our videos as our backend team posts that live trading videos that we are taking, just like today. Okay, just like today. Right, I want to run through some real-time trade probabilities today. I want to run through some real-time trade probabilities. Some of you may be asking and wondering, how do you join the WhatsApp group? We will be posting you the details very shortly on what you need to do. It will take you less than 10 seconds to join our WhatsApp group, and after that, you will get all our live trading videos. Okay, good. Now, let's analyze what we have today in terms of cable, right? So first of all, the first thing I do always mention in all my videos is, as intraday traders, before you trade any strategy, you need to have your concept and your objective. Okay, your concept and your objective. The concept for the morning glory strategy that I'm showing you right now is that price makes X range every day. Okay, price makes X range every day. What do I mean by that? Now take a look at this now, traders, right? You see, you can see that every day price moves a certain range. Yeah, every day, right? Every day price moves a certain range. If it doesn't move a certain range, then the open will be the same and the close will be the same. There won't be any highs or lows. So if every day it was that similar and the price doesn't move, what you will get on the chart is a horizontal line, just a straight line. That's what you're going to get, right? But if you have price movement, then you will have price making even higher highs or lower lows in comparison to the bars, bar by bar analysis. All right, so that's what we are saying. So now, based on that, what we're now deriving first is that price makes X range, X pips of range every day. And how do we find that X pips of range? Do you all want to go and type in into the chat box? How would I find that X number? How would I find that? What's the best way? What tool can I use to find that X pips of range every day? So the concept, to reiterate, the concept of this strategy is that price makes a certain range every day. Okay, that is for definite. All of us will agree and all of us will affirm that. Now, how will you find that certain or the X range every day? What tool would you use? Now, let me see all the answers coming in. Okay, let me see. Yeah, already okay. So I've already got people already telling me that basically you've got all the ATR, okay, Rick and all that. Okay, good. So you guys, some of you guys do know that. Right, so we can use the ATR, right? So if I were to use the ATR 10, so I put it from yesterday's bar because today's bar hasn't formed yet. So from yesterday's bar, what we have is 90 pips, okay? 90 pips. So 90 pips is what I have as the ATR. Okay, 90 pips is what I have as the ATR. So now from that concept, now I can draw up my price map. Okay, I can draw my price map. Now, traders, you must be very, very aware at the moment. Everything I'm going to be showing you is based on raw price. Okay, based on raw price. Okay, these are all research that we have done over the last 6-7 years with a team of elite traders. Okay, so that's what it's all about. It's raw price is what we are having over here. I'm going to show you more and more, and even the statistical probabilities as well. So not only this is 90 pips, now the ATR range. From that, what we have found from our research is that in cable, and we have an indicator for this for each currency as well. In cable, do you know what is the range it does 70% of the time? Do you know what is the range it does for 70% of the time? And do you know what is the range it does for 80 to 90% of the time? Go in and type in that. So you have an ATR 10 of 90 pips. What percentage of the time does it do a range which comes up to 70% of the time? What range does it do 70% of the time? Does it do 1 ATR? Does it do 0.9 ATR 70% of the time? Or does it do 1.2 ATR? What does it do? Has anybody done the research in this room? Traders, it's very imperative. It is very, very imperative that you must know the statistics before you trade. Because range trading is very, very critical because it's a very, very strong concept. So, okay. So in this room, almost no one knows the answer. Let me just type in the question what I just said. What percentage of the time, what is the ATR range that cable does 70% of the time? That's the question over there, and all of you can see that so that we all are clear of what the question is. I'll be covering a lot of this kind of concepts in real time with live trading in our WhatsApp group where the levels and the videos will be posted out. Okay. Right? If you want to know how to join it, just look at the chat box. Now, in terms of this, what we are looking at right now is, let me give you all this answer. Let me give all this answer. We'll shortcut your journey by at least 2 years. Okay, at least shortcut your journey by at least 2 years. 70% of the time, traders, 70% of the time, cable will form 0.7 ATR. 0.7 ATR. Okay, 60% of the time it will do 0.8. All right. And 80 to 90% of the time it would do 0.6. Okay. Now all the statistics for all of this has been formulated by our research team and our programmers. Okay. Let me just show you a glance of that, and you can see over here all the stats that we've got over here. All right. All based on this probabilities that I've just showed you, over 2,372 trades. Okay, that's what we've we've got over there. Now, let me tell you now, couple of things that are very critical in this price map. So the first thing I've told you is 0.7 and 0.8 ATR. So that's why I've got it drawn on my price map over here on my diagram. The next thing what I do want to mention to you is the two critical levels that you can take note every day is the previous daily high and the previous daily low. Take note of them. They're very critical as well. So previous daily high and previous daily low. Right? Previous daily high and previous daily low. Now, does anybody in the room know why is that important? Why is those levels important? Previous daily high and previous daily low. Why is that important? Okay, I'm seeing some answers over here. That's not really that true. Anybody else? There's a few answers coming in. So why is that previous daily high and previous daily low important? Now, the usual answers I'm really getting is support, resistance, trend, you know, those are the usual answers I'm getting. Now, it's got to no, all right, as I expected. I mean, most of you really don't know the answer. And here, listen, I'm going to tell you something very, very important here, which actually only took me, when my trading mentor actually taught me this, it didn't make sense straight away, okay? It took me like 2 years really for the penny to drop. And I'm going to tell you the answer right now. But I don't expect most of you to really fully understand and comprehend it, okay? One of the reasons why we look at the PDH and the PDL, you're all right in terms of all these technical terms of support and resistance, but there's one very strong market logic. There's one strong market logic behind this. And when you know this, you will have more conviction on these levels. Now, the market logic is this, traders. Behind yesterday's high and lows, there's a lot of entry orders and there's a lot of mainly stop loss orders, okay? Or I can say stop orders. Stop orders can be for entry or for stop loss, okay? Because a buy stop can be either be an entry or a stop loss. So it can be an entry to go long or can be a stop loss to cover your short position. So since there are a lot of stop orders and since brokers make their money out of filling transactions, therefore, since this model is based on transaction filling, because that's how the broker can make the money, because of course nobody would do anything if they're not able to make a single penny out of it, because that's how the economic structure has been built. So therefore, since there's a lot of orders that the broker can fill here, the price will move there. Either to the previous day high or previous day low. Now, do you know, let me ask you something else. Now, do you all know the percentage probability that it will break its previous day's high or previous day's low? Do you all know the percentage probability? Type into the chat box if you know the percentage probability of it breaking out the previous day's high or previous day's low. I can see that most of you right now already typing it in and all just making educated guesses at the moment. You must have your research, traders. You must have your research. Okay, I can see that in this room, probably no one really knows the answers to all of this. Now, do understand that if you're trading without all this knowledge, you're just waiting to be getting slaughtered in the market by professionals like us. Because we'll be just eating away your stops, just like what I'm talking to you and explaining to you right now. Now, let me tell you the probability of it taking out the high or the low of yesterday. There's an 80% probability, 80% probability. And if you want to know why, what's the reasoning behind that, go and watch our previous videos that we have done. And I also talked about these probabilities in the last London Forex Expo as well. If you want to get those videos, you can always email us and we will be happy to send them over to you. Okay, you can purchase them. Right. Now, 80% of the time, it can take out this high or low, because it can form either a higher high or a lower low. So 80% of the time. But how do we put the probabilities to either one side? How do we do that? Now let me explain to you. Now yesterday, how you can do that is you got to find out from yesterday's bar whether it closed above its mid-range, whether it closed above its mid-range. Yesterday it did close above its mid-range of its bar. Once it closes above its mid-range, there's a 70% probability that it would take out its high. Okay, 70% probability that it would take out its high. Now, not only that, I'll tell you one more thing as well. Now, you can see currently price has come to 3 pips away from its previous day's high. Currently, price has come 3 pips away from its previous day's high. Now, once it has done that, you will expect cable to take out the previous day's high by X number of hours. By X number of hours. Now this is what we call, and in our previous YouTube videos or live trading videos that we post on the WhatsApp group, we talk about this as we call it time-based studies. Time-based studies. Now does anybody know whenever cable comes to 5 pips or 10 pips from its high, previous day's high or previous day's low, do you know how long it would take to take out the previous day's high or low? Go in and type in into the chat box if you know the X number of hours that cable would take to take out the previous day's high or low if it comes to less than or equal to 10 pips away from the previous day's high or low. What would that answer be? Okay, now you just got to ask yourselves, is this educated guesses or is this out of pure research? Most of you are saying it's all educated guesses, and that's not good because you know what happens when it's educated guess. Fear will start to creep in. Subjectivity starts to move in. You don't have conviction in your trading. Okay, traders, over here, traders, you know, you must understand that when we are giving you all the stats and everything, trade and everything, we are telling you as is how is trading, because trading should be based on probabilities, not just on hype. Over here, we're here to establish the truth in this industry. Okay? No hype, no nonsense, right? Okay, now the X number of hours, what we found, 66% of the time is 2 hours. Within 2 hours, it would take out its previous day's high. Okay, within that hour, there's at least 50% of them. Within that hour, there will be at least 50% of them which take out the previous day's high. So if this doesn't take it out within the next 2 hours, this being the first hour and another bar next hour, then my trail will get aggressive if you're looking to take out your profit at the previous day's high. So let me tell you right now, in terms of considering these two probabilities, which is it's coming near to 3 pips, less than 10 pips of its previous day's high. So less than 10 pips of its previous day's high. That's the first point. The second point, yesterday's close being above its mid-range. Based on this, there's a very high probability that it will take out its high in the next 1 to 2 hours. So within this bar and the next bar, there's a 66% probability that it will take out its previous day's high. Okay. The final stats I want to tell you is, since the concept of this strategy is to capture, is to mention that price will make a certain range every day. So therefore, the objective of this strategy is to capture X amount of range every day. Okay. The objective of this strategy then, in line with the concept, is to capture X amount of range every day, because the concept is that price will make an X amount of range every day, at least 80% of the time. Okay, that's the concept. Price moves a certain range every day. Price moves a certain range every day. That's the concept. Objective is, the target objective is We want to capture at least 80% of that range. Okay, whichever X range that it does 80% of the time, that's what we want to capture. Right. Now, based on all of that, then you might say, okay, Thiru, this is all well good and said, but what is the chances that once it takes out the previous day's high, what are the chances that it will continue to move in that direction and make its range? What are the chances that it will continue to move in that direction to make that range? So what are the chances once it takes out its previous day's high, where currently right now there's a 70% probability that it can do that? What are the chances that once it takes out its previous day's high, that it will continue to move in that direction to make its range? Do you all know the probabilities towards this, or have you all even asked this question even before? Go and type into the chat box if you know the answer to this. Yeah, most people won't know. And I know a lot of you are saying, not sure, thinking, what will I type in? Some of you putting question marks in. I can totally understand. Because traders just taking out the high continuously on a high percent probability is not going to put money in your pocket. But it will add a strong edge to your favor if you know how to align all of them together. And this is what we really talk about at Traders Basecamp, a full 2-day workshop, immersion with the professionals, which can shortcut your journey. Because over the 20,000 traders that we've talked to, some people have wandered around in this industry for 10 years without making a single penny from the market. And I've had people like that come into the workshop. You must know these probabilities and stack them together. Okay? Right. So let's observe what happens in this market today. In terms of a higher time frame bias, today we have it to the upside based on one factor, but based on two factors, no, we don't have that. So I'm actually staying away from the market today. But if you were to take a position, it would be definitely towards the long side, at least taking out the previous day's high. After it takes out the previous day's high, I would say the stop loss management should get aggressive. Okay, should get aggressive. A couple of things are showing up on this lower time frame that the probability and stacking is to the upside. I've got all these green lines over here, which also puts the probability towards my side as well. Okay, right. So that's what we have at the moment in terms of cable. That's what we do have. Right. If I get a furthermore retracement of this price towards the downside, then I will definitely be looking at a position, because my reward to risk ratio will also be increased and be in my favor. But looking at the momentum right now, highly probably we will get that. So we will look to see to break that high, and we can continue to see that. Now, for those of you who've been listening and everything, I'm going to give you all the first question, an interactive exercise that will give you a chance, to win a Trader's Essential Kit. Okay? So this is what we are going for. I'm going to give you a question right now that will give you a chance to come onto our Traders Basecamp workshop for free if and when you buy a Traders Essential Kit at 50% discount. Okay, so prize winners of this next question, when you buy a tea kit for 50% discount, you will get a free ticket to Traders Basecamp, but we'll go through this in much more detail and so much more high value content over there to make sure that your trading gets into consistent profitability. Okay, right. So now let me just put this now over here. The question is what is the concept of the morning glory strategy. What is the concept of the morning glory strategy? Okay, I've posted that question to all of you. The first person to answer it correctly will stand a chance to come and meet us live and hang around with the professionals for 2 full days. Imagine the amount of immense knowledge you're going to get and the immense growth you're going to get out of that. Okay. Right, I'm getting a few answers over here. I'm going to give the prize to Rick. Okay, Rick. Right. So Rick, you will get the prize. You've said objective, you come quite close, is to capture the range every day, and you've given a more specific answer, which is 80% of the range. So if you can just send us your contact details, and our team will contact you. Okay. All we need from you is your email address and your phone number. Okay, email address and phone number, and then our team will contact you. Okay, good. So I will move on. So today, based on all of this, I'm going to give you all a strategy that you all can use. I can give you all a strategy that you all can use in the markets. Okay, right. So stops to cash is the strategy, and we've gone through this in our live trading week as well. What this is a reversal contrarian move. Traders, I'm going to give you all some really strong points over here that will put the edge massively to your favor. So listen up very carefully. I'm going to be giving you certain points that you can be using, that will be very, very highly favorable and profitable for you. Okay, right. So that's what stops to cash is about. So reversal contrarian move is about driving the stops out and exiting on the higher time frame. All right. So let's move on into the next slide where it teaches you about the entries. Now the first thing you need to look at, and I'll tell you this and you can jot this down, is we'll be looking at the daily time frame to formulate a bias. The first thing that you need to do in terms of your entries for stops to cash, you need to formulate a bias. Now the bias is derived from your daily time frame. You look at your bias. I'll give you a clue what you can look at. You can take a look at your daily time frame, and as long as you have 2 bars, only bars, yeah, we're only looking at bars, which has got higher highs and higher lows, and also a higher close, take your bias to the upside. If you have 2 bars which are lower lows and lower highs, then take your bias to the downside. That's your first point. So take it from the higher time frame. Okay? Whenever you have a mismatch, I would say that for now, stay away. Okay? Because we got so much statistical studies, we can still take it even when it's a mismatch. That's what I show in the YouTube videos that we post in our WhatsApp group. Okay? So that's massive learning for you in terms of the WhatsApp group over there. All right. Okay, good. So you can see over here that yesterday, in terms of that, you can see compared to these 2 bars, you take the previous day's 2 bars, you can see that there was 2 bars over here. Let me just draw it accordingly. 1 red bar and a green bar. One red bar and a green bar. You can see that that is a lower low, and that is a high, and that's a lower high, right? It's a lower high. So that's what you have. But however, the close was higher. So we have a mismatch, isn't it? We don't have the exact setup. So we won't be taking this. If you were trading this strategy, you won't take this trade today. Understand? I'm just teaching you one way where it will give you very, very high quality setups. All right. So that's the best way that you can make money, because what's important is not the number of trades you're taking, but how much money you are making. Understand? Right. Okay. So now the next thing is we want a downward move on the 1 hour time frame. We want the stops to stack up. So today, if I were to take, let's say, imagine that today, according to our statistical probabilities, we would take this on a bias on the upside, okay? But based on the stops to cash strategy, if I were to wait for a sell-off, which is the stops to stack up, I do not have it at the moment because trade has moved more or less in the upward direction. I need a sell-off, traders. I need a sell-off of at least 3-4 bars consecutively, which I don't have at the moment. I only got one. You can see this bar here. Understand? So that's what we are missing at the moment. Yeah. Okay, so that's what you are waiting for. Now let me tell you one critical point that will help you massively, and listen up very carefully here, because once you go and look at this in the market and in any instrument, this will massively put the edge in your favor. So let me tell you this critical point right now. Okay, if you're all ready, I'll tell you all right now what that point is. Now, this sell-off that I mentioned to you, yeah? Now listen up very carefully. When you wake up and you want to place a trade at 8 a.m., the open of the European session and the UK session as well, observe the range from midnight to 8 a.m. So here I've drawn for you 7 bars, 1, 2, 3, 4, 5, 6, 7. So this will bring you to the 7 a.m. 1 hour bar, which is also the same as 8 a.m. Now the second thing what you need to do, is draw out the range for that day. You need to draw out the range for that day. You need to draw out the low and the high. You need to draw the low and the high for the day. Yeah, the intraday range, high and low. Intraday range, high and low. Intraday range, high and low. Now let me show you on the chart what I mean by that. So today, as you can see, you've got the intraday range high, which is on this bar, and intraday range low on this bar, isn't it? So that's your midnight bar, and that's your 7 a.m. bar. So between midnight and 8 a.m., what is the highest and lowest part of the range? So you can see this one and that one here. Understand? Yeah? So that's what we are saying. Now, between that range, what I want you to do is, based on the second point, once you have mapped out the highest and lowest part, I want you all to see a sell-off. I want to see a sell-off that either takes out the high or the low, depending on which direction you're going. So let me explain. If you're taking on a bias on the upside, yeah, if you're taking on a bias on the upside, what I want you to do is wait for the sell-off to occur such that it takes out the low. All right, I want it to let it sell all the way to take out the low of the range. Understand? The only time you will not wait for it to take out is intraday range if the 7 a.m. bar is already the lowest part of the range. The only time you would not wait for it to take out the intraday low or high is when the 7 a.m. bar is already the lowest part of the range for a bias on the upside. Okay, so that's enough of that on that side. So I believe that those of you who are very keen to making this work have given you a very strong edge in the market that we have found that you can use to boost up your trading performance. The next thing is a price bar analysis. Once you have that sell-off, wait for a reversal bar pattern, a reversal price bar pattern which closes above its 50% mid-range on the 1 hour time frame. Okay, cool. That's to do with that. Some more additional rules you can put on: stochastic 20% oversold point if you are going long on that particular basis. Reward to risk ratio at least more than 1 to 1. If you get a bit more seasoned, you can do more than 0.5 to 1 as well. Okay, more than 0.5 to 1 as well. And the final one, placing the order. You can do a pending order in the beginning if you do not have all the price level maps and the price studies that we have done. If you want to do it, then you can do a pending order. Okay, just to be a bit more safe. Sometimes based on some critical analysis of the price, we will enter on the close, and you can see all of this, all of us doing this live on the YouTube video posted through our WhatsApp group. If you want to join our WhatsApp group, just post in your number and we'll tell you how to join it. That's all you have to do. Okay. All right. So that's to do with the entries. That's to do with the entries. All right. At the moment. Okay, good. So that brings us to our next question. On stops to cash. That brings us to our next question on stops to cash. So what is the next question? Okay, what is the next question? Okay, so let me ask you all this question. Let's see who gets this right the first time round. Okay, first time round. When we are looking for price reversal bar pattern, and let me just type this in. When we are looking for a price bar reversal pattern, where must the close of the bar be in relation to its range? Okay, so I've done that to you all. Okay, good. So I've sent that over to you all. Okay, good. So Ankit, you are the first one to say that. And there you go. You got the prize. Okay, you've got the prize. Ankit Agarwal. All right. If you want to send us your contact details, your email address, and your phone number, and then our team will follow up with you. And the good news is, traders, I mean, if you're really keen and all that, we have a full 2-day Traders Basecamp coming up on this weekend, on this Saturday and Sunday. Okay, and we ensure that these Basecamp workshops are not filled up with like 50, 100 people, to give the quality knowledge for a good ratio of presenter to client. We usually cap them at about 18 to 20 people in the classroom, so that you get the best amount of one-to-one time and the best amount of client to presenter time as well. All right. So currently, right now, we already have about 16 people already booked onto the Basecamp. We got about 1 or 2 more spaces. So if you're interested, so definitely do get in contact with us. Okay, massive amount of value over there, and we're looking for committed, determined traders. Okay, traders. So now let's move on to the stop loss section. All right. So now moving on this. Let's take a look at the stops, on how we place the stops on this strategy. Before I move on, is there any questions that you all have? Any questions that you want me to answer? I will take them later on as well. I'll answer them later on. And I also want to show you also a live trade that we're currently on as well, in terms of our end of day strategies as well. You can also see in our WhatsApp group and our YouTube videos that currently smart money is up 4,000 pounds just in the last 3-4 weeks. I've been placing it. Very low frequency but very high profitability trades. Okay, currently based on that, we are also up on the dollar yen as well. Now let me show you a very quick brief on dollar yen at the moment. Now dollar yen, we got in on 2 positions. One is the smart money based on this bar alone, even before the swing high got confirmed by our smart money indicator. So we entered on the high of this. Currently we are in. Yesterday was a small pullback. Now it's coming back in our favor. That isn't the point. The point is to follow a strategy based on the statistical probability. Do remember that over here, everything we're transparent. Every loss we take is transparent. Every profit we take is transparent. Not only that, traders, it's cumulative. The trades are cumulative. And most traders that you follow, any other trading companies that you go that I have been to, they do not show you a track record which is cumulative. Okay, a cumulative track record A cumulative track record would look something like this. Let me show you. Cumulative track record will look something like this. See, for example, it will show you every trade by trade that you take. And these are the videos that we post on in our WhatsApp group, okay, on a YouTube and through our WhatsApp group channel, right? And you can see every single trade that we have taken, every single loss as well. That is called cumulative. Currently, right now, Morning Glory is up just under £1,000 this month over the last 15 days of trading. Okay, very tough conditions in the market just because the elections are coming, so it's getting stagnant. Understand? Cable's getting stagnant, but still, we're able to make money out of that job because of the statistical probabilities that we do have over here. Right, the final thing what I do want to mention in terms of that strategy, what I've just mentioned to you, is that the stop loss that you got to put it at the low of the setup, and once you have to trail it, so if that bar becomes the lowest point of the range, then of course simply put it for the low of that bar or the low of the setup. Or if you have to trail it after that, then trail every 2 1-hour bars. Trail every 2 1-hour buyer bars. If you want to make it more stronger, you can do it every 2 1-hour buyer bars. Okay, 2 1-hour buyer bars. Good. Swiftly moving on. The next thing is your target. Your target has got to be based on a swing high, swing low on a daily time frame or on a 1-hour time frame, or you can make it to X pips of the range, which I gave you some clues on how you can do that as well. 0.7 or 0.8 ATR. All right, you can test and adapt it. That you have to do your homework. Of course, if you're on the shortcut, hang around the professionals and move forward faster with them. Okay, that's what you can do. Right, so okay, so great. I'm just aware of time, and we are just coming down to the last part of the presentation. Money management you must have. I don't have much time to cover on that. Some live trading week examples that I want you all to go and look at in your own time. I've already shown you some live example at the moment as it is happening. Okay, as it is happening live in the market. Okay, so the final question. The final question towards getting our ticket at a 50% discount, which includes a free ticket to our invaluable, priceless Traders Basecamp workshop, where you will spend 2 full days with us, with the professionals, which can massively shortcut your journey and massively turn your equity curve positive. So the questions are here. Questions are this: for a long trade, how should we trade our stop loss? And finally, what is the objective of stops to cash? I would just say that since we've already answered this question here, just tell me the answer to this. For long trade, how should we trail our stop loss? Anybody will get the answer right in the beginning, the first one, and then we'll get the prize. Okay, already can see that some of you are already typing in your answers. I'm still awaiting the first answer to come true, which is correct. Okay. Okay, I will just move on swiftly just to see if anyone gets it right, and then we'll give the answer prize off to them. All right, I've got the correct answer out of the several answers that we got so far, which is Graham S. Congratulations. Okay, every 2 1-hour bars we trail the stop loss. Graham, if you want to post in your contact details, your name and your email address, contact details, name and email address, then we'll be able to send you the prize. All right, send you the prize. Okay, so there you go. Right, so that's pretty much that in terms of the presentation here. By right now you would have seen us trade in real time, and you have also seen a stops to cash strategy as well, and taking questions and answers. Currently right now, just got about 2-3 minutes right now. If you want to ask me any questions at all, you're more than welcome. You're more than welcome. Okay, so that's pretty much that in terms of us, in terms of the presentation. In terms of those of you, some of you might be wondering, some of you may be asking us as well on how you can get the Traders Essential Kit. Traders Essential Kit, you can just book it online. There will be a link coming through. The value is $499, but we're giving it away at £97 plus VAT, and that comes together with a 50% discounted TV ticket. But of course, for those of you prize winners, you get this at 50% discount, and you get a free ticket altogether for Traders Basecamp. Immense value. Okay. For those of you who are living overseas, not in the UK, two options. Some of the people who won the prize have flown down all the way to come and attend our Traders Basecamp workshop because they know the value of it. But some of you can't do that. You can always talk to our team on alternatives. Okay. Right. We got a lot of digital products that you can learn distantly as well. Okay, all the questions that are coming in on how many DVDs and all that will all be answered by our backend team. Currently, I would say there are 7 because there are 7 steps to making the Traders Essential Kit, to making your success. So there are 7 DVDs altogether. Okay. No, somebody's asking me, is this based on currencies? No, definitely not. Everything that we talk about here is based on price, and it can be used on any instrument altogether. Okay. With the answers that you derive from the questions, you can use it at any instrument altogether. Okay. Right. Okay, that's the end of my presentation. It's coming to 9 minutes to 10. What I would say right now, if you all got any other questions, you can definitely ask me. At this moment as well, I think maybe if Rishi is around as well, maybe he can just come in and talk to you just about the 1 or 2 trades maybe that we're also on in terms of the other end of day strategies, because I know that some of you may not be able to do intraday trading every single day, so you can look into end of day strategies as well. So we give you a brief overview of the end of day strategies that we are currently doing and that we are currently on as well. Okay, I'll continue to monitor this intraday trade, and I'll post all the updates for you all with a video today on our WhatsApp group. So if you want to join it, simply just post your number and then we will be contacting you. And at this moment, I must do mention as well, traders, that because of how this industry has become, some traders now also got a lot of blogs and thinking that, oh, if you give our numbers away, people will start keep hounding us, calling us. This doesn't happen in master the markets because our ideology is totally different. We are traders first traders. We're traders first. We are trainers second. We've got no intention to waste our time and waste your time by just hounding you and calling you and spamming you. We want to give you quality knowledge that will move you forward with your trading performance and boosting your equity curve. We are here with one mission: to establish the truth in this industry, because a lot of nonsense is happening over here by hindsight trading and by a lot of wishy-washy talk. And this is why in our presentation already you would have found out that we talk over here in a quantified manner, which is statistically based. And you will start to see that the more and more you follow us, the more and more you see all our blog videos, the more and more you see us on our WhatsApp group videos and all our live trades that we take in real time. No hindsight trading over here. Forward going. All right. Okay, that's pretty much that over here from me. I'm going to hand it over to Rishi just for a quick overview of the trades that we are currently on.
Thank you very much for that. Thanks very much for that, and very warm welcome to everyone this morning. Simon, so I won't be taking too long, just 2 minutes or so, to give a quick overview on the trades we're taking end of day. Obviously, our ideal case scenario is that we can place some trades with you all intraday, but if that doesn't happen, we're not going to force ourselves to place trades, because over here we're traders first and then trainers. We're not out here to impress anyone. We're trading the market live, real time, for our own wealth creation. And what we do feeds into the training business perfectly. So as there are no intraday trades this morning for us, I'm going to walk you through some of the end of day trades that we're taking at the moment. There are 2 setups that we're looking at the moment. The first one is on the liftoff 3.0 trading strategy here at Master the Markets. And that's a very concise trading strategy that looks at moving averages, retracements, mean reversions, very heavily quantified. using a key rule set which is tightly made so that it's non-disputable. We know exactly where we're getting in. And I can give you a live trade that we're actually running at the moment here. We're hovering around the entry point, and that's why I'm calling this market at the moment. So on the dollar Japanese yen at the moment, we are long from the close of this particular bar just here. This bar here has actually given us what we call a confirmation on our smart money indicator. You can see the smart money indicator here is on the screen, and this is a confirmation bar on that. It's also closed above the 200 period moving average as well. We've also seen a key retracement, Fibonacci, more than 38.2%. Now, there are actually a total of 7 rules. Actually, my mistake, there are a total of 8 rules that we look for regarding an entry. I've given you 3 of them. I can't go over all of them, but what I want you to know is that the exact entry that we took on this trade dollar yen was 111.76. You can see the current price is 111.85. We're 9 pips above that entry point. Our stop on this trade was below the low of this buyer bar just here. So this is a buyer bar that's got a low here of 111.85. So our stop 111.83, 11083. So I'm just punching your levels into the chat box as well for you for absolute clarity. So that's the stop loss there. The entry, as I said already, was on the close of this bar. That was 111.76. In fact, it was 111.78, including the spread. And the target currently set is for the last swing high just here, as denoted by the Master of the Markets indicator. There's no dispute on that. So that's where it is just there. It's on the high of this bar at 111. Sorry, it's on the high of this bar at 114.35. 114.35 is the target. So 114.35, I shared the levels there with you. Now, if you would like, this trade will be held over multiple days. If you would like to receive the updates on how we manage this, including how we trail the stop loss, all in real time, and where we take the profit or loss, if any, then we will go ahead and update you in the WhatsApp environment. If you'd like to be a part of those updates, all you need to do is simply shoot us back your number, which is WhatsApp enabled, add us to your phone book, and we will actually go ahead and set you up on that broadcast list. The great thing about that is your details are kept privately because it's a broadcast list, not a group, which is public. And of course, then will be able to exclusively receive those updates. We'll also update you with key trading videos and analysis we're doing. I want to take this opportunity to thank you all for joining in. We look forward to interacting with you on the WhatsApp group. Until the next time, stay disciplined, follow your plan, trade like a master. Have a great day all.
Well, thank you very much, Rishi and Thiru, of course, for that first hour's presentation on their trading strategies. Rishi, if that's all, I'll take back the controls now from you. And
thank you very much, Simon. Wishing you a fantastic day ahead, sir.
Thank you. Yeah, there's lots of numbers coming in on the chat box. Of course, you'll be able to pick them up for the WhatsApp group. They might just keep coming in over the next few minutes. So thank you very much, Rishi Patel, Thiru, Nagappan of Master the
Thank
Market.
you, Simon. Thank you for your time.
Pleasure.
Thank you.
Have a nice day. So I'm going to take back the controls now because we are moving on to our next speaker, our second speaker, or indeed our third. We've heard from 2 speakers already. 9 o'clock, welcome to Round the Clock Trader. If you've just joined us in the last hour, you've been listening to Thiru Nagappan and Rishi Patel from Master the Markets. We have another 11 presentations to come today, so I'm excited to tell you about some of the speakers we've got coming along. We are just in moments away from hearing from George Hallmey, our friend at Click Events. He's going to tell us how to make the Forex markets work for you as opposed to educating brokers' children. And after George, Ed Matz will be joining us from Matrix Trade. He's going to be telling us specifically some ideas on how to trade the UK election, which is coming up. David Paul joining us just after 11 o'clock, highlighting the VectorVest system on the UK and US stock markets, fastest training trading stocks there. That will be a stocks orientated session, not Forex. And then, of course, at 12 o'clock, we plunge back into the Forex markets with Carol Harmer at Charmer Trading Academy, and lots more in the afternoon to come. But I'm pleased to say George is here waiting in the room, so let's go across and unmute his microphone and say good morning, George. It's Simon. How are you?
Good morning, Simon, and good morning, everybody. Great to be with you on this amazingly sunny morning.
Fantastic, isn't it? It's a first taste of summer, and I'm wishing I was up north in Inverness, because I think they're going to be getting 30 degrees up there on Saturday. So there we are. But super to have you back, George. I know you're no stranger to the round the clock trader events. We've always had a great response to your talks here. Have you been busy in the markets of late?
Well, most certainly, yes, indeed. We actually had a good year last year, and in fact, just this week, I've been looking at sort of numbers so far this year, and this year is way in front of where we were this time last year, and we've had a fantastic few months with everything on target. We've got sort of good profitability ratios, and all in all, I think we're benefiting from the volatility that there's been in currency markets, and I don't see that coming to an end anytime soon. You know, one or two frustrations out there, particularly with the stock market, but certainly the currencies and some of the major commodities, of which I trade silver, gold, and oil, particularly oil, and the Canadian dollar, which we're going to be talking about a little today. Yeah, you know, it's been a really good start to the year, using the principles that we're going to be talking about.
Fantastic. Volatility, good for trading. That's always been the answer. I think we have to say a very special good morning to Maverick G, who's got up very early in the US at 3 a.m. So good morning, Maverick. Thank you for being with us. I hope you have a cup of coffee to hand. George, we'll turn over to your screen so that you can get started. I'll put the usual presenter handover, which you should see now.
Right. Okay, let's just click the necessary there. With any luck, you can see Traders Class and my mugshot just over there on the left.
Yes, we can see that. That's great. Okay, so welcome everybody. You're just joining us at Round the Clock Trader. This is the start of our second presentation of the 12 that we're doing live today, and I'm pleased to have George Hallmey from Click Events Traders Class here. So George, I'll hand over to you, and as always, we welcome questions throughout the hour that we have. Okay.
Absolutely. Only two, please. Don't hesitate to challenge me and indeed ask questions going somewhat further. Many thanks for that introduction, Simon. Yeah, I'm going to talk just about two areas. I'm going to talk just a little about how we need to make money for ourselves, as opposed to, and I think, Simon, did you word it that instead of educating our brokers' children? I thought that was an excellent line there.
That's right. I have to credit David Paul with it. It's one that he used in his seminar, so
right.
It's not my original copyright, I'm afraid.
Well, I'll probably remember that one, and I'll mention that it came from David. Yeah, I've been around this business a good many years, and in fact, I was talking to somebody yesterday and said, "Oh, you're a bit of a veteran in this business, aren't you?" I thought, "Oh, yes, okay, well, I guess I am." And I've seen all sorts of things come and go. Way back, there was a book that was called "Where Are All the Customers' Yachts?" And it was a book based on New York brokerages who, collectively were making shed loads of money while their customers were barely breaking even. And that tradition is carried on. It's carried on with so many methods, systems, processes out there to try and make money in the markets. And what we find is that a lot of people in the business are being sucked into what I consider to be unethical, probably not quite the right word, but a method of trading that benefits not necessarily the person doing the trading, but the brokerages and those people who receive kickbacks from the brokerages, of which there are a good many. And I count myself in there at times. I've sort of had the odd kickback. And there was one particular spread betting company who were providing kickbacks and commissions, and these commissions were getting to be rather large. So I just going to throw this in. This particular brokerage, they went bust. They went bust, fortunately. And I went along to a meeting with them, and they said, right, we'll be only too pleased for you to introduce customers to us. And I said, oh, okay, well, what's the deal? And they said, oh, well, we're going to give you a percentage of the spread on every trade that they do. And I said, okay, right, that's fair enough. And it was a modest percentage. It was around about 20–30%, which is pretty typical throughout the industry. They then further went on to say that that's just on regular trades. He said, but if the trade actually loses money, if the client loses money, we will pay you, and wait for it, 30% of the customer's loss. Think about that for a moment, whilst you're supping your coffee and toast. So there were parts of the industry that were actually encouraging their customers to lose money, because not only were the brokerage taking the other side of the trade and making an awful lot of money, but also the people who introduced them to the brokerage were actually were also making a huge amount of money, and they weren't interested if the end customer, actually made money on those trades or not. So always want to be a little bit careful. Whenever you see something that's offering you what you think is a free lunch, and somebody's saying, right, well, join this brokerage, join that brokerage, just remember that there will be, there's a reason for it. Follow the money. There are commissions being paid on the end of it. That's number one. Number two, and this applies more to, well, I say it applies more to stock market trading. It's certainly it's rife in the stock trading business. Brokers and market makers need liquidity, meaning they need lots and lots of people to trade, and consequently, brokers via the market makers, the ECNs, and so on, will provide cash rebates for the number of trades that are being done. So slightly different to what I just mentioned, but it's a similar sort of thing. And consequently, there are a number of companies out there who perfectly legitimately, quite legally, are effectively training people to become liquidity providers. What they do is that they will train people how to scalp low-priced stocks. So they don't need to put up a fantastic amount of money, low-priced stocks, 20 cents or so, 20-cent share price. But what they will do, they'll train them to trade over and over and over and over again, putting in probably, what can be more than 100 trades in a trading session. And yeah, they may well be making a bit of money out of the scalps. But of course, the risk is that it goes against them, a bit of news comes out, and all of a sudden, what was going to be a scalp trade that could produce 10 cents, 20 cents profit, perhaps, if they're really, really lucky, could end up being, 100-cent loss, just like that. And that will wipe out a good many previous trades. So there we are. I just really want to point this out, that it's part of the industry which, it's purely legitimate. It's absolutely fine. But who does it actually benefit? Well, it really benefits people other than us Joe Soaps who are actually putting the trades on. And whilst I do the occasional short-term intraday trade, it is only the occasional one these days. You know, scalpers are not welcome with spread bettors because the spread betting companies find it very, very difficult to hedge those bets. So if you've got somebody who's successfully scalping, and they try to do that with a spread betting platform, what they'll end up getting is all the requotes and fast market and blah blah blah, and you know, you'll find that your executions are very, very, very slow. If you trade at the market, the fills you get will be pretty hopeless. And consequently, it's a world that I've left behind, and now I more or less exclusively, you know, with the odd exception, will trade longer term charts. And overall, since I sort of followed this policy now quite a few years ago, it absolutely transformed my trading, and that's what I'm going to be talking about. So let's just take a little look at this. On my site, on blog there, I've got this article. It's not rocket science, and it very definitely is not rocket science. So there's a little article here that do head on over, take a look at it. In fact, I can probably put this in the chat box if I can work out how that actually works. Anyway, we'll do that in a second. Right, let's just put it in there. Paste that to Simon. I'm going to send it to you, and you can probably send it on. There we go. Right, so quite simply, I'm a detective. I'm looking for evidence to mount that will tell me that a reversal appears to be imminent. And once I've got that reversal that's imminent, I'm going to be watching the market very, very closely. It goes on my watch list, and I'm looking for additional evidence telling me where to get in and then eventually where to get out. So there's nothing clever about it. It's using tools which are generally available. Having said that, I've got a couple that I've adapted that we'll look at in just a moment. But most of it is common sense, and it's looking for trades which are going to be putting in big reversals, such as this one, that then just run and run and run. Right, let's now, I'm just going to switch over now to some charts so that we can look at some examples of this. And I just want to check, can you see this one all right? It's the dollar index. It's the dollar index. So we've got to chart the dollar index up. Are you seeing that all right? Right. Fine. Yeah, you got it there, Simon. That's good. That's good. Excellent. So the dollar has been in the news, and we know that Janet Yellen with the Fed have gradually been increasing interest rates. We've got a tiny increase last year, then we got another little increase of 0.25%, and it is hotly rumored, in fact Goldman Sachs are telling us that there's an 80% probability that we're going to get another 0.25% rate hike, and that's going to happen next month in June. We had the Fed minutes out last night. The Fed minutes suggested that, yeah, things are still on target, and that is likely to happen. So it sounds as if there is some encouragement, certainly from the Fed and Janet Yellen, to try to move away from more QE and move to a normalization of interest rates. Now, if that's going to happen or not, we just don't know. We've got to wait for the next crisis to find out if QE is dead and buried or not. We will rather suspect that it isn't, and the next time the stock market takes a tumble, we may well find that they embark on another round of easing and QE. But let's just look at this chart for a moment. We've got then this dollar index, which has been moving down. It's been moving down this year in anticipation then of Trump saying that he actually wanted a weaker dollar. But during this time then we've had a rate increase, and it's likely that we're going to get another rate increase. Now what you would expect is for a rate increase to actually make this chart go up. It would make the dollar that much more attractive. It hasn't happened. So there's a bit of conflict going on there over in the US, and it's waiting to get resolved. So far Trump has got his way, weaker dollar. But what we may well find is that in this region, where we've got quite a lot of prior price action, where price is getting down to, we might possibly be on for something of a rally that could well run into next month, certainly prior to the rate hike, which is largely priced into the market. And if we look further out on the monthly charts, we can actually see that this dollar has actually moved up quite a long way since the crash that we had, excuse me, back in 2008. Maybe, just maybe, Trump is actually going to get his way, and the dollar index is going to crash to earth. So it's a market that we, as Forex traders, we've got to look at very, very, very closely indeed. So that's the dollar index, and at the moment it's still moving on down. But my little indicator over here, my index, which is based on volume and momentum, is telling me, look at that, over the last including today, 2 days previously, look at this. There is quite a lot of buying coming into the market. While this is red and getting further extended in the red territory, then it tells me that the momentum is on the downside. The majority of the trades are on the sell side, or resulting in price moving lower. We're now starting to get exactly the opposite. So that's suggesting to me that we just might be ready. We just might be ready for some form of a bounce. So there we go. Now, what actually benefits from a weak dollar? Well, it's gold. And gold has run up really quite nicely. And just now, look at this. We've got a really neat little wedge. And once we get price deciding it's going to move up and up and up, the detective in me is saying, right, well, look, we've got a higher low down here. We had a really good buying opportunity there with this blue line, which is a Fibonacci cluster area. We've had price move on up, and we're waiting for this now to be resolved. This could well be a halfway house. It could be a flag. If it breaks to the upside, then we're most likely then to get the previous high there, just under 1300. I think we're 1297, and I guess the price is going to pop up to that level. But there again, exactly the opposite could happen. And if we look back, what are we in today? Thursday, Wednesday, Tuesday, we had price that attempted to break higher, but look at that, it broke lower and it engulfed. And we look, part of the evidence is to look at some of these key candles, and that is a key candle. So that is a bearish candle. We only got temporary follow through on the bear side yesterday. So what am I looking for now? I'm looking for price, and I'll use this red line, to move above the Tuesday high. And that will be highly significant. It will suggest that we're getting a breakout of this wedge pattern, plus that formerly bearish Tuesday candle. If price goes above it, it will completely and utterly negate any of the bearishness from that candle, and the chances are that price will then go for a major run up. Both of my indicators, activity index, are pointing north. The swing trend, as you can see, it just changes color, follows the momentum of the move, and whilst that is green, then great, I'm quite happy to be in this trade and following it higher. So there we are. That's going to benefit from a further weakening dollar. If, though, the big if, we do get a strong rally in the dollar, then the chances are that this could break to the downside. So just putting together a couple of little things there, a bit of basic intermarket analysis, if you like, without getting too carried away, and there we go. Now, I'm going to move over to stock markets for a moment. Now, stock markets seem to be getting increasingly fragile, and you know, we look at the S&P. Look at that, neatly breaking higher again. There we are, looking at longer term, breaking to new highs. We can then look at the Dow, which is doing much the same sort of thing, attempting to break to a new high, hasn't quite managed it yet, but the VIX, the volatility measure, is at an all-time low. Nobody sees any risk in the market at all. There's an expression called the Minsky moment. The Minsky moment. Look it up on Google. And it tells us that when volatility is at an all-time low, when everybody's complacent about a market, that's just the time when we're going to see a major eruption. So it could well happen. And if you listen to my previous couple of talks, I was talking about the presidential cycle in the US and how historically every two-term president has been followed by a president who presided over a recession in his first year in office. Now, Obama was a two-termer, so we've now got Trump in, and Trump is probably going to be remembered for a stock market crash in his first year. There you go. How about that? Now, let's just look at the DAX for a moment. The DAX has been moving up really quite strongly, but just look at this. It's now engulfed bearishly so far today. It had a go at it on Monday. Today, it's done it again. It'll be interesting to see where this one ends up. If we find that it closes below this red line, that's going to be highly significant. And I wouldn't be at all surprised if price is then going to run down to the area picked out by this gap, and we could see a decline of several hundred points. As you can see, the swing trend is just turning today, and the activity index has dropped below zero line. Broad brush approach, when this is above the zero line, we're in an uptrend, and we can see that quite clearly. When it's below the zero line, then we are then dropping into downtrend territory. So there we are, stock market's very, very fragile, not looking at all happy. Now, let's just look at WTI for a moment. Another little bit of intermarket analysis that we tend to throw in. And this, everything I've been talking about is part and parcel of the 20-minute extreme swing trader, but more importantly, this stuff comes up, which I discuss twice a week with my members through Traders Class membership, which actually comes with the 20-minute extreme swing trader. And what we look at are the influences on the market, and of course look at those trades that I'm in, and we're about to probably want to get into. So WTI, US crude, it's been rallying extremely well. So let's now just whiz over and look at the Canadian dollar. All right, out. We've got the USD JPY there. Can't quite. It's bullish move. Anyway, let's come over to the US dollar against the Canadian. Now we've just looked at WTI going up over the last sort of month, and what we find is that the US dollar against the Canadian dollar is actually moving down. So the Canadian dollar is getting stronger while the US dollar is getting weaker. There's been a bit of a double effect because the US dollar overall has been somewhat weak, but this has also been helped by that rally in the oil price. Now, I've just marked up a couple of these moves. In fact, we had a really good run on the upside when it came out of this consolidation area back through March and April. So we picked up 300 plus pips on it. It ran on up, and our indicators told us, with a combination of the swing trend and the activity index, that look, you know, the activity index started to turn red even though price was still going up. It was telling us that the buying had actually slowed right down. Yeah, price did go on higher, but it went higher on very, very, very low volume indeed. And that is a red flag. It's all part of the detective process. Anyway, it then formed a consolidation. We had the right candles here. We've got a bearish engulfing candle, and then over here we've got a shooting star, which means it's got a much, much longer tail or wick or shadow, you might want to call it, in relation to the body. And that was telling us that the chances were very, very, very strong that this was going to collapse. We actually got the breakout just here and have been running it down. Well, as of last night, the trade's up. We've taken half profits, of course, but the trade on the remaining amount is up just over 250 pips. Remains to be seen whether it will bounce back or indeed not. And we're always very cautious because we've got this very good run. And what we don't want to do, we don't want to give back the profits. We don't want to give them back. So consequently, we're very, very tight on our stop control. We never want a profitable trade to become a loss, which is something that happens, you know, to so many traders time and time and time again. And we then start to look at reasons why we might get a bounce. And as you can see, these light blue lines, these are Fibonacci cluster areas, and we've got a projection down from this high that is telling us that just maybe, I'll show you how we do it. It's a process that we just use. We will look at a previous swing and we'll relate it to one that we've had, and lo and behold, we've got an area here suggesting that we've got a fib expansion area. And if we put this on, we can put the grid on, and sure enough, we've got yet another one in that area. Again, it's not rocket science, it's all very straightforward stuff, and we can just start to build up a picture. Also, add to that the fact that price, where it is now, just hovering this 134 region, a round number. Price so often with currencies will respect a round number. And look at that, we've got a correction here which came down to exactly the level that we're at now. And look at this, we've got previous peaks, previous areas that price has found resistance very often will become support. And that's what we're actually finding right now. And if we come down to, say, the 30-minute chart, we can see that we've got just something of what might develop into a strong snapback coming. It's been very reluctant to drop down through that 134 level, and whilst the indicator hasn't changed yet, we've got some suggesting that we just might get something of a bounce coming as we go into what is going to be a long weekend. So there we go. That's the process that that we use. It's there's nothing super whiz bang, super clever about it. What does start is that it highlight area that we really should. Let's just go and wander over to the. We'll take a look at New Zealand dollar. Now, New Zealand dollar. If we just walk back a little way, and it was end of last month, early this month, end of last month. We had a statement coming out of the Reserve Bank of New Zealand, who were telling us that because their milk industry, which is a massive industry for them, was starting to struggle a wee bit, they could really do with a little bit of help. They could do with a weaker New Zealand dollar. That's what they said. Now, they didn't actually do anything about it. They didn't drop interest rates any further or do anything fiscally, and they were talking it down. And we then sort of looked at this and thought, oh, right, okay, well, it's a no-brainer. We always want to follow what a central bank is doing, and consequently, we sold it. And we got a nice little run out of it. And then we started to get a consolidation. Then into the blue box area here, I've just highlighted that. What do we get? Well, we got a further break lower. And we thought, this could be a big move helped along by the New Zealand Central Bank. But what almost immediately happened was that the following day, price recovered somewhat. Little Hallmey candle, very, very useful. And we found that although this went to a new low, the activity index didn't. In fact, the activity index started to diverge. Price then moved up. Anyway, it became a buy just out of the blue box, and we ran it up. Only to find that this week, yesterday, last night, was statements coming out to say that they're doing great. New Zealand economy is doing great. They've actually got a budget surplus. Fancy that. Wouldn't the UK love to have a budget surplus? Wouldn't the US? Well, long gone. I think they didn't they have one in the Reagan years. But you know, the New Zealand economy is going great guns, and consequently, you know, that was why we had the rally. Now that final bit of news came out after the event, and we're now just finding today, this morning, that at these previous highs, typical level for this, price is starting to come off somewhat, and you know, the good news is out. But we saw what was going on here and could just work out in the tea leaves that, yeah, you know, price was not going to collapse down, and recover it did. Now the New Zealand crosses do work very, very well, and what we've got, let's just look at one of these other ones. Now, Pelican's New Zealand, these tend to have quite a large in the day, and they move like crazy. So yeah, you know, intraday traders will be trading stuff like this, but what I prefer to do is to take these long swings, and we had a very, very, very long swing. This trend picked out by the activity index, look at that. It moved up. In fact, we had confirmation there that it was moving up, and there we are above the zero line, and it's remained above the zero line until 4 days ago. So if we work back 1, 2, 3, 4, breakout day. If we look at the weekly chart, we'd actually put one of these Fibonacci bands that picked out not just Fibonacci, but also a pattern predicted level. There was another one higher up, but so far price hasn't broken through there. It's come back. So at an area that we previously identified as being a bit of a problem for price to go higher, what do we find? That we've got 1, 2, 3, 4 attempts to push through there. All of them failed. We've got a trading range. All we needed to do was to wait for the signal, and we got the signal here. If we just look at those candles, look this up, an Hikaki. It's an Hikaki, and an Hikaki is a series of several several candles. Anyway, that's one of the patterns that we look for. 20-minute extreme swing trader, and sure enough, it played out. And what do? We sold it. We sold it. As of last night, it was up a couple of hundred pips. Remains to be seen whether it's going to move on. We've got a long weekend coming, so what do? Take half profits, stop to break even, cannot lose money, can only make money. And that's the sort of trades that we like. Previously, we had this really good run, and it gave us, as you can see, a substantial number of pips. So it's those sorts of trades that we want to take, we want to look for. This doesn't involve us in scalping. It doesn't involve us in trying to hunt out a 20-pip trade. It doesn't involve us in looking at the screens all day long. It doesn't involve us in getting wound up and upset if things don't quite sort of work out. And consequently, it's a lifestyle choice. It's a lifestyle method of trading, which means that we're relaxed. You know, if we don't want to trade, we don't trade. Simple as that. Simple as that. So let's just look at another one that may run for us. We don't know. It's the British pound against the Canadian dollar. Now, we know that the Canadian dollar has been strong, and the British pound, I just wonder, is it going to get more collywobbles as we move into the UK election? You know, will there be sort of corrections along the way? We just don't know. But what we do know is that our detective work has told us, once again, we've got one of these blue lines, that after this really good run up, and just look at, you know, the sorts of pips that this has yielded, then it's rolling over. Well, yeah, you know, we've sold it, and uptrend has given way to downtrend. It's got the potential to move quite a long way. We don't know if it's going to run right the way on down here, or it might, as we can see today, it's starting to push back somewhat. What have we done? Taken half profit, stopped to break even, and, you know, we're comfortable. We've got positions on that cannot lose money. And that's the situation we like to be in. Now, let's just go a little further with the detective analysis. We do a bit of channel work also. Channels are brilliant. So we identified the channel. We looked at the depth of it, look out of the channel, and we did something so simple. We took another line, which was the depth of the previous channel. Now, the previous channel is not actually shown there, but that was the depth of the channel. And where did we think the price would go? Well, we thought that on the break of it, it would go to there, where the red line is, and then the blue line is. And that's exactly where it went. Again, no rocket science, common sense, just looking at it, being cool, calm, and collected, and not needing to look intraday. So there we go. The activity index is now down below the zero line. The swing trend is pointing down. There are two main trend and momentum indicators are telling us that, yeah, there's a pretty damn fair chance that this is going to go considerably lower. Right. So there we go. That's that particular one. You can do Scalp using these principles. Absolutely, you can. And this is not a proper scalp. We're just going to look at a 4-hour chart at the moment. But we have here how against the Swiss, it's moved up in a whole series of values. Now we don't really slavishly follow Elliott wave, but we're just aware of it. And one of the rules is that if you've got a new high, okay. And this will apply with most of your oscillators, CCI, RSI, and so on. If you've got a new high, look to see what the oscillator is doing. If the oscillator doesn't also go to a new high, the chances are that you're going to then get a reversal. And if you can just see a whole series of prior waves, that previous peaks did actually have higher highs, then there's a pretty good chance that this one is going to roll over. And it did. As you can see, it's rolled over quite nicely. Switch to the 4-hour chart, And over here on the left-hand side, what do we find? We find that there's a top forming. Shooting star candle, a bullish engulfing that went nowhere, and so we thought, if price drops below the low of that bullish engulfing, it becomes a sell. Sure enough, we then get a bearish engulfing that did just that. The activity index by now is pointing down, and then on the 4-hour chart, this one's got itself well and truly established over here as the activity index dropped below the 0 line, and look at that. It's been below the 0 line right the way down to here, and 372 pips later, thank you very much. And what do? Take the profits. Very relaxed trading. So there we go. You know, that's the sort of process that we adopt and like to trade, and that's all contained within the 20-minute extreme swing trader, which I'm just going to mention a little about that. Time's sort of creeping on, but I just want to mention an offer that we've got. If I can pick this one out. So that's where we came in to look at this. It's not rocket science, and click on website. Is that everything that I've talked about comes through on the twice weekly, sometimes 3 times, twice weekly videos that I produce. Not too dissimilar to what we've just been looking at, but we do get quite specific on what it is that we're trading. And by joining up here, it's a deal. If you to just join up, it's either 157 quid for 6 months, 97 for 3 months, but then you get discounts on our products, of which the 20-minute extreme swing trader is. It's regularly 279 quid, but if you're a member, you know, obviously having paid, then yeah, you should get a discount, shouldn't you? Well, you get £100 off. It ends up being, you know, just 179 quid. So there we are. That's one of the offers that we've got, and move to the 20-minute trader itself. There we are. It's just over at Click Events, Extreme Swing Trader. Follow the links. And what this does, it gives you what we've been looking at today. It gives you the 20-minute Extreme Swing Trader process. It gives you the 2 proprietary indicators that we've developed, and also gives you 3 full months of Traders Class membership. Comes out at $279, and the further part of the offer is that you only pay half that now up front. If you don't like it, if it's not going to work for you, what do? Just say, look, didn't quite work for me, I'm going to send it back. Just send it back, instant refund. But if you stick around, you like it, then the balance is paid over the next, well, just over a couple of months, and as a result of this, then, you know, hopefully it's going to turn you into a trader who's got a much more relaxed outlook on life, and so that you don't have to spend your time in front of screens looking for every little twist and turn, every little 20 pip move, which, you know, you might get a couple of nice little 20 pip moves and then think, oh, hey ho, damn it, I've just taken a 70 pip loss. So we don't want to get involved in that. What we do want to do is to have a relaxed life and get the markets working for us. Get the markets working for us. And what I tend to do is that I go off sailing every now and again. What do? Oh yeah, got the laptop with me, and yeah, finish a day's sailing. You look up, see what the markets are doing, alter a few orders, and probably take a few profits here and there. Might enter a new trade, and then look at it the following day. But definitely not intraday. Right, okay folks, well look, I've come more or less to an end of what I wanted to talk about. Don't hesitate to get in touch with me. Be only too pleased to answer any of the questions you've got. let me just put in the standard email for me, which is support@clickevents.co.uk. And again, Simon, I'll send it to you if you can send this on. There we go.
Great, George. I've got that. Yeah, I've also put these links that you brought up there before for the traders class and the
that's great.
Big Trader. So these links are all in the chat box, guys, and there are a few questions sitting on the chat. We can go back to these. John was asking, how does your activity chart correlate with the parabolic support and resistance indicator?
The parabolic, right on here, parabolic SAR is one of the problems with the parabolic. Let's see if I can bring it in for a moment. The where are we? The PSAR. Let's plonk it on. One of the problems is that when you actually enter a trade, then yes, you've got to have reasonably wide stops, but it does give you a very, very wide stop indeed. But yeah, there are similarities to it. And on this particular move, it would have picked that out sort of reasonably well. So it's something of a proxy for it. This is based on the ATR, and so is PSAR to some extent, in that when we've got greater volatility, then we find that this is moving away from price somewhat. When price is somewhat tighter, as we can see here, then it comes a little bit closer to it. But yeah, correctly identified, there's not a million miles difference in it. You can also use things like short-term moving averages, an exponential moving average, and so many of things. There are so many things that you can use that I've actually boiled this down to just as few as possible. But good question. Good question.
Well, George, question from Steve quickly, save me typing. The swing trading package is 379, and is that monthly, quarter, or annum, or is it actually lifetime?
It's lifetime. So when you buy, you've got it, and the indicators last a lifetime. And so, it's you can actually get it right now for £209. So there you go, and the deal is half that now, and then the balance 69.75 in 33 days time and 66 days after that. But of course, people can take a look at this, see what you think of it, and if you feel that it's going to be of benefit in your trading, you keep it. If you don't, you say, thank you very much, had a look at it, it's not for me. But the number of people who do use it and don't actually return it, in fact, of all of the products we've ever done, we have fewer returns on this than any other product we've ever done. Why is that? It works.
Good to know. Paul says, hi George, I'm hopeless on the computer. Can I get help from your side? Old dog, new tricks and all that. How would Paul get in touch with you? Probably use the email address that's support@clickevents.co.uk.
That's step one. Now, what we do is that we sort of provide the service, not too different to what we're doing right now. We can actually, and we feed into your machine needs to be set up. And we've done that with clients who, for whatever reason, are not entirely comfortable about things on computers and this particular program. And what we can do is delve in there and just make sure everything is set up correctly. And we also do offer anyone who's bought the package, in addition to our regular 2 to 3 presentations a week, then we can do a personal session, 20 minutes, half an hour or so, to make sure that you're comfortable with everything that it's supposed to be doing, and to answer your questions. And that also works very, very well indeed. So,
okay,
yeah, no problem at all.
We've had a few patchy, sort of scratchy times with the audio, and I think we all missed a few things just over the last sort of 3 or 4 minutes. David was saying, could you go back and just comment again on using the intraday system?
Oh right, yes.
Swing trading.
Yeah, quite okay. Now this is the chart. Now for intraday trading, we combine it with the daily. So if we've identified a trend which is very, very mature and looking as if it's going to go sour on us, then we'll use that as an intraday opportunity. Now this just happens to be a 4-hour chart, which will give us a run over several days that we can quite often, if we've got the luxury of being able to, or even wanting to look intraday, then we can do so. And up over here on the top left, we saw what was going on. We saw that the of the indicators, we've got the swing trend rolling over, becoming red. We've got the activity index doing exactly the same, which is telling us that the previous up move is very suspect and we could move into a downtrend. Then when it goes below the 0 line and it's broken out of here, we've got the confirmation, we put the trade on. Now equally, if we wanted to come down and trade this on a 15-minute chart, we could, and as we can see, there's a fair bit of noise here, of course, and we've got to be that much lighter on our feet. Okay, over here we get a signal. We've got a signal. We're going to take the long, and it comes to an end here. And how many pips are we going to be taking out of that? Well, obviously it's all pro rata. We're going to be getting in there. We're going to be getting out approximately here, and we're going to be taking a very modest number of pips on those small time frames. That's why we like the longer time frames. And I certainly commend to you the 4-hour chart, which, you're not scalping, you're not going to jump in and out, but we get from the 4-hour chart, we do get these trends that last quite often several days. And again, it's fitting the ethos, the philosophy of relaxed trading. We do not, once we've got a trade on, stop to break even, we can just leave it to get on with it. Hope that helps.
Thank you. Yeah, I think that probably, David, is that it just says, I know you don't use the shorter time frame, but do some of your users use that particular system on a shorter time frame than you do?
Yes, they do. Absolutely. Yeah, it works on any time frame.
Okay, Gary's saying, George, how many charts are you looking at typically to see these trade opportunities?
Oh right, okay. I look at let me see. Let me just show you what I will look at these main British pound. I'm looking at a round chart. I've got another little set of crosses there. Of these, I probably only need a couple of. We've got a whole load more. To look at these and the major commodities. So I've got a roundabout getting on for with about 27 charts that I'm looking at on a regular basis, and it really boils down to if I just looked at 8, that would be this little lot, and the previous ones, the majors, and that would be as I want to look at. Hope that helps.
Yeah, sorry, could you just repeat that again, George? So we just keep losing you on the sound coming and going. So could you just go over that again?
Okay. Right, I look at 27 charts, and I do that every day, but I tend to make most of my money from the ones that we can see now. There are 8 of these: Euro, US dollar Jappy, US dollar Swiss, Cable, Euro GBP, Canadian dollar US dollar, Australian US dollar, and Euro against the yen. And the main indices in gold as well. So I've got another rate here. So I could just boil it down to 16 charts, and that would be as many as I would really need to look at on a regular basis.
Okay.
Did you hear that?
Yeah, I think we got there. Sorry, it's just the technology is it just seems to be coming and going a bit. Just must be the signal. So, but I think we got it. Thank you for that. Okay, does anybody have any other questions for George? We've got about another few minutes before our next speaker will be checking in. Okay, what about using MT4?
Yeah. Now, MT4, when MT4 sort of first came on the scene, I hated it because I had TradeStation charts, the best in the business. Well, I still do have TradeStation charts for other things, but MT4, I've actually learned to love it. It's a brilliant program, and it's free. It's free. It's generally available. If you do want to get loads and loads of indicators, you can, and it's so simple to use. Plus, it's fast. It is fast. Compared to my TradeStation charts, which last night, for instance, when the minutes came through, the Fed minutes came through, I was finding that MT4 was updating more rapidly than TradeStation was. So there you go. I love it.
Fantastic. So interesting comments on the US markets. You think we might be heading for a correction in the US at some point this year?
I do. I do. Absolutely do. Yeah.
Fantastic. Well, George, thank you very much indeed. That brings us up to 9:57. Just a few minutes before our next speaker. Oh, one last question. I like TradeStation and MT4, but he finds the Ninja platform too hard. Would you agree with that? You've had experience with these platforms?
Yeah, the Ninja, I have had Ninja, but I don't have it anymore. I just found it not suitably flexible. And with my whole process of trying to make my trading simple and hassle-free, then I'm doing pretty well everything now on MT4. And whilst TradeStation, very sophisticated program, and it's quite useful for all sorts of other things, and sort of programming indicators and so on is in some ways a little bit easier. But I just like the simplicity of MT4, and that's my trading, simple.
So the sell in May and go away phrase could still apply. Yat Shah commenting on that. Would you agree with that?
Yeah, I think so. I think so. But I've been calling a correction for quite some while, and there comes a time when you start to think that, well, is it really different this time? That wonderful market expression. It's different this time. Well, it isn't different this time. We're finding that what is actually keeping stock markets up is government buying. It's the US plunge protection scheme. It's it's the Swiss central bank who own more Apple shares than any other single shareholder. There is concerted action throughout the Western world of central banks of making sure that stock markets do not plunge, and at some point they will. And I wouldn't be at all surprised if dear old President Trump is going to be the scapegoat for a mother and a father of a correction. Anyway,
Wow.
that's the way I see it.
Well, you heard it here first. George Hallmey, Click Events, thank you again for joining us. It's always good to have you on, and I can see by the reaction on the message boards that everybody also enjoys your presentation. So it's been good to have you. Thank you for giving us the time this morning. And obviously, we'll follow up again with all these links to your website in the emails that we will be sending out tomorrow. So, George, thank you very much. I'm going to take the presenter role back from you now.
That's great. Thanks a lot, Simon. All the best.
Take
Bye
care.
now.
Okay. Thank you. There we go. So thank you, and welcome to those joining us. I can see a lot of new faces appearing in the last hour. Welcome to Round the Clock Trader. Simon Campbell here, and we've had 2 sessions already of our 12 sessions that we have going on live throughout today. So I hope you can stay with us as long as you can. Our next speaker is already in the room, Ed Matz from matrixtrade.com. Ed has spoken briefly before on the event. I wasn't able to give him enough time, so he's come back again this month, which is great. But he's going to talk to us about something which is impending very soon, the UK general election, and give us some insight into trading that big event that's coming up in just a couple of weeks. So I'll take the microphone off and say good morning, Ed. I think you should be able to hear me, and we should be able to hear you now.
Loud and clear, Simon. Can everyone hear me? Put your hand up if you can't.
Fantastic. Put your hand up and click the yes button at the same time so that we can see. Great. Yes.
How many people did that in the Brexit vote? Yes. I'll put my hand up and say no, I did.
Now, Ed, thank you for coming back to join us. As I was saying to everybody here in the webinar, you came on and sort of popped your head in last month or maybe the month before, but it was a very brief session. I wasn't able to give you proper time, but so I'm glad that you've been able to come back and speak to us. And I know you came down to our live show at the beginning of the month in London, and I hope that went well for you. But
no, it was very enjoyable. I was actually, Simon, I would say I was very impressed by the audience. They were animated and very interested and asked lots of interesting questions and some challenging questions. And it's always good to be challenged when you're a trader or analyst and you sit there too often complacent about your own view of what the market's doing. The market's always challenge us, so we need to be aware they're going to do that, but also be flexible and not be stuck in a rut. And I think there's a real danger that a lot of people have been stuck in a rut. I just caught the end of the last speaker about people being complacent about this is a bubble that's going to burst, and I've been of that view for the last 7 years. And it's approaching, which is going to frame actually what I wanted to talk to everyone about today, which is the UK election. But as we well know, it's a very small world, and anything that happens in any one country is not an isolated event. So whenever one looks at a UK event like the general election, many say foregone conclusion, then you have to put it in the parameters of what's happening in the world, not just from a macroeconomic point of view, but from a flow. And it's at the end of the day, markets move because people are chasing a buck. They're looking for a return, and therefore the question that everyone will ask about the UK is, will it represent a sound return through Brexit longer term? And the answer is, well, hang on, there's the US and Donald Trump round the corner. So anyway, that kind of heads up. I might as well finish now because that basically sums up what I'm going to talk about today.
That's it. We can have a break now.
Yeah, Simon, as you well know, as an ex-politician, I just love to talk, and you have to shove something in my mouth to stop me. So.
I was going to say, does your history as a politician, does that give you sort of special insight into what things might be affecting the markets?
Two answers to that. Absolutely yes. I have the privilege and honour of pretty much knowing every member of the cabinet, past and future, Tory obviously, sorry, any apologies to any Jeremy Corbyn fans out there, but also no, because I'm a failed politician, which as my wife will tell me and everyone else is a blessing not in disguise, but a blessing, because I have two passions in life. One is politics, and done that, failed that. And the second one is markets. From the very early age when my mother introduced me, my mother actually was a bookkeeper to a Jewish financier. So from a very early age, me and my brother were immersed in markets, stock markets and stuff like that. So it's in my blood. But it's my passion. Anyone who knows me knows that I'm addicted to markets and what moves markets. So the combination for me of how to trade the UK election, given that I have some degree of political experience, and also that I came out of Oxford with an economics degree, or PPE in fact, majoring in economics and politics, that I have the background not just suited to this type of event, but one that enthralls me, because there's lots of issues going on. Anyway, let me Simon, talk to me as I go along, because I'm likely to bore the tears out of people otherwise.
Well, okay. First of all, we're going to share your screen, so you should have a button to press now confirming you as the presenter. That's super. Now you need to swap that slideshow so that we can see the full slide.
How do I do that?
If you go up to the top display settings, right at the top at the left in the middle, there we are, and say swap presenter. That's it. Press that one there. That's it. Fantastic. So okay. Now we can all see your slides and we can all hear. So we'll hand over to you, Edmat's Matrix student. I will be here though to interject with questions.
Button and just give me a shout. Shout every 15 minutes. 15 minutes gone. Otherwise, we'll be here until tomorrow, and that'll be very rude for the people.
Yeah, I will do. Okay.
Yeah, thanks, Simon, a lot, and welcome and good morning, everyone. How to trade the UK election? Notice how it's slightly slanted to the left. There's nothing about the UK election that's slanted to the left. Just a brief summary of what and who I am and what we are, Matrix Trade. Essentially a macro trading and advisory service on foreign exchange, stock markets, and commodities. I started off life out of university, went straight into a foreign exchange dealing room, and soon learned that there's no good being right in the wrong market, that my economics would pretty much not help me make money. It might help me understand what's going on, but wouldn't help me trade it. And through that experience working at Citibank and through various investment banks, went into my own business with two other guys. Effectively, since then, moving to a position where now at Matrix Trade we focus on evidence-based research. And by evidence-based research, that's analysis of what the markets are doing, what we believe they're doing at least, but also evidence-based trading. How do you therefore translate that into a trade? Because one thing, as an aside, one thing I'd ask you to bear in mind, any takeaway from my talk today is a view is not a trade. You can have a great view, but not be able to trade it because the risk-return parameters, the risk management issues, and in fact the how you frame the trade just doesn't work. So what we try to do is we take that analysis and we try to quantify that into a trade, into forecasts and in fact trades. So let's go step back and say what really moves markets. It's interesting, on the weekend I had the pleasure of being on a panel that was ostensibly about the UK election, and the very first, and it seemed like the only question is how do you trade an event like the UK election? Should you look at the fundamentals, the politics, what's really going on, or should you just stare at your screen, base it on price action and technical analysis? And again, interestingly, I think pretty much at least 3/4 of the people on the panel answered, forget everything else, just look at your chart, Shag. Which reminds me of a phrase. I went out for a beer once with some guys at Old Goldman, and I was a technical. Once I threw away the economics and started focusing on what I thought would help me make money was technical analysis. I developed a bit of a name as one of the pioneers, in fact, of Elliott Wave, certainly in the London Forex market. But just generally a pioneer of technical analysis of foreign exchange. So I was known as that. So I went for a beer with some guys from Goldman, and I remember this very well because they said, or in fact one particular person, Simon, said, Ed, put your charts away. It's about the weight of money. money talks. In other words, you can have a chart, you can have a view, but if someone comes in with a wedge and buys against your selling point, you're going to struggle. The reason I mention that because pretty much the very next day I had a sell signal on dollar yen. So I went when I was about to sell it, and then Goldman came in and by literally it was about $800 million yen. So I thought, well, my sales signal's wrong, and lo and behold, it did go up by 20 points, but the next day it was 150 points lower. So it's what really moves markets. It's a combination of different things. It is the fundamentals. I mean, talking particularly about the fundamentals today, or if you like, the UK election, which is what I'm talking about today, what is really going on. And there's, if you like, there's two underlying themes. One is, and the obvious and the headline theme is Brexit. And the second one is the machinations and the political result from the election that will have an effect on what we do in Brexit. In a nutshell, well, I'm going to assume or presume or whatever that the Tories are going to win. I can't foresee, and I don't think anyone else can foresee of any other result. The issue essentially, as Theresa May says, is a hard but smooth Brexit. In order to do that, she's called the general election early. Several reasons why she's done that. One is so that she can pursue her own agenda, have her own mandate rather than David Cameron's mandate or George Osborne's. There's a few things in the budget that she took great exception to. As an aside, on a personal level, which is why George Osborne's not there anymore. But she's now in a position, provided she wins, to pursue her own agenda, which is, sadly, I would say, not Singapore on Thames, not a free market, low regulation, low tax economy that I would love to see Brexit as an opportunity to provide. The UK could be something quite special, use Brexit to its real advantage, but rather shifting the Tory party centre ground and squeeze what is a pretty dilapidated, poor showing of a Labour Party at the moment out. So when they come back through Miliband or whoever, they're going to find it very hard to recapture the centre ground, and therefore to differentiate, they'll be back on the left. I hope I'm not boring anyone with this, but that's what this election is about. Enables her to pursue her own agenda. Now, when that comes to Brexit, this is the crunch. When it comes to Brexit, in order to pursue a hard but smooth Brexit, which really, you know, bells and whistles, forgetting about passporting, which is an issue that no one really is talking about, which is massive. Massive for the likes of you and I, and how that knocks on for the banking industry and a lot of my customers. It is essentially about where this country can position itself. In other words, are we going to be in the single market, or are we going to find some compromise, or, you know, that allows us to be in the single market, buy our way in, or be out of it? And what the result of the general election will achieve, if she clears, which I think it's going to be close, if she clears 100 majority, that will enable her not to listen either to the Remainers, the Ken Clarks on the left wing of the party, or the likes of the David Davises and Boris Johnsons on the right, who are pretty much hard Brexit. It will allow her to steer her own course, and therefore, more importantly, if she gets the majority of over 100, she will not just be sending a signal to the newly elected candidates within the Tory party that she is control and it is her Brexit, but she'll be sending a signal to Europe. And when it comes to negotiating, and it's going to be a very long, drawn-out, difficult negotiation process, they will take note that she has a mandate. Just think, if she hadn't called the election, then she would be negotiating up to within a year of the actual Brexit itself, and therefore be mindful, and the European politicians, and there are a few, I'm not going to say any rude words, members of the European Union political bureaucratic organisation who would seek to take advantage of that. With a clear mandate, she can say, no, you need us just as much as we need you, and therefore these are the terms we think we should agree on and can agree on for the benefit of all. So the best result for everyone is for Theresa May to win by a majority of 100. And the first thing you'll see, if she does, is you'll see one or two of the three clear, you know, the David Davises, the Boris Johnsons, they'll be out of the cabinet. So that's the fundamental framework that, you know, that will, if If she wins a strong majority of over 100 or thereabouts, we'll get an aggressive sterling spike, and we'll get FTSE up higher as well on the back. UK assets will like that because it shows a strong, effective government, which essentially is what this election is about. How that affects other markets, or how it will be affected by other markets, the other strain, we look at four things at Matrix, what we call fits analysis: the fundamentals, the intermarket relationships, in other words, gilts. Gilts will love the same result. It'll be a UK plus day if we clear a 100-seat majority. If it's anything less, let's say it's around 50, then she'll be like buffeted by the wind of politics. She'll have to compromise left, not just left and right, but also in Europe, which will make the whole process very uncertain, and markets hate uncertainty. The third aspect of the fits analysis is the technicals, and how analysis is essentially a geographical representation of, if you like, of the golden weight of money, of supply and demand, and therefore gives us an indication based on what markets typically do in the technical formations as to what they might do in the future. Now that's an important premise. What markets do now is nothing new, even if though the details may change. Our technical formations, and we follow them for a simple reason, is that they've worked in the past. And the reason they work is sentiment. It's you and I making decisions based on fear, greed, or otherwise complacency, and therefore we will make decisions based on that sentiment. And that is just, at the end of the day, it is the Goldman's way to money. It's what actually moves markets. So how do we frame that? I might just very quickly give you an idea, because it's all very well talking about evidence-based analysis, but we take the view, our analysis, and we apply it to a trade. And there it is, a view is not a trade, trying to identify the right risk-return parameters. I'm mentioning all this because it will frame how we are and will trade the UK election, and the reliability of that approach, the reliability of the formation. And if you take something like the Eurodollar or DAX, they hate head and shoulders. 73% of head and shoulders in those markets fail. And yet, if you take a market like a dollar yen, when it's in trend, it only corrects 23.6%, whereas stable will correct something anywhere from like 75 to 95%, which is, you know, anyone who trades cable will know that is the case. And therefore, once we have our risk return parameters and we know the probability, the likelihood of success of that trade, that will help determine how much we put on it. And therefore, and thereafter, the discipline that we apply in maintaining that trading strategy, and the 3 Ds of discipline are discipline, making sure that emotion or surprise events don't actually steer you away from your own strategy unless they impact that strategy, impact the underlying edge. And lastly is the edge, not just from the analysis, but also the trading. In other words, learn from the lessons mistakes we've made previously. Evidence-based trading. So essentially, just a quick run through. I would suggest, because I don't want to take up too much time talking about this, anyone who's interested, I would actually, this is an old PowerPoint which shows us there is a free trial. It's just been applied now actually for a 3 weeks trial of Matrix Trade. Where we get our trades from, based on, I'll show you the analysis, some of the trades we've got on now for the UK election and going forward, is based on the simple metric. It's the risk return parameters. So multiply the probability of success of that trade, not the success or the probability of a market going up or down, but the probability of that trade. And by multiplying that, we get a payout, which we multiply by 10. If it's over 15, for us, it's a trade. If it's below 15, say 10 to 15, it could be a trade. I do a lot of those trades myself, but we don't signal them. We do signal our trades. And if it's below 10, it's a no-go. In other words, the view is not a trade. Just to give you a quick example, running through 3 to 1 times 70% probability of trade success, that's a good trade. 2 to 1 with only a 65% probability is to drop below 15. A lot of people will take that trade. I actually may well take that trade, but I won't signal it. And let's say it's a 2 to 1 with only a 40% probability. You see a lot of those trades. no aspersions intended, but you see it a lot in the retail market, particularly amongst new traders. Your question is how you identify the probability. Well, one way you identify probability is through history, not just history of the markets doing that, but also the history of that trade succeeding in that type of market. So we use evidence-based trades. Funny is, essentially, it's a quantitative approach to qualitative analysis. I've been doing this for over 25 years, and why am I still doing it? Because I just simply love it. I'm very, very passionate about markets. It's used to, I think it's Paul Tudor Jones who described trading, and certainly macro trading, as three-dimensional chess. Every day it's a puzzle. Every day it's a new puzzle. And with the complexity of the current market, I strongly believe we're in the final leg of the dollar downtrend. We're in the final leg of the stock market uptrend. And at that point, the correlations break and the intermarket relations break down significantly and increasingly. And anyone who's tried trading correlations of late will know that is definitely the case. And because of that, it's actually much harder to use one market as an approach to another, and it essentially becomes an increasingly difficult puzzle unless you understand that those correlations breaking down actually means nothing, and that it's actually all part of the same story, that we're entering the last stages of the third largest bubble in stock market history, certainly in the US, and therefore that has implications for the US dollar. Moving on. Oh, finally, deep breath. We finally got back to the UK election. So I've given you the background, what I think is at stake in the UK elections and how the markets will react from a fundamental point of view. Now, you will find many people will be arguing the dollar's turn, sterling is a major uptrend. The UK election, this is a major buying opportunity. Brexit is going to allow Brexit to help this go through smoothly, and uncertainty will be fall, and sterling will be going up in a massive return to the uptrend, up to much higher levels. You'll also find, by the same token, you'll find people talking about sterling being in a downtrend because of Brexit, and that Brexit implies has, and since June the 23rd, has implied a downtrend, that once the UK election is over, that sterling will be able to rejoin its downtrend and go all the way down to the 103.50 low. I can give you countless reasons why both of those might be right or wrong, and the simple answer to the question is, well, where's the evidence? When anyone presents you with a view of a market, as you would do in life, I'm sure many people here listening in today don't trade full-time, they're part-time, and they probably lead very successful careers elsewhere. And one thing they will do is any decision, major decision they make when they put money on the line, is they evidence it. They do their homework. And therefore, it's based on that evidence that they then take a decision. Why are markets any different? Why is it when you trade a formation, say in dollar sterling, a head and shoulders or whatever, or you think it's a trend and you're looking for a minimum 23.6% pullback, why is it you or someone else who's provided you with that view or trade hasn't actually done the research or the evidence, provides the evidence for what sterling normally does? And going back to the UK elections begs the big question, well, what do UK markets normally do during the UK election? Well, let's start with what sterling normally does on June 8th. Can everyone see that? I can't, obviously you can't shout, I can't see that. That's the case. Simon, can you see that?
Yes, we can see it fine, thanks. Great.
Okay, now what you can see from the chart in front of us is what sterling has done on average through general elections. I don't know if I can see this. Just to show you, the red line is what sterling does. This is 100 days before the election, and you can see with the prospect where there's a possibility of a Labour win, sterling declines and then recovers into the election. This is where we are now. On average, because of obviously there have been quite a few Labour governments, has had an impact on dragging it lower before it rallies into the election. And as we well know, it has rallied into election. But obviously the most interesting one, the one we're really interested in, is what happens when the Conservatives win. And we have showing that the light blue line is what happens when the Conservatives win, but also when the dark blue line, you notice is higher and more bullish, is what happens when there's a significant Conservative majority. And essentially, it's followed the Conservative victory. Well, there's no surprise there, but it's also followed a strong Conservative majorities. From the moment Theresa May announced the election, it's followed this average, the average of Conservative strong majority wins. And you can see that it started consolidating exactly in the same place. So it begs the question, what happens afterwards? And as you can see, the Labour actually sees it recover, albeit slowly. But going into the what we're really interested in, what cable tends to do historically on UK elections when there is a strong Conservative majority, and you can see that it consolidates, comes off into, because market nervousness, and then spikes into the election before it comes down. So there we are. We have the Conservative typical average, the average of Conservative majorities, what this means for cable, and obviously where this is above 130, just above 130, and sells off into the election and rallies again. So essentially what we're looking at is one final spike, a buy the rumor, sell the fact spike. And typically I would frame that. The mantra I use is not buy the rumor, sell the fact, but buy the rumor, buy the fact, up, sell. In other words, you get the reaction, a bit like the French election. First reaction is it's marked up higher, people come in and buy it again, the market moves even higher again, and then you get sell the fact. It's delayed. And essentially what it says is for the week, or I think probably longer in this case, and I'll show you the reasons why, it will come all the way back down. So going into elections based on this alone says that we trade a range into the market, so beggars belief why people are looking for sustained trend before the election itself. But we trade the range, and what is that range? I'll show you in a minute. Looking for that final spike on the election in order to sell for the break back down. Pure and simple. One of the reasons why I'm looking at this particular formation is we go back through, you know, okay, we're trading an election and we're trading cable on the election. What has it done historically? And we'll look at each, not just the averages, because the averages contain, obviously by definition, contain a whole host of possibly very different elections with different impacts on the market. Well, the one it resembles the most, it's actually one I stood in, Oxford West, the Oxford University seat, Oxford Western Abingdon, was the run-up into the election was, if we look at the period 98-2002, this was the election itself in June. It sold off before the election quite aggressively and then rallied thereafter. What we appear to be doing, and I think this is explained by the uncertainty surrounding Brexit and therefore how Theresa May will position her party and the government and this country on Brexit after the election, we'll actually see some uncertainty until that's clear. So what this is an old chart, apologies for that. What it's basically saying is this is a correction that from we now know from the 120, 127 range, it will spike up into the previous consolidation phase. Let me just see if I can zoom into Simon, you there?
Yes, we're here.
Just seeing if you can see the this chart. This is I always get asked this question whenever I put any of my charts up. What's this trading platform? And it's a Reuters icon. I've been lucky enough to be provided with an icon for many years, so I have no reason not to use it. That's part of our long.
Yeah, we just got a comment from Richard. He says, this time through complications of Brexit negotiations making cable a lot more volatile. After the elections, perhaps better to stay away from the GBP pairs. I think that concurs with what you're saying.
No, not at all. I'm saying that it's a trading opportunity. That sterling is. It goes back to the panel I was on the weekend that. When it's uncertain, you know, the actual real world's uncertain, then you shouldn't trade it because it could impact. And what I'm saying is that the real world events, developments for elections are quite typical, and that people are confronted with the same obviously very different questions in detail, but essentially they're the same. In other words, we need the election out of the way to get the result, particularly, but if it's a well-known result, then we also need to know what that confirmation of the result before we can get on with our real lives, if you like, but what the market is going to do. And that shows over history that sterling does a similar type of thing, particularly with a conservative majority into the election. As soon as the election is announced, remember we've only had one fixed term announcement, if you like, but all the previous elections have been announced by the Prime Minister of the day, and all of those have had an impact, particularly for a likely conservative majority, of rallying on the announcement and then consolidating into the election, spiking higher and then coming off. And if you look at this in terms of the, it's quite similar, in fact, to the Brexit run-in, very similar, in fact, short-term price action just before Brexit at the moment. So it's saying that cable is setting up a top. Just to give you the context of just a couple of things if you want to look at, we look at interest rates differentials, and there's time lags on that. Cable is actually 47 days behind its 3-month forward, which is kind of weird and wonderful. We also look at volatility, saying that we got a spike up and then down, which is consistent with the view of a new low. Where are we coming from longer term? It's very similar price action. This is a chart of the last 30 years of cable. And we're doing something very similar to the period from 1991 into 2001. And this is, if you recall the chart saying we were looking at a very similar election, it is this yellow circle. If you look at this decline, it's a 3-legged decline. Consolidation breaks down aggressively, consolidation breaks down aggressively, then forms a slow bottom, head and shoulders. You can a rounded bottom below the previous low, as we are now, below the Brexit low, and then breaks up. What it's essentially saying is this election will provide us with the buying or the sell-off after, to provide us with a buying opportunity, potentially of a lifetime, but certainly potentially of a generation, and potentially for the next 1 to 3 to 5 years. So when Simon asked the question, we should stay away. No, not at all. It means in the shorter term there are selling opportunities, but it also means that we're unlikely to break this 103.50 low here. Let's put it down there. This is the all-time low on cable. And that any sell-off to new lows is a buy against the low. Well, that's going to be about 13%. So I don't know how big your pockets are, but obviously we need to fine-tune that. Again, that's a trade. I'm not going to buy cable at, say, 116 and with a 103 stop because it doesn't make sense. But we will look to time and fine-tune this period through the Brexit uncertainty. Coming out of Brexit is good news for sterling, which is good news for us. As UK, I'm sure there are many listeners from outside, but certainly from a UK perspective, it's positive news. So going back to the shorter term, what this actually implies for cable, going back, is this is quite similar to a much slower version of the pre-Brexit. The UK election is doing a slower version of Brexit. Now, what is interesting, and one thing I think is very interesting, is that people are still in a mode where strong hard Brexit news is a sterling sell, because from June the 23rd, when there is an indication of Brexit, cable went lower, and when there was any doubts about Brexit, when people started talking about another referendum or it was unclear what was going to happen, sterling rallied. In other words, uncertainty that Brexit represents actually was strong, stable for sterling, and greater Brexit uncertainty was bearish. Since Theresa May made her speech in January, I think it was January, sterling changed that mode. Whenever there's hard Brexit news, in other words, greater certainty about us leaving the UK, leaving the European Union, that has essentially been good for the pound. And that, for us, was one of the preconditions of our view that sterling is close to, but not necessarily at, a major bottom. In other words, going back to that point about in the final legs, the correlations break down. The correlation of harder Brexit being bearish for sterling has inverted, has broken down. The correlation now is stronger news for Brexit is stronger for the pound, and that is ultimately a key fundamental intermarket relationship is showing the way that sterling is close to a major bottom. But as we've seen in the last few days, in if you want to use the Trump-Russiagate story, for that move to happen, the market has got to be positioned the wrong way and not the right way, and there are far too many sterling bulls out there at the moment. Why anyway?
Sorry,
Yeah.
I think maybe there's a disconnect between the slides we're seeing and what you're discussing. We are still looking at the PowerPoint preview of the cable 1998 to 2002, 2015 onwards. Is that the wrong?
Yeah. Yes, it is. What do you? Let's have a look. What are you seeing now?
We're still looking at the same thing.
Let's go. Okay. Yeah, let me try and get back to how do I do this?
You need to put it into PowerPoint presentation mode, which is just round about the bottom right. You'll see a projection screen, or actually, sorry, you're on this top left on this version. You'll see a little icon of a presentation screen. Yeah, further up, move up, move up.
Oh, you're there, are you? Oh, okay, that's no problem.
We're looking at your cursor.
Can you see a new chart?
There we are. That side. Yeah. Okay.
Unfortunately, I'm not the most technically able person as far as I've got multi-screen, so I'm looking and talking about a chart that no one can see because it's in bottom right. So I've moved it back into. This is essentially what we're looking.
Yeah. If you could explain what, first of all, just what some of these trend lines and things are that you've got, because it's quite a busy chart. So maybe if you could take a second just to explain.
But from the top left, you have the ramp into Brexit, which we're actually following on a much basis in the last rally. Into Brexit, into the event itself, and then it crashes. We're doing and arguing something similar, but on a much, much slower basis. This rally, even though we think, let me just go a step back, even though we think sterling is close to a major bottom, I was explaining before, which you obviously couldn't see, how this is very similar price action, breaks to new lows aggressively, consolidates the bottom, breaks back up, breaks to new lows, consolidates aggressively, and breaks back up. I think a lot of that is actually a dollar downtrend rather than cable, but it still ultimately says that Brexit is good for sterling. Now going back, this is zooming into that chart. What we're doing now, it actually says therefore that this is likely to be, this is still a correction from the low, and that we've got one final wrong footing move to the downside before sterling turns. And it's quite, we've already hit, just to show you this channel, we are pushing the top of the channel. Now, the problem with this channel actually is it stems from the fat finger spike. So where was the fat finger spike? 118.15 people seem to agree on, but there are all obviously lots of different levels as to where we come from in that respect. But essentially this is, I'll just sum this up. This, we believe, is the last correction in the downtrend or the sell-off. And that we are looking for a major buy, but we think this is a sucker's play to the upside. And that I used the example of last week with the Trump-Russiagate of how if for a market to move aggressively, it not only needs people on board and those people buying, in this case we want it to reverse sharply, but you need people short. And the most powerful combination there is when people get themselves short, but actually believe it's bullish. So in other words, not only when they stop out and buy, they'll actually buy more, and they have a willingness and disposition to buy more. So you look at markets like the dollar-yen rally from 2011 upwards. People were very bullish. Retail, in fact, was very bullish at the bottom, and as it broke higher, they bought some more, and then it went a bit more, and they started selling because it went too far too fast. Even though they believed it was going higher, they found themselves short. So not only were they going to stop out and buy it up more, but they're actually going to buy into it as well. And that's when you get dramatic trends. It's when people actually believe the market's positioned wrong against their own view, and therefore they go back to their view and fuel it even more. So to go back to this, what it's essentially saying is we are doing a slow version of the pre-Brexit price action. and that going into the election, it's going to do nothing for the next 18 days until it spikes up on buy the rumor, buy the fact, sell. And interestingly, there's lots of things, as Simon says, it's a busy chart, and apologies for that, but these charts are like a working, for me, they're a workbook, so I need to retain although I've got, actually got a photographic memory for charts, but I can retain a lot of the information. It's nice to come back and say, oh yes, there's this, and there's that, etc. So I know what's going on. We are at the top of this up channel. The up channel, essentially for the last, let me find out how to tell you exactly. It's type of weird, boring, anorak thing I do. For the last 164 days, cable has been traveling in a slow flag updrift. Now, forgetting anything else, politics, intermarket relationships, sentiment, simply it's saying this is not as yet an uptrend. It is slow, and therefore it should be bearish. It's a down flag, and therefore you have to ask yourself, will it do what is a textbook down flag and break to the downside and then go the same distance again, which you're talking about 9 big figures, which is 111, or in our case what we believe it is to be far more muted, because history shows, going back to that original slide, the final new low was very, very slow. See how marginal that was? That was pretty much only 3 big figures. So we're looking for marginal new low, 300 points marginal, 300 pips marginal, but looking for new lows. So our trading strategy going into the election on cable and cable alone is we're trading the range 127, 130 and change. It has already met the first objective, effectively this level here, the 38.2% retrace at 130. In fact, I had 130.45 on another chart used, going back to the, where you put this fat finger low, 130.45, and we sold 130.40 with a stop at 130.140, 100 points for 116.95, 115.95 rather. That is our target. Now, unfortunately, if you remember the election average, what it says is that we go sideways into the election, then spike. It means that it's already met the objective before the election, and that we're likely to get a further spike later, and therefore we'll get stopped out. So in the shorter term, we're looking to exit this strategy. That is, obviously at the moment we have what is effectively it's about a 15-to-1 risk return. Now you can attach a low probability of that of only say 33%, and that's still a massively good trade. But unfortunately, it looks like we're going to get stopped unless we do something about it. So let's go into the shorter term on cable and cable alone. One thing that cable, again, going back to whatever market you trade, ask yourself, what does it do? What does it do in trends? What does it do in consolidation? What are the powerful, successful formations that work in the instrument I'm trading? Not what the textbook tells me about all markets, but about the market I am trading. And once you start with that as a parameter, it is amazing the difference it makes to your trading, because you then start to understand not just the formations that work, but understand possibly why. And that cable is buffeted by more than just sterling at the moment, but also by the dollar, but also by the interrelated markets, namely gilts and FTSE. And that's why you were not seeing clean price action. But it's also why one of the cable's favorite formations is actually quite a rare formation for many other markets. It's an expansion. And from the 129.05 high in April, cable has been ratcheting higher, could be a wedge, you could argue, but what is more likely, given it likes to do it, expands the range. Now, an expansion reflects two things. It reflects a lack of upward momentum, which we think is necessary. Obviously, if we think it's a top and it's within that broad up flag, but it also represents increasing volatility through increasing uncertainty that Brexit, but more importantly, the election represents. So what it means is, in a nutshell, cable is a pig to trade. because what it should do is just stuff every obvious level. An expansion will take the highs, it will take the lows, but actually not go anywhere until you get the final dramatic spike to end the expansion. And as the expansions have 5 legs, starting from this 29, we think there is one more downside into the election before that spike higher. Why I'm trading cable, given that it's such a whippy market, is because I'm pretty convinced, I'm very convinced what this market is doing, and that is that expanding range, which will probably take out. You've already seen it the last week with that initial spike down from above 130 as the market got long and long, back up to the same levels, and yesterday we spiked down again, and then today we're even though it ramped on the back of hot air, on the back of FOMC, Fed minutes yesterday that were arguably dovish because they didn't commit to this tightening that people saw, even though men's balance sheet reduction, dollar weakened, and now it's strengthening again because it is hot air. And what we'll see is 128, 129.30, 128.90, 128.70 and 128.30 all blown out the window before the election, and it means nothing because it's 127, 130 and change. And once that's run its course into the election, then everyone again long or wrong more dramatically up to a target we now have of 132.60. So what it essentially means is how we're trading this is our risk return parameters are spot on to stay short. We could actually get away. I think we'd get away with even though we're short at 130.40, we could get away now with the 130.50 stop. In fact, the other day I lowered it to 130.50 and thought, this is too whippy a market to have such a tight stop, so put it back up to 131.40. But what it means is that going into the election as it comes off, we'll look to buy, and we'll look to buy as much close as we can to 120.60 with a stop below 127.10. You can see that there. That's the top of the previous range, which it shouldn't get back below. As soon as it gets back below that level, it's back into the range. And what? So basically, there are 3 major trades here. The first one is to be short now, as we are selling rallies against the 130.45 filler, looking for 127-ish, 127.60, looking to buy against 127.10. That will give us for a final new high. 132.60 is 560 pips against the 60 point. That's an 8-to-1 ratio. Risk return reward ratio. The probability of that trade working are reasonably good. They're going to be around 50%. What, 50% only? It's not of the view working, but also of our trade working, of our stop surviving that sell-off into the ramp, and that would be a great trade. But more importantly, will be to sell 132.60 against the 134.85 previous corrective high. Now, if this is still a downtrend, then given the ferocity of the previous move, the cable should not trade above that previous corrective high. So if we are right to believe that cable is going down to 115.93, we will look to sell 132.60 with that's 220 points away. So we're talking 250, that's 2%. So we'll reduce our position size because we don't commit more than 1%. We'll try not to commit more than 1% to any one trade, even though I came preciously close. In fact, I did that this morning on buying DAX. It's time to have conviction. Once you have conviction, then you're essentially saying the probability of the trade is actually is higher than the historically would suggest otherwise. Anyway, that's we'll look to do that, and then we'll look to run it down in line with election average. If you recall, the election average, which is on the wrong slide again. Simon, are you there? Just to help me out technically here.
Yeah, what are you trying to...
What are you looking at FTSE now?
We're looking at FTSE 100 election performance slide.
Is that just the one whole picture?
No, it's on the preview. So you need to switch
so
it.
You can see all this stuff here as well.
That's right. Yes.
Yeah. Well, not to worry, unless I can somehow move that. Oh well. Far more interesting keeping the market right. I'm not getting my PowerPoint right, but anyway. Okay, I hope that's clear. Bottom line, let's recap on cable. Cable is, well, therefore, let's get the Reuters chart up. Cable is consolidating, expanding, whipping. One thing I'm not doing, and I should be doing really, is taking 50, 60, 70 point pip profits on cable, because it's going to come back into the elections, go up, down, left, right, sideways, and whatever. It's more of a scalper's market than a positioner's market, a swing trader's market. But I'm holding out for 127 because it is so whippy. I got no idea when it's going to break down, quite frankly. And therefore, I want to be short when it breaks down, and guaranteed if I think it's bottomish at 129.30 for another 70-point rally, it'll probably break. What I should do, and as an aside, I should take back 10% of my position, because it's amazing how many times when you reduce your position size, the trade works. But that's besides the point. So basically, I'm trading the range, looking to buy 127.60 with a stop below 127.10. Should really be 126, but below 127.10 if the timing is right, and we'll signal whether the timing is right and try to fine-tune our risk return as much as possible for that final election ramp. And I would like to think, from a political perspective, that it will be a Tory majority of over 100, and that we have got the beginnings of a very sound political framework for our negotiations with the EU and a smooth, hard Brexit. But I will say that we got the Brexit view entirely right, but I thought it was going to be a Remain vote. For the simple reason, we were looking for this last rally because, funnily enough, it repeated what Eurodollar did into the Grexit referendum. In other words, spiked the top of the range and then came off. So I was thinking, why would it spike the range? Well, that's probably because we vote Remain, and then it'll be a buy the rumour, buy the fact, up, sell. But lo and behold, in fact, it spiked before Brexit 150.15. We're looking for a spike above 115 for another attempt at the lows, and we know the history. So it's from the next new high that we'll start trading it down. Now, given the history of what it did in 2000, that was a slow, laboured decline into the final new low, where we'll look to buy it. Now, the difficulty will be, once it goes to new lows, the world and his wife is going to be bearish, which is perfect from looking for a bottom. The sentiment will have the fundamentals we believe on our side. Hopefully, there'll be an indication, at least on the UK stock market, if not gilts, probably on gilts more so, and therefore on the differential, that cable was trading against the differential. In other words, it's defying it, saying I don't believe it. And as the market gets bearish, we'll have everything else telling us we're right to buy. The difficulty will be measuring the volatility. Volatility is the hardest variable in any market to gauge. As you were, anyone who traded this was involved in this fat finger will recognize volatility when they see it. We could look at something similar. We could be a soft landing. But either way, we know previous historically went by 300 pips, so that's what we'll be looking for, and we'll be looking to fine-tune that trade. I have 8 minutes left. Amazing, I've spoken for 50 minutes on cable. But let's have a quick look at the UK market. Let's do beforehand. You can see that it's pretty much all the averages are doing something similar. They're rallying into, when it was announced, it rallied, but generally they rally into UK elections for the 100 days previous. Even under a Labour potential victory, it remains relatively stable. And then starts ramping close to the election. This time, we've seen, essentially what we saw, it was twofold. One, it is the Trump Russia gate, but also it was the sell-off, the first sell-off from 2400 S&P that dumped, and the post-French election dump that's taken the UK average slightly different. It actually does look like an outlier. Anyway, bottom line is it's approximately following. Now, what does it say for the election? It says that we ramp. We follow the price action, the averages pretty well. It's the same story. It's buy the rumor, buy the fact. Whoops, buy the fact, oops, sell. Up to 12 to 15 days afterwards, maybe even longer, depending on one other factor, which I'll show in a minute. FTSE should ramp to new highs. Today's actually squeezed marginal new highs, but it looks like it's going to still probably trade sideways into the election, ratchet higher. If it's just an ordinary Conservative victory or an election day, we're talking 4%. So it's 280, 300 FTSE points. So we have a target 76.40 for that market, but I think that could be blown out the water as it ramps higher and then sells off aggressively. Now, given that I presented a case, hopefully presented a case, an understandable case, and apologies for the technical omissions if you've struggled to follow it, that the UK will come out of Brexit shining. It will come out shining on a relative basis for one simple reason. What we're looking at here, bear in mind that we're talking about sterling going to new lows and then sterling rallying aggressively. We all know that since the election they've had sterling cable and FTSE have had an inverted relationship. So this could just be a reflection of the dollar sterling rate going higher. In other words, FTSE in US dollar terms is stable, but it's sterling that has turned it aggressively lower, and I mean aggressively lower. But the overriding, I've talked UK election here. UK elections forms part of a much broader and wider, and quite frankly, a far more exciting story. We've been for the last 6 months since Donald Trump's election. It is 6 months, isn't it? It feels like 5 years, quite frankly. The last 6 months, we've been in a Trumpflationary or perceived Trumpflationary uptrend since Donald in stock markets and in the dollar. You could still argue, and in the yields, you could still argue. But there's that's part of what we believe, as I mentioned before, is a 7-year, 8-year uptrend, the biggest stock market bubble in the US, in the third largest in 100 years. Now, I'll explain simply why I'm showing you this. And this is a Greek model of the Dow Jones for the last of that bull market and how it fits in. When the market is now nervous and we're entering the final stage, essentially a new paradigm where everyone believes it's going up forever. There are lots of people still bearish, a lot of people still short. We tried selling it and failed, but we have underlying longs for this big blowout to the upside. As we broke higher today, it is saying we have entered the very, very final stage of a market that is truly aggressive both ways. We've been here before in history. Where is the evidence for what I'm saying, that it's a bubble? The price action is mirroring the 1920s and the 1980s. Okay, that's cool. A lot of people have said that before, but we've actually ridden it bullish all the way from the bottom up to this point, to the point where absolutely, if there's one big trade out there, forget cable. The one big trade is the US stock market, and therefore, if you like, it's related FTSE. So the reason why...
Could I interject for a second, just to give you a two-minute notice, if that's all?
It's fine. Thanks. It's fine. For once, I've timed this to perfection. I wish my trading was always timed to perfection, but we like to top tick and bottom tick. So the 2-minute countdown's perfect. So the reason why I'm showing you a US market is because that, when it comes down to it, at the end of the day, you should trade or be mindful of what is really driving the market. It is not UK, as far as the UK is concerned, it will not be, in our belief, it will not be Brexit that will drive UK markets. It will be the US. It will be the end of what has come, we call the Trump bubble, Trumpflationary bubble, if you like, but has been a bubble in the brewing for the last 8 years, to the extent that it's following price action so closely. Now we have a calendar chart of day by day what it did in 1987, which hasn't been updated because this was from a presentation I did a couple of weeks back. This essentially said that we had one more sell-off in the range before we broke higher. We're breaking higher here today. What this is saying is pinpoints late August, well beyond the UK election. Late August, early September for the top in stock markets. We have a clear, precise date. We have a clear, precise level. So when you look at what happens there, it's going to go back to possibly beyond the start of the Trump trend. That's beyond 2032 on the S&P. Then if you go back to the UK chart, you can understand what this sell-off represents. And if you have that underpinning the UK FTSE, you can expect the dollar to weaken significantly. And that will be the cable trade. It's not just a positive cable, sterling, UK related, it will be dollar weakness. So that's how we're going to trade it. If you notice at the bottom throughout this whole presentation, there is a chart available as and when markets present themselves, the opportunity presents themselves, like today. It's been a very busy morning. One reason I'm a little unprepared for this webinar, apologies for that. Try and time it and fine tune it to present ourselves with the best risk return, the best probability, so our payout at the end of the day is as high as it possibly can. And since we launched a year ago, we're up over 140%, so we must be doing something right. And thank you, Simon, for your patience, and thank you everyone for listening today. And my last words will be, my pleasure. My last words aren't going to be anything about Matrix. My last words are going to be like,
thank you.
Thank you.
Ed Matz, thank you very much indeed from Matrix Trade, and we are hurrying him along a little bit because before our next speaker starts, David Paul from VectorVest, we are just going to take a short break for the minute silence at 11 o'clock, obviously in recognition of the terrorist attack that happened in Manchester on Monday evening. So we'll pause for that and come back to you straight after the David Paul. Okay, so moving ahead with our round the clock trader event. Thank you. There we are to Ed Matz. Presentation just finishing up before 11 o'clock there. And Phil, yes, the presentation's all being recorded. You'll get access to these recordings at the end of the whole event. So we'll probably have it ready by tomorrow if we can. Our next presenter, David Paul from VectorVest, is an old friend again of the Round the Clock Trader, and of course I've worked with David on and off over the years. He is the Managing Director of VectorVest, the long-running portfolio management research software. We're talking specifically about stocks in this next session and how to spot the highest trending stocks and the highest trending markets. So you've got a system that can filter out through the whole stock market and give you these winning stocks, and also a timing indicator as well, which tells you when the markets are a bit toppy or due for a correction. So David, I can hear you. I think you're with us on the microphone, so good morning to you.
Yes, good morning, Simon. Can you hear me okay?
I can hear you absolutely loud and clear, which is great. Maybe if people at home can also confirm they can hear you using the chat box, that would be good. And shall we just go straight across? There we are. Joe says yes, it's fine. Yeah, it says great, thank you. Let's go across, David, to your screen.
You should be able to see the blue screen, Simon, the VectorVest blue screen.
We're seeing that now. Fantastic. So we've just been listening to Ed. I don't know if you caught any of his presentation. He's been...
Yes, I spoke to him on Saturday as well, yes.
Oh, great, yeah. Like we were talking about, so we've been talking about the UK election, of course, which is coming up very quickly. Let's go and have a look at what VectorVest is telling us. I know we have a disclaimer. This was part of the process to put the VectorVest is actually a regulated entity. So I know you have to go through your disclaimer. So I'll hand over to you to discuss that.
Okay, thank you, Simon. Yeah, and just pull me up if I run out of time as normal. But good morning, everyone. It's great to be here, and I saw some of you, I'm sure, at the Round the Clock Live, and maybe some of you at the Forex show last Saturday. It's great to be here, as I say. As Simon says, VectorVest is fully authorized by the FCA, and although I am qualified to give financial advice, I'm not allowed to give financial advice in the absence of sitting down with you and doing a very long and detailed fact find, the sort of thing that your financial advisor would have done with you. I'm allowed to talk about the shares that I hold myself, and I'll talk about those in a fair amount of detail, but the regulator has advised me to say that although I'm holding the shares, it may not be suitable for you. Okay, so that said, we can move on, and I've got a PowerPoint presentation. I'm not going to stay in the PowerPoint presentation the whole morning. I'm actually going to do my best to be in the VectorVest program for most of the time, but nevertheless there are a few definitions to be worked through that if I don't work through those definitions, then the whole proceedings fall away. So I'm going to talk to you about my personal wealth building strategy. I'm going to talk about the VectorVest system. I'm going to talk about how to time the London market to know when it's a safe time to be in the stock market and when it's best to be in cash or in fact short of the stock market. I'm then going to talk about the VectorVest Edge, which is the ability to trade both price momentum and earnings momentum, putting together the fundamental position of a share with the technical position of a share. As my dear friend Zach Meir says on Tip TV, he says it's the best of both worlds. And at the end, folks, a little bit of homespun philosophy, the secret to success, my secret to success. Okay, so if you hang around to the end, I'll give you something to think about, okay, and ponder upon. So my own strategy, and it's hardly my own, but when I started to trade with reasonable amounts of money in the 80s and the 90s, I was completely captivated, motivated by George Soros and the Quantum Fund, because Soros and his fund produced, I think, a guts of a 40% return for 25 years. And they did it in a very specific way, and I've read and I've made it my business to actually speak to not Soros himself, but people who reported to Soros, and their strategy was relatively simple. They did leverage trading in, as my dear friend Tom Hogarth says, in anything that moves, and there's not that much moving at the minute, but leverage trading in Forex, in indices, and index shares for cash. And then to use that cash to build a stable of high-growth companies, and I use VectorVest for that. Now, at the moment, and pretty much always, I've had an 80-20 split. So 20% of my cash in leverage positions, and 80% of my cash to build up a stable of high-growth companies using VectorVest. My biggest holding at the moment is the high street retailer JD Sports, and I'm up 6x in that over the last couple of years. So that's my particular strategy. That strategy works for me, and it worked exceptionally well for George Soros and the Quantum Fund, so not much point to change it, in my opinion. So a little bit more homespun philosophy. In my very first job, I was taught the 4 requirements of success in anything, and they are unselfishness, determination, courage, and cheerfulness in adversity. I was taught that in my very, very first job in somewhere between 1973 and 1977. So at the end of the day, that's going to be you, okay? So you're going to be listening to dozens and dozens of speakers. Well, maybe I'm gilding a lily a bit, but nevertheless, you can easily be like that signpost. And I just want to quote at this stage Bruce Lee, the martial arts fellow from my youth. I fear not the man who's practiced 10,000 kicks once, but I fear the man who's practiced one kick 10,000 times. So out of all of this, ladies and gentlemen, you need to get yourself to a point where you've got one little thing that you trust, that you've proven to yourself works, that you can execute with precision over and over and over again. okay, to break through this maze of techniques. Okay, for me, an hour a day is enough. I don't want it to take any more time than that, and I'm done with sitting in front of screens, although I do enjoy sitting in front of screens for a little bit of time. I was short the cable this morning. Those of you that have followed my work on the Which Way Today live trading room over the years, which is closed now, I have a thing called a morning trade, and I was short the cable from 92. I don't know, my stops at entry, I don't know where it is now, but I have a target in the system as well. Not the best entry, I was a little bit slow, but when I feel like it, I will trade intraday, and I think that morning trade of mine in the pound against the dollar hasn't let me down for many, many years. Okay, so I don't have to re-emphasize that the objective of trading, I couldn't get this in, but the objective of trading is to have enough money to trade tomorrow. That was first said to me by one of my first mentors, a guy called George Lane, who put together the stochastic indicator. I did his course in 1985. So managing your money really well, and at VectorVest we have a full course which shows you how to go about managing your money well, which is packaged within the VectorVest product itself, called the Quick Start course. So the VectorVest edge, and this is this one edge that Bruce Lee was talking about, this one kick. We put together the fundamental position of a company. In my definition of fundamental analysis is it's the search for the true value of a share. So we put together the fundamental position of a company with the technical position of a company. And my definition of the technical position is the study of trends and turning points. And then we look at the technical position of the overall market. And when all three are saying yes, then I can make a decision which has got a hit rate which is unusual for this line of work. Okay, so I want to be trading in the very, very best companies, those companies that I believe are undervalued, those companies that are growing their earnings aggressively and safely, that are rising, and I want to be buying and adding to those positions when the general market is rising. That's the kick. Okay, and later on in the presentation, I've got a checklist that you can tick off to that end. I tend to run out of time, folks. I'm happy to offer anybody a 5-week trial of VectorVest UK and VectorVest USA for 5 weeks. It's £5.95. It's then £44 a month on a month-by-month basis. My promise to you is that if you can't make money, with VectorVest, then you can stop it at any time. Okay, and that's the links. I'm sure Simon will put that link into the chat box. Now that includes full access to the VectorVest Quick Start course and the VectorVest University. That's in case I should run out of time at the end. Okay, so what's the share really worth? How safe is it? And some idea about the trend. The first two are fundamental measures of the company itself. Now I go right back to what my granddad taught me the guts of 50 years ago. Well, 50 years ago. He used to say that the only way to make money in anything is to find the value of something and then pay less for it. And he manufactured bricks and blocks, and he had a joinery business and all sorts of things. His only real desire was to buy more land, and he was a farmer at heart. And he would look at a farm, he knew which farm he wanted to buy, and he would wait until some calamity came across the economy, and he would step in and buy it cheap. Many, many years later, I read the Intelligent Investor by Ben Graham, Warren Buffett's mentor. And in the book, he spends many, many, many chapters showing you how to put a value on an asset. And then in the last 2 chapters, he says, wait until Mr. Market does something dumb, and then you can buy the darn things cheap. So largely he was saying the same thing as my granddad said. The only thing that I'm really sure of in life is that my dear granddad had not read The Intelligent Investor, because he was quite scathing of advanced education. He used to say that education shines a stone and tarnishes a diamond. So what's the share really worth? I think you would agree that there's a big difference between a great company and a great investment. Okay, a great company can be trading incredibly expensively, and the president of the US went broke, I think, quite a few times. The second time he went broke on a series of trophy assets that he bought, hotels. The hotels were making lots and lots of money. They were full to the door, but he still couldn't make a profit. He simply paid too much for them. Okay, so big difference between a good investment and a great company. Okay, how safe are the earnings? Has this company got a track record of making money? Are all those financial ratios getting better? And then some idea, should you be buying it? Is it rising? Should you be running for cover? Is it falling? Or should you be sitting there and sweating it out? It's going sideways. Okay, and we all have to sweat for a while. So the very first number on VectorVest, folks, that I'll show you momentarily is value. And every evening, VectorVest calculates the value for every share in the database. We also put another number to value, which is called relative value. And as the slide says, relative value measures the long-term price appreciation potential of that company in relation to the risk-free rate, which is a AAA rated corporate bond. Now, for long-term price appreciation potential, read 3 years. So we project earnings for 3 years into the future. We assume that those earnings will be fully discounted into the price at some time in the 3 years. We work out what the price will be. We take that projected price, we subtract it from the price today to calculate the upside, and we divide that upside by what a AAA rated corporate bond will pay over the next 3 years. If your company has got a relative value of 1.3, that means that that company should outperform the risk-free rate by 30% over a window of 3 years into the future. VectorVest reckon anything above 1.3 is excellent, and we have many companies on the London market that I'm in fact holding that have a relative value above 1.5. I think it's the most important number on VectorVest. It drives the share price, largely influenced by earnings per share growth. And again, to quote Ben Graham, earnings per share growth is the engine that drives the share price. So two measures of value, value today and the earnings potential over the next 3 years. Vital numbers. The next number is called relative safety. It measures the safety and the predictability of the earnings. So what we do is we download the balance sheets, income statements, cash flow statements, sales, etc. for the last 5 or 6 years from Thomson Reuters, and the computer gobbles those up and spits out a number which represents the consistency and the predictability of the earnings. We massage that number between 0 and 2. Above 1, it's good. Above 1.3, this is a company that's making a heap of money, and all those ghastly financial ratios are getting better, of which free cash flows are a really important one. The third number is a measure of the trend. Relative timing, it's a measure of the short-term trend. It measures both the direction and the strength of the trend. I think for those of you that are technicians, it's similar to the MACD indicator designed by a friend of mine called Jerry Appel. Again, mathematically massaged between 0 and 2. Above 1, the darn thing is rising. And the further above 1, the faster it's rising. And then what the founder of VectorVest, Dr. Bart Toledo, did is that he put relative value and relative safety together with relative timing into the one single number. And for the first time in my career, I saw a number that incorporates both fundamental and technical analysis, and I had not seen that before. And as a default, ladies and gentlemen, all of the shares on the London market, the American market, whatever market VectorVest is active in, as a default, they're sorted by descending VST. And that's where the winners are. And quite honestly, to make a good living, you don't have to look at many more than 20 to 30 shares sorted by VST. Okay. We calculate a stop loss for every share every single day. Stop loss is an adjusted 13-week moving average. It's adjusted for the fundamentals. If the fundamentals are really good, then we widen the stop loss. If the fundamentals are not so good, we tighten the stop loss. So shares with really good fundamentals, we give more wiggle room. We put a buy, sell, and a hold to every share every single day. Now, the buy, sell, and hold are largely trend-following tools. The only fundamental input to the buy is that VST must be greater than 1. So these can be used to time the market, but they're also incredibly useful to work out the breadth of the market. And every day, VectorVest, in fact, calculates a buy and a sell ratio. So we can work out, is the market rising across the board, or is the market rising on a few issues? Very, very important number. We'll see that a little bit later. So let's look at the program itself now. So if I get out of this and I go into the program and I go to home, okay, this is the front page of VectorVest. Now, if you see it for the first time, you may find the quantity of information quite daunting, and I can also fill these windows up as well. Now, we'll talk about all of this, but it's designed with a lot of information on the front page so that when you're on the go, there's actually enough information on this front page to actually tell you everything that you need to know with the one glance. And of course, these days, this can all be on your smartphone or your iPad or your Android device. Okay, and we've got a really, really sexy new app for the iPhone, and a similar really sexy new app coming for the Android. The app for the Android presently is just fine. I use it every day, every evening, but there's a new really sexy one coming in a week or two. Okay, so when you're new to VectorVest, the first place to go is to the welcome page, and that's Bartolito. We've got a tremendous commitment to education, a little video there, and then you can schedule a session with one of our people. If you're interested in the mathematics behind the valuation algorithm, it's all in this little green book, Stock Strategies and Common Sense. But I'm now going to go to Viewers. And all of the stocks listed in the London stock market and on AIM are here. And when you go into this first, that's going to be empty, but you just have to click on Stock Viewer and that'll populate that. I've been into it quite a few times this morning. So we start at the top, the highest share. This is the sort of Chelsea of the London stock market. It's got the highest VST on the London stock market and on AIM. So it's called Hastings. I'm holding it. I've been holding it for quite a long time. If you have read my blog at vectorvest.co.uk/blog, and I think Simon forwards quite a few of them as well to his base, I've been talking about Hastings. Trading it, that's the code clearly. It's listed in the London stock market. It's trading at £3.12. VectorVest believes it's worth £4.40. That's the first proprietary number in the program. And that's a proprietary calculation of the valuation of Hastings. It was up 2.7 pence yesterday, which is hardly proprietary. You can get that from the Evening Standard for free, which was 0.87%. So those two are not proprietary numbers. Now, the next proprietary number is relative value. Now, relative value is the earnings potential over a window of 3 years in relation to the risk-free rate. And at 1.66, that's not just good, it's not just excellent, it's bloody marvelous. So that is an incredibly good number. So Hastings ticks well, it's undervalued. Remember, the only way to make money in anything is to find the value of something and pay less for it. Okay, whether you're in shares, whether you're in used cars, whether you're in property. Relative value at 1.66 is outstanding. The relative safety on a scale between 0 and 2 is good at 1.19. The relative timing at 1.16 is saying this is going up the page fast. And when you put those three numbers together by the sum of the squares, then the VST is the highest in the pack. It's on a buy recommendation, and the stop loss is £2.79. We believe it's going to grow earnings at 36% next year. Now, that's quite a clip. And these numbers to the right-hand side are our best shot at the fundamentals going forward. And as you can see, it pays a reasonable dividend, and it should grow the dividend at 19% a year. So really very good numbers from this little company, and for that reason, the technical position is growing strongly. So let me scroll back to the, doesn't seem to want to do that for me. There we go. Now, if I right-click I can pull up a full analysis report, internet permitting. There we go. And all of those parameters that I talked about are analyzed in a great deal of detail. And that report is available for every share on the database, right down from growth, from sales, growth to PE, what Jim Slater calls the PEG ratio, 1 over it, dividends, sales growth of 26% last year. That was excellent. So that's a really good number. If you want to do some really heavy research, then we can go to stock news, and this will take us, with any luck, shouldn't have taken me there, it will take us with any luck to the FT. And pretty much everything that has been written on this company is here, directors' dealings, all the financials, and there you can do a tremendous amount of research. And this link to the Financial Times is a part of the VectorVest subscription, and that you would have to pay for if you don't have a VectorVest subscription. Okay, and let me get rid of that. That's very unprofessional of me to have that open. Sorry about that. So, and the last thing I can do, of course, is that I can pull up a chart. Not the last thing, but and there's the chart. It's my standard format. If you've read the blog, you'll have seen this 1,000 times. There is the share price moving up the page. That trend line is my own attempt at drawing a support line. This is a valuation, and as you'll see later, guys, I have standardized for my longer term work that I want to see a 20% buffer between the valuation and the price. Earnings per share growing nicely. It's up over the last year from 12p to 20p. And as you can see, the share price moving up the page. And the last buy signal from VectorVest, the first buy signal here after Brexit occurred just there at £1.80. It then went to a hold for a while, and hold means hold if you're a longer term player. And then another buy signal just here. Another bit of hold, and then the last buy signal was at 250. That would not less than 250, somewhere around here, 243, and that was towards the end of March. And we're now up at 312. It looks to me, with a decent market behind us, that it's going to keep going. Okay, somewhere up around here. Those of you that are technicians, you should be able to see the cup and handle patterns, etc. there. But you really don't need to do much more than that to make a good living. And that's your kick, folks. And you've got to become really, really good at it. Those of you that are support and resistance traders, well, you could have, in fact, defined support relatively easily here and bought in here, maybe with that outside bar or something. So many ways to finesse the entry. The one thing that I will say is that with VectorVest, you don't need to have very sophisticated technical analysis. You can make a good living just by buying breakouts of 52-week highs when the share is on a buy recommendation, or just following the VectorVest buy recommendation. You don't need much more than that, as long as you put the fundamental position together with the technical position. And that's why I'm happy to say that if you can't make money with VectorVest, then you can stop it straight away. There's no contracts, there's no tie-ins, and with respect to you, if you can't make money with VectorVest, then I think you need another line of work, to tell you the truth. Does that sound arrogant, Simon? I don't mean it to be arrogant in the slightest, but that is my feeling. So let's look at another share. This is a share that I called on Tip TV last week, and I'm holding for quite a long time. This is Coates, and Coates, I'm sure I can remember my grandmother knitting, or not knitting, but sewing with a spool that had Coates written on it. As you can see, it first came into my universe somewhere around here because VectorVest revalued the share, And at the first buy signal, I wasn't looking at it because I didn't have that 20% buffer. But when we got this buy signal, I was looking at it because there was a 20% buffer between the valuation and the share price. It all actually comes onto my universe and in my search when there's that 1.2 value divided by price is greater than 1.2. Now, you could have bought breakouts here. If you'd bought that breakout, the share was on a buy recommendation and it moved up the page. If you're a swing trader, that's a really nice move from 40 to 60. I think you would agree. It then went sideways. There was a little period of hold in here. If you're a longer term player, hold means hold. Then you sit there, and then it broke resistance, came back and kissed it twice. And on May the 17th, the directors confirmed what VectorVest already knew, that they were actually going to do much better than their forecast, and that caused this breakaway gap to occur on March the 17th, May the 17th, should I say. That was the catalyst that made this move, and it looks to me now that both technically and fundamentally this wants to get up here. When you have a little ascending triangle like this, technicians, and I know there's quite a few in the room, will in fact draw a little flagpole like this, and they will take that distance and add it to the breakout point to sort of triangulate a target, and that target looks somewhere up around 90p to £1, and I think with a half decent market behind us, that's where we're going to go. Okay, so very simple. There was the last buy signal. If you weren't in the darn thing at all, there was the last buy signal just there. That was at 62. It's already at 74. Okay, but if you've been doing your work and watching VectorVest in a few minutes a day, a few minutes a week, you should see these buy signals coming in a share that's growing earnings, in a share that's undervalued when the general market is rising, and that's where we're going to get to momentarily. Okay, so lots of this is another company that I called on Tip TV, Morgan Sindall. That's when Jenny Hammond asked me, what was your trade of the week? Well, first of all, Morgan Sindall undervalued. Again, I've got that 20% buffer. Earnings per share rising, and the earnings per share is going from 50p to £1 in the last year. And those of you that are technicians, you should see the cup and handle. One of our user group members said that you couldn't get much tea in the cup. She's quite right there. But nevertheless, a textbook cup and handle, the technicians I think would agree. So by putting together, ladies and gentlemen, some very simple patterns, a cup and handle, ascending triangle, symmetrical triangle, maybe a flag in an undervalued share, you don't need much more sophisticated technical analysis than that. Assuming the share is undervalued, assuming the share is growing earnings per share strongly. But if pattern recognition doesn't turn you on, and there's some people that after a million years they still can't see the patterns. I love the patterns. As you can see, the first VectorVest buy signal came just here. It was a day or two of hold that might have cost you to scratch your head, but the share was moving nicely, and then it broke that high, and then we have the little handle, and away it goes. So since that, it's gone from £8 and it went I think there to about £12.03, pulled back a little bit, and I wouldn't be at all surprised to see it pull back to these old tops. It's still on the buy recommendation, and you should still be holding it. Okay, I'm certainly holding it. And that is the kick. Now the next thing that we need to look at, of course, is the general market itself. Anybody like at this juncture for me to look at any shares? I'm going to show you a share now where I live in an apartment block in West London, and I was doing a show. Yeah, I was doing a show. I can't remember what show it was, and I got a call, and the concierge told me that there's 2 cases of London Pride just been delivered. What should we do with them? And I told them to put them in the fridge. But I'll tell you why the London Pride pitched up, Simon. Because this is Imagination Technologies. And we had a VectorVest subscriber. He emailed me, and he said, should he buy Imagination Technologies just here? Because there was a little support line there. You see the support line? New mouse, just bought it yesterday. Something like that. And there was an outside bar there. And there was a buy signal there. I looked at it, and first of all, I didn't like the earnings per share. It's sort of going nowhere. I found that earnings per share moving up from bottom left to the top right linearly helps. And also, our valuation was right down here, and at that stage, our valuation was 50p. And the share was trading at £2.50. So I said that he could do what he wanted, but I wouldn't buy it because the share is trading a mile above the VectorVest valuation. And I trade with VectorVest in the UK and in South Africa. And every time I've actually gone against our valuation, I've got a good old-fashioned smack. So I told him that I wouldn't buy into it. I'm not allowed to give financial advice, but I'm allowed to say what I would do myself. And he didn't buy into it. And then, of course, the share was up here because of its association with Apple. And again, ladies and gentlemen, there's one hell of a difference between a good company and a good investment. This may be a wonderful little company. It certainly is doing some wonderful work. But it was not a good investment because it was trading emotionally a mile above where it should have been. When Apple made that announcement, the darn thing fell, and as you can see, it fell pretty much to the VectorVest valuation. That would have turned £100,000 into £38,000 if I've done the sums right. So by putting together the fundamental position of a company and the technical position of a company, you can make much, much, much better decisions. And I've proved that to myself, and I'm more than happy to let you prove that to yourself.
David, we've got a few stocks being volunteered. Wincanton, Boohoo.
Oh, Wincanton, I called yesterday. I'll put that up with pleasure. I called it on our blog yesterday. I called it about in December, and there's the share. It's significantly undervalued. The earnings per share is not as good as I would like. I called it just here as it broke. See that buy signal just there, Simon? It was undervalued. I called it there. I think it was £2.10 or something. That was last December. And if you go to my blog, I wrote about it yesterday. It broke out of this pattern, and I wrote about it last December. And then it moves up the page, and it's now moved into this triangular pattern. And in the triangle, for those of you that are technicians, you should see we have 1, 2, 3, 4, and 5. And then it broke. It's broken the 52-week high. There's a good chance it's going to come back and kiss it, maybe, but nevertheless, it's on a buy recommendation, and I recommended that people watch the share. I can't tell them to buy it. I haven't bought it myself, and clearly, Simon, this won't have happened. This will never happen to a man of your means. But the reason I didn't buy it was I didn't have any money because I'm fully invested. But that, I'm sure, has never happened to you. Has that ever happened to anybody else out there where you want to buy something and you introduce a lovely Afrikaans word? You've got no geld left. So
Geld.
I've been in South Africa for a long time. The geld. Afrikaans people, we always say, English-speaking South Africans say that the Afrikaans folk have got, you never go drinking with them because they've got hollow legs. It sort of reverberates up, you know. That looks really good, and I think, folks, that I would be surprised that it doesn't come back and kiss that top. Be very surprised if that doesn't happen, even under the most positive circumstances. So maybe now the best thing to do would be to buy a pullback. It's undervalued. The technical position looks good. The London market is still rising, although we haven't got there yet, the earnings per share is not as good as I would like. It's not moving up smoothly. That detracts from it a little bit, but everything else looks fine. And if you read my blog from yesterday, I quoted the CEO who says that things are going along quite pleasantly, and he's very, very upbeat in his trading statement. So that was a catalyst that made it move. That trading statement, the catalyst that made it break out of this little triangle was that trading statement. So the market has taken the trading statement well. There's always, in these smaller shares, folks, there's always a catalyst of some description. The catalyst could be a trading statement. The catalyst could, in fact, be some directors' dealings. Okay, the directors put their money. For example, if you look at 3i, the catalyst to pull 3i out of that ghastly range it was in for a long time was some substantial trading in the share by the main team. The other one, Simon, and then I must move to the.
We were Boohoo.
Oh, Boohoo. It doesn't rate well. We've got lots of. Boohoo doesn't rate well on VectorVest, folks, because the share is flying up the page, but we believe it's vastly overvalued. And that's because the market's not stupid. The market is, in fact, pricing this well ahead of these results coming to the income statements and the cash flow statements. So at the moment, if you bought into that, you're buying into a share that's trading emotionally much, much higher than the valuation from the income statement, cash flow statement, and the balance sheet. So this is great, as long as the directors of this company do what they say they're going to do. If they should, in fact, fail to do what they say they're going to do, then you'll have another Imagination Technologies on your hands. So at VectorVest, we favor undervalued shares because there's simply much, much less risk there. But you do miss out on the Boohoos. You do miss out sometimes on the Fever Trees. Okay, and I see the guys from Fever Tree cashed in over the last day or two. 73 million they got. Good luck to them. We would have missed that, I'm afraid. Simple as that. So VectorVest, ladies and gentlemen, is a conservative product. It puts together shares with impeccable fundamentals, with proven track record, and it would have missed this particular move, that's for sure. Simple as that. But it's got lots and lots of other ones.
Just before we move on, David, there's plenty of other companies being volunteered here, but maybe we'll return to them at the end if we've got time. But there's one question from Farid asking, does the system work for investment trusts and ETFs?
It works well for investment trusts, certainly, but for exchange-traded funds, you'd be trading those just technically, because one, they change their holdings frequently, and two, an exchange-traded fund only has to, in fact, make public its main holdings. And that would mean that we actually can't work out a valuation. And the stance of Dr. Bartolito is that if he can't work out an exact number, that he doesn't put the number onto the system. So yeah, all the exchange traded funds are on there, but you'll be trading them technically alone. Investment trusts, we can work out a valuation. For example, if I clear this one, an investment trust that I'm looking at the moment, Caledonian Investments, and we believe that it's massively undervalued. And I haven't bought into it, but we believe that the share's worth £50. It's trading at 27. Earnings per share has doubled in the last 6 months, and I'm waiting here for a catalyst for this thing to break out. I haven't bought it yet, as you can see. We're not on a buy recommendation, but by all means, you can use investment trusts, because the investment trust is traded as a company with a set of books where we can put together, as Zach says, the best of both worlds. In an exchange-traded fund, we can't, and you'd be trading that technically, but they're all there. They're all there, certainly, yeah.
Okay, thank you. Well, we'll move on, because I know you've got a lot more to show.
Well, yes, I think that it's important now to add in the fundamental position of the market, the technical position of the overall market, because knowing when it's safe to be in the market and knowing when you should be in cash, or at least being very careful and not buying any more, is probably 70% of the exercise. The mantra is buying rising shares in rising markets, and of course selling falling shares in falling markets. And if you've got the stomach to sell something you haven't got, okay, many of you here will be familiar on the short side. I'm not myself, don't short shares much. I have no problem shorting the index, but I haven't got a great deal of experience in shorting shares, apart from gold shares, okay, which I've been working at for a long time. paid off my first house buying and selling gold mines in South Africa. So we've been timing the stock market for a very long time. I think it's really important to note that all our systems are totally and utterly objective. No scratching, no wave counting, totally and utterly objective. And we've got long-term systems for investors and we've got short-term systems for traders. And all systems are in fact based on three things. One, the price of the VectorVest composite. Now the VectorVest composite is not the FTSE 100 or the FTSE 250. It's all of the shares that we follow on the London stock market and on AIM put together on an equally weighted business. I'll show it to you in a second. We look at the breadth of the VectorVest composite, i.e. the buy-sell ratio. Remember we put a buy or a sell rating to every company in the market every single day, and the buy-sell ratio is our measure of the market breadth. And then thirdly, we look at the momentum or the relative timing of the VectorVest composite. Short-term systems are based around a 5-day rate of change of price, momentum, and breadth, and the longer-term systems are loosely based on a 21-period rate of change of price, momentum, and breadth. Loosely based. Now, to minimize chart watching, and there are many people who just don't like charts. I'm certainly not one of them. But we've summarized the trend into two words, up and up. If the first word is at up, that means that the short-term trend of the market is up, and the second word is the long-term trend of the market. Now, that could be down. That would mean that today the short-term trend is down and the long-term trend is down. That was happened in November, the last pullback in November. Since December the 12th, the longer-term trend of the market has been up, and this morning the short-term trend is up as well. So if you don't want to look at charts, you can tell the position of the London stock market on the front of your phone in seconds. As I say, there are many people who just don't understand charts. Probably that doesn't apply to many people who are listening to me today, but I assure you, in doing seminars over the years, I put up charts to quite a few people and they just shake their head. Okay, all of this is reported on the front page of VectorVest every single day. This is the front page of VectorVest, folks, the little traffic light, in fact, defines the short-term trend of the market. And when I did these slides, it was in fact neutral. There was 488 shares rising, 236 on a sell recommendation, and 1440 going nowhere. The short-term trend was up, and the short-term trend was down on the day I did the slide, and the longer-term trend was up. And VectorVest does not advocate buying stocks at this time. So we wait for the market to be both the little pointer to be in the green and the longer term trend is up, and that's in fact what we've got this morning. So rather than me faffing around in the PowerPoint presentation, let me go to the program itself. And there's the front page today. 495 shares on a buy, 243 on a sell, and 1431 going nowhere on a hold. The little pointer is marginally in the green. The color guard is mildly bullish, and VectorVest advocates buying safe, undervalued stocks that are rising in price at this time. Now, all of this down here, this is just the price, the relative timing, and the buy-sell ratio tabulated. So the program writes these down every day. If the price is up day over day and week over week, then we put a green light in the price column. That just is a visual indication that the trend is starting to strengthen. And today, the short-term trend is up and the longer-term trend is up. And that is called a confirmed up. Now, for example, some days I trade the FTSE intraday when I feel like it. That'll be with that 20% that I trade for cash, and I take the cash, and what I don't spend, I invest in companies like JD Sports, like Morgan Sindall, like Coates for the longer term, and that's been very successful for me, and that's my kick. I'm not changing it. I use the short-term trend on VectorVest to actually define my trend direction in the FTSE. So if I was trading the FTSE today, I would primarily only be taking long trades. A very, very useful measure. So let's go and find the market timing graph. If I click on timing and click on market timing graph, there we go. I just bought a new mouse yesterday and I find it quite difficult to work. Again, I've got my own trend lines on here. I want to go back to the start of 2016. There we go. Something like that. Now, this is the VectorVest composite. This is a composite of all 2,200 shares that we're following on the London market. The momentum indicator down below is called the market timing indicator. And it's loosely based on a 21-day rate of change of the price of the composite and a 21-day rate of change of the buy-sell ratio, all rolled into one. Ladies and gentlemen, when the MTI moves up through one and the market is traded up for 2 weeks in a row, we get the longest signal on VectorVest, which is called a confirmed call. And those are the confirmed calls, totally and utterly objectively calculated over the last year, since the start of 2016, so that for the last year and 5 months now. On the first trading day or so of January, we got a red triangle, which was a sell signal. This is saying, be very careful here. On the 22nd of February, we got a buy signal. Those of you who were in the market at the start of the last year, that was a vicious sell-off. That's when Yellen was going to put rates up 3 times, and then she's done an about turn. And this confirmed up lasted the whole way into the 3rd of November, and then we had that little bit of a pullback. And then since the 15th of December, this market has been running up the page, and it's still running up the page, as you can see. Now, all of the stuff that you've been taught on divergences over the years by me and by many other people can be applied to this. And as we can see at the moment, we can see that the price is rising, but the MTI is falling. And that is saying that this move up is becoming very mature. There's no doubt about that. So when I get a confirmed up, that's a signal to be fully invested in the market. And that's what I've been doing. And I've reported that 2-3 times a week. When we get a confirmed down, we don't know if this is a nice little 10% pullback. Remember, a pullback is less than 20%. Any more than 20% is a bear market, a la Charles Dow, 1880. Or we don't know if this is in fact a Lehman's moment. So when you get a red signal, simply don't buy any more. That's the first thing to do. 2, really watch your stop losses very carefully. And 3, look at your portfolio and get rid of the laggards. Those ones, let's say that you were there and you'd held a share on the way up and it's done absolutely nothing for you. You haven't got stopped out of it, but it's done nothing for you. Sell that, raise a bit of cash for the next buying opportunity. That's what I do. Okay. In this little bit of a pullback, very few of my shares that were undervalued, if any, in fact give me a sell signal. So the high VST shares tend to be resilient in a pullback. However, if that pullback were to turn into a bear market, I assure you that they'll all go down. Okay, so one has to be careful. Now, some people, when they see the red signal, they just go completely to cash. All right, simple as that. Now, along the way up here, we would have had an up-up situation there. That would be down-up. That's up-up, and we would have a down-up. We had a couple of down-up days just here, and now we're back on an up-up again. How long is this going to keep going? Well, how long? I'm not really sure. All I know is that some of my friends who are bears have lost. I know one guy's lost $1 million shorting this market because he says it's going to crash. Chris Benodi is down 50% and he's still making a case in the paper this morning that it's going to fall through the floor, and sooner or later he's going to be right. Our particular standpoint is that when we get one of these green signals and the market turns to down, then that's the time to go short. I was taught the Elliott wave by, in my opinion, the world's #1 practitioner of the Elliott wave, a guy called Robert Miner, and I spent many months with him in the late 80s, the early 90s, got to know him really well. And after all Robert's teachings, every morning he would end, in the morning he would say, let's trade the market, not the forecast. That's how he always ended every session that I did with him a long time ago. Now, ladies and gentlemen, when the MTI gets up to about 1.6, invariably you get a little bit of a pullback, but this divergence is worrying here. If I put on the buy-sell ratio as well, and we can see that although this price is rising, ladies and gentlemen, the number of shares that are rising is on a buy recommendation are falling, and that's also a bearish signal. So I'm wary of this market. I'm wary. It's still rising, but I'm wary of the market. I really am. And Mr. Gann, one of my mentors, is always wary of the 7th year in the decade. That stood me in good stead over the last 30 years, because I was in cash on October 87, I was in cash October 97, and I was in cash in October 2007 based on Mr. Gann's prognosis. So I think that sooner or later we're going to get one of these red signals. We don't have to stress. All we've got to do is to hang out in the present moment and just focus on what the market is telling us. Perfect execution. So at the minute, the short-term trend is up, the long-term trend is up, and I'm holding positions. I'm wary that this thing has moved a long way, but I've never seen a market too high not to go higher, and on the other side of that, of course, is too low not to go bloody lower. These trends can run along, and I wouldn't be at all surprised to see this push in to July, August, September time before we see a decent pullback. Although I don't want to count waves, but if you look at the S&P, we're in a 5th wave on the S&P, and I believe that we're in wave 3 of 5, and we've still got a pullback, and wave 4 of 5, 5 of 5 to come before we're going to see any form of pullback. Okay, so months to go in this run, I think. Let's now look at some shares again, and if I go to viewers, and let's go back to Morgan Sindall and pull up Morgan Sindall once more if I haven't got it up already. Now, what we can do is that if I click here, I can now overlay the overall market to this, and this little green triangle has not got anything to do with Morgan Sindall, apart from the fact that Morgan Sindall is a small part, a 2,000th of the index. So on that particular day, Morgan Sindall is undervalued, it's growing earnings strongly. The general market is now rising, and Morgan Sindall is giving us a buy signal and breaking up through new tops, and that's why I had no problems calling it when Jenny Hammond asked me on Tip TV. Okay, just somewhere around there, because everything was saying yes. The fundamentals were saying yes, the share was saying yes, it's rising, it's breaking new highs, it's on a buy recommendation, and the general market is rising. All the things that I measure are rising, and that is the VectorVest kick, ladies and gentlemen, and I can tell you that if you put that into practice with perfection, you will do exceptionally well in the stock market. You can certainly leverage yourself up if you wish, and certainly most of these shares are IG make a market in them, and all the spread bettors make a market in them, so you can leverage yourself up with the spread bet. You just don't have to buy the share. You can leverage yourself up with the CFD. I know the Forex market exceptionally well, and I know the stock index market exceptionally well, and this is easier. I'm not saying it's simple, but it's easier. easier money. And as I said to the Forex show people on Saturday morning, many people are not interested in the stock market anymore because they perceive it to be too easy. That really freaks me out. So the checklist, and this is the last little thing, Simon. This is my checklist. The value divided by price is greater than equal to 1.2. RV is greater than 1.3. The bigger the better. This drives the share price. RS is greater than 1, which means that the relative safety is good. It gets rid of the riffraff where the earnings are up and down. I like to see earnings per share above 15% and rising smoothly. The share is on a buy recommendation and buying, breaking new highs. The market is within a confirmed up, and the pointer on the color guard is in the green. You tick those boxes, you're going to get very lucky, folks. And that's my kick. Here's the secret. The secret, a loser becomes pessimistic when he or she has a winner. 99% of people, and I challenge you to observe your own thoughts, they become pessimistic as they feel the market's going to snatch away their profits. And to stop the market snatching away their profits, they end up snapping a small profit. 99% of losers invariably become optimistic when they have a loser. They're sure it's going to turn, and thus they allow a small loss to become a big loss. So my challenge to you is to observe your thoughts and to make a slight change. The winner invariably becomes optimistic when in a winning trade, and they become pessimistic in a losing trade. This allows these traders to let winners run and close losers quickly. Now, everybody says let your winners run, but nobody tells you how. A simple mind shift is all that it takes for you to be able to print money. The first step is to become aware of your thoughts and just practice changing them. That's the secret. Thanks very much, everyone. Simon, I've run out of time again, I suppose.
No, it's wise words. A little bit of trading psychology that can make a huge difference. I think that's just fantastic. Encapsulates it very well. I have posted the link there, so if anybody's not using VectorVest already, go ahead and take up David's offer for the 5-week trial. The link is in the chat box, take you straight there. Just a couple of quick questions. I'm sorry we didn't get through all the companies that have been put forward to us. Jeremy's saying, how does this compare to Stockopedia or ShareScope? David, I don't know if you want to comment on other.
I can't really comment on that.
They're not like for like, really. There are some.
Puts the technicals and the fundamentals together. It's much more of a trader's and investor's tool as opposed to a research tool. VectorVest is a practical, hands-on system to show you how to make some money. Okay.
Yeah. David, his contract, David Strachan, just commenting that would you need significant capital to make the most of VectorVest, as some of these companies are not listed on spread betting platforms?
I think that you can spread bet in that. There's going to be plenty of shares. If you look at the FTSE 350, for example, then there'll be plenty of shares that you can apply this to. But no, I have people who are making really good money with VectorVest that started with £10,000 accounts and are growing those accounts quite strongly. Clearly there's going to be times where the last 6 months have been very good. There's going to be times, for example, when we get one of those red triangles, that there's going to be a month or two that you do nothing unless you're short of the market. And VectorVest are very strong on being short in the markets, and certainly a lot of the backup that comes out of the US, 50-50 of that will be on shorting strategies. So no, I don't think so. I don't think so. Anyway, try it for £5.95 and see how you get on. Okay.
That's right. And that obviously opens a window into all your other webinars and the university. All that's on the inside.
Yes, sure.
All
of that. We want to. My objective, Simon, is to get people, and especially youngsters. Youngsters are good because they've got a 40-year subscription ahead of them. You know, so that's what we want. That's a joke, okay? But we want people to be customers forever, and we have to take care of them. It's as simple as that. And we have user groups around the country. I run webcasts every couple of weeks for those people that can't make the user groups, and I keep the blog up to date with what I'm doing myself. I'm not saying I'm perfect, but I'm doing my best to try and walk the talk on the blog, and all of those are time-stamped. So, as I say, my promise...
We'll need to wind it up there.
Sure, Simon. Sure.
So I apologise for that, but thank you again so much for coming on. Always a popular session at these round-the-clock events, and I appreciate the time you take to come and join us and tell us what's happening.
Thank you, Simon. It's great to be here, and have a great day, everyone. Okay? Have a great day.
Bye for now.
Cheers now.
Okay, I'm sorry to Carol Harmer for running over just a few minutes into her session, but Carol is who we are going on to speak to next. And if you've been on the show before, you will have heard me speaking to Carol Harmer, who is a technical analyst, a Forex trader, mentor. Carol, perhaps you can add to that. How are you? You should be able to hear me now.
I can hear you, Simon. Yes.
Great. Welcome to the event again. Good to have you joining us. Are you well?
Not feeling that great today, I have to tell you. I haven't been very well, but I'll not sure I can do the full hour, but I'll give you my best shot.
We'll take what we can, Carol. Okay, sorry to hear that. Well, as we normally do, we like to sort of share screens, so let's just go across to present your screen. Again, if you can hit that button, we should be able to see your charts. And
can you see
if
it?
we can ask those, there we are. That's great.
Perfect.
Okay, so we're looking at your live charts are open at the moment. I know you'd like this to be an interactive session with people volunteering what Forex pairs we'd like to look at, what markets, what indices. But perhaps we could just start off with telling us what's caught your attention most recently. What you think has been maybe moving the most?
Well, I think, do you know what? There's a lot of things that are absolutely dead over the last couple of weeks. Currencies have been a real pain. You can see on sterling there, look, I mean, we've just range traded for quite some time. We're not really breaking up. We're not really breaking down. We're just stuck in these horrible range. And, you know, if you look at the weekly chart on this, you can see that there is potential, if you like. You can see these indicators here. They're telling you that, you know, maybe all is not well. Maybe it's time for a correction. Now, that doesn't mean to say that we're not going to reach the target of 135.35. What it's telling you is that possibly now, not at the moment, okay, because it's extremely overbought and it's turned. If you can see here, it's actually turned. So there is a case for people looking to sell now into sterling, and I think here is where we're seeing a lot of the action. As soon as you can see, you know, you go up there, it gets sold off, it tries to get back up, gets up, sold off again, sold off, sold off, sold off. So there is this underlying fraction of the market that is really keeping it quite depressed, and it's holding above this little 20-day EMA here, but I just got this sneaky feeling with this that it's going to come lower before we go higher. And that's basically what the currencies are showing. We've had a big move up in the euro, but it's not following through, if you like. So is there... Yeah, go on.
Fundamental factors weighing on that? You think that we've already heard from a speaker this morning talking about the UK election that's looming. Are there any other factors that you think?
I won't, you know, insult people by saying they don't apply, because of course they do. so there is that election thing. I mean, we saw it in the French election where the euro was pretty depressed until, but that was a whole different ballgame to the UK one. You know, in the French election, one wanted to come out of Europe, one didn't. We're not seeing that in the UK election. It's the best of a bad bunch, really. So I don't really see how that's affecting the currency, although you will have some that will think that. They will think that that is what is affecting the currency, which is why we're at stalemate at the moment. I don't see it personally. I just think it's at a level where it doesn't want to, at the moment, go any higher or go any lower, and we just have to stay with it because you've got no choice, or you go on to trade something else. You know, you look at across other things, you look at gold, or which really isn't doing a great deal either. The stock markets have made a little blip higher. We've had the S&P overnight breaking up, but again, with anything like that, you've got to be, it's got to be on the cash market, not these spread betting overnight platforms, because they can go anywhere. But you know, it will always be the cash market that will determine where we go, and if it opens up at current levels or a little bit lower, stock market's looking quite bouncy.
Just on a practical level, Carol, I think I might be correct in saying that you don't apply fixed sort of stop loss levels. Is that, or would that be correct?
No, we have to apply fixed.
You do. Sorry, I'm getting mixed up with someone else. Sorry. There's some people prefer to put sort of have mental stops, running mental stops, as opposed to
you always have your mental stop. I mean, the problem with anything, isn't it, is putting stops where stops are seen to be placed. So you do find a lot of guys out there who don't actually put them into the system, but they do run them in their head, and as soon as that level gets hit, you're out. But you should, you know, it doesn't matter where you put your stop. You can put your stop quite a way away, but that is to, if the market gets, you know, if it has a wobble or something comes out and it will run that far away from you, you need to put a stop in at some place at some point. But the idea of not putting them in too tight on a platform is probably the better way to play this.
Yeah, sure. Gordon's asking about the Dow. I know we'll go on to look at that, but for the benefit of, we've got quite a lot of new names here today, and it might be quite interesting just if you could just give us an insight into the sort of patterns that you would look in terms of a trade setting up. What would catch your attention on a chart to give you the sense that...
I think what you have to understand is it's not just the patterns that you see on a chart. All a chart is, for the benefit of those that are new, is it's just a chart of price action, right? So what you're seeing is supply and demand, you know. So over the years, you see these patterns emerge, and you look at the ones that historically have made the better trading opportunities. Now, personally, I like double tops, double bottoms, these little flaggy pennantly things that you can see there. They're good. Now, obviously, it shows you the direction, the idea of the measured targets that we get to now when it's sort of come up against a brick wall like it has on this double top. You can still get these measured targets. You just have to be a bit more flexible, because these days everybody's looking at them. So you've got the pennant here, you've got the flag here, you've got the double top, and this is all still within the uptrend. So you're looking for continuation patterns. You're looking for something that is showing you that the market is going to continue higher until you've reached this double top in sterling that's saying, well, hold up a minute, we might well still be in an uptrend, but at the moment, right at this very moment, this isn't a continuation pattern. This is a topping pattern. If you look at the old style head and shoulder patterns, that, I mean, they fail so significantly a lot of the time. So I don't really look at those anymore. I'm looking at, for example, right, you've got cable here. Now, if you ignore this bit, because it didn't happen, so you're looking at this bit here, you can see quite clearly that's the double bottom. It's classic, okay?
Yeah.
Goes up, there, goes down. That alerts longer term traders, because this is on a weekly chart, that the market is ripe for a move higher. It's going against what we've seen, the trend since what, 2014. Okay, this was the first stop. Even this bit here, continuation pattern. This wasn't a continuation pattern. This is a base pattern. So you could get, there's a lot of reasons you can give of why sterling went from 119 to 130, but the bottom line is it went there because at this point here, whoever was making the big decisions, and it's not us, it's institutions, hedge funds, God knows who, you know, whoever made that decision there that this was going to rally, this confirmed the view. It could have been, I mean, I can think of nothing fundamental that came out that stopped sterling. In fact, at the point of this here, okay, I was looking at it, it was over a weekend, that happened on a Sunday night, and every piece of news coming out about sterling was negative, but something made it, you know, reverse and trade higher. You can't ignore this. You have to be on the back of this. You know, you can see where it then went up to its first retracement, come back down, intersected at these trend lines, and up we've gone again. All we're doing now is we're just going sideways, but you've got to remember that you've got this double top pattern here, and unless it gets above it, unfortunately, sterling's going to take a cold and it's going to come down before it goes up. But nothing's really changed in it. It's still looking, you know, you can see where it stayed in the uptrend, and it's been looking really good since it broke up above 121.
Indeed. So it's the combination of the Fibonacci levels I see that you have overlaid on the previous chart.
Yeah, I do look at Fibonacci levels. I mean, I know there's a lot of people out there that go, oh, do you know what? They are a complete waste of time. But, you know, they're not. Look, here's our Fibonacci level yesterday, 129.22. Our low was 129.25. You know, even if you don't agree with them, even if you don't look at them, you're pretty unwise not to take notice of them. I think where a lot of people come unstuck with these Fibonacci levels, they don't put them in the right place. So therefore, they assume that they don't work. And it's not that they don't work, it's that you're not in the right place. If you put them in the right place, you know, you'd be astounded at how many times they do work. You know, I've looked at them for over 30 years, and they still bring a smile to my face when they get down to a Fibonacci level. And they're not at every point. You can see, you know, they're quite spaced out. You've got 22 there, then you've got, you know, 128.45. So they're not very close together. So you can't even use that argument, or they're going to hit a fib level at some stage because they're so near to each other. They're not. They're actually spaced out. So, but to say, if you put them in the correct place, they're a very good trading tool. They really are.
Could you just remind us where the right place to start? Since you mentioned it, I know everybody's thinking it.
Okay. Well, what I do, look, you've got this. This is on a 4-hourly chart, so I want to look on the bit where the market started to absolutely motor higher. So I've took it from that point there. Okay. Now you can play about with them, but what I do is I take it from the point where the market actually started its big move. You can take this one as well, which, I mean, I've took a lot off because I didn't want loads and loads of lines everywhere. But if that one is too far away, for example, which that one seems to be, you just take it off, and you take it from the point from where the move started, and it started here. You can see where it just motored away, and
So that,
then go on.
yes, so that's a significant thing, is identifying, looking back on the chart to identify the start of a significant move, trend.
Yeah, I mean, it doesn't even have to be a significant move. What you have to do is you have to take it from the place where the move was first obvious. It doesn't have to be, you have to connect either a low and a high, you know, so I can't just put it, you know, if I'm taking it from here, I can't put it here, for example. I've got to put it to at least a high or a low. But where you start it from is basically common sense and looking at it and going, well, do you know what, look, it started from here. So it started from here, so therefore that's where I'm going to take that. I want to see the retracement from that bit. I don't want to go back to, you put your Fibonacci levels on longer term charts where you want, you know, on the weekly chart, I've taken it from the high to the low. That's how I've got these. But when you're trading intraday or shorter term, you really don't want to see the whole of the move up. You want to see what portion is relevant to your trading time frame for that particular instrument. So
in effect, you want to be trying to second guess where everybody else will be placing their Fibonacci's, because they're sort of self-fulfilling and take into account that human.
You say they're self-fulfilling. If they were that self-fulfilling, there wouldn't be an awful lot of people out there getting them wrong. So depending on where you put them, that's the problem. It really does. I mean, as I say, people will say to me, they don't work, they don't work. Well, we know they do. You know, I know they work. I know it's where you put them that's the problem. It's not the actual Fibonacci levels themselves. And you know, you've got very, very short-term traders looking at a 5-minute chart. They're not taking the whole of the move. They're taking from a specific bit that they're interested in. They're not wanting to see the whole of the move up. So you've just got, you know, trading's all about common sense. It really is. I know people want to read lots into it, and there is a fantastic system out there for doing this right and do it. If you just strip it all back and use basic common sense, you'll find you'll get ahead a lot easier than trying to, you know, I don't second guess where others are putting their Fibonacci levels. I put mine where I think they should be, and they work. So I'm not the only one doing it, obviously. Probably all the people I've trained over the years are all doing it the same way. I don't know.
Well, you mentioned that, Carol. How are the courses going? You've been doing some sort of mentoring and residential courses recently.
I have. Yes, I have. It's difficult because, you know, everybody's at different levels. They and look at markets different ways. I'm finding I'm not trying to bully people. That's not what I'm about. I'm not bullying at all, though probably the last class will tell you I am. But you've got to get them to look at the market, you know, in an easier way than they're looking at it. I'm getting people coming in and they've got, you know, reams and reams of stats and various trading strategies that they're looking at. And, you know, I try really hard to go, okay, let's get back to basics. And I think that's got to start. I mean, I think hopefully they're going well, but there are a lot that are coming in with a lot of preconceived ideas about how a foreign exchange market or a equity market should follow a pattern. It should follow this. It should do this. It should. Well, they don't. You know, yes, they are ordered. I like to say that there is there's organisation within what seems to be a chaos theory.
Mm-hmm.
And I think that's the problem. You're trying to apply too many variables to a market that really is quite simplistic in the way it moves. And that's my biggest problem, is trying to get people to basically ignore everything they've learned and start again. Now, I'm being told, you know, well, it can't be that simple. I'm not saying it is that simple. I'm saying if you use the simple approach to looking at it, you will get further forward than trying to apply all these different mathematical strategies to a market that really is not a mathematical strategy type market.
Mm-hmm. Algos have made the market choppy, Yat is saying. So.
Algos have been around for years now. This isn't a new thing. You know, even in my days back at Midland Bank, we used to call them black box systems, that we used to have teams of guys doing it. Algos aren't new. We've always fought algos. They've just got more, what's the word I'm looking for? They've got more clever, I suppose. Don't forget, an algo is only what somebody programs it to do. It's not. It doesn't think for itself. It's given a set of parameters, and it works within those parameters. Now, if you look at, like I do, because I've got quite an interest in the algo programs, you know, most of them break even. So they don't know everything. That I think they're just invented to trip up traders. That's what I think.
You might well be right. Oh, Carol, could we go across and have a look at the Dow? One or two other people have come in, so that's something they're looking for.
The Dow, I mean, it's not broken up at the moment. The level it's got to break up is 21,169. That's what it's got to break. Okay, that's its previous high, and that's what it's got to do. Now it has tried, I'll give it that. I mean, it really is, but we're not exactly bound in a way, are we? We've got the S&P that has broken up overnight, but it's whether or not the cash can sustain it, whether or not it will actually open and hold this level. I think we're trading now about just under the 121.78 we're at now. So we are sort of just below this line here. When I'm sharing my screens, the pointers are really bad. So you can see where we've got to break up above. We've got to break this level here, which is 21,169. If we can do that, then obviously the Dow's in a better position. If you take a look at that weekly chart, you can see really most of this year has just been a complete utter mess. Like since February, it's just sort of up and down and up and down. But basically, if you look at that, it's gone sideways. Now, it's gone sideways within an uptrend. So this sideways, I think, is a continuation pattern. There's nothing out there at the minute that is telling me that the Dow has topped. Not yet. If it gets to 21,150 and stops, then obviously I'll have a look and reassess it. But you know, all the indicators that are coming out, they're not really being able to give you a clear direction. It's just the Dow sideways, and until that changes, you have to stay within that. We've got a swing level of around 2,900 to 2,850, and that seems to be, if it goes below there, it goes lower. If it stays above there, it goes higher. It's that sort of thing. All the Fibonacci levels that I've put on this market, we have, in actual fact, if you look at this one here, let's get those off. We'll take them off. You know, this is the bit we were interested in, or I was interested in. And you see, look, we've come down to that 23.6 fib and gapped up, come down, filled the gap, gapped up, filled it. It's retraced 23.6. So I can not see any reason why we can't try for that 169 area. And if we break that, the continuation pattern that you can see quite clearly on the weekly chart should take that quite higher. I mean, you're looking at the Dow coming up to here, you know, 2200 and then 2320. It's not beyond the realms of possibility, and that's without even taking the measured target off of it, which is, you know, propels the Dow to quite high levels around the 2500 area. So I think with this particular market, all you do is you just, for the moment, you're just buying into dips. Easier said than done when the thing tanks like it did last Wednesday. You know, there was no clue at all in this bit here that we were going to have this sort of move last week, but we recovered. It hasn't had one day of, you know, ever since then, it's just gone up. So logically, you know, what can't go down has to go up, really, doesn't it?
Sorry, I'm just looking at the questions that are coming in. I'm trying to see the most popular thing that's being requested. Do you have any thoughts on the euro? I know that the DAX is not your favourite.
It's not.
From recent, but what about the euro? Any thoughts on the euro? You might have mentioned that already.
Yes, I mean, let's just call that up. It's obviously easier if I bring them up so that you can see.
Mm-hmm.
So look, here's where we made the break. Okay, we've made that break. You can quite clearly see that break higher. Okay, so then we've got the second one. We've just done it this week. We've broken up this week, but look, it doesn't want to go up. It really doesn't. It's double topped. It's rounding topped. It's all right. We've hit the first fib level, but you know, all these indicates everything we're seeing is not saying the euro is looking particularly strong at the moment. You know, we are extremely overbought on across all time frames. It's not just the dailies and the weeklies, you know, even out to the, you look at the weekly, see it's turning there. Yeah. I can't see any reason at the moment at these levels to rush out and buy it. I think we should have quite a good correction first, and I would think to come back to, and this is where I would put my Fibonacci's, I'd put it on this bit here and say, right, well, that's where I think we're going to come back to, between that and that. And also, if you just don't look at Fibonacci's, these are how they all tie in together. If you just don't look at them, we know that that level there was the break point of 1025, and you've got the 50% fib coming in at 1050. We know also that 1035 was the level from a previous lifetime. So around that 50 to 25 area is quite a good area for the market to come back to, and for it then to continue to move up. But I think at the moment it's run away with itself a little bit, and it's got a bit too overcooked on the top side, and this is what we're seeing. We're seeing it struggle. So I'd be very wary about rushing out and buying it until we've seen that quite good corrective move lower.
Mm-hmm. Carol, when you say overbought, do you mean that, are you looking at the stochastic levels, Gordon's asking?
It's the stochastics, the RSI, anything that shows you whether the market is overbought or oversold, really. You can use any of them. I use the RSI and the stochastics because I find that stochastics especially, because they incorporate the open, high, low and close of that particular bar you're looking at. So be it a 4-hourly, a 1-hourly, a daily, weekly, whatever, it takes the whole bar. And if you put that on a 10-3-3 basis, you get when the market is running out of steam. Although the price action might look strong, these stochastics actually tell you, well, hold up a minute, we could be seeing the turn, which is what we're seeing in cable and the euro at the moment.
Fantastic. Thank you for that. But does anybody else have comments on the euro before we move off to look at another stock? The FTSE being mentioned a couple of times. Have we looked at the FTSE already at the start, or?
No, we didn't look at FTSE. Do you want to look at FTSE? Is that the one you want to look at, Simon?
Yes, please. Yes.
Okay. With anything, what you should always do is you take a look at the longer term time frame charts first. Okay. So you take a look at the FTSE and you go, right, okay, well, we're not actually, where are we? So we look at the weekly chart, still in an uptrend, nothing new there. Go out to the daily, still in an uptrend, nothing new there, but there's levels we have to clear. You know, we have got to take out those highs. We have no option. Can we do it at the moment? Well, if you look at the stochastics, they're actually down. They've eased from that where it was extremely overbought, and it came down, didn't really do any damage on the downside, and out we go again. So the market is well placed, to be fair, to take those highs out, but it's got to do it, and it's got to do it in the cash session. I think this is, when you're trading the FTSE, this is a really big, huge problem, I think, is if you're trading outside of the cash hours. Years ago, you didn't. You weren't allowed to trade outside the cash hours, you know. So the market closed, that was it. It didn't do anything until it opened the next day. Now it can go anywhere it wants, but the actual volume and the thing that will move the market is the cash. So I do all my analysis and all my trading only based on the cash market. I don't look at it outside of hours. So you have to know where this is, and this is at 35, okay, 33, 35. So that's 75, 33, 35. So we've got to break that. And as you can see this line here, if we can do that, then we can stay within the uptrend and trade a lot higher. Looking at that weekly chart, there isn't really anything that detrimental to it. I mean, it's looking, whatever way you look at that chart, it's looking quite sexy, really. It doesn't seem to want to go down. It's not overbought. All right, it's at higher levels, but you're actually only looking for a turn. If you look at the RSI, the weekly RSI, it's not overbought at all. You know, it's only if we start to go above 80% that there is room for a change. What you're looking in these indicators are for them to start to turn. That alerts you, not while they're still pointing higher, and they're still pointing higher at the moment. So if they're still pointing higher, the chances are we're staying within this channel here, and we're going to go to the top of this channel here, and that channel comes in this week. Well, I don't expect it this week, but if you just follow it out, you're looking at 76.35, 76.40, 76.60 as the weeks go on. So you can define just by eyeballing that, you can see that it's in an uptrend. You can't not see that. But what happens is when markets get away from themselves, so they start to accelerate within their direction, you do get these pullbacks. Well, we've seen this from, you know, the middle of last year when you saw that FTSE base there, that head and shoulder base there. You knew pretty well that once it broke through, which seems quite funny now, but once it broke through 63 and a bit, it was going higher. Whereas here, we're calling for FTSE to go to like 50, 4,800, 4,500. You couldn't find anybody who wanted to buy it. Now, you know, it made that pattern, it reversed, and off we've gone, and we've stayed bid for like 18 months. It's not, you know, it's been, well, not 18 months, but a year at least. We've been in this uptrend for a year nearly, so stay with it. Why not? It's just that when it gets to the top of its range, you don't want to be buying unless it breaks. So at the moment, there's no reason to think that FTSE isn't going to break higher. But as I say, it needs to clear this bit first, and then we can. As soon as that breaks 75.40, you will see buyers coming in. And I think what scares people is they think, well, why do I want to buy the top? I hear that all the time. Why do I want to buy the top? Because that's what makes markets move, you know. You're not buying the top, you're buying it. You don't want to buy it at 33, agreed, but you do want to buy it on a break of that, because that suggests that we're going to go to here quite quickly. So that's why you buy a break of recent, especially when you're at all-time highs, which we are.
Fantastic. Thank you. Okay, one or two questions coming in. I suppose it's always there, the Aussie dollar and the Japanese yen.
Well, the Aussie is going to follow gold, right? That's a commodity currency. So really, that's a gold play. If gold goes higher, Aussie's going to go with it. It might take a couple of days, but it will do it. As for the dollar yen, as you all know, dollar yen is a stock market play. You know, that's what it does. If the dollar, if the S&P is trading higher, dollar yen will follow. It really is that simple. So you have to look at these market correlations, which I don't think a lot of people look at.
That's interesting. Yes, the people are maybe too narrowly focused on the pair and the technicals, and not taking into account these big fundamental impacts.
Well, as I say, I'm no fundamentalist. I just know that you've got, you know about the risk on, risk off trades. You know Aussie is very closely correlated to gold because it's a commodity currency. So if gold is going through the roof, the Aussie isn't or shouldn't puke. It should go the same way. So if you are trading that, it's like people trade sterling and they trade the euros, and nobody looks at the euro sterling market. I find that quite difficult. If you're trading to outright majors against the dollar, you have to look at what the spread's doing. You have to look at the euro sterling, because you know euro sterling doesn't stay the same. You know, it moves, and they all move. All these markets do have intermarket correlations, and if you want to buy the euro and the euro sterling is looking like it's not very good, then it alerts you to maybe the euro isn't going to go up as fast as I think. Maybe it's sterling that's going to go up a lot quicker, and vice versa. You know, you need to keep your eyes on other things that affect the markets that you're trading, and I don't think that too many people do that, which is amazing, because euro sterling is a big market by itself. And we've seen Aussie, you know, as soon as that gold started to turn, Aussie was with it and went the same way. Now, sometimes it takes a couple of days for it to follow through, but you've got to keep your eyes on these things. You must, if you're trading one thing, not become too focused, too, the Aussie's going to do this because of, well, look at gold, and if gold's showing you the stats, that's the way it will be, fine, but you've got to look at these other markets.
Mm-hmm. What would you advise? There's some people, they advise people to follow the institutions insofar as they will have their special desks where the analysts learn everything they possibly can about one particular currency or stock market, and very much specialize in just that area or that currency or that market. That sort of, for most retail investors or traders, I suppose it's easy to try to sift through all the markets looking for that perfect setup for a trade. Would you think that's a mistake, to be trying to spread yourself too thinly, looking for patterns across all the pairs, or should you look and study and learn one particular pair and get to know its cycles and all the fundamental political things that can have an impact on that. So you're ready to take advantage when the opportunities come.
No, not really. I wouldn't say to look at one particular market, to be fair. I think you can quite easily take on board 4 or 5 markets. You know, you've got to, I mean, all currencies, unless they're intermarket currencies, but all currencies are based on the dollar. So you've got to have some sort of general idea about what the dollar's going to do, you know. I don't look at figures, as you know, but I was there for FOMC last night, and I look and I think, you know what, that weren't bad news for the dollar. In fact, I thought the dollar was, you know, should go higher. Totally the opposite. It was the currencies that went higher. So you can know, you can be in the market years and years and years and years, and you still get these fundamental things wrong. I'm no fundamentalist, but what came out last night didn't seem to me to be bad for the dollar. But obviously currencies are in an uptrend, and that's the thing, okay? If you go back to when I very first started trading, I was a fundamental trader. God forgive me, but I was. And every single piece of news that came out was negative for the bond market. That went up. It just went up. And it didn't matter what came out, it would dip down a little bit and then go blasting higher. That taught me that whatever the market as a whole was looking at, it wasn't looking at these economic figures because they didn't work. So although you can have a broad outline or outlook on what you think the dollar's going to do, you know, even us professional traders, we can get it wrong. And the reason it's getting wrong is these currencies are in an uptrend, and it doesn't matter what the dollar's going to do until something tells you they are not in an uptrend anymore. You're going to get people buying dips in currencies because it's like a load of sheep following chief sheep. It goes up, and then they all jump on board. You know, institutions aren't any different. We don't have, or we didn't have, huge teams of research people. You had me and a couple of others that were looking at currencies across the board. You know, we were saying well, back then it was dollar mark, but for example, where dollar mark was going to go, where dollar Swiss, dollar yen, you know, there was about 5 or 6 of us that covered the whole of the dealing room, and we traded our research ourselves. We didn't not trade it. We did trade it. So you don't have these desks of people doing research, I don't think, anymore. The retail market can quite easily handle 4 markets, I would have thought, to have a look at. I mean, I look at a lot more, and I mean, I miss things because it's quiet for me at the moment. It's not doing a great deal, so I'm not as focused perhaps as what I should be. But I think if you're a retail trader, you can quite easily look at 4 or 5 different markets. You know, why sit there glued to a euro? You're missing so many more opportunities by broadening your outlook and looking across different markets.
Mm-hmm. But still, maybe 4 or 5. I mean, I think there's something to be said for learning a market, and maybe perhaps not
difficult to learn. I mean, it would be like somebody saying to me, "Well, learn the euro or learn the dollar mark." There's nothing really you can learn about it. There's only so many figures that come out, and the figures you've got to imagine is they're all a month out of date, so they're already priced into the market. So unless you get a really wacky figure, it's already in there. Don't think for 1 minute that the German banks don't know what the German figures are and the Swiss banks don't know what the Swiss figures are, and vice versa. I'm here to tell you they do, because their major bank, their central bank, are not going to let the German banks not know. I mean, or should I say, but you know, at the UK clearing bank I worked at, we knew the figures. We knew what they were coming out as, because they can't have you stuffed around the wrong way. It's not in their interests. So unless the figure is way out of line, it's already priced in. It's a month old.
So are you trading these events, or do you watch them but just try to avoid trading the actual event itself?
I like trading over it, only because I like to pit my wits against what the rest of the market's doing. I quite like trading over figures. I always have done. Nothing to do with the figure. It's to do with the fact that it might make it move in the direction I think it's going to move. I used to love trading non-farm payroll. I can't be bothered with it now because it doesn't move. You know, we're beyond non-farm payroll now. It's now looking for something else. It's now looking at FOMC, which, as I said, was a damp squid last night. So you're better off not learning about all these economic figures, to be fair, because to be honest, they don't really help you in the day-to-day trading. And that's, you know, at the end of the day, whatever way we want to dress it all up, the end of the day, trading is about making money. It's not about knowing how many figures do what and what it means and blah, blah, blah. It's about if you've bought at 25 and it goes to 75, you're happy. If you buy at 25 and it pukes, you're not happy. It's that simple. And you can only get that by looking across the markets at the different time frames and looking what the price action's doing. I mean, all it is supply and demand. You know, we know the currencies are in an uptrend. Therefore, even on a figure that makes that come down, it's still going to be bought back up because the market is thinking currencies are in an uptrend. Now, unless you get your head around that, you're going to come unstuck. I'm not saying you can't sell short currencies. There are levels where you can, you know, where you are scalping, for example. I don't scalp, so it's out of my, you know, spot traders do that. It's not what I am all about. But you can take a short position in an upward market, but you're leaving yourself in a far riskier position than you are going, it's in an uptrend, we're buying dips, because that's what the rest of the world is doing. It's waiting for these pullbacks to buy it. It's not waiting for it to go up to sell it, because it doesn't look like it's going down. So until you see a top, you know, like you've seen in cable, for example, you've seen a top there. So of course you're going to get people going. But remember, doubles hold, triples don't. So it's probably going to be, you've had that now. The next time it gets up there is the time it's going to break. And you'll still see these people selling it. And that's where they'll come unstuck. And it'll be self-fulfilling, because those poor souls that are short up there thinking, why not? History repeats itself. Yes, it does. History does repeat itself. But there is also other factors to factor in. There is doubles hold, triples don't. We know that as people have been in the market for years and years. So we're aware of that. So we're not going to be selling up at that level anymore, because the chance, the high probability is that it's going to break and to continue to go higher. I mean, if you look at 4 or 5 currencies, there are trading opportunities every single day. There really are. But if you focus too much on the euro, I mean, I've got guys that just trade FTSE and get very frustrated when FTSE doesn't do anything. You know, they get very upset and they stick buttons out the pram and whatever. But, you know, if it's not moving, look at something else. Go look at something else that is moving. You know, pick some favourites out. I suggest that people look at 3 currencies, gold and stock market. Then you get a broad picture of what the world is doing, rather than just being euro focused. Does that make sense? It does to me, but
it does. It does. Does anybody else have comments or questions? We're just down to the last few minutes with Carol.
I really don't feel well.
You've battled on very well. Thank you. you sound good, if that's anything to go by. But well, Carol, I think we will let you go then.
Thank you.
Thank you very much for joining us again, and hopefully you'll feel better soon. I know everybody's wishing you well. Hope you feel better, Carol. But we'll keep in touch, and we'll hopefully hear from you again in the future.
Okay. Bye, Simon.
Okay. Many thanks indeed.
Okay. Bye.
there. So my thanks to Carol Harmer at Charmer Trading Academy there. Not 100% unfortunately today, but as always, lots of nuggets of information coming through just on how she keeps it simple and how she approaches the trading. So that was very interesting. We're around about just under 10 minutes away from our next presenter, Peter Watson, over at Pelican Exchange. So if you're ready for a cup of tea and something, now would be the chance to go and put the kettle on and take that 8 or 9 minutes until we get started again at 1 o'clock. In the meantime, I'll welcome everybody that is joining us. I can see, as always with this event, there's a sort of a rolling attendance of people that dip in for maybe 1 or 2 or 3 sessions and then go off to do something else, safe in the knowledge that they can catch up with the recordings at a later stage. But we do like to have you as live as possible. Of course, all the speakers on this event are live. There's no recorded webinars that we're replaying to you on this event. We do have a great session still to come. We are looking at the Pelican trading network just in about 7 or 8 minutes time. Then at 2 o'clock, Rob Colville, the lazy trader, he's going to be talking to us about the carry trade, which is his favorite strategy. That's a strategy you can bank on, he says. At 3 o'clock, we're going over to Steve Ruffley, steveruffley.com, Chief Market Strategist at intertrader.com, and also a trading mentor in his own right. He will be, again, looking at the charts, looking through the fib levels, looking at the US, the UK, and the Euro, and anything else. I'm sure he will be commenting on all the political situations that are going on around the world at the moment. So that's at 3 o'clock. Then we move into the evenings, or the early afternoon sessions, really, I should say. Adam Harris, tradewithprecision.com, a rerun of his live seminar that he conducted at the RTC Live in London on the 6th of May. A 6-step strategy that you can apply in any market or time frame. Adam will be coming to deliver that at 4 p.m. this afternoon. And again, just when we were mentioning scalp trading with Carol 5 minutes ago, our speaker at 5 p.m., Mike Hamilton, is a scalp trader himself. Scalper Trading School, consistent profits from daily scalp trading strategies. So join us at 5 for that seminar. And then we're crossing over to the US for the 6 o'clock and the 7 o'clock sessions. Of course, that's 1 o'clock and 2 o'clock in US Eastern Time, consistently predicting market tops and bottoms by Bo Yoder, and the trends and opportunities in the option markets and the ETF flows. Christian Fromhertz from Tribeca Trade Group at 7 p.m. Mark's just texted me to say he's missed the, the schedule before that. Can I go back? Of course I can, Mark. There you are. We are just here coming up to the Trading with Pelican Network session, which will be starting at 1 p.m. And then we're having a session on looking at the carry trade specific strategy at 2 p.m. by Rob Colville, and at 3 p.m. another live market update, looking at the live markets with Steve Ruffley. Very much a fan of the Fibonacci technical and fundamental levels as well. So still lots to go, and Frank's saying, can we receive a recording? Yes, you can, Frank. We will be processing that overnight and into the morning. With it being a fairly hefty video, it does take quite a while for us to process it and edit it and then sort of upload and download it, all the things that have to be done. But we will get it out to you just as soon as we can, normally by tomorrow afternoon. of course, all the recordings of all the round-the-clock traders that we've done since 2015, I think. The recordings go back to are available at the London School of Trading. I'll let you see this website in just a moment. And this is where, if you are a member of the what we call the On-Target Trading Club, you can have access to not only the recordings that are updated every month after these live events, but also the full archive. So looking at my own account here, if you can see that, we have all the recordings there from April, and that's all the live events there. March, February, January, and again you can see we go back all the way back to March 2015. So lots of 300 odd webinar recordings in there. It's just simply a case of pressing the start button, and then the video will open up and you start playing. There's a recording of Kim Watson. There we are. So that's a recording from Kim Watson last month. So London School of Trading.com. If you want to become an actual member and get access to all these, as a registered attendee, you will have access to this particular set of recordings already. But should you want to increase that and not have to turn up for the live events, then simply as a $6 monthly subscription for the membership. So I'll put that link in here actually. So if anybody wants to go, it's London School of Trading without the wwws. Don't ask me why, but there you go. That's the link to use. So great to have everybody here. It's a good number of people in the event today, which is great. And I can see a lot of new names, which is also very good. And not to mention our regular attendees, which we're always grateful to have, providing great input and questions. But if this is your first event, I'd be very happy to hear your feedback and let me know how you're enjoying it. And if there's anything that you think we're missing out, do let us know, and we'll try and include that in an event going forward. So let's go forward now, as we do for our next speaker, who is Peter Watson, who is the head of business development at Pelican, and I can see that Peter is here in the webinar, so I will take his microphone off and say, hello Peter, you should be able to hear me now.
Hello, good afternoon.
I can hear you, you're coming through loud and clear, which is great. Can we ask everybody on the webinar just to confirm that you can hear Peter when we start when we start talking?
Great. Test, can you hear me?
Test, yes. Getting all the yeses and okays coming through. Great. Okay. Thanks for joining, Peter. We've just finished listening to Carol Harmer, who has given us a rundown of the markets, and so there's a nice link there because, of course, Carol is one of the Pelican mentors.
Absolutely. Yeah. So Charmer Trading is a group on the app, and yes, in fact. Oh, I noticed. I thought that John Piper was speaking. He's not today.
But John, unfortunately, he's had to postpone. So he's actually been replaced with Rob Colville at 2 p.m. But yes, now we do have a recording of John's talk, which I'm going to be sharing with everybody as we go through. He's done a special recording to YouTube of his talk, but he was.
That's great, because certainly John is also on the on Pelican, and I was thinking maybe I'd be in a metaphorical sandwich between Charmer Trading and John Piper, but it's great to see so many mentors who are benefiting from Pelican and benefiting students speaking at Round the Clock Trading webinar.
They are indeed. Just by way of an introduction, you'd like me to do this introduction. Pelican is a I think I mentioned at the beginning of the event. It is a trading platform, communication platform, in the form of an app, which you can download for free onto your smartphone, and then join up to various mentors' private groups and get the benefit of their signals and their teaching through that. It's a very convenient, user-friendly app, so you can actually look and search for groups based on the mentor, or even based on particular asset classes. If you're very hot on the trading the cable, then you'll find a group based on that, or the FTSE, any one of these groups. It is free. Yat's asking. It's a free. You simply download it. I'll put the link in the chat box now for you to just go ahead and download it. And consequently, if you download that, it only takes a few minutes. The first thing to do would be to search for our group, which is the Round the Clock Trader group, and everybody's partaking in that, and we're having a bit of a conversation ongoing in that all the time. A little bit almost like watching Question Time, and the conversation going on online as well at the same time as the live program. So Peter, you probably do a much better job than I can, but you're
I can't thank you enough for that, and that's a lovely introduction. Thank you, Simon. As you say, it's completely free to download. I'm sure quite a lot of people listening and kindly giving up some time on their Thursday afternoon will have already downloaded it and have a profile up on Pelican. We are a broker. We're not simply a social forum for traders, although as you'll hear, that's very much part of it. So I think I should probably get on with the first slide, how to identify and connect with the best mentors, educators, and pro traders. So what we're trying to do at Pelican is connect the world of the pro trader and the mentor with traders of varying levels on their journey to reach their trading and ultimately financial goals. The starting point perhaps with this whole topic is why do you want to take control of your own money? Now, a lot of people, most people have a pension of some kind. Some people decide to manage that in a SIPP. If you take the step into trading, you have to decide how much time you're willing to give to that. Now, you might, at the top end of the tree, you'd have the pro trader who derives his whole income from trading. So his no 9 to 5er, he can completely concentrate, and that's it. Lower down the scale, it might be a second income for school fees, second car, holiday, and finally it could be a means of hedging an existing portfolio. Now, that's a more technical thing to attempt. It's less common, rarer. We don't see so many of those. But what we're trying to do at Pelican is help all of those people find the right mentor. So that's why it's so important to connect with the educator that suits your goal. If you want to be a pro trader and derive all your time from it, there are mentors we can put you in touch with. If you're looking to do it as something of a second job, again, there are mentors that are excellent at that. And finally, if you want to technically hedge your portfolio, there are people that can help you there. And I think on the whole topic of managing one's own funds, certainly everyone at Pelican, certainly myself and the two founders, Mike and Peter Reed, have all worked in the financial industry. And I'm afraid the reality is that not all IFAs and stockbrokers have your interests at heart. Many of them use their clients as a money-making machine. Not all by any means. I'm not saying they're all bad eggs by any means, but there's a strong profit motive and reason, of course, for all these companies to make money out of their clients, that adversely affects your performance. And that's why more and more people are sensibly deciding to manage their own money, whether that be through traditional stocks and shares or what we're talking about now, which is trading. I think Simon's in control of the slides, if you could kindly skip that one. So that is not a picture of me, it's a picture of Mike Reed, director at Pelican. Say his background, I'll just briefly go through our background. So he's a qualified fund manager, and he did corporate finance at Evolution, which specialized in the AIM stocks, or the team he was in specialized in the AIM stocks. So that's himself, Mike, and Peter, his brother, who founded the company. Peter worked for Chenkos as an analyst, as an equity analyst. All of us trade. None of us are professional traders, of course. Peter Reed probably trades the most. He, when I say the most, spends the most time on it. He, interestingly, when he was an equity analyst, of course, he spent most of his time studying stocks on a fundamental basis. And one of the reasons he started at Pelican is because he became very interested in the technical sides of things, selecting stocks on a technical basis. He, as it happens, follows a mentor called Zahir Anwari, the dynamic trader. And yes, so that's their background. My own background's in stockbroking. I'm learning how to trade, like many people listening. And it's a fascinating topic. So I think perhaps if we get to the next slide, we will see what's going on there. Why do people trade the markets? Of course, the ultimate goal is to make money. When you do, what we are saying is when you do anything, you want to find an expert. I've already been through most of these things, so I think we'll go straight on to the next slide, if that's okay. Already been through income, extension of earnings, hedging. Yeah, so really at Pelican, sorry, back one, really learn from an expert. So unlike the other platforms out there, you know, that have the existing selection of shares, selection of markets you can trade, what doesn't happen at these brokers is the ability to learn from an expert, to get put in touch with a mentor. Now, you could try trial and error. You could take advice from a friend who has a bit of financial knowledge. You could, at an extreme end, buy a system, an EA package that plugs in to your computer and just gives you the trades. You could try learning yourself. Now, probably I'd have thought, if in the event you don't want to go down the mental route, learning completely on yourself would be the best one of those. And that would mean going to a bookshop, reading up on the subject, and making your own mistakes. However, at Pelican, we're firm believers that by getting advice from some of the great mentors who you're hearing speaking on the webinar today is the best route to go down. And if you can find the best one of those for you, that's 100% fit for your needs, it's going to be money well spent and save you a lot of money. It's unbelievable. You know, most mentors say this, you know, when you start off trading, you're going to lose money. And I think that's probably right, actually. When you start off doing your own trades, your own thoughts, you are going to start losing. The way it's about turning that around and becoming a profitable trader, starting small, turning it around, practicing on a demo account, following a mentor on Pelican. So learning from an expert. The next slide is, please, Simon. Thank you. So what is on offer out there in terms of mentors? Well, the answer is it can be the Wild West. If you randomly look up, learn how to trade on the internet, you'll see the huge number of hits you get. The terrifying thing is this is all unregulated. Sorry, all unaudited. There's no central market to make comparisons. There are, of course, some great mentors. There are, I'm afraid, some awful mentors. However, at Pelican, we select specifically the mentors who we believe are genuine, have a track record, have a history of good trading, are willing to put up live trades, are willing to stand by what they're doing. And, you know, we've been to many courses, we've read books, we've done the CDs, the one-on-one tuition. And this is one of the reasons we formed Pelican, to give people a guide of really where they can get advice that's going to point them in the right direction with their trading journey. So from the Wild West, we go to the next slide. Please, Simon, thank you. I'll just find this in my notes, hold on a minute. Yeah, so the checklist when considering a mentor. Perhaps the first and most important thing is price, how much they're charging. Now, if it's 10, 20, 30,000 pounds, that's an immediate warning bell. If that's what they're asking for you straight off. No serious mentor will demand a huge amount of money. That's the kind of money that should be in your trading account, not going on education. What are they actually teaching you? The strategy. Obviously incredibly important. It's got to suit you. You've got to decide what kind of trader you want to be, and there will be an element of trial and error here. How much time have you got? You know, do you want to be an intraday trader short term, or do you want to hold longer positions? Well, what's your style? What kind of personality do you have? Do you have a full-time job? If that's so, you're going to need a very different mentor to somebody who's going to be able to concentrate this and try and turn it into a full income. The other interesting factor I'd point out is, you know, a good trader isn't necessarily a good teacher. So, you know, many of the mentors, of course, are excellent traders. We see even more great traders on our platforms who would be hopeless mentors and would not suit anyone's style, be worth following. They're just too random. So I think style and building your own style is just so important in this area. So are they accountable? Can you see them trade? If somebody just gives you, with the benefit of hindsight, a number of trades they've done on the past and said, hey, look at the money I've made. You know, fine, that's fine, nothing wrong with that in itself. But if they can't also trade live and show you what they're doing, show you the opinions on what the markets are going to do in the future, then what on earth use is that to anyone who's following them? So what is the end product? We've sort of dealt with that. Are they independently endorsed? Can they demonstrate form? Very important. So on Pelican, all the live trades are up there. They're in their history. You can see them. You can see exactly what they're doing. It's not simply like getting recommended somebody by a friend or believing promises online. It's there. You can see their performance. And certainly look out for the upsell. As I was saying, point number one, some of these big prices, you know, they might start with a free seminar all day. And we're talking about the bad eggs here. There aren't many of them. They'll get you in there. They'll say, well, you know, £1,500 will get you a, you know, another course, 3-day course. And you get great, I want to learn more. And then before you know it, you're into the big money. And I think, you know, a lot of people talking to this just won't be something that's affected them. They're at the next stage, that they understand what they're doing with their trading. But for people who are very fresh into it and are promised, you know, literally people are promising fast cars, you know, immediate riches, like winning the lottery. It's just something to be wary of if you're very new to it. Hero trades and hero traders, same sort of thing. Anyone can have a lucky run, get it right for a bit. That's not what we're looking for on Pelican. We're looking for people with a solid track record. Of course, people are going to have down weeks, down months. I'm afraid that goes with the territory. Trading is very difficult. You will have failures along the way. As long as you realize that, it will set you in good stead to become a successful and profitable trader, hopefully with the aid of a mentor. So, brilliant, Simon, thanks. I think we've done that slide. Simon, yeah? Oh, brilliant, thank you. So this is pretty much on the same topic, beware. So I went along to a course, a person who will remain completely nameless. And this was on my chair when I got in there. Actually, so this wasn't on my chair. it was the full prices that were on my chair when I got into the seminar. About an hour later, lo and behold, they'd been discounted. And of course, these are huge sums of money, 50,000 discounted to 24,000. Well, what's that? 2 or 3 years school fees, 34,500. What's that? As long as you haven't got very expensive taste, that's a pretty decent sports car. Again, £15,000. There's your conservatory or maybe a small extension. But if you bought any of those things with that money, you get some kind of guarantee or a warranty that, with your car, you're going to get a 5-year warranty. This being a totally unregulated area beyond the reach of the FCA, you've got to be wary of this because there's no comeback. And what is happening here is by throwing a big number at potential students, 20, 30, 50,000, it makes them think they're getting something amazing for their money. And in my experience on that course, to be honest, it was something that you could have got for £4.99 on Amazon, and you'd have got a much better idea of what's going on. Now, I'm not saying some of these people can't trade, they probably can, but they decide the only way they can make money out of it is by upselling the courses. This is a minority of mentors. I'm just going through this to make people aware of what to avoid. Right, brilliant. If they're so good at trading, why are they mentors? Sorry, I just had a sip of water. This is the question, isn't it? It's the question that keeps on coming up, and it's a very fair question to ask. It's also quite a tricky question to answer sometimes, because you're thinking, well, honestly, why are they mentors? Why are they not just trading? So I think the answer to that is some of these guys like an audience, they like to talk, and they really enjoy it. They may have had a career in a city as a trader, they may have done a lot of their own personal trading, and it's something they enjoy. Secondly, almost all traders' incomes are quite, have a bumpy element to them. As I've already mentioned, a month down here, month down there, big up month. This, of course, with if a mentor is operating with a monthly subscription model, as many are on Pelican, then that gives them a steady income and something to smooth out the ups and downs of their own trading. Ironically, one of the best traders on our platform who takes huge positions, has no interest in being a mentor at all. And he said, if you want my trades, you can have them. But that isn't really the mentor we want either, because we want somebody who is going to help us learn to trade, to become our own kind of trader, with the mentor giving us advice and being in the background. Great, so I think we're on to the next. Sorry, Simon, yes?
Yeah, no, I just thought I'd come in here because I've obviously had a lot of interaction with traders and trading mentors over the years through doing the live seminars and, of course, all the webinars. And it's true to be said that there are a lot, and they are absolutely genuine in their assertion that they do make money from trading.
Yes.
Whether it's lots or just enough for them, it doesn't really matter. And they love to get involved, and this is often the case. Well, then we'll come on and do these webinars even.
Yes.
It's just because, of course, it's a lonely pursuit to be sitting at your desk trading away. You don't have that trading floor psychology, so you grasp onto these opportunities as a retail trader to sort of just bounce off ideas of charts, and this whole thing of social trading that's taking off is very relevant, and a lot of these traders, they get a lot of enjoyment, a lot of just a good feel from getting involved with having a group.
I completely agree with that, and certainly the mentors on Pelican, the ones who are on there now have shown that, and it's like having a teacher at school. If they, the teachers you remember are the ones who had enthusiasm for their topic, and the mentors speaking today, they have real enthusiasm for what they're doing. Of course, if you get someone who stands up and says, when I trade, I pay for my skiing holiday by putting a trade on in the airport, and then closing it out when I get to my skiing holiday. This is the stuff I've heard, absolute nonsense. What we want is people, trading is hard, they accept it, but they're great teachers and they're enthusiastic, and they make it fun, they make it enjoyable. And in a group at Pelican, what you get is sort of the power of the crowd, that you can, you know, sort of the wisdom and the power of the crowd that can improve students' decisions. And we'll touch more on this later. But yeah, it's so we're going perhaps go straight on to the next slide. It's not just about the performance. We've been through some of the mentors that you have to be wary of. There aren't very many of them. Many of the mentors, especially on Pelican, have a great following and are able to give you the skills at the end of a course that's going to make it very worthwhile for you. So we've got some of the other valuable lessons that can be learned from mentors. So if we just go back a slide, I think, Simon. Sorry, back one. Yeah, this is the one. Thank you. Risk management. Everyone will say it, who trades, absolutely vital, whether that's 1%, 2%, or it's a system of compounding. That you know, the way you manage your risk is absolutely vital, and it's certainly, that is probably the single biggest error you can make when you begin to trade. It is not to manage, is money management. Managing your trade behaviors. Trading is very, you know, you can learn from the mentors the importance of discipline, sticking to your system, whatever the system the mentor is a proponent of, and remembering not to deviate from your strategy. So, you know, I speak to traders, you know, very regularly, and a lot of them will say, well, I was going really well with my trading, and then I had this sudden idea that I thought I had a big edge on the euro dollar, and I took a large position. It went wrong. It knocked me out. Now, what we hope is, if you're in a group at Pelican, you'll be encouraged by your friends, and you'll be able to discuss a trade before you go into it. So they say, well, listen, be sensible, stick to your 2% risk, or whatever that is. So another thing is market strategy focus, market focus. Of the traders I speak to and the mentors, again, that some of whom I follow myself, focusing on a small group or a handful of markets is proven to give you a better chance of success, more likely to get an edge in that scenario than if you're trying to do everything. If everyone's trading gold, silver, the FTSE, I mean, I know you can trade in anything, but some kind of focus, even if it's in different markets like that, but just not trying to do too much is really important. Another thing to be worried about, I mean, if there's no after-sales service, so all the mentors on Pelican, they charge a sensible amount and they want to keep you on board and they have a plan for you. If somebody ever says, you know, £10,000 for the course, after 3 months you learn actually nothing, see you later, waste of time. We don't want that. So Pelican's a great environment for mentors to give that after-sales effort, keep them in their groups, but perhaps have a different rate for people who are almost there as traders. So people aren't going to necessarily charge the same amount of money or anything like that, but they want to see you through the journey. You know you can find your mentor on Pelican, and it gives you that security and peace of mind as you grow as a trader. So the community and the power in the crowd, I've already touched on that within the group in Pelican, and you'll have to, if you haven't already, download it and see for yourself that, you know, the ability to chat and interact, it really is the unique feature of Pelican in a fully regulated environment. You can't do that on any other trading platform. So I think perhaps if we move to the next slide, brilliant. What is Pelican now? Because we already covered this a bit. Mobile app, the desktop's coming in 3 to 4 months, and we're very aware here that most traders trade on desktop. We wouldn't pretend our charts replace the desktop charts yet, which is why we're going to have a desktop version and a much fuller and actually top of the range desktop charting package there. We're currently only a mobile app. And the next slide, please, Simon. Great, thank you. Just find my notes. So here we have it. Here's the mobile screen, Pelican on it, best-in-class trading platform. we don't pretend to be better at execution than IG. That's what we're aiming for. That's what they do. We're just as good as them. Over 1,500 markets. That's a lot. Again, it's not everything. The one thing we don't currently have is options. But the great thing is if you want a market, we can add it within 24 hours. Just give it a ring, bang, you're there. It'll be there for you in 24 hours. I know that we're in the process now of getting Bitcoin and Ethereum and some of these cryptocurrencies onto the Pelican platform. So top right, if you see connect with other traders, this is really important. So on the app, I've already discussed the groups that mentors are able to head and educate students, show their trades, really like no other scenario out there at the moment within a regulated environment. There's also the option for private groups. So you and your friends say, well, we're not just talking about novice traders here. People, have shown interest to work in banks, trade themselves. They can get together with their friends, like they do on Bloomberg terminals in their profession, form a group, discuss trades, get the latest market info off their mates, and that's something that all levels of traders can do. Not everything has to be public. You can have a completely private group, just like on WhatsApp. Discuss trade with your mates. So the other really important thing on this page is bottom left, the only FCA regulated social platform. Now we spent 3.5 years getting a particular kind of RDR compliance, which effectively makes everyone operating on Pelican an investment manager. It's like being a fund manager. So that being the case, everyone is able to copy, tap on the trade, copy it, or even inverse it if they want to. And no other platform is regulated to do that, but fully by the FCA. The aim of it is really for retail traders who view and share their trades with each other in this environment. WhatsApp meets Bloomberg meets broker. There we are. So that's marvelous. And on to the next slide, please, Simon. Why is Pelican relevant to finding a mentor? Well, it's kind of been I think we'll go straight on to the next slide here, which has got some information on the marketplace for mentors, please. Thank you. So yes, when Pelican was started up by my computer reader, it wasn't really envisaged that we were going to become the marketplace for mentors. We knew they knew they had a great idea to create a truly social trading platform. What they didn't realize is that this whole area of mentors that would sink in with our ideas. And it's really so important that we attract the best mentors willing to show that they're live trades. And just going through a couple of these, I noticed, so Audacity Capital, he's later in the presentation, great friend and support of ours. Easy Trader, Charlie Burton, Master Markets, Rishi and Thiru, Trader Noble, Brian Noble. We've got some really great traders on here, Steve Ruffley, Carol Chalmer, who's been mentioned before. So there's lots to be excited about in the groups currently on Pelican. And we'll go to the next slide, please. Great, so as mentioned before, Karim, so he's a great friend of ours who's been really the first mentor to get up and running on the app. Expert trader and analyst, manages 30 traders at the Audacity Capital trading floor in Shoreditch, nearby our offices here. Founded the Hidden Talents program for financial traders and trading. So this is a kind of high-end program for people who want to become professional traders. He's an easygoing personality, a great trader, has managed funds in several banks and hedge funds in the Middle East, and has seen in-depth knowledge of FX markets, macroeconomics, etc., etc. And he has formed 2 groups, Pelican, as a mentor. And I think in the next slide, please, there's further information on those groups, or should be. Creamy's from Pelican, that's right. 2 public groups launched last well, actually a bit out of date, so they launched about 2 or 3 months ago. You can see here, if you haven't downloaded the app, that's roughly what it looks like now. Again, it's not completely up-to-date version, but you can see the various groups there. And so Karim has 2 groups, one specializing in Forex, Audacity Capital Forex, the other one in commodities, Audacity Capital Commodities. You know, and this really is the salient point about Pelican, that this allows Karim to be answerable to his followers. If a mentor says, well, this is the way I select stocks, this is the way I trade Forex, go do it, you'll make money. Well, that's great, you may do. Maybe he's giving you gems of absolute wisdom, but on Pelican, you see, right, show me how to make money. Trade live, the proof's in the pudding. So we're not looking back retrospectively with the benefits of hindsight, you know, like looking at yesterday's racing results in the Times or something like that. This, you know, is a thoroughly transparent way for people to teach becoming a trader in the financial markets and learning by your own mistakes and seeing how real professionals trade. So I urge you to go and visit Karim's group on the app and see what he's up to. Now there should be more on this, I think. Great. Audacity Capital Forex. There's some examples so you can see when you go within the group. So on the previous screen, you'd have tapped on Karim's group, and you can see here, it's a little bit like WhatsApp in the way that people can post messages. But vitally, you can also see the trades there. And we will see on the, probably on the next screen, the way you can interact with them. But it's very much, so since Karim's been up there, he's, of course, not every trader's won, no one can do that, but he has been profitable. One thing that's come out of it is that not, you know, you really, if you want to follow a mentor and follow his trades, you do have to do them all. Of course, if you do 25% of their trades and end up making a loss, of course, you're bringing a randomness into it. You really have got to do every one of their trades with the same parameters. So when you do copy a trade, what you will find is you will get the option to copy or invert it. And the same parameters will come up for the stop loss and so on. So you're not just copying the trade, you're putting in the proper stop loss and limit and whatever the mentor has put up there. I just mentioned this, using smaller stakes to ensure accessibility. So I think Karim generally, I mean, he trades on a live account, or all mentors are asked to do that. And he trades on £1 per pip, which is, you know, accessible to most people looking to learn to trade. That's great. I think if we go to the next slide, please, Sonny. So here we go again. Here's a nice little feature of the app. And I think actually if we could probably just go back one slide, if I could point something out on the previous. So yeah, you'll see in this group, to the right of the name in capital letters, Audacity Capital Forex, you can see a sort of bar chart type sign. If one presses that, you get to the next slide, which shows the leaderboard and the performance. Now, only trades placed within the group. So this is where our sort of how-to guide comes into play. We're looking, when you trade within the group, you've got to press the yellow trade button at the bottom left-hand corner of the group. That trader will then come into the group. If you want to do a private trade, you do it outside of a group on the main market page. But the idea of this leaderboard is quite simple, and you can see we've not followed all of his trades. If we had, we'd have made the same amount of money. Now, Karim's made £237. This was 2 months ago. He's now made quite a bit more. Clearly, we haven't been doing our job following him. If you miss a trade, I mean, I would add, you get a notification on your phone if you want it. There is a mute the group feature, but if you want the notification to come up from a particular group, you can get it. But if you immediately copy, you'll make a very similar amount of profit. But that's not all of it. It's about interacting with Karim in the group. He's there to answer your questions. You question his trades. Ask him, why are you doing that? You know, that's really what Pelican's all about. Not simply copying, which is why we don't have auto copy, because that's not really what the line we're going down. It's about people learning to become good traders in their own right. Right, so I think if we go to the next slide and see what it brings us, that'd be great, Simon. Let's find this on my slide. So what else can you do on Pelican? Lots else. We'll see in the following slide. Please, Simon. So we will have touched on some of this before. So just to explain our broking facility. So we're a small company. So we started up, the app's been online for 18 months. It got reskimmed about beginning of January this year, the new version released. In our current size, our liquidity provider, i.e. the underlying broker, is Intraday. They're based in Gibraltar. They're fully regulated themselves, but under the Gibraltar financial regulation. They're also owned by a major PLC who owns BWin Party and other things, a £1 billion plus company, and that just extends the safety net of depositing money with them. They're absolutely safe as houses. It's already been mentioned, 1,500 markets, world-beating spreads, trades can be kept private or made public. You'll notice, so this is the first screen we've had with the flashing red and blue that you can see on any platform. And when you place a trade from a group, when you press, you'll then get an option to search the markets or to press watch list. And many of the mentors will have shown the importance of having a watch list. You know, it focuses you in on what you're trading. The graphs, we have graphs, they're better than that. Now, in fact, that's an old picture. We now have a horizontal line that moves as a live price, and they're slightly fuller and richer than that. We're not trying to replace a desktop. That version's coming out in 3 or 4 months, but it's a nice little resource to have on the app when you're trading. That's great. So I think if we go to the next slide, see what else we can do on Pelican. Yeah, so this is something we haven't touched on. So this is kind of Twitter meets trading. You can create your own trading profile. This here again is Mike Reed, one of the founders. You can see there and access a sort of a bio, the person's trading history. You don't have to put it up there. Most people put a little about themselves, you know, trading 6 months, trading 6 years, professional trader, whatever it might be. You can find all of it out about them. And there's also the ability to follow others and be followed. So that's quite an exciting concept. So what we have allied to these groups, we have a feed. Now, the feed on the app will be the trades of those you have followed if the followers have allowed people to see their trades. So you can be private, but again, you can be public. Now, that's a nice concept. You might want to follow a trader who you're particularly interested in. They might not be a mentor. They might just be somebody else on the app. As I've mentioned, there are lots of good traders on the app. It's not just a case of 40-odd mentors and no one else can trade. Not at all. So you have the ability to follow them, to be followed, and that facility, it's excellent. You know who you're talking to. You know who you're speaking to. It's just like if you follow someone on Twitter, you know all about them. You can do the same on Pelican, but of course the topic is generally trading. And so let's see what else we have. No hidden agenda. It's all transparent, but we're not trying to sort of take data and details and sell it on it. We're all completely transparent. We're simply trying to bring together a community of traders to benefit from what's on Pelican. Of course, we're a broker. We make money from the spread, albeit less than a normal broker because we're using Intraday's prices. But that's the business model. And profiles formatted to optimize information. Well, as you can see, it's a slightly technical way of saying it's all there. It's easy to read. The user experience is good. I think over time we will improve these features significantly, but the first shot is a good one. So it says here we're going to add metrics according to the demand. So I mentioned earlier that the leaderboard feature, it's an apps. Currently it's absolute return. So theoretically, somebody could make a £300 a point trade. Sounds rather large. Make 1 pip, and that would show us £300. Now, obviously, we need to finesse that and make sure there's a track record of people's proper proportionate trading performance. So that just irons out any idiosyncrasies of the trade, of the figures there. That's great. So that gives you hopefully an idea of more of what's on Pelican, which incidentally, I mean, you can discover this literally within 10 minutes of being on the app. You get a free demo account. You can just sort of, you know, fiddle around with it without any danger of, you know, any live funds at risk or anything. And I recommend doing that. So the next slide, thank you, Simon. Interact with traders. We've covered a bit of this. So create your own groups, public or private. Again, that has two modes. The left-hand mobile is has got the groups there. Again, they've changed since this has been done. The right-hand group is again another example of chatting within a group. Great. So I think we'll move on from that. Join other groups. You can be members, of course, of as many or as little groups as you like. So, as I said, there are roughly 40 mentors. The nice thing is you can be in all their groups, but you don't receive notifications from all of them. You can just mute that group, and as I say, you can just keep notifications coming from 2 or 3 groups. It allows you to, so your phone isn't buzzing the whole time, or you're getting unwanted notifications. So having interacted with the traders, which really is the whole point of Pelican, it's all about interaction and helping out the trading. We go to this next stage, which this is in fact what it looks like on an Android phone. It's slightly different on an iPhone. Again, this is much more in terms of what I was talking about earlier. The ability, when you tap on a trade, you can see there, interact with this trade, copy, inverse, view chart. Now, obviously, if you're following a mentor, the likelihood is you'll copy. If you were to inverse or challenge a mentor on a trade, it would be an unusual thing to do, but the facility is there to do it. It could be worth mentioning at this point that some brokers, I don't know if you're aware of this, do B-book, which effectively means they bet against their clients' positions. This has been shown to be a profitable strategy. It's not something we agree with. Intraday themselves are a market neutral broker. They just take the spread. I could reel off dozens of names of brokers. In fact, almost every other one does B-book. That means they basically create a book themselves. They don't hedge off all their position. They let it run. They want losing traders. They show scant regard to their client, who generally lose their money quite quickly, which is why they have to spend so much money advertising. That, you know, £100,000 gets them 100 clients. We're talking about 100 active trading clients. We don't have the means or the wish to advertise like that. It's not part of our model. We don't agree with B-booking. But I think, strangely enough, that's partly why the inverse option is there, because, I mean, if you're a sort of slightly cynical person, you could theoretically follow somebody who you don't think is a very good trader and inverse every one of their trades. And I'm not suggesting you should try and do that, but anyway, the inverse option is there. It's a fun and potentially useful feature. But what you can see here is just that ability to copy a trade that's not there with other platforms. There are other platforms that do copy trading, but it's without this interaction that you get within the group, which has proved so popular with mentors and regular users. Great, so I don't know what we've got next time. Is there any more? Right, find and connect with the best traders. So we're trying to create an environment that's social on your terms. We don't want people feeling they're giving away trades or anything else that they don't want to. The option to operate on a completely private basis there. You share what you want with who you want. That's what we're aiming for. But we want the mentors to share everything. And we're very lucky to have guys who are willing to show their live trades. Attracts the better quality mentor, there's no doubt about it.
I guess
right.
I guess the question on everybody's lips right now is, do you have to have an extra long iPhone for it to work?
Well, yeah, that's very, very true. I think what you're seeing there is the designer giving you a sneak preview of the beveled edge iPhone 9, which will be coming out in 2 years' time. So that's all free.
There we are.
Yeah, no, you're correct.
Nothing is.
Perhaps not the best slide in the world. But
No, thanks, Peter. Just before we
so who you follow and how you're alerted is up to you. Again, I've mentioned the notifications. You don't have to follow anyone. You can come onto Pelican. You don't have to chat with anyone, speak with anyone. You can do it all, but that really would be missing out, because really the whole benefit of it is being able to discuss your trades in the market, and get some great content out there. It's not all mentors trading. We've got groups where people are putting up news, tidbits about the market, info, stuff you can get elsewhere, but you can't get it on a platform where you can trade as well. We're trying to put everything in the same place. I mean, it's been mentioned that we're trying to be a Bloomberg Light for the retail trader, which sounds rather grandiose, but effectively we're trying to bring the professional advantage of being able to interact with other traders, the wisdom of the crowd, to the retail market. And that's the bottom line proposition here. We're not perfect, but yeah.
Just to be clear, Peter, people don't have to open a trading account just to have access to the groups. Is that correct?
So yeah, you're quite right. So currently, it is all apps. Well, it will always be free to download. It will always be free to have a demo account. Currently, all the groups are free to access. What we are doing in the future is bringing in a paywall facility for the mentors. Now, we won't set the prices. It will give the mentor the ability to charge a subscription, for example, £50 per month, if that's what we decided, each month to his followers from within the group. Now, it may be the mentor has, in addition to being on Pelican, they all do have a website. They might even have some kind of email service, but they might decide to charge their students via Pelican as well as operating on that system. And the further ones, remember, there are a lot of advantages to mobile. I mean, who wants to be stuck at their desk 16 hours a day trading? You want to be able to check on your trades. You want to be able to, if a mentor has a sort of live trading room environment, this is great. You can just check up if you've got any positions running, or if you haven't, you just want to check out what the mentor's doing. If is the market quiet, if it suddenly gets hectic, people have busy lives. This is Pelican's trying to very much fit into that.
So everybody on Round the Clock Trader is very sophisticated, experienced traders. They might be interested. Someone here might be interested in actually becoming a mentor themselves. Opening up a group. Are there any? Is there a criteria or any sort of set down hurdles to someone within that position?
Yes, I think the answer to this is currently anyone can set up a public group and show their trades. If somebody wants to start charging for those trades, we want to see a track record. We don't want people being charged money from the unlikely event we have a chancer who didn't know what they're doing. But the reality is I've had lots of experienced traders approach me at trade fairs and elsewhere who are currently giving a signal service on Twitter, who have a system they believe is working. They consider themselves pro traders, but they don't consider themselves mentors, and that's getting these people into the mentoring world and giving them a source of income, giving them a source of income they didn't think they had the option of getting, and also giving the retail market these extra sources of pro traders signals where they can properly trade live, not simply a vague post on Twitter, because as you know, I mean, you can't, it's a grey area. You can't charge in an unregulated environment to give financial advice. On Pelican, the ability is there for people to do that. But the answer is, yes, that there are criteria. There are some people, some mentors we haven't invited onto the app because we don't like the way they operate. And I mentioned earlier that the minority of mentors who operate a massive upselling scheme. We're not interested in that. But there were so many great mentors, great personalities who've written books on the topic, had 20, 30 years experience, like that. Someone like Carol in the life exchange, who are fun to be around and make this whole thing fun. I mean, all of us at Pelican, we love trading. We want to make money, we don't, but we all want it to be fun, and it is fun. And I think that really comes across with those who like Pelican and like the chat and the trade together like this. You touched on, and perhaps I haven't spoken enough about the fact that it is a very lonely pursuit, trading. Everyone says that. Well, this potentially can change it.
What about hacking? Those pesky hackers. Is it an issue? Is that know anything about it? Is there any special firewalls and things to?
Yeah, I mean everything's fully encrypted, and we don't take any risks with other people's information. To be honest, I mean that is in the hands of the highly qualified and paid developers we have. We have a team here who built the app from scratch. Of course, it's their job to secure as well. So fortunately we've had no pesky hackers or any other kind of hacker. I guess anyone, as has been proved recently with this cyber attack on the NHS, almost anyone is vulnerable to some kind of attack, and no one's infallible. But I would, we haven't had any problems before. Thanks.
Sure, all the relevant balances are there. Caroline says, what size of trading is this? A little while ago, you put up the screen which showed Peter and Mike's and Kareen's trading.
Yes.
It looked quite small, the returns, and the losses as well were quite small. Is that just that particular example?
That's that particular example, yes. So if you go into Six Financial, spelled S1X Financial, they're a group of German algorithmic traders. I mean, they go in larger size. I think the reason is that Karim really, I mean, he's giving a signal when he does his trade at £1 a point. He's not, he's himself running his own trade. He's a slightly special case because he's running his own trading floor. So one would think that's probably, in his case, not his main trading account. But for others it is, for Six Financial it is, and they trade in what you could call more grown-up sizes, I guess. But £1 a point can add up, and certainly on some stocks, if you're trading £1 a point in Google or whatever it is a share, that's actually quite a big bet.
Frank says, what about does Pelican have a trading room focus on Forex?
Yes, good question. The large majority, probably the majority of groups have a Forex element to them. So Forex trading is by far the most popular on Pelican. I can't say whether that's something that's industry-wide. I suspect it is. So the intraday traders who tend to trade in currencies is the most popular type of trading. Is there a room specifically for Forex? Well, certainly Karim's group is Forex. There are other groups whose sole purpose is Forex. But what I find is that many of the mentors, they'll trade Forex, they'll trade maybe some indices, but not generally indices, Forex and commodities. Although anything's possible. But certainly he'll. If it was it Brian, did you say?
Frank.
Sorry, Frank. If Frank was to come on to Pelican, he'd find plenty of action in Forex and interest in it. So I recommend he does so.
Yeah, you can sort of find these groups based on Forex and the profiles of the groups. I guess you can sort of search through them.
Yeah, exactly. So each group, if you press the group and then you press the top right button, which is kind of the settings. In fact, on the screen it's up at the moment, looks like an anchor with spikes on it. It's got a proper name. Apologies, I don't know what it is. But you will then, the screen will sort of flip around. You'll have a profile of the trader, and there briefly, if they say that, well, we specialize in Forex, then boom, you're in there for a Forex trader. We are honing the way in which people can find groups, the way the performance is tabled to make it more user-friendly is kind of our next stage of development. It's not to say it's hopeless at the moment, it's not, but it's just something we're going to be concentrating on in the future. So currently, the best way to do it is to perhaps, literally, you'll probably, if all you've ever done in trading is listen to the webinar so far, you'll be able to go and find people who've spoken today. But if there are any queries, don't hesitate to get in contact with me. I don't know, Simon, is my email address up there? Is it possible to get it up there? If anyone would like to email me.
In the chat box. Again, is it
don't
Peter?
worry if it isn't.
Peter.Watson?
Yeah, it says peter.watson at pelicanexchange.com. Peter.watson at pelicanexchange.com. So, we're here all day, answer your queries, and don't hesitate to do so. We want feedback. We're not. We don't pretend we have all the answers. We want the trading community and our clients, and whether they be demo account holders or hopefully later down the line live account holders, to have their thoughts and comments and make it a better experience. So it's absolutely the idea of it. Yeah.
Fantastic. Well, Peter, thank you very much. Are there any more slides? I think no. I think that was the final slide there. So I like it. I think it's great fun. I'm sort of managing the round the clock trader group, and it's great to see so many of you joining up into the group. It's a rather informal version of really what Pelican's about. We're not actually offering trading signals and things in that group, but rather more of a social group to keep people aware and updated about the various webinars, and of course the speakers are pitching in there if they have any big news or big events or anything like that happening. So.
No, that's absolutely great. So I think that just one thing I'll mention is that I've been talking about the app and what you can do on it. We're not another way we keep in contact with traders, and you can come and meet us at we have Pelican Pints once a month. I think the next date I haven't properly arranged. I've got two things going on next month, probably the second week of June. But if you go to the meetup.com website and look for Pelican Pints, you'll find it. Join our group, and then you'll get a notification of when the next meetup is. We've also got Trader Noble, Brian Noble, who's going to be coming to office on the 22nd of June, giving a talk. It's exciting. He'll shortly be live up on the app. So it's all happening, and really, we just, like I say, trading can be lonely. We want people to not only meet on the app, but to meet in person, and to, really, like you say, Simon, bring a social element to it that's just not been out there before in the same way.
Fantastic. I'm just putting that website again in the chat box. Anybody who wants to go ahead and just download the app, they can do so. There and have a check out with it. Peter Watson, Head of Business Development at Pelican Exchange, thank you very much for coming and joining us. We're out of time, and I'll need to welcome our next speaker. So we'll talk again, but thanks for your time. Really appreciate it.
Thank you, Simon. Can't thank you enough. Sure.
Yeah, fantastic. So it is a fabulous product. I'm sure you'll agree if you can download it and start having an experiment with it. We'll also be interested in any of the feedback that you can provide. The boys are always interested in improving the app. So moving ahead, I'm keeping our next speaker waiting, Rob Colville. A strategy you can bank on, which is the carry trade. Perhaps more famously known as the lazy trader, but that's no bad thing. He just enjoys living life and experiencing other things, as opposed to being tied to his screen all day, every day, looking at the market. So let's go over now and speak to Rob and say good afternoon. Are you there?
Hello, Simon. A very good afternoon to you. How are you doing?
Very well, thank you. Very well. It's good to hear you. We've had you a few times on the event over the years. Actually, a long supporter, which has been great. But it's been a few months, I think, since the last time you took part. So it's good to have you back on. The carry trade, without telling us, it's something that obviously sort of does well for you, because having set yourself up as the lazy trader, as I just explained to people, you're not a fan of tying yourself to the computer all day and performing endless analysis. You like things to be sort of fairly quick and simple, so you can get on with other things in life. So we'll look forward to finding out what it is and how it can help us. Shall we go over to your screen first of all and make you the presenter?
Yeah, sure. Let's do that. Do you send me an invitation to do that? Do I get a pop-up on the screen, Simon?
Just be happening now.
Oh, here we go. Show my screen. There we have it.
Fantastic. Great. Okay. So have you been busy? Been busy in the markets?
Yeah, not so much in the markets, funnily enough, but I have been busy traveling around to South Africa, just sorting out my visa to go to Russia next month. And yeah, I've really kind of been doing an awful lot of traveling, trading on the weekly timeframes. Got a couple of positions open at the moment, which we'll talk about in the webinar. But thank you for inviting me on, Simon. It feels like it's been a long time.
It is. The laptop lifestyle sounds very appealing, I have to say. So you are managing to fund that from the trading, which is always good. But yes, I'll hand over to you, Rob. We've got just under an hour and time for questions as we go. But I'll be here as always to sort of chair the questions. But in the meantime, I'll hand over to you, Rob Colville, the lazy trader. Over to you.
Thank you, Simon, and thank you once again for inviting me. Well, as you've probably seen, this webinar is dedicated to the carry trade, and this is something new to our syllabus. I mean, we figured, for those of you who already know me, we've presented strategies and ideas to do with trader psychology. We've done it on trend-based trading and also reversal-based trading. So we thought, well, why not cover something which ultimately gives you a very good return for doing even less than what we talked about before, trading the weekly and the daily time frames. Okay, so without further ado, let's jump in. We're going to have a few giveaways in this webinar, so do keep your eyes peeled. For those of you who don't know me, my name is Robert Colville, founder of thelazytrader.com, founded that in 2012, and I've been trading for about, well, 10 years actually now. It's the big double digits, and approaching this year. And I'll be honest, if you when I first started trading, I sucked at it. I was so bad. I made every single mistake in the book several times over, and then some more just to make sure. I went long when I should have been going short. I went short when I should have been going long. I confused a currency pair for a commodity and a commodity for an exotic stock. You know, I really learned from the school of hard knocks back in the day. And certainly I've blown up trading account after trading account in my formative years back in 2007. And the reason I chose trading essentially was for the wrong reasons initially. I wanted to make a lot of money. Having moved to London as a journalist to seek my fortune, I did a Dick Whittington and moved to the big city and fell into trading because I looked around me. I saw all of my peers who got into white collar professions like banking, medicine, accounting, all of that. They were certainly working less hard than I was, and they were certainly making more money than I was. And I thought to myself, well, I love journalism, but I didn't want to be a foot soldier for someone else's ideology. So I figured that the best way to do anything is to do it yourself, whether it's your own business or running your own magazine. And what appealed to me about trading was, of course, the benefits, which I'm sure you're already familiar with, and that's making your money work hard for you on your behalf so you can make your money grow, providing you know what you're doing, of course. Okay, so after many tears, blood, sweat and tears, I became finally consistently profitable. I say finally, after about a year and a half of struggling in 2008, 2009, And after building up a track record on the daily and the weekly time frame, trading predominantly Forex, I moved on to the commodities and the occasional stock, and launched the brand The Lazy Trader in 2012, which has taught thousands of people around the world how to trade specifically in the set and forget style on the daily and the weekly time frame. Okay, we don't do intraday trading. I've got a lot of respect for people who intraday trade. For me, and many of my clients, dare I say, I don't have the attention span for intraday trading, and you can ask anyone who knows me. I am not very good at being at the same place, tied down to a time and a place. I absolutely can't stand it. Maybe I'm a commitment phobe. I don't think it's down to that. Talk to my girlfriend, she'll say otherwise. But anyway, trading in the style of a end of day trader or end of week trader, as we're now concentrating our efforts as well, it allows you to free up a lot of time, so you can essentially focus on the hobbies and interests and family, of course. So when I'm not trading, which is, I can say 90% of the time, I'm contributing to some of these magazines which you see, and I do a bit of mentoring for the Prince's Trust. I've got a couple of mentees there who I help build their business from the ground up. These are disadvantaged people from troubled backgrounds most of the time. So yeah, I like to keep my life pretty full where possible. But anyway, that's enough about me. I'm pretty sure you didn't take time out of your busy schedules to hear me prattling about myself all day. Although we can do that if you really want to. Let's get to the pith. Okay, so once again, for those of you who don't know The Lazy Trader, I just want to reassure you that we've definitely got credentials. We've got our CPD accreditation, and all of our courses are accredited. Our coaches are accredited by the Society of Technical Analysts in the UK, and we've got a very good Forex Peace Army rating. Moving on. Okay, so let's talk about the carry trade. Have a look at this disclaimer. There's nothing untoward here, just standard stuff. Okay, so the carry trade, it is a long-term strategy which we use to essentially arbitrage the difference between interest rates offered by two different currency pairs or countries. Okay, we essentially, thanks to the leverage broker gives us, we're able, if we're buying the country or the currency pair with the higher interest rate and in turn selling the one with the lower interest rate, we can get a decent sum every night. And this is what we call positive carry. Okay, so let's take, for example, a few years ago, back in 2007, where Australia, New Zealand, those big mining economies, or more so Australia, should I say, is gold mining, diamond mining, you name it, they mine over there. They used to have quite a high interest rate. It's gone down ever since. But the Australian dollar versus the Japanese yen used to be a very popular currency, because what people would do is they'll go long on the Australian dollar while selling the Japanese yen. For those of you who aren't overly familiar with Japan, from a fundamental perspective, they're in dire straits. They've got an inverse population pyramid. They've got deflation. Yeah, the balance of the balance of exports is completely steeped against them. So they've kept interest rates low for a long time to kickstart the economy, whereas Australia, they've got a very high, well, did have a very high interest rate. I believe it was about between 5 to 6% for a number of years. So what people would do is they would essentially go long on the Australian dollar versus the Japanese yen, because what they'll be doing is essentially taking advantage of the leverage interest differentials between the Australian dollar and the Japanese yen. I will explain the actual mechanics of how this works in just, well, shortly, should I say. Okay, so if you don't get it immediately, don't worry, it's all going to make sense very soon, I can assure you that. Okay, so the carry trade is generally true to form and true to the style of lazy trading. They're executed on the daily and the weekly time frame, because the real aim of people who are in the carry trade is not necessarily, even though it is a bonus, to make capital growth. It's just to be in the trade for as long as possible, because they're doing so well from the interest differentials. Let's move on. Okay, so like I mentioned, just to recap, we are buying the currency with the higher interest rate while selling the currency with the lower interest rate. Or what we could be doing is selling the country or the currency pair with the lower interest rate and inadvertently going long with the country or currency of the higher interest rates. At the moment, what is slightly unfortunate is the fact that many countries around the world with the high interest rates, that we're talking about Brazil, South Africa, Turkey, Indonesia, they're the ones where they have quite high interest rates, but stability, unfortunately, isn't, well, guaranteed. Certainly in South Africa, we've seen President Zuma acting in a very dictatorial way, and of course the rand off the back of that absolutely collapsed against the US dollar, momentarily, should I say. But essentially, if we're looking to get positive carry these days by essentially taking advantage of countries with high interest rates and buying their currency against countries with a low interest rate, it essentially means going long on a country which might have underlying problems economically and politically. Okay, but regardless of that, this is a great strategy to keep in your reserve. Okay, because what goes up must come down, and what goes, interest rates cannot remain the same forever. Okay, so here we go. In terms of taking advantage of the carry trade on your broker platform, what we need is the cash daily rolling. One thing a lot of retail traders or people relatively new to the markets, including myself back in the day, is if we're trading the cash daily rolling position, your broker, okay, they're going to charge you. But if, for example, you are in negative carry, say you're selling the country or the currency with the higher interest rate and going long on the one with the smaller interest rate, then you'll be penalized for it every night. Okay, cash daily rolling positions, a lot of brokers, they charge LIBOR plus their markup, whatever that might be. Some brokers charge an absolute fortune for this, especially BBIT brokers. Need I say more? But London Interbank offer rate plus the markup, and if there's positive carry, i.e. you're going long on the country with the higher interest rate and selling the country with the smaller interest rate, you'll be rewarded overall. If it's the other way around, you will be penalized. Okay, so this is one thing to bear in mind. I always have a look. If I'm trading a currency pair, no matter what it is, I always have a look to see what the interest rates are like, because I do not want to be penalized and paying exorbitant costs every night. That's what you call a business that is hemorrhaging money, okay, especially if you're blissfully unaware. Okay, so what I tend to do, and this is a tip for you, if you do, and this is happening an awful lot, if we're looking to sell, say for example, the Australian dollar, which has an interest rate of about 2%, I believe, against the US dollar, which is practically nothing, then instead of having a cash daily rolling position where you are suffering negative carry, i.e. you're being charged the interest rate differentials rather than being credited them, which you would be if you're going long on Aussie dollar, then I will go for a options order, for example, because what happens is your spread might be bigger, but you won't be paying that overall kind of like charge every night. Okay, so that's just a little tip for you so that you don't find yourself inadvertently hemorrhaging money. And this admittedly took me a number of years to discover this in my trading journey back in 2007. I stumbled across this, and I realized when you realize the sneaky ways that some brokers can, some of their tactics that they employ to make more money out of you, it really makes you rather jaundiced. And lo and behold, I actually spoke to a broker not long ago. I can't reveal the name of it, but the broker actually said that they penalize their clients if the asset class gaps against them, but if it gaps in their favor, they do not reward their clients for the gap. And they rely on the fact that a lot of their clients actually don't even know about this, so they can just simply hoodwink them and blindside them and just make money out of them. And this is, you know, when you get to know the broker industry inside out, it does make you really appreciate the ethical ones even more, because it can be a bit of a minefield. Okay, so what makes a carry trade possible? Well, leverage. Okay, it allows you to essentially control a lot more money with a relatively small deposit, like 100 to 1. Some brokers offer 500 to 1. There are murmurs from the FCA that they're going to make it a requirement to reduce leverage, but that's yet to be confirmed. But essentially, if we are looking at, say for example, we are looking to go long on a currency pair, let's say for example, for this sake, Australian dollar versus the US dollar, and the difference between the interest rate differentials is 3%, then we'd make 3,000, which is 3% of 100,000, providing the interest rate stays fixed for the year, which is essentially 30% return on the year. Okay, but this of course depends on the country's central bank policy. It really does depend on whether they keep interest rates constant. Of course, if you look at the charts and you see any kind of like meeting with the ECB or the Bank of England or the Federal Reserve, when they're talking about monetary policy and whether they increase or decrease interest rates, I'm pretty sure you can recall or imagine that if there's an interest rate hike, then the currency will go up, and if it's cut, it will go down. Because if you think about it from a logical perspective, from an investor standpoint, if you have like a load of money, then you're going to want to invest it in the country or the asset class which yields the higher interest rate over and above the one with the lesser interest rate. Okay, so let's go back to 2007 again. I'm going to give you some examples here because I can appreciate it's quite a bit of theory we're talking about here, and I'm someone who likes to be shown. I think that's a far better idea than just reading off facts and figures. So let's say, for example, back in 2007, we had the Australian dollar versus the Japanese yen. That was the historical carry trade of choice with the kind of like investment bankers and banks. And I buy the Australian dollar and essentially receive an interest rate of 6.5%, and I'm selling the Japanese yen with a 0.5% interest rate to borrow. The net profit on the deal is 6.25%, 6.25%. Whereas if I'm selling, for example, the United States dollar or US Swissy, also known as, if I'm buying the Swiss franc and receive a 2.75 interest, and I am selling the US dollar, USD, and pay 2% interest rate to borrow, the net profit on the deal is 0.75%. Okay. So one great thing at your fingertips to look at what interest rates are is simply going to these two resources. I prefer globalrates.com, interest rates central banks. It will give you a very accurate and relevant snapshot as to what the interest rates are for any country in the world. Okay, and it's always good to keep up to date with that. It's just good habits. I always look at the interest rates in the country before I place a trade, so I know if I'm getting positive carry or negative carry for the trade. Okay, if I'm getting negative carry, I place a futures contract. Okay, that's the way to avoid paying essentially negative carry every night. Okay, so here we go. We've got this. This is, like I mentioned, on the right-hand side, we've got the list of the countries with the higher interest rate, typically the kind of countries which have higher volatility. That's South Africa, Russia, Brazil, 14.2%. So if we're essentially going long on the Brazilian real and selling the US dollar, you'd make a veritable fortune in leverage interest. Okay, the carry will be very positive in your favor, but we can only do that, like I'll describe to you in a bit, if we've got a technical reason to get into the trade. Okay, we can't just go jumping into the market for no reason. Okay, so here we go. Let's look at this visually. I'm a very visual person. Like I mentioned, I like to be shown with lots of pictures. I would have had more pictures for you and more diagrams, but unfortunately my computer had a bit of a meltdown this morning and I was very feverishly putting together this presentation at the last minute, unfortunately. All the text was there, but all the pictures disappeared, and that's, well, never really convenient if you're presenting to a wide audience. So what we do to trade or identify a potential opportunity, the carry trade, is we look for a currency pair with a big interest differential. Say, for example, the Turkish lira, 7.5%, and we're looking to buy the Turkish lira against the US dollar, which is just 0.5%. So if we're essentially selling the US dollar and buying the Turkish lira, that means that we make 7% overall profit, and we'll be rewarded with this in positive carry. Okay, and the way we look at it is, say, for example, it's paired US dollar versus the Turkish lira. We'll be looking to essentially sell the US dollar while simultaneously buying the Turkish lira. Like I said, it's very easy to do because all currencies are in pairs. It's a two-horse race after all. Okay, so let's have a look at this. If the US dollar at the time of this chart, when this chart was taken, I was trending upwards rather aggressively, would we have a technical reason to actually go long on the well, essentially go long on the Turkish lira. Not really when the US dollar is an upward trend, because the chart will always reflect the currency on the left-hand side, the terms currency. Okay, so if we're going long on the US dollar in this trend, upward trend, we would essentially be selling the Turkish lira. So whilst we might be doing well from a technical standpoint and getting the capital growth that a long trade with the trend will get, will be penalized with the negative carry, because essentially we are buying the currency with 0.5%, the small interest rate or the tiny interest rate, and selling the currency with the high interest rate. Okay, so whilst if we're buying the dip, for example, in this upward trend, it's a great upward trend by the way, we're getting capital growth, but we're being penalized with negative carry. So if we did want to make the capital growth by buying the dip, like I mentioned, what we can do is just use a futures contract instead of cash daily rolling order of our broker, because what that does is it mitigates the, well, it basically means that you don't pay the negative carry. You pay a slightly bigger spread than you would if it was a cash daily rolling, except you won't have those pesky overnight fees like you would if it was a cash daily rolling position, and those are never convenient. Cash daily rolling positions, if I'm in a trade for a week, 2 weeks, 3 weeks, 4 months, 5 months, a year, there's no way I would want to be in a cash daily rolling, because that would see any gain I make completely dwarfed by these overnight fees and negative carry if that is the case. Okay, so let's move on and look at some other examples. Okay, we've got, like, fast forward to now, we've got the Australian dollar and the New Zealand dollar, and the difference between the two of them is, for example, 0.75%. Okay, so this is more realistic. We can essentially look to sell the Australian dollar versus the New Zealand dollar here. The overall trend, okay, it's a very, we've got a bit of sideways movement, or a lot of sideways movement, shall I say. So it would make sense to simply look for the top of the range or key level, and look for a sell opportunity for the Australian dollar versus the New Zealand dollar, because we can take advantage of the positive carry, given that at the time of preparing these slides, the interest rate was higher in New Zealand than it was in Australia. Okay, so this is what happens when we can work it out using the numbers. Okay, so if, for example, we've got our fundamental argument like the interest rate difference, say if we've got an opportunity to sell the currency with the lower interest rate and buy the one with the higher interest rate, then great. That's half the battle done. We've identified the pair. Let's see if we've got a technical reason congruent with our direction. Okay, so if we've got that, then that's an example of Aussie New Zealand here. We do have that actually. Okay, we've got the fundamental point with the interest rates, say we can make positive carry of selling the Aussie dollar against the New Zealand dollar, and we've also potentially got a technical reason to sell because it's not trending in a direction which makes us sell the currency pair with the smaller interest rate. Sorry. Okay, so if, for example, we are trading with a leveraged account, like many of us are, in fact all of us are pretty much, and we've got the difference in the interest rate between the two countries is 0.75, we times that by 10 in a leverage situation where $10,000 or £10,000 becomes 100,000, then we can essentially do the same with the interest rate. Okay, so 0.75% profit becomes 7.5 or $750 when we're looking at this. Okay, so essentially, if the leverage is 10, then we can increase the interest rate by 10. And when I say the interest rate, I mean the difference between the two pairs in terms of the positive carry. Okay, let's go a little bit more extreme. Let's have a look at the US dollar versus the Brazilian real. This is quite an extraordinary difference between the two. There's a difference of 13.7% between the two. That makes very good carry. Okay, so what we want to do in order to take advantage of essentially selling the US dollar and buying the Brazilian real is, of course, finding an opportunity, a technical one on the chart to sell the US dollar versus the Brazilian real. Okay, so looking at the chart long term on the weekly time frame, we can see that the US dollar is well, it's in a range. It's in a huge range here. So we are looking essentially to trade a pullback in this range. We can see that over the past, well, I wish I could see, this goes back over the past, let's say 15 years, that the US dollar versus the Brazilian real has done nothing but range. So I know it's a little bit of a volatile place up here. We've got above 400. We've got a few breakouts, but what we're looking for is essential opportunity to sell the rally. As we can see that the US dollar has turned around against the Brazilian real at this point at 4, and it's going back down into the middle of the range here, it's reverting to the mean. So we're just looking for an opportunity to sell. So what we'll be doing essentially through selling the US dollar versus the Brazilian real is essentially, okay, taking advantage of the difference between the two currencies, which is a huge difference of 13.7%. Okay, so if we do the maths on this, we can see that, okay, the difference of 13.7% times 10%, sorry, times 10, which is the margin, where $10,000 becomes 100,000 equals a very sizable interest rate, say 13,700. So for the checklist, what we've got here, in order for you to take away with you, and these are the 5 rules for doing this properly, is do we have the currency pair with a meaningful interest rate differential? Okay, and we can always find that out at the website globalrates.com. That's a very good resource. It's free, it's updated often. Does the chart agree in the direction, okay, of the currency with the higher interest rate, and whilst we're simultaneously selling the one at the lower interest rate? Do we have a technical entry, like in a trend? Do we have like the opportunity to buy the dip in an upward trend, or do we have the opportunity to sell the rally in a downward trend? Have we trade sized? That's important. Keeping your risk small, or small as well as comfortable. I'd always say in trading, never trade with money you can't afford to lose, worst case scenario. And also your stop loss, and this is true of every time I place a stop loss, is the stop loss at a point where if the market reaches it, it would render the setup invalid. Okay, that's important, and I'd always say that. Okay, so let's move on. I just want to talk to you about a couple of trades I'm in at the moment, because we do have time on our side. Let's have a look. I'm currently selling the US dollar, funnily enough, against the Norwegian kroner. This is a setup which has positive carry because the interest rates in Norway are, albeit not very much, they're slightly higher than what they are in America. So I'll be getting positive carry on this one, even though this wasn't the ulterior motive behind this trade setup. This was a reversal setup where I just simply traded the, sold the top of the range here. We can see it's a very well established range. Here we go. And we simply sold the top, and we're anticipating taking profit. We've scaled out at the midpoint here. We're just waiting for the price to come down to this horizontal level here. We're trailing our stop loss for every second sell bar as well. And a lot of people say they trade trending markets. Is absolutely fine. You've got speed and momentum behind you. But a lot of the time, range-bound markets get overlooked. And for me, there's a lot of opportunity in range-bound markets. It's a simple case of simply buying the bottom of the range here, like at this point here, and selling the top. One of our power zone strategies, which we have, is dedicated to obviously just taking advantage of where we can reasonably expect demand for a currency to come in, i.e., for example, the US dollar against the Norwegian kroner. We can see that this is the cheapest point where, or the best point the US dollar has been against the Norwegian kroner for quite some time, ever since August last year. And we can anticipate other people feeling the same way in the market. So what people who've got quite a high risk appetite tend to do, and this is congruent with our trading community, who a lot of our clients actually love this kind of trade, where you're simply placing an order on the level. You're not waiting for a price action based reversal at all. You're just simply buying on the level, stop loss down here behind where you might have seen price having faked out before. When I say fake out, I mean a false breakout like we have here. So that you can be essentially be, say, the first ones in the move according to the chart. Okay, like, let me just go back and simulate this for you, because it was a case on the way up as well. When we sold at this level, we had a number of people who, in our community, they actually were happy to have their orders on this horizontal level here, like so, their stop loss around about here, and they're looking to simply just take advantage of a potential reversal in this range, risking 2% on this horizontal level, making 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14%, 7 to 1 on the way down. So risking 1%, you'd have made 7% potential profit on the way down if, as and when it hits the bottom side, the level of support, the floor, the level of demand, whatever you like to call it. That's what would make decent reward to risk. So a number of our clients place their orders on the level, stop loss above, around about here, points where the false breakout was evident. But people who are slightly less risk averse, they're very content with just simply waiting for a price action based reversal, which on the weekly time frame manifested itself as a bearish pin bar reversal here. And that's where people had that entry just below the low, stop loss above the high, and are looking to trail their stop loss for every second seller bar. And we're currently in this trade. Currently moved our stop loss to break even, and we'll be looking to, well, we've already scaled out half. We are just waiting there. I'm happy to acknowledge that typically the bull climbs the stairs, the bear falls out the window. So typically in a falling market, the moves happen far faster than in a bull market. Okay, so that contrasts with euro dollar. Of course, looking at euro dollar, we've got the inverse going on here, which is unsurprising. So it wouldn't really phase us if our dollar knock sell position hits target exactly the same time as we have a potential sell opportunity for euro dollar here. And we're looking to potentially sell at this horizontal level here. We can see that this range here hasn't been, well, price hasn't been above this level since 2015, and it's a very well established range, and it makes sense given that this is a huge obstacle in the way of price. It makes sense to anticipate a potential selling coming in, because this is the best price. People who've held euros, this is the best price they've had to sell it in a number of years. So it just goes back to like supply and demand, actually. If you've, for example, you've got like a possession and you've seen a multi-year high, for selling that possession, you're going to sell it at that multi-year high if you want to get the best deal. And obviously that still works. That's obviously works in financial markets, that whole logic. Because if you don't, I mean, you'll be getting a less good deal. Of course, you can hang on anticipating that euro is going to go up even more. But like I said, we're technical traders here. And of course, you know, fundamentals aside, I mean, the Eurozone isn't exactly prosperous at the moment. And there's a lot of instability with various kind of countries echoing their desire to exit the European Union. We've had France has narrowed Marine Le Pen, escaped her, and of course, had France elected her in the elections, then we could reasonably expect the euro against the US dollar to plummet in value, because of course investors get jittery over uncharted terrain. Let Brexit and the value of the British pound against the US dollar, as well as the euro, and of course every other currency pair, be as an example. We're in the biggest constitutional change in 300 years, and markets, funnily enough, they don't like it. They don't like uncertainty. They like the continuation of change. Sorry, they like to prevent change, to continue the status quo, essentially, because it gives predictability. Whereas, you know, if we go back to those countries which offer high interest rates, like Brazil, like Turkey, like South Africa, Russia, Indonesia, they offer high interest rates, even though you'll be rewarded with positive carry. The fact is those countries aren't as stable as a number of these Western countries have been in the past, offering a higher interest rate, like Australia, one of the most stable economies, politically, socially, economically. That's one of the most stable countries I can think of. If you've got a country like that offering a high interest rate, then that's a double win, quite frankly. So going back to this trade, technically, regardless of the state of Europe, I will be looking to potentially build a sell position here. We did it all the way back at this point here, 2016, so just over a year ago. Let's move on as well to some couple of other ideas which we're talking about. Forgive me, I mean, this computer is a little bit slow, struggling with parallels at the moment. It's a real shame. It's starting to really annoy me. Hopefully it won't. There would be too much of a lag. Okay, so let's go to New Zealand. Swiss, I believe it was. There we go. So, for example, here, New Zealand Swiss, we can see that we've we've got lower highs and lower lows. We've got the 20 moving average below the 50. We've got the 50 moving average below the 200. That's a sign to us that the short, medium, and long-term traders are seen from the same hymn sheet. So we're just waiting for an opportunity, given that we've got bearish cyclicity here with this currency pair, that we are looking to essentially sell the rally. And we're just waiting for a price action based sell, whether it's a bearish pin bar reversal, a bit like what we had on the 10th of May 2017 this year. Bearish pin bar reversal would look to sell that, whether it's on the daily or the weekly time frame. Okay, a lot of people ask me, well, why do you trade the daily or the weekly time frame? It's not as exciting as intraday. Well, actually, I don't want my trading to be exciting. I want it to be as dull as possible so that I can actually have fun in other areas of my life. And if you think about it, from opportunity flow, if you're trading just the daily and the weekly, how many times do you think you need to check the charts to identify potential opportunities and manage them? Well, if you're trading the daily, it makes sense to look every day and manage your trades once a day. If you're trading the weekly time frame, it makes sense to manage your trades once a week, or analyze markets once a week. Okay, so that's the weekly time frame is severely underrated, and I am having more and more fun trading the weekly on its own. As the older I get, quite frankly, maybe I'm getting too used to being lazy. But for me, I never really chose trading for academic reasons. I wanted to use financial markets in order to really kind of like make the most of my money and have my money working for me on my behalf, rather than like essentially getting deeply immersed and suddenly going out and buying 4 screens or 5 screens for my computer space station at home. No, I want trading just to be a vehicle to make excellent return on my capital, rather than being chained to the desk, you know, just boggle-eyed waiting for the next opportunity. I mean, like I mentioned to you earlier, I've got a lot of respect for people who trade intraday. I really do. For me, it kind of contradicts the very reason why I chose trading. Okay, I chose trading so I can free up time away from the screen and have more time outside. I'm very much an outdoorsy person. I'm from Cornwall originally. Not really, it's not in my blood to be desk bound. So any kind of strategy or a vehicle I can use, i.e. trading currencies or any asset class on the weekly time frame or the daily time frame, fulfills that, and I can understand how that will appeal to a percentage of you, and how it might also really kind of repel a percentage of you at the same time. I understand that everyone's different in that respect, and certainly for those set and forget traders and people who like to trade the hard time frames, we can definitely help you. Okay, so moving on from this, going back to the currencies, I mean, this year has, compared to last year, not been that great in terms of the frequency of setups, but the percentage gain of those bigger moves, sorry, should I say, has been good. I just want to share with you the trade which we took for Brexit last year. And there's another opportunity coming up with this, with good carry as well. Let me just rewind, and let's go onto the hard time frame here, because this will, you know, some of you will really quite like the look of this if you resonate with the kind of set and forget kind of mantra. So for example, take a look at pound Swiss on the weekly time frame here. You'll notice that ever since 2011, just turning 2011, we've been sandwiched between 2 levels. And after a long trip back from Cornwall in 2015, December time, I noticed when I was doing my daily scan on the daily time frame, I noticed at the top of this long-term range here, at the very top here, let me just jump back and zoom in so I can show you exactly what I'm talking about. We had a fantastic opportunity to sell. So what we did, and what a number of my clients did, was simply place this as a bearish pin bar reversal. What made me so excited about this one was, okay, if we look at the level again, you can see that this horizontal level here is about 7-8 years strong. It hasn't been broken with any conviction at all, so it's more likely that we're going to get a kind of reversal of this to the downside than it is to pop to the upside. So we just traded this as a conventional, safe third entry into what we'd normally teach as a reversal. So entry just below the low, stop loss above the high, and we just left it. We had, unfortunately, we had negative carry for this one because we were selling the British pound in Britain, you know, very small interest rate, 0.2 whatever at the time, whereas in Switzerland it's 0.75. They've got negative interest rates, so we were getting penalised, unfortunately, had we been trading a cash daily rolling position, because the difference between that is, you know, we're pretty much down 0.72% every night, so, of the interest rate differentials I'm talking about. So looking at this, you can see that had we just entered this trade just below the low, stop loss above the high, we've got a long way to go here, all the way to the bottom. So many times this 2% little our risk here fits into our reward, all the way down here, all the way down, all the way down, all the way down here. So we just set the trade up, and true to form, we just walked away. Quite lucky, that was the acceleration point in a reversal. And then what we did, we just simply sat back, took it easy, and we just waited for the moving averages to cross over to confirm a downward trend. You can get downward trends inside ranges. That's absolutely fine. Okay, a lot of people don't recognize that. You can get trends of inside ranges, or even trends of inside trends. You know, it's absolutely fine. Those people who follow harmonics, you know exactly what I'm talking about, where you can get ABCD pattern inside ABCD pattern. So here we go. We're obviously, people who stayed in the trade here are still very happy. They've been looked after, but you get the first meaningful pullback. And now what we're waiting for is for price to start making lower highs. There's our first entry here. Sorry, second entry, my apologies. So we're able to take advantage of the first lower high in what will soon amount to be a downward trend inside a range. There we go. So we're just waiting for another pullback rather than just a hesitation. And this was our trade of last year, one of our huge trades. Some of our clients really did fabulously well off it, like fabulously well, because some clients just sold on the level as well as took this sell trade here and took this one and took this one. If you imagine, like, all risking 2% for every trade and having your ultimate target, even at the midpoint, you're making a very, very handsome percentage gain. Okay, so for those people who trade with the trend and they wanted a high probability, low reward outcome, then the take profit target was the previous swing low, but a number of our clients just simply let the position run. And of course, March, April campaigning for Brexit was getting all pretty nasty on the streets of England. I remember very, very clearly what it was like. And then, of course, enter June. And we had, I remember that night, waking up in the morning, like 3 in the morning, looked at the charts, didn't even look at the news, and I saw that enormous spike. And it was Nigel Farage, his face next to it pretty much. We were down like 1,000 pips, which is the equivalent of 10 cents against the US dollar. Absolutely incredible. Absolutely incredible. So, you know, people who took that trade did very well, just in the midpoint here even. But now, fast forward to this year, we've actually got, just on a point with our positive carry theme, as well as trading reversals, we had that test on this level of demand here. This horizontal level here, price hasn't been below this point since the 1970s. So we can reasonably expect, if, as and when price gets to, one spot 166 here at this level, we can reasonably expect buying pressure to come in. And I'd far rather buy the British pound against the Swiss franc, actually, if I'm trading cash daily rolling, because of the positive carry. Even though in England, or Britain should I say, we've got a tiny derisory interest rate, it's still higher than what they have in Switzerland, which is negative. Okay, so we will be taking advantage of that. And if we're in a position here, entry just on the level, stop loss round about here, just below 1,500, my apologies. We can do very well just from setting and forgetting and just leaving this to do its thing. You can see how long it took for it to come up to hit target in 2011. It took a decent amount of time, over a year, for it to hit its target here. But if we're in this long-term trade here, by entering on this horizontal level, and we're in a long trade against the Swiss franc for about a year, until it hits this level here at the very top, or indeed the midpoints, which is not an unreasonable target for those people who'd rather have a higher probability of winning, yet a smaller reward, then that's good enough. Okay, but this is very much a long-term set and forget trade with positive carry, and this is why we're waiting for price to come down. We can see the previous 3 occasions where the British pound has spiked down to this level here at 1.165, we can see the whiplash that occurred at the time. So we can look to capitalize off the back of that and have our buy orders just above the level, stop loss below, points were expected at before, and hope for an easy, quick fill and the price to go up again, and like it has done historically before. Okay, so that is hopefully a good little kind of insight into not just trading the carry trade, but also being a little bit more mindful as to who's taking the money out of your trading account every night without you realizing it, as well as an insight into trading reversals as well as trends. So we've covered an awful lot today, and you've done very well if you're still, dare I say, still logged in and your head hasn't exploded. So one thing I want to do, because I know we're running out of time, how are we doing for time, Simon?
Fine, well, we've got about another 5 or 6 minutes.
Okay, good. All right then. Well, if you've got 5 or 6 minutes, let me.
Maybe before we go on to that, there's a couple of questions that are.
Yeah, sure.
You want to finish off first and then go back?
No problem. Let me have a look. Sorry, the questions I've got that window closed actually.
Okay, I'll just read them out for you. Richard said brokers have got big carry trade interest rate margins, which erode the benefit. Who are the brokers who are reasonable on this and pay carry trade money nightly? For example, on the Australian New Zealand dollar short, or even the Euro US dollar short positions.
Okay, well, yeah, and it's a very, 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 very good question, and thank you. That's a very good question. I know that it's the kind of question people will be asking further down the line after leaving this webinar. And I would say I use Atom 8 as my broker, ATOM number 8, actually run by a personal friend of mine. I'm not just saying that out of nepotism, but they are a broker which do not have that. Okay, you can make money from the overnight carry. Sorry, the overnight carry if it's in your favour. I know some other brokers, some of the less scrupulous brokers out there, they've cottoned on to the fact that people are getting educated about the carry trade and are looking to basically penalise them in this respect, as they are with LIBOR plus their inverted commas discretionary markup. And it's always something worth checking out before you go to a broker what the overnight fees are. LIBOR like London Interbank Offer Rate, that's fair enough, that's standard, but what their markup is can make your trading very, 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 very expensive indeed. So shop around is my advice.
Okay, and what currency is this, please? We were talking about. Now, this is about 7 or 8 minutes ago. Sorry, John's asking a question about what currency you were discussing. I don't know what chart it was referring to. The covered pound Swiss franc.
Oh, pound Swiss franc. Yes, that's right. That was the chart I was last talking about, and that's referred to our Brexit. Well, what I call our Brexit trade. Not that. Well, Brexit, of course, favoured the direction, but it was an example of essentially a range-based play where we simply took it from the top of the range to the bottom, and our view was perpetuated by news which was positive in our direction, thanks to Nigel Farage. Even if, regardless of whether I'm a Brexiteer or not, it's just an example of how news, we or anyone should use news to perpetuate a winning trade. Okay, news can be used as a catalyst rather than actually trading the news, sitting down thinking, okay, I'm going to try and predict what the direction is by entering just before the news announcement. It's far better to simply just set a trade up with high profit potential, like high reward to risk, should I say, and just simply ride it out. And if you're wrong, at least you lose a small percentage if you risk manage. If you're right and the news is in your favor or the theme is in your favor, then at least it's helped kind of perpetuate a winning decision far more. If you're riding a wave, it makes sense to ride it until the end, right?
Gotcha.
I hope that answers the question.
Yeah, I think it does. Thank you. And Mr. Chan, hello. How do you collect your interest if you do carry trade by spread betting?
Well, every night it's taken from your account every night, essentially. If you've got positive or negative carry. That's another thing you might want to check with your broker. Some brokers have very funny ways of doing it. I would expect nothing less, and I demand nothing less of having it taken away or given to me every night, depending on whether I have positive carry or negative carry. To avoid, I just want to reiterate this, to avoid paying negative carry, if you're in a position like many of our clients are for typically days, weeks, months, it makes sense to trade if you've got negative carry, i.e. if you're selling the currency with the higher interest rate and buying the one with the smaller interest rate or the lesser interest rate, it makes sense to have a futures contract, okay, which, okay, at the time of buying, yes, the spread is a little bit wider than the cash daily rolling alternative, but you'll save yourself so much money, I promise you.
Gary's asking what the name of the broker was. Mr. Chan, does that answer your question? And that's why you're thinking about that. Gary's saying, what's the name of the broker that you recommended? It was Atom 8, I believe.
Yeah, Atom 8. I mean, there are a number of good brokers out there. I mean, that's who I use, and I've had no problems with them at all. They've always been good to me over the years, and they're very they're very what's the word, straight by the book, and you know, it does make sense. Sorry,
it's Atom ATOM with the digit 8, isn't it? .com.
That's right. That's the one.
Yeah. Okay. I'll just put that in the chat box, everybody, if you want to look at them.
Yeah. I mean, they're a good broker. I mean, I've been with them for about 4 years, and I've got a number of other brokerage accounts of other companies, but they're the ones I use for my specifically very long-term trades with positive carry. There you go. I've got a number of
other brands are available.
Yeah,
okay.
sure. Every brokerage has, you know, they might fall down in some areas. Some brokers are excellent in other areas. So that's why it's good to have a collection of broker accounts, okay, for different purposes. And when you become wise to broker tricks, advantages, disadvantages, specific ways, specific strategies, you'll see the need for various different brokers.
Mm-hmm. Okay, we've got another few minutes just for you to finish off what you were moving on to, if you'd like, Rob.
Yeah, sure. Thank you, Simon. They're all great questions, and please do keep them coming. I mean, this really does conclude the actual pith of the webinar. But what I wanted to do was really, as you've taken time out of your busy schedules, was to invite you to our groundbreak, well, I'll say our ultimate program, which is essentially dedicated to helping anyone who wants to trade from as little as 10 minutes a day, any asset class, any market, achieve that. And we have been valued at $1,997 by the CPD, and they've accredited us. But today, exclusive with the London Investment Week, and I'll stress that today only, you can access it for $30 for a test drive for 30 days and see what you think. And in terms of what you get everything. We do not hold anything back whatsoever. It's all there for you to take at your leisure. Okay, so you get access to our strategies, both basic and advanced, all of our video training, flip books, podcasts. We have weekly market webinars. We have guest traders come in, like Julian, who's got like 25 years experience. Some of the veterans come in. We share the trade ideas which we take. We don't, like I said, keep anything back at all. And curiously enough, we've got pattern recognition software which you can download and integrate with MetaTrader. We've got an audio hypnosis audio course. We've got like well over 20 hours worth of learning, which you can learn on the go. You can learn from your phone, your tablet, your have it on the loudspeaker on your phone, sorry, on your computer at home. And all we need to do really to get this place is use the link that Simon puts in the chat window, or simply go to that and use the promo code round the clock, and that will generate your discount to $30. Okay, and it's an absolute steal. In the highly unlikely event you don't like it, we'll just give you a full refund, no questions asked. Okay, so we look forward to welcoming you aboard for those of you who do come on board. If not, then absolutely no love lost. It's been a pleasure, well, talking to you today. And yeah, any more questions, please do drop me a line or ask Simon and forward them to Simon, and he'll forward them to me. Okay. Thank you very much, guys.
Okay,
and thank you.
Yeah, thank you very much, Rob, coming to join us. Any more final questions on carry trading, or the carry trade rather, before we say goodbye to Rob and move on? Nope, you've answered everything that there is to know about carry trading, Rob. Thank you very much for that indeed.
I've got off lightly.
Well, listen, thank you for that. We will take care, and we'll speak to you again in the future, and we'll follow up these links in the email that we normally do on the follow-up day, so people can have a second chance to get that. You said that offer is open tonight.
Until tonight.
Until tonight. Okay. Well, there we are. It's in the chat box now, so you need to act fast if you want to take advantage of it. Brilliant, Rob. Thank you very much. I'm going to take the presenter role back, and we'll wish you a good day from now, and we'll speak to you again soon.
Fantastic, Simon. It's been a pleasure. Thank you once again for having me on.
Fantastic. Thank you very much. Rob Colville, everybody, the lazy trader. So here we are, marching our way through the May edition of Round the Clock Trader. I'm Simon Campbell. I'm the host for today's event, and we've had some great speakers today talking about Forex markets and stock markets. Hopefully you're getting some valuable content from us today that's going to help you in your trading journeys. And we're not finished yet, of course. Waiting in the wings, we have Steve Ruffley from Intertrader and steveruffley.com waiting to come and give us some live market analysis using his trusty Fibonacci levels. So let's go over to Steve now, see if we can bring him into. Okay, so now if I take the microphone off, we should be able to say good afternoon to Steve Ruffley.
Hello, Simon. How are you doing?
Very well, thank you. How are you?
Hot.
Hot, yes. Enjoying the rather, well, it's not unseasonable, really. It is May, but we're having a rather nice day here on the island of Jersey. So I'm glad that you're able to come indoors for an hour to join us at Round the Clock Trader. We've had a few presentations today. There's been a bit of mood of complacency really in the Forex markets. Most of the speakers saying it's not been it's been relatively flat for a few days, maybe a week. Have you been finding the same?
Yeah, certainly. It's been quite difficult. I mean, I think there's a lot of my clients are asking, why the kind of old correlations aren't working as they used to. So I've got a few kind of ideas that I'll go over today about, the kind of fundamental view, the kind of the technical levels that we're trading at right now. And really just, again, it just really just highlights why you have to be adaptable as a trader. There's no one set of correlations. There's no one kind of, trading style that's always going to make you profitable in the market. Sometimes, you have to, not go against what you believe or what you've learned or what's made you successful. You have to adapt. That's the whole point of the markets these days. You have to adapt to every style of market condition.
That's true. That's very true. We should be looking now at Steve's screens. We should be looking at the 8 little windows with the various charts in there. So if you can just confirm that you can see Steve's charts and you can hear him as well, that just gives us the green light to get started. Great. Thanks, Gordon. Roger, Richard, great, fantastic. Okay, everybody can hear and see. Steve, I'll hand over to you. As always, we sort of just appreciate a rundown of the main indices and highlighting anything that you can see that you think is worthy of noting for hungry traders.
Okay, no problem, Simon. Okay, good afternoon, guys. Right, well, I think the main thing that I've kind of picked up the last kind of few weeks is that a lot of people are struggling with kind of correlations and reason why markets, especially the FX, are moving in the way they do. So I'm going to kind of focus on the bottom right in the short term. Now, we've got this problem, and we've had it for quite a while now in the US. They are trying to lead by example. So we've got Janet Yellen, with his forward guidance, trying to explain, what's going to happen in the kind of coming months, weeks, years, what's going to happen with interest rates. Now, what's really kind of confusing for a lot of people is that they like to take the Fed the word. Now, if you've learned anything about the Fed and the government and the world in general, is to kind of not really kind of, believe too much of what they say. Now, there's a reason why you hear things like Bloomberg polls or, statistics and this kind of things, to how the market's priced in further movements. Now, markets don't really move on the what is known. The trouble is that what is known is in your charts. So what you've known is here, yeah? It's this movement here. It's what's happening on the left of the chart. What is going to be known, yeah, and what the future and where you make your money is to the right. Sounds simple, doesn't it? But a lot of people keep forgetting that this right area, this gap, towards towards your scale is where all the money's made. It's not made here, right? Unless you're kind of holding along from here, and looking to get out here, then that time's gone. It's gone, it's past, you'll never get it back. The money's to be made in speculating on what we know now, yeah, and where the market's going to be in the next 5, 10, 15, 1 hour, 2 days, whatever it is. So we'll go back to that kind of interest rate kind of story and journey that we've been on. So Janet Yellen said we're going to put interest rates up. Okay, so last year we're expecting 3 interest rates and we got 1 hike. This year we're expecting 4 interest rate hikes and we've got 1. Now the market pretty much discounted and priced in straight away that we weren't going to get 4 rate hikes. So if we're going to get 4 rate hikes, and again when we're looking on the higher time frame chart, yeah, when we were talking about it, 3 rate hikes is still pretty good considering we only had 1 last year. So we're all expecting the dollar again against the yen to go up, but it didn't. What did it do? It went down. But why did it go down? Well, a lot of people say it's because the market priced in we're not going to get 4, but the real reason the market went down is because all the speculation time and time again the interest rates were going to go up was done here. So all your big boys, all your institutions, your Goldman Sachs, the big players have got long here, averaged in here. So we get to the top of the market and everyone that is that good little student, that I've read the economics, I've read the fundamentals, what should happen? Interest rates. Well, if interest rates go up, we should buy some dollar. Great. Well, if you know that, not that difficult, is it? If you know it, I know it. If I know it, then all the kind of big players know it. So what they do is they sell the market because they're still long. And what they don't do is they don't close the gap. They don't make any kind of technicals become overly complex. And again, here we have, as Simon said, my old friend Fibonacci. 50% is at 109.922. So in the short term, after all that selling, people scratching their heads going, I don't know why this dollar keeps going down. Surely an interest rate going up is good. It is. But it's back to my old saying, trading's about being right at the right time. So if there's an opportunity in the short term, yeah, short or medium term, to make people think they're wrong, well then that's how the market capitalizes. That's why your Goldman Sachs traders are making 10, 20 million quid a year, and you're not, because they have the size, they have the account, and they have the ability to do what other people cannot, which is make the market do things that they're not comfortable with. So as everybody's getting out and not understanding why the dollar's not going up and making highs above 130, like it should do, like we've all analysed, everyone's gone down, lost money, scratching their head. So we get down to the kind of nitty-gritty on your kind of weekly levels here. Then what do? Well, the market then starts to rally and go up. So people are getting excited again. Okay, but it's like, well, maybe then, we're going to get a rate hike in June. I don't know. Donald Trump says he wants a low dollar, but Janet Yellen still knows more than Donald Trump because really anybody knows more than Donald Trump when it comes to economics. So, again, we're going to kind of price in buy. So again, and then the weeks coming to that, all the kind of pain has been taken. People have been kind of squeezed out here. Yeah, pushed up here in the short term. So the market is any kind of strong directional move that I've talked about a million times will retrace to 50%. So we've got the market, yeah, this strong directional move, haven't made a new low, haven't made a new high, yeah, double top here, has come down, yeah, and it's hit the 50%. Now granted, it's got down and it's pushed through towards the 61.8, but then again, that could be another, almost kind of squeeze mentality, where we just get the weak longs out here, because again, remember all the big players still long, from way back in the charts. Then hold strategically above that 50% and that 109.922. Again, our targets 38.2, 23.6, and ultimately to break these highs and get back and make new highs. So very difficult, isn't it, to see that if the UK are going to put rates up before 2019. It's looking less and less likely with Brexit. The EU haven't really got a plan, to be honest. Mario Draghi doesn't know what he's doing, but I can say that interest rates going up in the EU anytime soon are very unlikely. So even one hike that we've seen is enough for the market to say, okay, well, what we'll do is in the short term, we'll go against the market and we'll justify it in any way we want. Say we're not going to get 4 hikes, we'll sell the dollar, blah, 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 blah. But the reality is we're expecting 3 rate hikes this year. We've seen 1 with more than 80% chance, in my opinion, and I'm one of the people that votes in these polls, to see the rate hike in June, and then the rest of the year, who knows? We're already talking about 3 rate hikes in 2017, so much more opportunity for the dollar to be bought from these lows and to go up. So your strategic points, again, are your Fibonacci. So you're looking for the pivot, hold above 102.99, then a break above 119, and then I would say 124, and then one kind of 36, if I remember rightly. For me, looks like a nice kind of, I've not got the extensions on anymore, but kind of at the 136 level up here, looks like a natural place of where the dollar would be happy. And again, the Japan economy, in lots of trouble. They can't create enough people. There's 2 people for every job, that's advertised in Japan. So the kind of growth aspect in Japan is very limited. And no matter what you say about Donald Trump, he's opened the checkbook. He's going to be, blowing some bombs up. He's going to be spending some cash. He's going to be doing some stuff. So essentially, it doesn't really matter, does it? Kind of what happens in the rest of the world. If the US are going to kind of spend the way out of trouble, which historically they've always done, then there has to be some demand for that dollar. Again, so just going back, cycling through to your weeklies, your dailies, again, these are your levels, and you can see, these consolidated levels that look interesting. Yeah, the good buying points. So as I've said to you, in previous webinars, sell the euro high. I've pretty much always said as well, buy the dollar low. So these low points on your dailies when the market closes. Yeah, we close around here again today. Then again, buy. You've got your resistance points. You know where the market's going to go. Where it's been in the past, yeah, it's more likely to go in the future. And the trend for me with interest rates, in the US versus the rest of the world, even if we see 2 hikes in the next 2 years, it's still going to be more than the pound, more than the euro, more than any other country that's really, the markets care about. So again, in the kind of major correlations, you buy that dollar low. Now, a lot of people have been saying the correlations aren't working. So you can see that when the dollar sells off, sometimes, the euro has been selling off and the pound's been selling off as well. So that's what's been catching people out. Now, the dollar yen is the straight battle in the markets between interest rates. When the US going to hike rates and how many and how quick. The euro, dollar, and cable are a little bit different. They're not as sensitive right now to that interest rate decision, because Europe and the UK got its own problems, and that problem being Brexit. Now, the kind of battle between the euro dollar and the pound dollar gives it a level playing field. We'll go through the euro pound in a little bit, because obviously that's where the main battle you would think you'd be having. But you have to remember on the global scale that people are interested in the UK, and they are interested in the euro. But also on the same point, they're not interested. They're interested in making money. So they don't really care about the outcome of the UK. They don't really care about the outcome of the euro. What they're trying to do is get an edge. Now, what you have to realize as well about your bigger institutional clients, your bigger institutional trading houses and stuff, they don't just trade pound a point. These guys are trading huge sums, and they're trading it in baskets. So they're looking for an edge of multiple currencies. So that's why you're not seeing the dollar sell off and everyone get excited and buying the euro and buying the pound, because there isn't that outright need to be buying a low pound or indeed selling a high euro. There isn't that institutional demand. What they're trying to do is get as much size through the markets and balance out that risk, because they've got a slightly longer term view. They put more size through, so they have to hold positions for longer. Now, this is another thing that I touched on when I did the Round the Clock Trader live event a few weeks back in London. There's more than one way to make money out of the markets, and just trading money makes money in the markets. Now, you have to look at trading as a business. If you only ever trade small size, A, you're only ever going to make small trader money, and B, you're not going to have the advantage of what trading volume actually means within a business perspective. I treat my trading like a business. I can make and lose 10,000 quid in a day. It makes no odds to me, okay? Because I have a big account and that's what I do. If I lose £10,000 in a day, it won't be because I've held £200-300 a point, you know, and just watched it go offside. It's because I'll have traded a number of things and other products a number of times and I've just been wrong. I'm allowed to be wrong. I'm right more than I'm wrong. Now, what you don't understand is if I lose £10,000 in a day and I trade the aggressive style I do with averages and I trade maybe, I don't know, £5,000 or £6,000 worth of costs, I will get back £3,000, yeah, to me, because I trade volume, I trade size. Now, this is the advantage you get when you trade the markets within the kind of realms of the professional trader. You know, the market will pay you back for being involved, for providing liquidity. So you might have lost 10 grand, you get 3 grand back, you've only actually lost 7 grand. Sounds bad, I guess, your average trader, but then if you have a winning day, yeah, and you make 10 grand, you also get 3 grand back for your trades. So win, lose or draw, you're still getting paid if you put volume through the markets. Now, this is how I take good traders to be great traders to be professional, outstanding traders, by understanding that you have to trade the markets and act like a business. You know, if you think to yourself, if you can generate X amount of money per month, then that could be your wage. So as long as your capital grows ever so slightly, then you're still massively up in the game. How many people out there have traded your account for a month and made a little bit of profit? Too small that you can't take it out, or you've lost a little bit of profit. Too small that you don't want to take money out. So you spent maybe 60 hours in front of the screens and you've made nothing. Not that it ever happened these days, but if I was to spend 60 hours in front of the screen, I'd make sure I got paid at least £10,000 a month. At least. If I didn't, what's the point? Why am I going to be involved in the markets to be pushed around and bullied around just for the fun of it? And you can do that too. The markets are moving all the time. Okay, you might not understand the correlation between the dollar, between the euro and cable. Doesn't matter. The S&P. What have we learned for the S&P? Stock markets in general. If you sell them and hold it, you will lose money. Monthly chart. How many times have we gone through this? Rejection, higher, rejection, higher, rejection, higher, rejection, higher, rejection, higher, rejection, higher, rejection, higher. The interest rates still where they are. It's not tempting enough for people to put their money from a risky investment in stocks and put it in cash. That time will come. So the crashes are going to come from, or the corrections are going to come from people getting frightened about stock markets. They're not going to get frightened. What they're going to do is see a better, safer alternative to someone to put in the money. So they will get out of risky investments, which stocks are, yeah, and then put it in the bank. And what will happen is we'll see the spikes on the upside. So we'll see rejection, hold, rejection, hold, and you will see all of this gains here probably wiped out in a week or two. And you can see easily the market's trading below 1800, and it might be, as I said, all that speculation is in the future here. So expect being right at the right time. So the expansion points, yeah, we could go as high as 2,460, 2,500 even, yeah? So what happens is if you want to sell it and hold it, you've got to be able to take all this pain on, because that's where the markets could be, and they could hold, they can hold, they can hold, and then in 1 week they could do that, yeah? In 2 weeks they could do that. In a month they could do this. But that's speculation. It's in the future. We don't know. What we do know is when the charts are as they are now, when you see a significant point, dotted line, buy it. Dotted line, buy it, buy it, buy it. And the market continues to go up. So don't sell something that doesn't want to come down. When you see the wicks like this reversed on the upside and it holding, then get involved and sell it. So if you want to know an easy correlation, buy the stock market's low until interest rates get above 1% in the US, or get above, 150. Anywhere above 150, then when you're talking about the institutional clients, people that I have, that have billions of pounds, they're not interested in big returns. Yeah, this stock market rally has just been a bonus. It's made the 1% even richer, sickeningly, just by them having nowhere else to put the money. But when they do want to pull that money out, it's going to go back into the bank. And that's going to be in pounds and it's going to be in dollars. It ain't going to be in euros, I'll tell you that. So again, something else to think for when the stock correction comes, where the safer haven currency is going to be. For me, that is definitely the pound. Definitely the pound. So I see big upside in the pound. But anyway, just going back to this kind of idea that you know, if you want to kind of trade intraday, well, you know, just look at your hourly charts. Yeah, you see anywhere where there's good consolidation around these lines, you just buy them. Yeah, the 50% pivot, oh, you buy it and it gets to the red lines. I mean, it's how hard do you want to make trading to be? I don't have any lines. All these lines are pre-drawn on iView charts. Okay, they're just always there. They predict market movement, so you don't have to be a great trader. You don't have to be a great technical analysis. You just have to pick up your screens and go, oh, stocks, yeah. When they get above the 50%, Steve says buy them. Buy it. There you go. The S&P made itself 34 pips. Yeah, where else have we got? So we're below the 50% in the DAX and the in the FTSE. So they've got the ability to go higher, don't they, if they're going to follow the S&P? So you buy them low. Well, there's a point of support. Buy it low to 50%. DAX, there you go. Buy it 12692.6 to 50%. Or whatever you think is going to happen. Again, you know, with gold pivoting around that 50%. So stocks are going higher, yeah, and the dollar's going to go higher. What does that mean for gold? Well, risk off. Yeah, higher dollar, more expensive gold, people sell it. So it's going to break here. Yeah, 12555. Then it's going to get back down to 1252. So again, it's putting these things in correlations, but using them in the right way. If you're trying to trade, you know, cable, or you're trying to trade the euro dollar off the dollar yen, or off the dollar index in general, it's very difficult because the dollar index is solely focused on the US, on Trump, on its policies. Yeah, it's the biggest currency. They've got the biggest army. It's its own entity. So you don't necessarily get the correlations and triggers in the pound and in the euro against the dollar at the minute because the dollar's got its own problems. So what we're trying to figure out is, you know, what's ticking away, what's making the euro and the pound move? Well, it's the Brexit argument. Who's going to win that? Lots of talk in the press about how great the European economy is doing. I mean, GDP in UK, and the FT it said today, was rubbish compared to, you know, Spain. Spain. Who cares about Spain? I lived there for 8 years. If you think Spain's going to up and booming, you got nothing coming. It's the same generation that are still booming. They've still got massive unemployment in the youth. They've still got massive problems in the property. Still got massive problems in pension. Yeah. So all these things are all related. My GDP might be better than it was, you know, month on month in the UK, but it's still rubbish compared to where it was, you know, 15, 20 years ago. So these growth figures can be spun however you want. At the end of the day, you know, the new norm is that we're not going to see these huge jumps in GDP. I mean, look how China, how they were downgraded by Moody's. No, first time in 30 years. Because you can't trust anything that comes out of China. You know, they've got these ghost cities. You know, they don't really kind of play by the rules. They just say whatever they say, and we have to believe it. Well, Moody's have said for the first time, no, I don't believe it. Okay? So if they don't believe that, then why necessarily should we believe any kind of data or any kind of real impact on this data? At the end of the day, people are going to demand something in the markets. They're going to want something to buy and make money, or they're going to demand to sell something in order to make money. People just want to make money. This idea that gold is going to be the strategic reserve anymore and it's a protection against inflation, the store of wealth, is nonsense. That store of wealth is nonsense. If you wanted kind of uncertain times, we've had the most uncertain times in history in the last 2 years. Brexit, Trump, terrorist attacks, blah, 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 blah. If any of them are really going to, you know, put gold back to where it should be, where it has been, yeah, then why are we not trading up here? Why are we trading at 1600? Because all the speculation for the hedge funds, the cash for gold, you know, the pawnbrokers, all that kind of stuff was done here. Yeah, that was the speculation. It wasn't on fear. It wasn't on people protecting the money. It was on greed. Greedy, greedy, greedy. I've got gold under my bed. Cash for gold. I've got granny's earrings. Greedy, greedy, greedy. Yeah, markets go. Well, actually, UK has sold its gold reserves. US, Fort Knox is empty. Who's got lots of gold? I don't know. Russia, China, India. We don't care about them. Sell it. Yeah, oh, there's fear in the world. Well, sell it. Oh, there's a fear in the world. Trump. Oh, buy some. Oh, yes, go to your old-fashioned IFA. Yes, yes, Mr. Broker, buy me some gold. No one cares. Sell it. Goes up a bit. World's ending here. No, it's not. Hold below the 50%. Magic fib level. Yeah, I've said that once. I've said it a million times. 1301.63. It might touch that. It might get back. But it's got no chance of getting to 1400. No chance of getting to 1500. It will never, ever get back to 1900. What it will do, we'll just figure out that the world had to pay for this quantitative easing, had to pay for these secret military missions and somehow, and what's the easiest way to do it? A big fat gold bar. Supply and demand. What's the latest thing? There's 1.3 trillion bajillion dollars worth on the ocean floor. Supply and demand, people. What's going to happen if that supply hits the market? Yeah, think about it. We're not actually that short of gold. Gold is just a store of wealth, an old-fashioned store of wealth. It takes a lot of time, money, looking after. Much easier ways to store money. Bitcoins up 88%. Yeah, what does it cost, to secure a Bitcoin that doesn't exist? A lot less than it does to secure, a boatload of gold. So what's going to happen? Old-fashioned people that believe that store of wealth stuff are going to die, hopefully soon. Hopefully it's a lot of boomers. And then they release their money. They give it to the kids who are ungrateful and disillusioned and sell it. So just like house prices, just like gold, it'll all come crashing down because it isn't actually as important as people make out. So you make me any kind of argument that gold gets above 1,300 and there'll be a special prize for someone that convinces me to go and buy gold. But for me, technically, fundamentally, everything I've said from the kind of technical levels, it's just a relief rally. All the market wants to do is sell gold. It wants to break back below 1206. It wants to get back to below 1,102, and it's going to get to $1,000. And then below 1,000, you could see it drop $200 in a matter of weeks because that's all the stops are out. Don't know. As I say, anyone's got a better argument than that, then just send it to me. The DAX, the FTSE, again, the FTSE has been very uncomfortable above 7,000, 7,300, but it just carries on with the trend. It just carries on buying, and I can't really make any other logical reason than it's just that lack of alternatives to put your money. People have been, scared off by bonds. People, were over-investing in property. People have diversified as much as they can, so the stock markets are just having that kind of run. And, if you talk about the 1%, top 5%, 10%, they've got so much money combined. They're the people that are buying at these levels, and they can keep the stocks as high as they want. And if you think about Trump's administration, well, it's essentially a lot of old Goldman Sachs bankers. So, the market is going to correct when there is a viable option, as I say, in cash, or when Goldman Sachs say to their rich guys, you know what, guys, off we go, sell away. Rich's family in Turkey apparently spent $600 million selling shares the other day. So that's a lot. That's a lot. I personally have people and I have people around me that have billions. Yeah, I know the top 1% of the top 1%. So when they go to liquidate their holdings and in the shares and stuff, that's going to move markets. It's not your average man on the street. So you have to think the markets are being moved. I don't want to say the word manipulated, but they're being held at these high levels because of higher powers. People that just have more options than your average man on the street. Now, you don't want to get drawn into that. You can use that as an opportunity. At the end of the day, I've always told you, we're not in these markets to buy and hold or sell and hold. We want to be right at the right time. We want to be making 10, 15, 20 pips out of the market. We just want to be doing it on the right kind of size. So if you're doing that on £50 a point, £100 a point, £200 a point, you're making good money. And that's how you do it. You compound these wins every day. You don't have to buy the market low and have all that risk on the table. Leaving money on the table. That's the biggest problem that intraday traders have right now. They don't like the intraday movements because it's hard. And you have to be very patient, very disciplined, and you have to be like a sniper. When you see it, you've got to hit it, because if you don't, you've missed it. Yeah, but they don't like that. They want to kind of be handheld through the markets, and they want to use an indicator, or I want an oscillator, Steve. I want like 3 things before a trade. The market doesn't give you that anymore. The market doesn't want to do that anymore. You have to change with the market conditions. The markets want to move in a way that you don't understand. The markets want to move on any old bit of news, some nonsense Trump tweet. That's what they want to do. So if you don't like the way the markets move, stop trading. It's just as simple as that. Don't beat yourself up. It's a tough game. It's very hard at the minute. So if you're not enjoying it, stop doing it, because you'll lose money. If you don't understand it, stop doing it, because you'll lose money. There are a lot more ways to lose money in trading, than there are to make it. The only way I know how to make money in trading is to use size. Is to leverage up what capital you've got, use it responsibly, but use size through the market. Because if you come, for instance, this whole mentoring stuff, I did a presentation with Simon in London, and I told people that if you're with any other broker, pretty much any other broker than the one that I'm the chief market strategist for, Intertrader, that they're going to trade a B-book. That means they're going to be looking at a big screen of all your positions, and they're trading against you, and have been doing for years. And people are like, oh, I didn't know that, right? Well, just move broker. You know, you switch your mortgage, you switch your credit card for a better deal. Why let somebody make money off the back of you? It's insanity. You know, and if you come to me, I can arrange it, and I heard the last guy talking about overnights and stuff. I can arrange your swap rates. You know, and again, if you're trading any kind of size, we can look at your hedging options. Yeah, we can look at trade back. Yeah, I can look at paying you for every time you trade, win or lose. Does your broker do that? Well, no. So there's three things why your broker's against you. What loyalty have you got to your broker? What have they ever done for you? Nothing. So go to somebody who's going to have interest in you. Now, if you want to come to me, I've told you. It's very simple. If you've got £25,000, yeah, in an account or more, I will give you a miles better deal, and I'll do it through me, yeah, Steve Ruffley, because I am somebody, an intrader. I'm the chief market strategist. I've been for 6 years. I can make anything happen. But if you've got less than 25 grand, don't expect as much help. You know, money makes money. I know lots of people have had things to say about the videos and the way, you know, I'm like, you know, the guy that tells the truth, people don't like it. Well, you don't like it, I don't care. I'm not here selling anything. Yeah, why do you think my services are free? Why am I looking out over the beach with my swimming pool? Yeah? Why am I, you know, with my dog walking watch, a Rolex? Yeah? Because I make loads of money. Make loads of money. People pay me lots of money just to be around. So if you want to be part of my world and get involved in these things, you've got to invest in yourself. And it's only 25 grand. That's a starting point. But if you want to make money in the markets, it's like setting up a business. You need to be capitalised. And if you don't have that capital, your chances of going into the markets with 50, 100, 200 pounds a point, nicking a bit of S&P here, yeah, making yourself a couple of grand a day, they're gone. And what you end up doing is buying a pound here and hoping it's going to go up for 3 days and checking it on your phone and putting all that effort, all that emotion in for nothing to make 100 quid. Yeah? Go and work. Go and work somewhere. You know, go and do the gig economy. You know, go and put yourself on, you know, one of these ad sites. I'll walk around with a banner on my head saying, buy stuff at Tesco's for 100 quid. You know, do that. And you think about how much people physically invest emotionally, time-wise, you know, intellectually-wise, in looking at these screens. These screens are just spitting out money. But you have to be willing to get hold of it and do the right things. Because if you're just buying and holding, leaving money on the table as it goes up and down, it's just ridiculous. It's stupid. You're shooting yourself in the foot every time the market has any kind of significant move. I mean, really for me, it's difficult to see how high the FTSE is going to go. Now, obviously, the pound dollar has been an interesting one. You know, lots of times you've seen, obviously, you know, kind of this break towards, you know, kind of 130 and holding significantly above it. You know, we've kind of gapped down, we've kind of failed. Another great kind of indication, you know, the market didn't really know what to do. So a big spike up and then a big kind of sell-off. If you look at the pound, you know, versus the dollar and the pound versus the euro, as I've said, it doesn't look bad, but in the short term, it's very hard to make a justification for it to be great. We know against the US, they've got their own thing, you know, they're to do with interest rates. So interest rates are more likely to go up in the US than they are in the UK. But the whole thing with the European Union is it's 1 against 27, and it's 1 against, you know, Europe. So the markets like to think that we're the weakest link in this, you know, that we're the ones that are going to suffer the most, and they might be right. You know, they like to jump on our GDP, they like to jump on this, that, and the other, but the way I look at it is, we've had a bounce off the lows, okay? So we had a bounce off the lows, that's natural. People are just buying it. The pound is always going to be around, the UK is always going to be around, because we've survived it. We used to have the empire. We're a lot smaller than we used to be, but, you know, we're small and mighty. No matter how you look at it, it's not in the world's interest for anything to happen to London, let alone the UK. So intrinsically, there will be value in the pound. So we've seen this bounce. And these are decision points now at 130 to say, is the pound going to be better value than the euro going forward? Well, it all depends, doesn't it, how good Brexit turns out. Because if we start to make trade deals and the European Union get wobbly, and there's a, you know, talk of, you know, Frexit, Netherlands exit, you know, whatever exit there is, or Greece go pop finally, or whatever. The Eurozone has a lot of moving parts, okay? A lot of people to please, a lot of decisions to be made. The UK only has one moving part. So you can see that as we get closer to making trade deals, as we get closer to this idea that, that this break from the European Union is going to work for us, the more we hold above these lows in the dollar, irregardless of what interest rates do, the world will be looking for a second, global safe haven currency, because I just do not see it being the euro. And I certainly don't see it being the yen. We've seen what happened with the Swiss. New Zealand dollar, not a chance. Aussie dollar, not a chance. Renminbi, yen, no. So the pound is always going to have that intrinsic value. So that's why all along these lower levels, people can buy, and see some value. Now, we might see it dip back down towards 120. And again, that can be because of negativity with the Brexit deal, negativity with, politics in the UK, anything, terrorism, all these unknowns. But what's not ever going to go away is that people tie money up for a month, a year, 10 years, 20 years, 100 years. So, there will always be this idea that what's going to be around in the future. Will it be the euro as we know it? There's been talked about, breaking up into north and south. There's been talked about this, that, and the other. I mean, if you look at the euro chart, it's very much like this. We go back to the euro dollar. Same scenario. Very much like this, it just hit the lows and we're all thinking it could get to parity. And we've seen a bounce, but it's a relief bounce. It's not a bounce any more than a technical bounce. Still in this channel. There's a down channel here. So you could easily get to these points and in a couple of months we easily be back down to 106841. It's got every opportunity to come down. And again, everyone likes to talk up the euro and how well it's doing. It's doing well, compared to its almost disastrous past. Almost disastrous past. And you look how aggressively the market sold off, bounce, sell, bounce, sell, bounce, sell, bounce, sell, sell. So we have the bounce, but the bounce is going to happen. It's going to have to get above here. We're going to get above one spot 1952. Maybe to 130 for it to be a significant bounce against this selling. So for me, days of the euro being high, especially against the dollar, are numbered. And Mark Carney, Mario Draghi can make a case that they've kept the central banks respectable on a global scale, but still look at the problems with the Italian banks. Look at the problems with Greece. They continue to be, they come and they're swept under the carpet. It's like, do you think the ECB is this magic money machine that can just rely on Germany making all the money? How long's that going to last for? What, forever? No, it's not going to last forever, is it? So there has to be an idea that one currency is going to pay for it or not. It's not about losing, because again, we're not interested about holding these things for considerably long periods of time. So we just look to sell the euro high. So in the hourly chart, again, you sell it high and you get back to the 50%. So again, the trend in the short-ish term is up. So maybe you want to buy the euro against the dollar here, and look to get your 20 ticks, 10, 15, 20 ticks up here, or you put your stop there and you sell it. And you make your 12 ticks, or you get down to here, make 30 ticks here. Look for interesting points. We're at interesting point here, intraday, the 50%. So for me, I'll be selling this, buying it back here. Job done. That's how you trade. Simple. And you just go through each chart there, looking. Sell the euro high, buy the dollar low. Where's it going to get to? The 50%. And you just look through each chart and you do that every day. And if you can pick 10, 15, 20 pips 5 times a day out of the markets, on decent size, you're going to be doing well. I mean, that's really, again, Fibonacci. We can look at some other kind of easy Fibonacci's on your dailies. So we're looking at the pound New Zealand dollar. So again, you look at the pound New Zealand dollar over history. Then again, we've seen this massive sell-off. Brexit comes in, sells off even more. But, we used to be at 2.4. Then we were down to 1.68. So what are you going to do? Well, there's going to be some value somewhere, isn't there? New Zealand's 4.8 million people. What are they going to do? They're not going to change the world, are they? So, you're going to see a bounce. So you see the market bounce, but you buy low. Look at these fib points. Just keep buying the fib points and it comes back. So again, the weeklies, 50%, just above here, 108.8. So you're thinking, well, is it going to break and, sell all the way down here? Well, what would the reason be for that? I don't know. In this consolidation period, looks like it should go higher. So maybe we get back to the 50% and we buy. We've got these previous targets to get back to, 2, that 50% of the entire move. Looks like a good level. 4.8 million people versus the UK. I don't know. Who's going to make the most money? We'll see. And then, you know, again on your kind of daily charts, you know, looking for just kind of correlation. So these are your fibs on the daily. Then you're looking at like the euro versus the pound. So again, you can say that, you know, the euro against the pound been pretty strong. Where's it going to bounce from? 50%. Where does it start bouncing from? The 50%. Where's it going to get to? The next 50%. So if we're thinking in the short term, if the euro is going to be more valuable than the pound going forward, well, then you just pick place to buy. I mean, it's not a coincidence, is it, that the market keep picking these lows? Well, these points of interest, should I say? Yeah, you know, these fibs are just simply based upon movement, where the market's been, therefore where it can go to. So anybody any questions or thoughts? I mean, I've been whittering on now for nearly 40 minutes. Anything you guys would like to know? Or, I mean, I've been through fibs a million times. You know, again, it's people tend not to want to have the confidence in their own analysis, but, you know, Fibonacci gives you that. You know, all you have to do is pick a move that hasn't broke a high or a low, and then it pivots around the 50%. It's either a strong directional move or an individual candle.
Steve, it's Simon here. There are a few questions, or comments rather, going back a little bit. Are we saying that Bitcoin is taking over from gold?
Well, I mean, it's hard to argue, isn't it, with the kind of Bitcoin success? And it's not that I'm trying to argue with it, but it's it is what it is. You know, Bitcoin is unregulated. So when it's unregulated, you have this ability to lose 50% of your investment, or you have the ability to make 88% in a week. I mean, it's unregulated. So is it taking over from gold? I mean, it's not taking over from gold, because I've said for all these different reasons that I don't think gold is what it used to be. You know, when I first started being, you know, doing my trading to be an IFA and all these kind of things, you were talking about a balanced portfolio. You know, have some amount in stocks and shares, you know, some amounts in commodities, some amounts in, you know, kind of fixed assets, and, you know, there's a kind of really defined ways of how to build a balanced portfolio. But I mean, what's a balanced portfolio these days? And how can you balance it? You know, it's practically impossible. So the reality is that, you know, this kind of missing link of that safety part of a balanced portfolio, or any kind of portfolio, isn't really being fulfilled by gold. And as the world becomes more savvy, more tech savvy, you know, more kind of turned on by, you know, unicorn stocks, tech stocks, Bitcoin seems to be something that is interesting to people. I mean, how can you say it's a replacement for gold? I mean, gold can drop, you know, so much in a day, so much in a week. Gold's not going to move 88% in a week. It's impossible. And if it did, it's because the world has just let off a nuclear bomb and everyone's dead anyway. So what's the point in anything? So gold cannot do that. It cannot do it because there's too much time, money invested at every level. The problem with Bitcoin is that nobody really knows its value. And it's not regulated. So, you know, huge volumes can come into the markets and take stops out, take prices out, because there isn't that history. There isn't that security of people trading throughout the ranges, you know, trading at every single price historically. So, I mean, it's just moving into the, you know, into the modern world, isn't it? I don't think it's taking over from gold. What I think it's doing is just becoming what we call like these alternative investments. And I don't know anybody sensible or anybody, you know, that's rich that has any interest in holding Bitcoins, because they're not looking for an 88% return. The people that are looking for an 88% return are, you know, millennial investors, you know, people that want to punt, people that want excitement. Yeah, people that have made the money and made that over time want a return to maybe 3%. They're not looking for 88%. So it's never going to replace gold in a traditional sense, because until it's regulated, until someone like Goldman Sachs or Morgan Stanley, which they have done, you know, apply for these cryptocurrency licenses, until it's somebody like that, you will never get any serious paper or institutional money in it. So it will continue to be volatile, and it will just be a news headline. Bitcoin went up. Bitcoin got stopped in China and it dumped. It's now worth flipping 10p. You know, these are things I've been talking about for so long. You know, I'm not interested in that kind of, you know, that kind of punt mentality where it's like, you know, you want to make huge returns on little amounts of money. That's not how the world works anymore. Yeah, for every guy that's made a fortune in Bitcoin, there's been a million people that have lost it. So it's an alternative way of investing. That's the only way you can look at it. Until it's regulated, it will never have any serious place in any, you know, institutional or any kind of higher end, you know, portfolio. But good question, yeah, good comment, good thought. I like that. Anything else?
Yeah, thank you for that. Let's moving on. Oh, Steve, you sound a bit bitter and twisted today. Says Gary.
No more better and twisted than usual. I've had 3 webinars today, and you know, I've had conference calls and stuff. You know, I've done 4 hours work today. I mean, that's like a full week's work for me, and it's about 300 degrees, and you know, it's hard. It's hard to keep the motivation. Remember, I do these things for you for free, for free.
And you keep reminding me, Steve. Thank you for that. Okay, British pound better than the Swiss franc? Asked Yat.
I mean, again, I mean, the Swiss franc was the darling, wasn't it? It was the place to go to, you know, as was the Norwegian krona when you wanted a safe haven currency. But when they removed their peg from the euro, what did we see? Well, we saw companies going bust. Alpari, yeah? Alpari that trades against you, why did they go bust? Why did FXCM need 200, 300 million bailout? Because they were trading against you. So that's why they lost that money, okay? Because they were overexposed in the market. Are they viable alternatives? I don't know. The world seems to be turning its back on capitalism to some respect. There seems to be a lot more transparency, a lot more kind of understanding about the trust world, you know, that kind of a lot of my clients are involved in. You know, they want that transparency. So this kind of idea of holding money, you know, in different countries is getting harder. It's getting more difficult. It's getting more taxable. So I don't see the different things. I think the long-term established currencies, you know, are, you know, the pound, the euro, and the dollar. Now that's set in stone for me. That's not going to change. You know, you kind of people that want to hedge off risk, you know, and do that in currencies like the Norwegian krona and Swiss franc are becoming less and less abundant. There's less of them. And this again is how the landscape of the world is changing. That's why gold's not at the highs. That's why people are jumping in to Bitcoins. Why people, you know, are investing so much money in things like Snapchat. You know, I still don't understand Snapchat. And I'm only 37, but it's worth $1 billion. Whatever. Great. Nice one. People are much more happy to have Snapchat as in their diversified portfolio because it's there, it's in the news. Mark Zuckerberg, you know, 3rd richest man in the world. They kind of get the future, the currencies and that kind of stuff. It's a dying breed of people. It's a dying part of a portfolio. So it's not that if a currency is better. It depends what your reasons are for doing it. What I would say is there are better opportunities to trade maybe the pound against the Swiss with that view that maybe the Swiss is a dinosaur, you know, with a very high standard of living, but, you know, closed off. And as the people that can, you know, have access to that world get less and less and less, then perhaps on a global scale it becomes less attractive. You know, London's only going to keep growing, so maybe that's, you know, the pound becomes more attractive. So you buy the pound against the Swiss. So, you know, that's the views you want to take, but that's longer term, you know. And again, what you're trying to do is zoom that down onto an hourly chart or a 15-minute chart, stick on iView charts or some fibs, and just say, right, well, in the last 3 weeks, the pound against the Swiss has done this. Okay, it's low. I think that's value. So you look for long trades between those levels. Simple.
Steve, there are a lot of questions coming in about Fibonacci. Obviously, where do you place the fibs, and how do you find the right Fibonacci, etc., etc., etc. What I've done is I've placed a link in the chat box. I've just sent that now. That's to your presentation that you did in January, particularly on Fibonacci trading.
Absolutely, or just go onto Amazon and get the Rough Guide to Trading. You know, it's only 20 quid. And that has, you know, 3 really good sections on your Fibonacci, your overextended move and your strong overextended candle and your strong directional move. If you just buy it for those 3 chapters, it's worth you 20 quid. Get it on the ebook and just read it. I think it's like 8 quid or something. And I can't be bothered, you know, going through the whole Fibonacci thing again. It's a strong directional move, something that you draw from an extreme to an extreme. Okay, so as long as it doesn't make a new high or a new low, that 50% is the pivot. Once those high and low are broken, yeah, you have to find the new Fibonacci. That's as simple as I can make Fibonacci. You use the past to predict the future.
Yeah. What kind of monthly percentage could you expect to attain using your system? Asks Gordon.
It really does depend. And again, it comes back to the amount of money you've got. I've got people with 100 grand accounts that are making 30%. I've got people with 10 grand account that are making 5%. I've got people with £100,000 plus that are making 0% because they just sit there and watch it. I've got every different, kind of client you can imagine. I've got trust fund kids, I've got millionaire property developers, I've got surgeons, I've got a lot of pilots for some reason. Pilots seem to love me. But the system isn't there for returns. The system is just the lines, the support resistance, that idea of what happened in the past will logically spill out to the future. What my mentoring side will do is I'll sit you down, we'll have a chat, and we'll see what you want to achieve. And 9 times out of 10, I will get you to that point. But you have to come with the money. You have to invest in yourself. I'm not going to give you my time for free if you don't come with your own investment. And I'm not asking you to, give me the money. You put the money in the account. It's you that's trading it. You just have access to the charts, access to my thinking. And my key is I've done over 1,500 webinars now, well, probably more. Written books, hundreds and hundreds of webinars. That's for everybody. These sessions are for everybody. That's general knowledge. You can Google it. You can buy my book. You can do watch a past recorded webinar. The whole idea is that when I do this mentoring, it's with you. Yeah, what people struggle to do in the markets is to figure out how they want to interact with the markets. They're always looking for somebody else to copy. If I do it like him, then I will be good. Yeah, who did Muhammad Ali copy? Nobody. He was his own person, but he still had a trainer. He still had people around him. That's what trading is. It's a lonely game. You need to find somebody, who's been there, done there, got the T-shirt, and tells you how it is. I'm not going to sit there holding your hand, stroking you on the head. Aren't you a good little trader? No, I'm just going to get into the bones of what trading's all about, figure out what you're trying to achieve, get a plan. I'll tell you some little bit of magical tricks, and all of a sudden, I've opened the wardrobe. You're in Narnia. Go off. Be free. Run, little fawn.
Okay. Well, Carolyn says we're up for 14% in 3 months with Steve's help. So there you go. You must be working with Carolyn, which is great.
Yes, the Clarks, I do. I work with them. Yeah, absolutely. Like I say, my client list is long and distinguished, and I have people. Don't get me wrong. Some people break the rules, and sometimes we have big drawdowns. Somebody lost a lot of money over non-farm payroll, but we're working together. We're back on it. We're talking. It's different for everybody. It's different for different people. I wish that I could say that I guarantee everybody 5%, but it doesn't work like that. You have to put the effort in. What the missing part of training is that bit in between the learning. Everyone can listen to a webinar. Everyone can pick up a book. Everyone can buy a bit of software like VectorVest or whatever else. It doesn't tell you what you want to know or what you need to do at that precise point in time. Yeah, there's very few people on the planet that can do that, and I am one of these people. And we'll either get on together and it'll work, or we won't. But all you have to do is open an account with a broker that doesn't trade against you. Yeah, somebody where I'm going to give you, if you do the volumes, 10, maybe 15% of your money back each month. Yeah, and that's it. Then you get time with me. What do you want time with me anyway? That's going to be worth just sticking 25 grand in an account, isn't it?
Steve, I'm putting there. We're getting quite a few questions. Say, how do we get started? How much do you charge, etc.?
No charge. It's free. Just go to steveruffley.com. And you have to put 5 grand in. I'll give you my charts, but you can't talk to me. More than 25 grand, you get to talk to me. Above 100 grand, I'll take you out to a Michelin star restaurant and we can have a nice little chat.
Okay, well, I've actually put them in.
There's no in between, there's no bargaining, there's no sub stories. That's it. And I will be absolutely honest again, Simon. This is tick tock. I'm not going to offer this mentoring service for forever. I mean, you'd be lucky if you can get it. If you don't sign up to in the next kind of day or week, then all of a sudden it'll be closed off because I have no shortage of clients. Don't get me wrong. And who else comes on your webinar, Simon? Time and time again, giving you all this great showmanship, and at the end of it, charges people nothing. Nothing.
Fantastic. Okay, well, there's a lot still coming through. I'll put the link in the box if you want to get in touch with Steve. Just fill out that form and he'll get back to you.
Yeah, I mean,
basically,
there's loads of stuff, you know. You just Google Steve Ruffley. I've got about 8, 9, 10 pages, you know, on the web, you know. So do your research, you know, figure it out, you know, come to me with some intelligent questions because it's a very fast-moving process. I'm not going to sit here and, you know, kind of say, okay, right, you know, you've got $5 grand, right, let's, you know, strategically plan our future together. So it's not going to work like that. You know, in my experience, I've taken people, you know, from £25,000 accounts to 100, people with 100 to 500,000, people with 1 million to 5 million, right? I've done that. Yeah, it's not easy, but I've done it. I've got a track record. And it's different every time. I can't give you a blueprint of how it'll work with you because I just don't know. I don't know you. Yeah, but what I can do is we can have a conversation and some dialogue, and I quickly understand what kind of trader you are based on what kind of people. Because there are only 3 kind of people in the world that I've met. Yeah, and not all of them make good traders. All right, Simon. Listen, I've got to be rude here. I've got to actually finish this because I've got yet another call that I've got to jump on now with somebody to sort out this thing in London. So if you've got the ability to cover me for the next 5 or 6 minutes.
Absolutely fine, Steve. Thanks very much for joining us. It's great to have you. We'll speak to you again soon. Bye.
Speak to you soon. Cheers, guys. Bye.
So there we are, Steve Ruffley. Okay, moving on. Now is a good time for the kettle. If you are just joining us, we have a short break, 6-7 minutes, until we welcome our next speaker, Adam Harris from Trade with Precision. I can see that he's on standby. Thanks, Adam, for letting me know you're in the room already. So if you want to have a quick break for 5 or 6 minutes, come back with a coffee. We're going to be starting again on the hour at 4 p.m. London time. Just to recap, we've heard already this morning from Thiru Nagappan, George Hallmey, Ed Matz, David Paul, Carol Harmer, Peter Watson, Rob Colville, and just now we've been listening to Steve Ruffley. Still to go, of course, today. Adam Harris coming up in 6-7 minutes time. Mike Hamilton, Scalper Trading School, Bo Yoder, RBJ Financial, and finally Christian from Hertz at the Tribeca Trade Group. So lots still to go. My name is Simon Campbell. Welcome to us if you're just joining, and or thank you for staying with us if you've been with us throughout the day. These are all live sessions at Around the Clock Trader, and thank you for all your questions. I'm sorry we're not able to get through everything as it goes, but yes, Klaus, as you're just asking, recordings will be made available to you as a registered attendee on this event. And if you do want to watch all the recordings, they are at londonschooloftrading.com. There's over 300 pre-recorded webinars in there. I'll put that link for you in the chat box just now. You just simply join the up to the On Target Trading Club, and then you've got access to all these webinars as we go. So my pleasure, Klaus. Thank you for joining us. So over the next few weeks, we'll be bringing you 1 or 2 special event webinars as well. But we have switched back to Round the Clock Trader as a monthly event. Some of you will know that we were experimenting with doing weekly events, but that has now gone back to the monthly events. So we have this rather large event taking place just once a month, because it was all becoming a little bit too stressful and logistically wise speaking, quite a lot to handle. So we're looking forward to that. We just had our live event in London at the beginning of this month as well. We're going to be doing the next event in London on the 4th of November. So that's what we call the RTC Live. And great fun event. As many speakers as we could persuade to come down to London and present some of the seminars that you hear on the webinars. Always nice just to do it face to face. A few sponsors there with tables, quite an informal type of event, but obviously a lot of activity going on, and just always nice to put faces to the names, to meet everybody there. So if you can keep the 4th of November free, that will be the next time that we run that event for you. And indeed, that is where Adam Harris, our next speaker, was down at the show a few weeks ago and presented this workshop live there. So if you weren't there, this is your chance to catch it. Learn a 6-step strategy you can apply in any market or any time frame. So I'll be starting just a few minutes time from now. Steve, Steve's asking about which brokers should be avoided. It's difficult for me to comment. There are literally so many different brokers and different types of services that it's hard to advise on what is best suited to your needs. As Steve was saying, or I think Rob was saying in one of the previous sessions, it depends on what you're trading and how you're trading, and different levels of service. There are some brokers which are better for trading in the US stocks, some brokers better for Europe, UK, and so forth. So it just something that's hard to comment on. Oh yeah, well Adam's saying I think the forexarmy.com do reviews. Yes, they do, and that might be somewhere you want to go to have a look and type in the broker's name and see what people are saying about it. Also, tradetowin.com, they have a huge forum stretching back for years with threads, and they'll tell you about most things trading related, education providers, etc. Just to search them at Trade to Win, and you'll see what people have been saying, if they've been on these courses and things like that. That's always a good place to start. Well, let's go across to Adam anyway. We're a couple of minutes out from the start time, but I think we should welcome him into the event. I can see him in the list, so what I'm going to do is to make him a panelist, and when the
Can you hear me? Hello.
microphone comes off, yes, Adam, hello, it's Simon here.
Hi. Oh, hi Simon, how are you doing?
I'm very well, very well. Thank you for your contribution. You're right, Forex Army, and there are various other sites, of course, that they all do review these different
Yeah,
things.
I think they take it. It's a really good question. It's a universal question, and it's tricky because some people have bad experiences where other people don't, and so the reviews really aim to kind of work off, I guess, in terms of trying to determine whether the brokers are legit or not. First of all, so it's a very good question, and it can be a bit tricky out there. I think many brokers today are in better shape than they were, say, 5-6 years ago, and so really at this point, most of them are pretty much the same in many cases.
That's right. But of course, there is this new guidelines coming out from the FCA, which are changing some of the parameters that brokers are allowing to smaller traders to leverage up their trades. So that might be making some changes in the coming months with spread betting companies in particular.
Yes, I think that the markets are attracting more and more people, which is a good thing. But also because everyone is relatively new to it, to some degrees, the safety checks have to be in place, and one of those is leverage margin requirements as well as just general education. So it's definitely evolving in the same way that that 50 years ago, very few people had a computer, or 30 years ago, very few people had a computer. Now everyone does have a computer, even on their phones. Most people are now looking at the market, just like they do at properties, as a way to earn an additional income.
Adam, welcome to the show. It's the first time you've spoken on the Round the Clock Trader event, and this is good to have you here. We are a multi-speaker event, and we feature presentations by 12 different speakers throughout the day, so it's good to have you taking part. You are currently a mentor for a company called TradeWithPrecision.com, which is a sort of a global community of traders and mentors based around the world, conducting a lot of mentoring through webinars. So you're very comfortable with obviously this sort of format. but you weren't always a trader. You came from, you had your own business and things like that. Can you just tell people a little bit about your story?
So I mean, I'm 42 now. It's not a big deal except for the speed at which time goes by. But I was actually, after I watched Jurassic Park, I was enamored with the film industry, and I got into computer animation in its early days. So I used to work for a company called, well, it's now Autodesk, but I used to work for a company called Silicon Graphics and another company called Alias Wavefront, and I was very much involved in the animation industry. Traveled around the world, which was fantastic, and then and in fact trained a lot of people who subsequently now work in the big companies around the world. And then I had a production company in South Africa, in Johannesburg, and ultimately sold my shares in that in about 2008. And at the time, I wasn't aware, because my financial education at the time was minimal. I could sense that properties were overpriced, and I could sense that the budgets were getting cut. And working with a lot of advertising agencies, I was aware that there was something going on, but not really aware, kind of strictly speaking, of what was, what the issue was. And I think at that time I decided to sell my shares, and then the question that I asked myself was, how would I used to stress about making sure that I had my staff salaries paid and your taxes and VAT and everything that had to be sorted, and rent, and of course just trying to keep the business afloat. And I decided that whatever I did next, I didn't really want to employ people. And then I also thought, well, I don't really want to be employed either. So I kind of did some research and thought about things that historically are known for making money, but that would tick those boxes, and ultimately landed on property and trading. And at the time when I Googled it, Forex kept coming up in Google searches, and so that was really how I started to investigate the idea of doing a program. So I started looking at a few different programs. Do you want to share? Do you want to hand over to me? Shall I share my screen?
Please, let's do that now. I will send you the invite to make you the presenter. Yeah, it's a good story, and I'm sure there's a lot of people here share that a similar story to that. It just leads us into these positions, and for all these reasons that you're mentioning, not wanting to be employed or to employ people, the financial trading offers a great opportunity to do that. So this is great. I can see your screen. Learn a 6-step trading strategy. If I could just ask before I back out of the webinar, people just to confirm using the chat box that they can hear Adam and they can see the title slide. That would be great. That's great, Guy. Thank you very much. Okay, Carol, great. So, Adam, I'll hand over to you. It's just about 4 minutes past the hour. The next speaker won't start until the next hour, so we've got about 56 minutes. So, over to you.
Yeah, that's fine. Thank you. I'll monitor the time from my phone. And Simon, thank you for the invitation, by the way. It's great for you to have created this. I guess because when I was starting out, this would have been the best place for me to go to investigate and sniff around and do a whole lot of things. So I just want to say thank you. It's a pleasure to be involved from the other side this time around, and I just want to say thanks very much for setting it up. I think it's a much needed contribution to the industry. So thank you.
Thank you for that, Adam.
So all right. So I was just gonna say that I arrived in London, and this was around 2009, and started sniffing around looking for programs to do. And I ended up doing a couple of programs, paid a lot of money, did quite a bit of education. I think there was some value in the trading programs I was doing, and I read everything I could get my hands on. I read, Trading in the Zone, The Disciplined Trader, Steve Nissen's Candlesticks. I did, I just did everything I could get my hands on. So anything that anyone else is talking about, I sort of got my hands on doing that. Larry Williams, Niall Fuller, Al Brooks, price action, everything. So, and I made all the same mistakes. I got greedy, excited, up at 5 in the morning trying to trade the market and be done by 8, and just all the different sales pitches. Basically, I don't think there was a single sales pitch that I didn't hear in those first few years, and I was a little bit sort of all over the place. But I was grasping stuff in principle. The issue was that there's always someone offering another strategy or another indicator or another gadget, and it's exciting, but it's also very flashy and doesn't really necessarily. It didn't really feel like I was progressing. Anyway, so I probably did that for a couple of years, and I was also trying to pick the time frames I was trying to trade. I was a little bit all over the place, and when I was doing the program, there was the presenter at one point recommended that I look at. He said, "Listen, if you aren't subscribing to Trade with Precision's newsletter, weekly newsletter, you should." It was like 2 6-minute videos where Nick McDonald, who's the founder, was doing market analysis for the Intercontinental Exchange, which is a massive exchange in the US. And basically, his stuff was just so good. He was always right. Every week he would say, "This is what I'm expecting the market to do, the dollar, this is what the euro is going to do," and he was just always right. And eventually, I had already spent so much on education. I was loath to do it again, but I was actually saving and making money. So eventually, I just committed and did it. And I think that was the best decision I ever made, predominantly because about 80% of the general knowledge that was in the program that I did with Trade with Precision was already roughly known to me. There was 20% which was details, which I think are crucial, that I wasn't aware of, but it was mainly also about how it came together. It was really about pulling it all together, making it. I wasn't applying what I was learning properly. So anyway, so that was really just the progress. I wanted to tell you a little bit about myself. So obviously we've got the risk warning and disclaimer. Just to Trade with Precision is not a signal provider. Now I wish I had sort of listened to every speaker who was presenting today, because I think there's some really talented individuals, and I think there's a lot of knowledge to be gained. I think for beginner traders, it's very confusing potentially, because it's kind of everybody's trying to sell their wares and everything, and I'm not going to do that. I'm very proud to be part of the team. Although I trade full time, I'm very proud to be part of the team at Trade with Precision. So what I'm trying to say here is that I want you to be able to be, make your own decisions here. We're all adults, and in my personal opinion, this is the best trading system I've ever seen, but that's just the same thing that everybody else says, so I want you to judge for yourself. So first of all, sorry, welcome to the Round the Clock Trader event. It is great to be here. Who is going to benefit the most from this session? Effectively, people who have been trading for a while but are just not getting the consistency that they're wanting. So I'm just having a look at some of the comments here, just making sure that the questions and everything are being answered. It all looks good to me. And actually, give me one more second here. Yep, just making sure it's all good. So yeah, if we have questions, by the way, please feel free to ask them as we go through into this one.
Adam, are you seeing the questions?
It looks as though I'm really just seeing my conversation with you at the moment. Right. If anyone has typed a question in, I'm not seeing any.
Let me give you. I think I need to give you more rights as an organizer.
Okay, hold on a second. No, I know what it is. No, send chat to you. Yeah, okay. What you can do from your side, thanks.
I'm going to make you the organizer, which now should give you access to the questions box. You'll see a whole lot of whys in there from people confirming that they can see.
Thank you. Okay. All right. So keeping an eye on the time. Okay. So just to kind of sort of keep rolling forwards on this. This is really where I have found that so although I trade full time, and what does that mean? It means I work from home. I'm in Wimbledon at the moment. It's a beautiful day, and I probably collectively spend about no more than an hour or two physically in front of the charts. I mean, I do sometimes sit in front of the charts and just play around, or I might do about 6 hours a week for Trade with Precision. And that's really because I think that if I wasn't doing that, I would just go crazy. I would literally I would just pester the local coffee house because I would have nobody to talk to. So it really does benefit it. Plus, my colleagues are incredibly good traders. They're incredibly good at technical analysis, and so it always benefits me to work with really good traders. And if you had access to that, wouldn't you do the same thing? So really, that's kind of what I do, but it doesn't take more. I'm going to show you some of the trades I took last week, and collectively, that was probably no more than an hour's worth of management of those trades. So for me, it was really just about getting the results. And so when I saw Nick a few years ago, he said, look, do you want to join the team? And I had the time, so I did. And so we're going to talk a little bit about a trend flow strategy, which is yours to Sorry, I'm looking at the questions here. Yeah, you know what? Even I'm not sure I can get Wimbledon tickets this year, but that would be fantastic. I saw the semi-finals about 2 years ago. It was amazing, and it was a perfect day for it as well. So here's what we're going to cover today. We're going to talk about the trend flow strategy, which is the one that I use. I've got a couple of strategies which are TWP, trade with precision strategies, but the one is just so easy for me to do. It's very easy. It's the ones that I traded last week. It's easy to spot. And basically, they're tradable in any liquid market in any time frame. So you could trade stocks, forex, indices, commodities from 1-minute time frames to monthly charts if you so wish. Now, I'm very sensitive to the idea of trading is not a secretive society. Trading is not a conspiracy. It's really not. It's technical and it's logical and it's sensible. Okay, we might get a technical incident such as a flash crash or the Swiss CD picking, and that's possible. Of course that's possible, and that's going to happen. It's inevitable at certain points. But aside from that, for the most part, technical analysis always delivers. And so I'm loath of people who try to bully you into buying their products or bullying you into doing certain things, because that's actually makes trading not as pleasant as it really is. It's very much a learnable skill, much like a language. But here's where we have to, this is what we have to understand. The way that trade with precision works is common sense. We trade only trending markets. The reason we trade only trending markets is because, first of all, the direction in which the market is going is very clear. Secondly, the odds of us hitting our 1-to-1 or 2-to-1 or 3-to-1 or even greater targets is much better than it would be under any other market conditions. And third, it's a time saver. We can let go of charts that are not trending, just let them go and just move on to charts that are trending. So we're going to go through the markets depending on time, because I have promised Simon I will be finished exactly on a minute. Let's call it a minute before the end of the hour so that I can hand back over. And so basically we need to be trading liquid markets. Liquid markets meaning any markets, and there's so many out there. There are thousands out there that we could trade. Basically that just means that the costs for us to place the trades are going to be very cost effective, and also that we're not going to get gaps out. We're not introducing risk into our trades. It's very practical. We want to trade stocks, forex, indices, and commodities. Why? Because sometimes the trends are incredibly strong on commodities and stocks, and they're not trending on currencies. They're ranging on currencies, and it's relatively speaking, it's easy money. And that's a very important aspect. Is a lot of people overcomplicate it. They, you know, there's one slide I want to cover because I can associate it pretty much with anyone who's almost doomed to failure. And that sounds very negative, but it's kind of the same as when we keep picking bad relationships with the same type of people we shouldn't be doing that with. People pick bad charts to trade or whatever. They pick bad trading ideas. But the point is we could trade from 1 minute to monthly charts. Personally, I'm normally trading 1 hour, 2 hour, 4 hour, 8 hour, and daily. Nothing more than that. And all the trades I'm going to show you later, I took off the daily. So who's Trade with Precision? It was started by Nick McDonald. In my opinion, he's the most natural trader I've ever met, and there is zero bullshit with this guy. And I'm sorry, but there's so much of that out there. I'm just, it's everywhere. And we live in London, so it comes with the territory, but there's just nothing with Nick. Nick is a shy kind of reserved person, but wow, he knows his stuff when it comes to technical analysis. And so these are the clients. We've got the Intercontinental Exchange, the Chicago Mercantile Group. We're providing, well, I say we, like I said, I'm very proud to be part of the group that is providing market technical analysis to the top institutions in the world that goes out to their clients. I mean, the stuff for ICE was going out to 30,000 people every week. And you can't do that. You can't get away, you can't fake that. So and of course that's analyzed by pros. Please just give me 1 second here. I've got this, okay, never mind. So yeah, so I'm very proud of that, and they've got a great reputation. And so that's just something that I think is really good. So I've told you a little bit about my history. I'm now predominantly just trading full time. I'm not doing too many of the property things. Let me just do this quickly. Sorry, I've got ironically got a fund client calling me right now. Okay, so this is just the idea that we'll just introduce you to that. So why trade the markets? There's a series of slides here on compounding, and now if I did see you in person, that's fantastic. I don't, as a general rule, I don't present to live I don't attend these events. This is not what I spend most of my time doing. But I do like it because I get out about and I kind of see other people in the industry, and I don't even, it's a small pond, it's a very small pond. So it's nice to do that. So and I will be there in November. I have promised Rakesh that I will be there. And so if you do want to attend and meet everyone, that would be fantastic. Come over and just say hello, whichever desk we're sitting at, and just come over and say hello. But for the most part, I'll just be at my desk at home. So compounding is worthwhile talking about, excuse me, because we can use it to our benefit. So although a lot of people talk about it, nobody really uses it properly. And we all understand it in terms of credit card debt, but it is quite impressive if we are able to achieve growth on it on a monthly basis. We can actually we can use it in our favor. And the best example that I can think of for that is, honestly, this is what I do when I'm delivering when I'm trading for clients, is that I anticipate that if I can just hit a certain type of return every week, that I will generate an additional return by the end of the month simply through compounding. And an example of that would be if I can kind of generate 5% in terms of trading as I go through week 1 through to week 4 in the month, by the end of the month it could be as much as 7%. And just through compounding. And so that extra percentage is the same amount of work, there's no extra work, but it has made a significant difference to the returns on the account. And so I use compounding as part of that. It also takes the stress of trying to hit a particular target per week, meaning that if I just do 0.25% a day, it'll compound to 5% a month, which is incredible. And so it takes the pressure of having to do a certain amount per day, but rather per week. And so that's kind of what I do. So just the whole idea here is saying that, look, if we're not using it properly, if we're not paying attention to it, compounding can kill us in terms of the debts we build up in life, but we can actually use it in our favor as a trader. Is everyone with me so far? Is everyone alive? Nobody's trapped under a rock or anything? Okay, so that was just to introduce that concept. Now, in terms of how much is feasible to expect to return, this is the other thing I wanted to say here, because you know, trading is very much a learnable skill. There's a certain amount of stuff that you have to get through in the beginning, because you have to determine where you're bringing your baggage into the game and where you're not. But trading is ultimately a simple process once you get rid of your headspace, the stuff that's going on in your head. So a certain amount of practice and familiarity with the strategies does start to make it a lot easier, relatively speaking. So when I'm showing the trades that I do to the fund managers, it looks so easy to them. When they see what I've showed them, I go, well, that's the trade I took. Well, they go, well, that's obvious. But if they were to try and do it on their own, they have all kinds of fears and doubts and funny things that get in their heads, like what's Draghi going to say, what's Trump going to do, and that doesn't really help if we're technically analytical traders. So this is something to keep in mind, but it's feasible to anticipate to do about 4% a month. Okay, so that is something that we believe that traders who are looking for high quality trade setups should comfortably be able to achieve, and sometimes even more. A lot of people are very scared of saying how much you can do, but the point here is to learn, is to teach a man how to fish, okay, as opposed to give a person a fish. We're trying to, it's a very much learnable skill, but it is also about not trying to complicate it and not trying to make it secretive and not trying to, confuse people with it. So, we're kind of looking for 2 to 5 trades a week if they exist. If they're not there, we don't trade. If the trades are there, we take them, because really good trade setups are worthwhile taking. It's money on the table. And so I wanted to give you a sense of that. So the first thing we do is we want to really be selective about the charts that we trade. We're looking for what we refer to as optimal price action, meaning a very clear price direction, because the market is either going to be trending or not trending, or trending up, trending down, or not trending. And so we need to be able to differentiate that. Also, people need to understand, and new traders need to understand the difference between a strategy and technical analysis. Technical analysis is just studying what the conditions in the chart are doing. It's a study of historic prices, mainly so that we can determine key levels. We need to look at history data so that we can determine which price levels are significant, because they are ultimately the barriers, the walls between where the trades are going to be taking place. Then we have to be aware of the indicators, types of indicators and oscillators that are out there in chart patterns. Those are just, they just tell you roughly what's going on in the charts. The trading strategy itself is very much a pattern, a definition of a type of pattern that you're going to trade, a high probability pattern, that when this type of pattern occurs in a chart, that it tends to unfold a certain way. And if it looks like this, it's a very strong version of that pattern. And if it looks like this, it's a weak version, meaning it could be hit and miss. And so really we learn to identify the stronger setups from the weaker setups, and then we trade those. And that can take a little bit of discipline because initially we're excited about just trading in general. But once we get to the point where we realize, holy cow, I'm really good at picking these types of trades, then it becomes about actually starting to just find them. So you stray less and less as you get more, as you mature as a trader. You're kind of like a kid who just wants to eat sweets before bedtime, and your parents are trying to feed you vegetables, and you don't really get it. So now as you get older, you know, you still want the sweets, but at least you understand why your parents give you the vegetables. So it's a lot more like that. Anyway, so every strategy should always be based on evidence. You're always collecting evidence to take a trade that it's much more likely to go in your favor than go against you. So that's the edge. And it should always come with a very specific excuse me, entry, excuse me. I got one of those dry throat things. Okay. It should always come with a very specific entry and a very specific exit, a series of, you know, actual where your stop loss should be placed, and how to manage the trades to squeeze as much profit out of them as possible. And then we talk about focusing on flawless execution. So flawless execution is actually just a state of mind. It's a decision to behave a certain way. It's kind of like somebody gives you a diet, and it's making a decision to stick to the diet until it's not an effort anymore, until the diet becomes the normal way of just healthy eating. That's really what flawless execution is. So technical analysis won't make you money just by analyzing the charts, but the strategy itself, once you've analyzed the chart, it will help identify where the setups are or the strength of those setups. So a lot of people struggle to do this. I mean, first of all, honestly, trading is much more about mastering fewer strategies and just mastering them and understanding them, and less about you know, changing time frames, changing strategies, new shiny indicators, all kinds of things. And certainly this is the way that trading has been done for the last 100 years. So the only 3 areas of technical factors that we do need to focus on is, one, who's in charge of the market we're looking at the specific chart, the bulls or the bears. Is price trending? If it's trending, then we're going to look for an opportunity to join the trend. If it's not trending, we're going to walk away. We also want to use traditional indicators as leading indicators to predict price movement. So usually indicators are lagging because they're derived from price action. But we can read them in a different manner to help identify where trade setups are going to be. So we use them in a different way. This, to my knowledge, certainly for a while, this has been unique to Traders Precision. Technical factors are really nothing more than building blocks. We're looking to build a case, to build evidence, and so we obviously want to combine as much evidence to support our idea, or to support that the pattern we're looking at is a good setup. So each technical factor is a unique building block. So this is looking at price action, support resistance, Fibonacci, moving averages, for example. And each building block has unique characteristics. So what does this mean? It means understanding each particular element, understanding price action, and understanding how to identify true support resistance, understanding how to read price action, understanding how, what moving averages, what the purpose of them are, what the purpose of horizontal support resistance levels are, and just understanding how to then combine all of them. So when we put these specific blocks together in a certain way, obviously that's when the magic happens. We start to build up a case. So for someone who's been trading for years, their ability to read price action, it's like reading body language. If that's all you do is study people's body language, you're going to get to a point where you don't even realize how much you know. You'll just read someone and you'll pick up everything. For a beginner, it's hard to look at all the different amounts of information that's coming in. So for traders, so what we have to do is we have to provide beginner traders with a long list of things that they need to do to check, because we have to teach them all the different things that they have to take in. But over time, it becomes muscle memory and unconscious. So just showing you how we can build up that case. So the 5 technical factors for the trend flow strategy are: we need 1, optimal chart structure. This is the price action itself. So everything should start with price action. So no matter what indicators are on the chart, we should be looking at price action. And anyone who tells you otherwise is selling you something. 2, the moving average fan. Okay, so this is using the moving average geometry to help frame the price action. it does two things. It confirms that the trend is healthy and established, and two, it identifies areas where price action should provide us with opportunities to join the trend. Then in this area, we call the dynamic buy and sell zone. So I'll go through that in a bit more detail. Then we look at price action itself specifically in terms of what is it signaling to us in terms of our opportunity to join the trend, and how is it behaving within the context of the trend. And then we look at support and resistance. Support and resistance is incredibly powerful for the following reasons. Effectively, support and resistance levels from the daily, weekly, and monthly timeframes help tell us where the meat on the bone is, so to speak, where we can trade from one level to another level. It also tells us where we need to make sure that we're out of the trades by a certain point, or we take profit by a certain point, and also we can use them for stop loss protection. So we can use them to, it's just incredibly powerful. If you had nothing else to trade with other than price action and support and resistance, you could still make money. So the rest is just extra stuff that traders need to help either strengthen a trading decision or not. So technical factor number one, optimal chart structure. Focus on charts with a clear trend. Trend analysis is the single most important technical factor. Okay, for this. Highs and lows that give us an indication of who's controlled the market, and too many unsuccessful traders regard trend analysis as too basic or easy. And every program you ever go to, the very first thing they teach you is this is an uptrend, higher lows and higher highs, and a downtrend is lower highs and lower lows. It's the first thing they teach you, but nobody ever applies it, and that is magic for me because it's the one thing that people just don't do. And I know lots of people who've been working in the city for years who don't actually know how to read price action properly. So the point of it is that if we arrive on a chart and it is producing higher lows and higher highs currently, then we should only be looking to buy. Okay, depending on where the support resistance levels are, we should only be looking to buy because the trend is up. If we arrive on a chart and it's producing lower highs and lower lows, then we should only be looking to sell. That's it. There's nothing else. If we're buying in the situation, then the whole point here, ladies and gentlemen, is to earn a consistent living. So I don't know what I'll be trading in 6 months' time, but I know that it will be whatever is trending. If that's the euro, or if that's cocoa, or if that's the S&P to the downside, that is what I'll be trading. But it has to be trending. So that's the beauty of it, is I don't really care what the fundamental reasons are a year or 2 years from now. I just care what's trending. And it takes a lot of the strain and the stress and emotional pressure out of doing it. But to go and try to short the S&P today while it's bullish on multiple time frames is suicide, because there's just no supporting evidence for it in the price action. And so that's really what we need to do. Is a lot of people, that's a great example of that, because we will see when the market goes into a downtrend and then we can start selling it, but it isn't that way now. And it won't cost us anything really to do that, to just be other than patience. And everyone's preparing to do it, and actually we should be buying. So this is just highlighting that we need to be trading today what's trending today, and then just trade it in the direction it's going in. And we need to be doing that a month from now and 2 months from now and always. And that's how we earn a consistent living. We find a trend, we join it, we take some profit. We find another trend, we join it, we take some profit. And so that's really our obligation. All right, if we arrive on a chart, and this chart doesn't get enough appreciation, in my opinion, is if we arrive on a chart and it's mixing up its highs and lows and it's inconsistent, then it is either consolidating or ranging. And it is not producing, it is not a money-making opportunity. It's a time waster, and it's going to cost you. It's just going to cost you in terms of emotional, in terms of your emotional equity, because it's going to hurt, because you're going to be trading something that has no clear direction of where it's going, and it's not going to follow any rules. And also remember that pros do like to trade trending markets. So that's very important. So what we do is we talk about trading any market, any time frame. We refer to trading any liquid market. We don't want to trade something that gaps. I mean, that's because that introduces risk and it increases the spreads or the fees that we pay when we get in. It's not practical for us to do that. All right, and we want to avoid charts with long tails. This is just crazy. This is, again, these are bad relationships, and every trade is in its own way a type of relationship that you have. What we're looking for is something like this. Doesn't really matter the time frame, doesn't really matter what the instrument is. If it's liquid and it looks like this, we can trade it, so we can make money. All right. And so this is very much an emotional choice many people have to make. Everybody that I'm talking to now, I'm presenting to now, can see that this chart is clearly trending. You can see it with your eyes. Your brain is telling you that it's definitely a better quality chart. But then there's these emotions that come in saying, well, but I don't know, maybe the trend's going to change soon, or blah, 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 blah. And then actually what happens is our emotions just get in the way. And so this is really when we talk about how trading in itself can be very simple from a technical, cold-hearted, precise perspective. But most people just bring their baggage in. And when I say most people, I should say all people. Just the quantity and type of baggage varies, but everybody brings it in. So don't ever think that you can't learn how to do this. You can. And I've mentored enough people to know that it can be done. So technical factor number 2. So this is just to recap. This is the kind of price action we're looking at. And I always like finding this on the daily, because if I can find this on the daily time frame, then it's tradable on the lower time frames as well. Then we want the moving average fan. So this is a 200, 50, 20, and 10 simple moving averages. You can use exponential, doesn't matter, but they're there and we can use them. And we really just use them to frame price action. They tell us that the trend is established and that it's stable. Okay, so the price action is actually telling us that as well, but the moving averages are reinforcing that. So that's important for us. It tells us, it smooths, first of all, moving averages smooth out the short-term fluctuations in price. They highlight the trend, and we can use simple or exponential moving averages. We do not use them for support or resistance. We do not use them for entering trades. We don't look for price to touch a moving average, and we don't use moving average crossovers. We don't do this because it's not 95 to 100% reliable for us. We need tools that we can count on all the time, and not something that randomly seems to show something else. It's not enough for us, and that's a choice. And the way that we've developed, or the way that Nick has developed the program, it works more than enough. So identifying the moving average fan, obviously what we want is if price is trending upwards, we want all the moving averages rising as well. In a downtrend, we'd want them all declining as well. And at a similar angle, so if they're running largely parallel to each other, that is an incredibly strong trend. It's beautiful. If there's a nice space between them, just almost like train tracks, just going in the same direction. And if they're forming a fanning pattern as well, that just tells us that the trend is nice and healthy and happy. And if we do moving average crossovers, that's just too delayed. We want to be able to know, I've got a trade set up now, is it a good setup right now? Okay, and know that all the evidence is supporting it to take the trade. The third technical factor also uses moving averages, and it helps us time our trade entries. So now what's happening is we have identified a trend in our price action, the moving averages are supporting it, we are now looking for an opportunity to join the trend. So price will move in these waves in the trend, extension, retracement, breathing in, breathing out, breathing in, breathing out. And each wave offers us an opportunity to join the trend as price pulls back to that point of equilibrium. So to identify where this equilibrium zone is, we use these moving averages. Okay, we use the 10 and 20 moving averages, the space in and around the 10 and 20 moving averages. This is a point of equilibrium. It's impossible to find a steady, healthy, sustainable trend that does not interact with the 10 and 20 moving averages. They don't exist. You can't have one without the other. Okay, it's like night and day. They're always together. So the colored zone around the 10, I know that sounds like a contradiction because you never get night and day together. What I mean is that one always follows the other. They're just always two sides of the same coin is what I guess I was trying to say there. So the colored zone around the 10 and 20 period moving average is considered to be the buy zone in an uptrend. Okay, is everyone there? I'm just checking. You guys are very quiet. So you either my dulcet tones are putting you to sleep, a nice afternoon nap, or I don't know. Just checking that. There we go. Okay, everyone's alive. Okay, good.
Everyone's still here. Yeah, we're hanging on every word. That's all. We're just digging in.
Okay, good. Good. So, and the sell zone. So we've got the sell zone. If you go do this, put this on any chart that's got a nice trend, and you'll see this interaction with the sell zone. So you can't, this is self-evident. That's a great way of putting it. It's self-evident. It shows that it works because you can see it. And so the logic behind the trend flow, this is why I like it so much, is because it's so simple to me. It's basically saying, I can see that you have this habit of interacting off this sell zone. And as long as I'm not near a support resistance level where price might change direction, which is what happens at those key levels, it's not crazy for me to assume that the next time you come back into the sell zone that I have an opportunity to join you for the next move. So basically we're saying, look, you're doing this type of thing as a type of behavior, and all I want to do is see you do it one or two more times. So it's actually very sensible from that perspective. So the next technical factor, number 4, good. Thank you very much. Number 4 is candles. So again, having done Steve Nissen's candlesticks, and I love them, and Al Brooks price action as well. These are all different things out there. There are hundreds of candlestick pattern names. Candles alone are not a complete trading strategy. Think of a candlestick pattern as just one of the many technical factors that's out there. So the first thing is that this industry is fantastic because, to be honest, there are people who are very good and just specialize on the MACD or specialize on Bollinger Bands or whatever, and they do that. And they can write a book on it, they can write a thesis on it, they can make an indicator, they can make money off that. And there's nothing wrong with that because as long as they're adding value to that particular instrument, there's someone who's interested in learning about it. There's a market for them. So that in itself is not a problem. And honestly, that I keep saying the word honestly, but what I mean is that knowledge is cumulative. It's not really wasted, but it can be distracting because it can often undermine the most important things such as price action itself. However, at the same time, there's always a lot of people who have worked out that all they have to do is produce all these shiny bells and then keep selling them to people and go, okay, I've got a new indicator for you. That'll be $90. Okay, here's another new indicator. Okay, I've improved this one, blah, blah, blah. So a lot of people, it's very easy to produce gadgets and things to you can sell people. So it's a massive market for that. And just be aware of that. When in actual fact, the way that these strategies work, you can trade on any platform, literally with any charts. You can trade off MetaTrader 4, off EKG, you can trade off eSignal, off TradeStation, any platform you like as well, through any broker. And so you can use the strategies. It's literally universal. And that to me is testament to how solid it works. So the candles alone are not a complete trading strategy. Think of a candle pattern as just one of the technical factors of a trading strategy. Learning lots of candle patterns can take focus away from what's really important. Who's in charge, the bulls or the bears? Thank you very much. Thank you very much. There's just a question here. I want to have a look at this one. As markets only trend 27% of the time and we need to sleep, how can you use alerts to avoid living on the computer? All right. So from experience, once we find a trending chart that's trending on the daily or say the 4-hourly, to a degree, we are going to have to check it every few hours. So let's say I'm looking at a chart every 4 hours. I'm waiting for an entry on the 4-hourly time frame. So I'm probably going to check it every 2 hours because I'm just waiting to see if the setup. And so we're going to talk through the strategy in a moment, and then I'm waiting to see if that setup occurs. So this question is actually going to get a better answer in the next 10 minutes. But I'm waiting for that setup to effectively occur for me. And yes, it's possible that it could occur at 4 in the morning or whatever. And so really what actually happens here is that we really are only able to trade in the period of time that our lifestyle allows us to do that. So we are responsible. We do have to sleep. We do have to eat. We do have to exercise. We have to do all these different things. And some people have kids or whatever and a job. They might only be able to trade during lunch or in the morning or in the evening. So what they do is there are multiple markets trending. What they're looking to do, it's a very good question because this is the dilemma that plagues everyone, is during that period where you're able to scan the markets, you'll go to your watch list, which is your short list of charts that are trending, which you might have done on the weekend, or you might just, it gets faster the more you practice doing it. But once you go to your watch list, you then go and look and see if there's a setup occurring within that window that you're sitting in front of it, okay? And if it doesn't occur then, you're going to have to let that go, but that's because you'll never get all the trades that are out there. But all you do need to do is get a certain amount to make your anywhere from 2% to maybe you have a bumper month. Maybe you hit 5 trades in that month and each one goes 3 to 1 and it compounds and you hit 20%. It's not impossible, but what matters is that the quality of the setup is high quality. That's what matters. And if you do that, the money will come, kind of thing. That's, you've got to focus on doing that. So, but I was more interested in the fact that you said the markets trend 27% of the time, because that seems like an incredibly precise amount, and we have different markets and they do different things. I just thought that was it's interesting, but I don't subscribe to that. I just subscribe that there is a trending market somewhere, and I'm going to go trade it, which means that at any given time there's a trending market. Okay, so technically I could say that I'm trading trending markets 100% of the time, but that isn't true because this week I haven't taken a trade yet. But last week I took a whole lot, and it's mainly because I just haven't had the time to go down to the lower time frames and see if there's anything. But some of the dailies aren't looking that great. Okay, so sorry. For me to carry on, what I wanted to proceed to the next point here is to Okay, so here we go. So you can take every single type of candlestick and you can put it into one of three categories. It's either going to be bullish price action, all right, such as these ones in the top category here, or it's going to be bearish, or it's going to be indecisive. It could even be bullish indecisive or bearish indecisive. But the point is we don't have to overthink it. And it is a fact. Every single type of price candlestick can go into one of these three categories. Just like every type of chart can either be trending, uptrending, downtrending, or no trend. So it's more about just stepping back and going, okay, what's the story here? And instead of really trying to evaluate something, just going, you know what, it's not trending, I'm just going to move on. And that takes a little bit of letting go of things when you just realize, actually, I can't affect the market. There's so many analogies that work, but the analogy I like the most is the idea of learning how to surf in the ocean. So you would go to a beach, you would immediately determine what the weather conditions are like. Is the ocean too flat? Is it too stormy? Presumably you can swim, okay, and presumably the water is safe to be in. But then the next step is finding the set of waves. And we know that they come in sets, so then you identify the set. You time it so that you can paddle with it and join it. Sometimes you're going to miss the timing, you'll be off, you won't paddle fast enough, or you're ahead of the wave, that kind of thing can happen. Once you get on it, you ride it until it dies out or until you decide you're done with it. If you get on the wave and it dies out immediately, you don't get pissed off with the wave and go, oh, you let me down, you betrayed me, blah, blah. You don't do that. You just go back and get the next wave. And you do that for that period of time that the waves are there, the conditions are right, and then you have the energy to do it without, getting too tired and endangering yourself. Trading is the same. We're going to go find the conditions, find the set, identify the set of waves, and then we're going to time it so we join it. And we're not going to get emotionally invested in why the market's doing what it's doing. We don't think about why the waves are forming. We don't do that. We don't really care about it. And we think because the markets are man-made, that man has an influence on them. There's so many people involved, thousands and millions of different things going on. There's so many cogs. Sometimes one move might be attributed to one incident. But generally speaking, on a day-to-day basis, that isn't the case. There's just so many participants in that market. And this is another thing. Everyone's talking about what's going to happen with the currencies because of this political thing. And I'm going, the currency markets are predominantly businesses transferring money, people ordering stuff off Amazon, tourists exchanging money, banks, companies paying suppliers, ordering stock, people, banks, companies transferring money across to each other. There's an entire underlying market. And some little dude who runs a shop in Spain that maybe exports a product out to America is probably shaking his head at Trump, but he's not going to change his business model based off what comes out the news one day unless he feels that it's going to be a long-term change and he has to adapt to it. So we really overthink what the news does on an ongoing basis. And that's why we can't match it to what we see in the markets, because it isn't matched to the markets. Like I said, Draghi can say something and upset the market, that's fine. But to change the trend and stuff, it's not that weak. The markets are not that weak, and they exist for other reasons other than just the pandering of politicians. So, I'm sorry, you got me rambling there, just keeping an eye on the time. So we've got, let's call it 16, okay, it just switched to 15 minutes. All right, and so basically we want to categorize price action into that. The next thing is trade with precision doesn't really go with sloping trend lines. It isn't because, again, although we can often see price interact with those trend lines, it's not 95 to 100% reliable. So forget about it. So we just take it away. It can be very subjective, and price action can be slightly different on different brokers' platforms, and then the trend line, there's a trend line on one person's platform that somebody else can't see. Forget about it. Just get rid of it. We use support and resistance levels. Now, a true support and true resistance level must have a minimum of 2 touches in that point in space by price action before it can be acknowledged as a true support resistance level. Otherwise, it's just a random point in space. So it must have a minimum of those 2 touches. And so the same thing again, a level of support again is at least 2 touches. And obviously, the more touches, the more we can acknowledge that level must be significant. So going through this from the top again, 6-step trend flow strategy, looking for a chart with optimal chart structure. Ensure that the chart is displaying the moving average fan, the 50, the 200, the 50, the 20, and the 10. Simple or exponential. Wait for price to interact with that dynamic buy and sell zone. Look for a bullish or bearish candle, which is our signal that the bulls have returned to resume the trend, or the bears have returned to resume the downtrend. Ensure that there's no support or resistance in the way of our target. So we're talking horizontal levels, that's where price changes direction. And we, And so what we want to do is make sure that, you know, as I said before, we can use those for different things, but they do largely determine how much profit there is for us to take. And I would add news, economic calendar news into this, meaning the economic calendar tells me that there is a US dollar medium or high impact news event at this time, and I'm looking to take a euro dollar trade. So I have to determine if I'm going to be able to close my trade before that news announcement comes out. I don't really care what it is. It's medium or high impact. I don't really care what it is. I just got to make sure that, because it could impact the market in my favor or against me, but I don't actually know. So I lose my edge. So therefore, I want this trend to keep going without anything interfering with it. And the only two things that can interfere with it, three things. One would be a support resistance level that I've missed, that I haven't seen, an economic event news announcement that I haven't seen, or a flash crash, something like a black swan event. Okay, so that's it. Ensure that the chart is displaying the moving average fan so that we can determine this. Okay, and so trend flow. Let's go through some of these examples. I wanted to have a look at the markets, but I have to keep an eye on the time. Yes, I can happily show you steps 1 and 2 again. Let me just go through those steps again. Blah, 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 blah. Step 1, looking for that optimal chart structure, price action, that beautiful chart structure. I'll show you very quickly on silver what that looks like. Actually, let me just go across to that. So let's go across. Okay, so let's say we went across to, only because silver had a really beautiful one and I missed it. It was on the 4-hour. So let's just go across and have a look at these, just very simply. And just see. So I've got the weekly and daily, but that doesn't really matter. Hopefully you can see my chart in front of me now. But if I just go down to, say, the 4-hourly and let it load up. This was really nice, but this doesn't happen. This is very unusual. I mean, as in, this perfect, picture-perfect trend does not occur all the time, but when it's there, you would milk that. Okay, and we had this kind of thing on, we had it on soy, we had it on some of the commodities as well, so we had it on other commodities, and you know, we can also get it on currencies. So my point of that was just to say that it does exist, and sometimes it's on a lower time frame, sometimes it's on a higher time frame. Sometimes we're very lucky, like dollar CAD. 6 months ago, dollar CAD was just trending beautifully, but on every time frame. So we want to look for that. We want the chart to be displaying the moving average fan, the 200, the 50, the 20, and the 10. And we want to wait for price to pull back into that dynamic buy and sell zone. Then we're looking for a small bullish or bearish candle, which is our signal candle, to join the trend. Okay, and then also we just want to make sure that there's no support or resistance in the way of our targets, so we can hit our target. We're looking for 1-to-1s, 2-to-1s, or 3-to-1s, ideally risk-reward setups. If anyone cares, I risk maximum 0.5% per trade on all of my trades, but that's my emotional safety zone, because if I have a 50 grand hit, that still hurts me, and that would be 1% of an account. So that still hurts. Whereas 25 grand, it's hard to explain, but your temperature adjusts slowly over time with how much money you kind of associate with it. So 0.5% is nothing for me, because I'm always looking for 2-to-1s or 3-to-1s, and sometimes 1.5-to-1, so it doesn't matter, but I know that I can recover. And also I have a 5% drawdown mandate. And so that means that I don't want to get to that. It's possible, I could have 4 or 5 losing trades in a row straight out the gates with a new client. It could happen statistically. It hasn't happened in a couple of years, but it could happen. And I don't want to suddenly have to stress about that. So basically by 0.5% per trade, I'd have to have 10 losing trades in a row to get into that situation, and that doesn't happen. So I'm actually managing my emotions. That's the irony. Ensuring the chart is displaying a moving average fan, I feel like we're repeating that. I think you've got the gist of this. Let's go look at these on the charts. So look at this price action structure here. That looks pretty nice. Very, very nice here. It's broken through a level of resistance. That looks really nice. It's pulled back into a level of support, and you have a bullish candle in the buy zone. You've got your 50, 20, and 10 moving averages fanning out. They're running parallel to each other. They look really good. This is a sustainable trend. Okay, looks really good. It's a very nice setup. The stop loss is, so where would we place the stop loss? Well, in this case, normally we would place the stop loss below the candle in question, our entry candle, which is supposed to be the turning point. So we're looking for the turning point where price retraces and then begins the new extension. We're looking for that. And so our stop loss would normally be below that turning point. Because if price goes through the stop loss, either before triggering us into the trade or after, it means we didn't find the turning point. Again, it's practical. So, but in this case, what's beautiful about this is that this is an extra bonus, is that this level of support and resistance becomes a stop loss protection. Our stop loss would actually be under this level anyway, but it's also protected by stop loss. So that particular setup, that's a no-brainer. and that one, it is the same chart, just ultimately went on, and that was, I'm normally banking at 1.5 to 1 or 2 to 1 or 3 to 1. I don't go for more than that because I can't tell you honestly which trade is going to be a 5 to 1 or which one's going to be a 10 to 1. Nobody can, I don't think anyone can predict it. We can see where the next support resistance level is, but sometimes the trend just goes and you can't predict that. So we put the same amount of money on each trade because we know that ideally, if they're good trade setups, most of them, if not all of them, should go at least 1 to 1, and some of them will go 3 to 1, and some will go further. We just don't know which ones. So we actually have to treat each trade equally. And again, I think if anyone tells you that they can predict which one's going to go 10 to 1, I don't know. Of all the books and everything I've ever discovered, I've never seen anyone who claim that, any pro anyway. So there's another question here, which is, yes, you would, sorry, there's a couple of good questions here. Do you have all 6 of these steps on one chart? Yes, you would have all 6 of these on one chart. Yes, you would. That's what you want in a chart because that describes a steady trend and a good setup. Does the candle have to be green and bullish to take a buy trade, and will you take the red candle with a long tail down too? So in other words, that's a very good question. Technically speaking, a red candle with a tail, which is a rejection, which is a bullish candle, not this one here, but let's see if we can find, if that was a red candle, technically that would be bullish, that would qualify, like this one here, sort of. Interestingly enough, that does qualify. My personal preference is a green candle. So it's a fine-tooth comb, but I do kind of personally prefer that. So, yep. Let's just go through some of these as well. Here's a setup here. You can see that the angle of the momentum of price is really good here, and then it's sort of slowing down a bit here. Here's our setup there, and it actually ends up being stopped out by the outside candle. Now, I actually think price went up first and then went down. I don't think it was a losing trade. I don't think that was the case, but statistically, this is the type of, all traders are okay with having losses. We accept, we're all adults, we're all grown-ups, we know we're going to have losing trades. We're not going to get precious about that. But what's important to us is to determine, was that a loss that I could have avoided, or was it just a statistical loss? And for me, almost all of my losses are statistical losses, where I just get stopped out by the next candle. And often what happens is I could get stopped out by a candle and then get another setup a few candles later, and then that takes. And in reference to one of the questions earlier about it being a setup during the night when you're unable to take it, that happens too. Sometimes I'll see a setup at 4 in the afternoon, it'll trigger me out by 8 o'clock or 9 o'clock, and the next setup happens at 4 in the morning, and I'm waiting for the next setup and I miss it. That does happen, but usually I've got about 6 or 7 trades on the go at the same time, so cumulatively I'm just going forwards all the time. I'm just crawling forwards. Some are, you have your losses statistically, and then you have a couple of winners, and you just keep going forwards. And you should, because the setups that I go for are good quality setups. Do I use a scanner? This is another really good question. I use a scanner. I built a scanner into using the language inside eSignal. So very quickly, because I know, by the way, we have like 4 minutes, give or take. So I want to be very careful with this. But I have, just to show you, so I have got a scanner one here, but I don't actually use it. But I just wanted to show you that I did actually do it. All it does is it directs me to a chart, and then I have to determine if that's something that I want. So then I might go, so this would be the trend flow long, and then it'll provide me with some setup. So let's go see, there we go. So it's come up, it's done a scan, and these are the ones it's come up with. And that's too choppy and gappy for me, so I'm going to pass on that one. The same thing, too choppy and gappy. Eventually I'll find something that's really, really nice. That one's a bit better. And it's interesting because you can tweak it and you can make it better. Sometimes it comes up with setups and I'm going, how did that tick all the boxes? Anyway, look at that. Whereas this structure here, it is gappy. It looks really good on the weekly. This is great to trade on the weekly, but on the daily it's crazy. So I just wanted to show you that I had done it, but I don't actually use it, I promise. So this is a level of support, a resistance which becomes support, and is a nice same thing. This is again is not that perfectly steady price action, but it's definitely a nice uptrend, and it's broken through this level and coming back and set up like this. It looks really good, and subsequently goes on. And again, it had that nice stop loss protection. That was really, really, really good. Same thing here. We've got that really good interaction with price and looking for that setup, and it was quite a big run. So I'm just running through these because I know that we're close on time. This price action here looks very, very good, by the way. It doesn't look overextended. It looks very, very healthy. This is a trade setup that I would take, but interestingly enough, it triggers you in and stops it out. So this to me is a statistical losing trade. But the quality of I keep looking at it and going, that is definitely a valid trade. It's absolutely a valid trade. There's nothing wrong with this setup. So there's nothing in here that is a clue that you're going to get stopped out. So it's just a statistical loss. And in fact, this is a news announcement That's why there's this reaction, because it triggered, it was going to carry on with the trend, and then a news announcement came and just spiked it out. So that's all it is. Okay, this one as well, this trend is not picture perfect, but the principal structure, the infrastructure of price action is there. So, and it does ultimately then really starts the trend. So I just want to keep an eye on the time, really, really nice price action structure, just showing you there are some winners and losers there, and just keeping an eye on the clock. So you've got some questions, and I want to answer that in the next 2 minutes. So just let me finish up, and then I'll go to the question section. So these are just things that I have noticed when I talk to a crowd of people, and then people come over and tell me what they're doing and how they're struggling. These are things that I can collectively say are not a good thing long term. This doesn't lead to sustainable earnings from trading. Trading very low time frames, 1 minute, it's too volatile, it's too fast. It goes from trending to ranging to trending, it's all over the place, and it's too unpredictable. And the fees, the spreads, and everything are too crazy. Then no awareness of the higher time frame or lack of trend. So someone will trade one instrument, the euro, whether it's trending or ranging, and they'll trade the 1 minute, and it's like throwing someone to the lions. Trading only one instrument, trading only the DAX, trading only the FTSE, trading only the euro dollar. It's crazy. If you're doing all these things here, I guess my point is if you're still making money in 6 months' time, come talk to me, I'll be amazed. Generally, most people will just get the crap beaten out of them by doing this. Changing the risk management rules, so there's no stop loss. They're using a MACD crossover, and then they're changing the amount they risk, or they're changing a amount per pip. This is not sustainable. And then trading without a stop loss, which is the single reason for all greater stop losses. All it takes is one trade without a stop loss to lose everything in your account. You could build up an account over 20 years and lose it all without a stop loss. So I don't think that can't happen. So I'm going to have a look at your questions. What I want you to do, though, is if you want to find out a bit more about this, please contact Rakesh at tradewithprecision.com and book a one-to-one with him. So he'll phone you and answer any questions you have. And he's an awesome guy. Everybody at Trade with Precision are the best people I've ever met. They really are. They're just such great people. So if you have any questions or you want to find out a bit more, send an email to Rakesh at tradewithprecision.com and book a one-to-one with him. So I'm going to do your questions now, and I'm going to clock out in about 1 minute and 30 seconds here. So let's just go through these questions quickly. Do I use multiple time frames? Yes, I do. Absolutely, completely crucial. Must trade in line with the high time frames. Do I personally offer mentoring at Trade with Precision? Yes, I do. I have my hands full at the moment with 4 mentees, but obviously, eventually, they finish up their mentoring, and they don't. In fact, the funny thing is now they're all about halfway through their mentoring, and they don't need me anymore. So, meaning they'll contact me every couple of months and say, I have a couple of questions, because they're all pretty consistent by now. So the short answer is yes. Do I use a scanner? You've seen that one. Do you want the majority of the candle in the buy sell zone, or just the tail? Actually, that's a very good question. It just has to be approximately around that area. It doesn't matter. The setup, actually, the price action itself will tell you if it's a good setup or not. How do I create the shaded areas? That was actually done. That was done in Photoshop or whatever. So don't worry about that. But there are, in some programs, some packages, they do have a tool that will shade between the moving averages. But I don't use that. Can I go through the 6 steps again or summarize? Basically, you need that price action, that optimal price action, the moving averages. You'll need to keep an eye on support resistance levels, and that buy zone and sell zone. Those are the key things. Okay. Thought there would be a summary slide with those 6 steps. No, I'm sorry, we covered them a couple of times. Can I use all moving averages on the daily charts only? You can use these moving averages on every time frame. So they work on every time frame. Like the 1 hour, 4 hour, 8 hour daily. I know lots of more experienced traders are looking at 15 minutes and 30 minutes. It's better for beginners to master stuff on the 1 hour, 4 hour, and daily. They can still make 4 to 10% a month, or they can still make a really good return per month just by trading the daily or 4 hour timeframes. Then once they've mastered everything and their brains can cope with the amount of data coming in, they can go down to a lower time frame. And do all our timeframes have to be trending in the same direction? We want at least 3 higher timeframes in the same direction. What's my target? Interesting enough, my target is just really good trade setups, just high quality trade setups, just taking those, and if they're not there, I don't trade. But generally, from experience, I anticipate about 4% per month. Simon, I'm going to ask you to jump in if you're there and come back in and just see how everyone is doing and make sure that you know that I'm ready to hand back the reins.
Brilliant. Brilliant, Adam. Thank you very much. You are a professional. If ever the phrase "leave them wanting more" was more appropriate, I think, because I think you are leaving a lot of people wanting more, judging by the amount of questions that you've generated. So thank you on everybody's behalf. Thank you for a wonderful.
No, thank you for inviting me. It was an absolute. It's a pleasure to be here. Thank you.
It's some great stuff you've got there, and very professionally delivered as well. So our thanks for that. Okay, I will take the presenter role back. The only thing I might add is that when you log out, you just exit the webinar instead of ending the webinar, because you have.
My menu only has one option, which is my menu only says I can end the webinar. That's all I've got. I'm just kidding, of course.
Thank you very much.
I'm just kidding.
It's happened before.
I know. I think I've done it before. No, I'm just going to leave the webinar nice and peaceful, no protesting. You won't have any trouble from me.
Wonderful. Adam, thanks so much. We'll follow up with all these links, and people can contact Rakesh to get in touch with the community. Thanks very much again, and I'll take the presenter role back.
Thank you. Thank you. Thanks. Thank you, everyone. Have a good day. Bye.
Thank you. There we go. Adam Harris. What a nice chap. Attended live to the Round the Clock event in London, and had a pretty much packed room there, as you can imagine, and has come back to do that webinar. So that was great. As I said, the email address for Rakesh, who will handle any inquiries for one-to-one or mentoring, anything to do with tradewithprecision.com. I put that in the message box there, rakesh@tradewithprecision.com. And if you want in touch, you can just contact me as well. I'll happily put you in touch. So moving swiftly along, we are looking forward now to a presentation on scalp trading. And this is going to be delivered by Mike Hamilton, who is the CEO of the Scalper Trading School. Mike's spoken before at this event. I think it's probably not this year, maybe I think it was 2016, maybe the last time he took part. So it's good to have him back. And following Mike, we have a further 2 sessions crossing over to the US for Bo Yoder and Christian Fromhertz. But let's go straight across to Mike now, because I know he's in the room, and we are just over the 5 o'clock. The 5 o'clock bell. So we'll click a couple of buttons, and as if by magic, good afternoon, Mike.
Hello. Can you hear me, everybody? Is that clear?
Wonderful. I can hear you. I presume everybody else in the webinar can hear you as well, which is great. How are you?
I am really well, yes, on this terrifically sunny day. How are you, Simon?
Well, very well. Yeah, I'm loving it. As I say, I'm thrilled that people are choosing to spend time with us, particularly in the UK. People that are here from the UK, we're not used to seeing weather like this. We're having a tremendously summery day. Temperatures in the 20s, which is a lot to get inside. If you're tuning in from the Caribbean or Spain, then of course you'll be used to it. But thank you for staying with us. We've been live all day. We've had some great presentations, and Mike, your speciality is a particular scalping strategy, and you're here to give us a little insight into how you do that. So shall we cross over to your screen? I'll make you the presenter.
Yes, please. I'm all ready here, so yeah, if you would like to hand over.
Wonderful.
Hopefully you can see just a single slide, is that right?
We're actually looking at the preview, so you need to swap.
How do I swap?
In the display settings at the top left, in the middle button on the menu. So move your mouse left.
Hang on.
Left.
Oh yes, got it. So I haven't used this. Got it. That's it. Is that better?
There we go. Wonderful. Yes.
Good.
So we can hear and see fine. Scalper School. So this is we have touched on scalping today, and one or two of the speakers have talked about scalping. Of course, they talked about it in reference to some of the spread betting companies not being great fans of scalping because it is hard to hedge against. And of course, we know that some of the brokers have been doing that sort of that B-book trading that we talked about. But tell us about Scalper School, if you will. Thanks.
Yes. Okay. Hello, everybody. Very nice to be invited back. Thank you very much, Simon. So, yeah, Trade the Easy Way trades Forex and stocks, but what Scalper School is one aspect of Trade the Easy Way, and what we are looking to do is to actually just create a situation where we can go into the markets in the Euro session. So I run a trading room in the Euro session, and what we're looking to do is just to grab the main slice of the market in during the Euro session, and then after that trading, I would then set the scene for the US session for those traders who want to go on and wait for the US Open. So what I'm trying to do here is I'm trying to offer traders a facility where they can trade in a style and a time that suits them. Because what you will find with all these different speakers that these great speakers that you've got that Simon's brought together, is that what they are doing, what we are all doing, is suggesting you might want to learn how a particular trading style that we like, that we make money out of. So people like me, we've been trading for a long while. We develop styles that suit us, and so I developed this style that not only suits me, it also suits a lot of people who just want to trade for short periods of a day. They don't want to stare at screens all day. Perhaps they're busy, perhaps they run a business, they just want to trade in the Euro session or trade in the US session and then close their account, close their charts and walk away. And this is what Scalper School is all about. This is what Scalper School facilitates, that you can make a good income. This is not about wealth building. Scalping is obviously about just generating an income. And then Trade the Easy Way is swing trading as well. In stocks, Forex and commodities, but all I'm here to do is just relay what we do in the Euro session. So the reason why I've used the word unique in this context is that it is not, Scalper School have not reinvented the wheel. The reason why we use the word unique is because we have taken some very simple tools that most of us use. You'll hear talked about from other speakers, and we combine them in a certain way that I have not seen taught elsewhere. And having done that, we've developed it, we've refined it, and we've really got it down to quite a very fine technical art now. And what I'm going to show you a little later on, I haven't got that many slides to show you, so don't worry if you've been watching too many slides today. What I'm going to show you is the result of a completely independent study that's taken about this particular technique. Now, this was carried out by a Scalper School graduate who, like you, sat in this session, in a session I did like this last autumn. He signed up for Scalper School, loved it, makes consistent profits every day out of Scalper School, and decided that he wanted to do a research project to backtest it. Because he wanted to refine his skills, he wanted to look at use the same technique in other markets. So he took it upon himself to do some backtesting, which all of you should do. I know a lot of people don't have time, etc. But I'm going to show you the actual physical hard results of what you can achieve in Scalper School, which I think, obviously, if you are going to get involved with this, it's something that you need to see. So let's just get through a couple of slides. Obviously, disclaimer, trading involves risk. You may lose more on your deposit. Don't trade with money you can't afford to lose. I know this is routine stuff, but as we all know, trading is a mind game, and you need constant reminding that risk management is a key aspect of, or should be a key aspect of all your trading, and that is uppermost in Scalper School. We are not looking to go in with a lot of leverage and grab 2, 3, 5 or 10 pips. That's not our definition of scalping. Our definition of scalping is to go into a session and look for a decent chunk of the market in that session and then walk away. So as a minimum of 20 pips. We're looking for a minimum of 20 pips. Most trading days we achieve 25, 30 pips in 1 to 3 markets. That's assuming that you're going to trade the US session as well. We're not busy scurrying around lots of markets in one session. So it's very rules-based, it's very focused, and I'm going to talk to you a little bit about aspects of this. Okay, so a little bit of I won't go into too much details about me, but I've been trading a long time. I did start trading on fundamental analysis a long time ago, but I've done extensive training in technical analysis over the years, and I'm a pure technical trader, like just about, I'm guessing, all of the speakers that come on round table, and rules dominate my trading. And that's a picture of me, bottom right. I think that was in Show FX in Almaty or Kiev, I think, one of the two. And so a little bit about Trade the Easy Way, and then we get straight into it. So founded in 2009, we do not sell systems, we do not sell indicators. We are straight down the line. We want everybody to be good technical traders, and so we call Trade the Easy Way because that's exactly what we do. We do what we say on the tin. We keep everything very, very simple, very rules-based. Okay, so why scalp? Because you don't want to be at your screens too much of the day. You want to limit the time you're trading. You want to stick to a precise routine that you can do every day, and you want to avoid high-frequency trading areas, violent volatility that you can get when some data is coming out. You need to know when the best time of the trade is and the worst time of the trade during the day and the week, and that's all encompassed in what we're looking at. So like I said, we're not about grabbing 2, 3, 5 pips or 10 pips. We're looking for a minimum of 20 pips today, and a little bit later, very quickly after 1 or 2 more slides, I'll show you what we traded today and why we traded it. What I'm not going to do is I'm not going to go into specifics about how we scalp, but you will see how we set our charts out, and you will see a clear example of how we plan our day and how we execute our trades. Okay, so we're looking at, I would say, this isn't for pure beginners, so obviously you've got to have some good technical skills behind you if you're coming to Scalper School. It's the reason why I think everybody likes it so much is because it's got a very, very tight set of rules, and the rules are very limited. You're talking about 3 rules to open your charts up in the morning, prepare your charts, which I do in the room, so you can just sit there and look at the screens if that's what you'd rather do. And then we're looking to take these setups and trade them. Okay, so what I'm going to do now is I'm going to get rid of these slides. I'm going to show you, this is the Dow, but I'm going to show you the pound US dollar first. So this is the pound US dollar. It's a 5 and 15-minute chart. Now we're not sitting there looking at very small time frames. We certainly do not use 1 or 2 minute charts. So like I said, if the industry's definition of scalping is 2, 3, 4, 5, 10 pips. Well, that's not what we're after. So what you're seeing here, let me just grab the pen. What you're seeing here is a range we're looking at and a potential target area, and now these are fixed elements of each of our trading day in each of the markets we look at. So you can see in the pound we were inside of this area initially, came out of it just as the data came around, and then after the data came out we took a trade, and then we took it down to this level here, and we actually trailed the stop down. I left the stop open for all of this period, and then trailed it down as we got into the latter half of the US session. So here, so the entry was around about the 990 level. We trailed it down to I think about 52 pips, and then eventually got stopped out as this flew back up. So we actually left 20 pips on the table and gave, so the total move was 60 pips, and we gave 20 pips back because we tried to trail stop and get this to run. Unfortunately, it didn't. So these are the rules we apply. This is another analysis, and this fibs is set in a very, very particular way to Scalper School. And again, I don't see this taught elsewhere. But it's something I've been using for a very, very long time. I discovered it when I was trading oil in the futures market in the crazy period of 06-07 when oil ran up to $150. And so I've brought that technique into scalping and how we set our charts up, which really helps us analyze not just the entry but the potential targets on this. All right, let me show you you saw the Dow. So this is what we trade on the Dow. This is the main criteria. This was a target which was still not hit yet, which looks possible at this stage. We are obviously selling at the highs, staying in this range at the moment, but just beginning to possibly come out and come down to this target. And we have a criteria depending on where this level is. This is a variable level each day. I'm not, like I said, I'm not prepared to go into specifics because I'm going to end up teaching you how to scalp, or the Scalper School technique anyway. And so, but this variable that we have every day is key to the way we measure our trades, and it's factored into A, whether we take a trade, and B, whether we are looking long or short, and obviously just looking for the break to see if we get a move. Now, on certain days of scalping, you can get some significant moves kicking off from this area here. But like I said, the reason why we look for a minimum of 20 pips is because it's a number that we can achieve very, very easily. And then you've got the choice of either banking your profits and walking away, or leaving the market with a trailing stop. So although we call it Scalper School, there are occasions when we enter a trade and it kicks off as a scalp, and we trail stop it to see if we can get a runner. There's another aspect of Scalper School as well, where we, through my membership, we're looking at the bigger picture at the weekend. We're looking at key entry and exit levels for the week. And so what you can do with scalping, and what we do in Scalper School, is suggest areas where you could instigate a trade via a scalper method or via a Scalper School method, but actually hold it in the early part of the week and scalp around it to build the position with very, very low risk, so that you end up with a core position in the early part of the week. You're adding to it as it waves, its natural waves throughout the week. So what you can sometimes do in a good trending week, and we've not got, these markets are not great at the moment unless you've been buying the euro up after that gap up. The weekly charts are very range bound at the moment, so this method has not been one that's been great to build your account in the last few weeks, but that's the nature of where we are in the cycle. I won't go into that now, but essentially what you're seeing is the nuts and bolts of scalping. So I mentioned about this particular person who did some research. He did the back testing. So I've asked his permission to come along and just show you a snapshot of what he's done, because he's done it of his own back, without my input, without any interference or work from me, and he's done it mainly for the members, for other members in our trading room. But I'm just going to share you a little. Got permission from him to share a little bit from you. He's an engineer, so he's good at details and spreadsheets and so on, and doing this kind of research. And he found that, you know, as all traders will find, that if you backtest to this level, it really instills the setup and allows you to trust it. You know, this is a mind game, isn't it? And sometimes if you're using the setup, well, the good trades often don't feel right. Sometimes they don't. It feels as if you are going against the grain. But that's why if you learn this setup and trust it, you can make significant profits out of it. So I'll just highlight a couple of aspects of this. This is 74% profitable. I'll just repeat that, 74%. There's not many. And this is not my work, this is not my study. This is a study from July last year to the 13th of April this year. So this is we're not plucking figures out of the air. Well, I'm not plucking any figures here. This author of this study is not plucking figures out of the air. This is, you know, he's taken my criteria and assessed it over this period, and this is what he's come out. So there were 18% stop outs, 74% winners, and 8% where there was no clear definition. And that's a key figure to me, that 8%. Yeah, we're not just sitting there doing this scalp or that scalp. We are, if a trade doesn't meet our criteria, then we'll walk away from it and we'll find a market that does. 53% of these were 20 pip winners, and let me see let me just clear that. I can't read this now. I've put so much drawing over it. 53% of the top pip winners. The move travels for 50 pips. Okay, so over half of the trades. I've talked about trailing the stop. If you were to trail the stop on all the trades that were taken, over half of them will generate at least 40 pips. Okay, so this is a hard and fast method of coming into the markets and coming out of them for a relatively short period of time. The reason why, you know, I start off by saying something about, you know, the types of people who do presentations like this. One of the things I find is that people go on these courses, you know, some of them are very, very expensive, and, you know, they can't make that system work. And the reason why that is because, you know, I think we're all different. We've all got different you know, psychological makeups, and some people are aggressive traders. They like to, you know, get in and out and you know, take very aggressive trades. Some traders have not got much time on their hands, and they are looking for so they just want to swing trade, or they just want to trade intraday or intra-week. But this suits people who are happy to, who want to just get in the market, grab a key part of the move, and either trail the stop or just close it and walk away and bank it. So that's what we do at Scalper School. That's what we are looking at, and that's what we are very successful at doing. And you can see from this trade, this is the Dow today. So this is, at the moment, not very tradable. So we come into, had all this selling in the early part of the day, and it's held the bottom of this area and run up, potentially a little bit like the pound I've shown you. It's so far it's knocked into some resistance and dropping back into this area, and still not wanting to come and meet our targets. Well, that's fine. If this area is a certain distance away, then we don't look for a target. We don't look for this as a target anyway. If it's over a certain level, then we actually look for a trade and go setup. So if a market has a level down here and it's opening up here and this gap is too big, then we do have a gap and go set up that looks for it to push. If it's a smaller gap, then we would either look for a complete test or a partial test. And of course, if it runs through this, then we'll hold it and hopefully get a runner. If it comes in and does a partial complete fill and then puts in a buy signal, then we will trade it the other way. Okay. This particular criteria is quite an old-fashioned criteria. I was taught a very, very long time ago, but this criteria is the one that I've worked on over many, many months, and the one that forms the main crutch of scalping. All right, so yeah, like I said, we're not scalping in the traditional industry sense. We are certainly trying to be very, very nimble, but very specific in this market and getting in and out under fixed criteria. So let me just go back to the slides. I'll just find the right slide for you. So this is, I haven't updated this recently, I must update this, but this is a snapshot of my account. You can see I did this, I think I prepared this for Roundtable last autumn. But this is, you got some 325, 101, that's where I probably trailed it and got taken out with a low profit, and this is a stop out. And that's fairly typical of what I'm doing in this market. And you can see we traded the Dow, the Euro, and then 2 pound trades. Okay, I think it's important to show your account. This is another one, again, typical, probably must have trailed it there, a reasonable run there, stop out, reasonable one, and probably trailed it. So overall, you know, that's a winning sum, but you know, just a little dent in the middle, and that's very, very typical of the way in which. Obviously, this depends on the size of your account. You know, if your account's only £500 or £1,000, then you know, obviously you're not going to risk this kind of capital. Risk management is core to everything we do, so it's all proportional to your account. But obviously, with that size account, I can. This is a particularly large account. I trade 5 different accounts for various different reasons, but that's just a slice of that particular day trading account. And so let me just find the next slide. So there's a little snapshot of what we're doing, looking for ranges, we're looking for pivots. These are time frames we use. Very, very interested in the 200 simple moving average on the charts. I'm not a massive fan of moving averages. I have across all these time frames, including the other 3 hour and the daily and the weekly, of course. You know, I do focus on the 200 mainly across those charts. I don't like, because I trade simply, I don't like to see a lot of moving averages across my charts, because I just want to see what I'm looking at here. So we do have data in Scalper School. We do have data setups as well. At the moment, I'm having to change and adjust the way in which I trade data, because markets change every now and again, every 6 to 12 months, or sometimes shorter or longer than that. The characteristics of a market change, and a setup I've been using for a very long time has recently stopped working. So I'm just revising the way in which I handle data setups. There's much increasingly algorithms trading these markets. You know, the banks dominate the markets. This is not about retail traders like you and I. This is all about where the big money is. And so sometimes algorithms these days change. So I am currently backtesting no, it's not a new data setup. I'm just using a previous setup that I've used, which I'm resurrecting, which is proving to be much, much more efficient. And I will incorporate that in the Scalper school we're running next week. So I'm running a program next week if you are interested. So we'll talk about that in a minute. Like I said, you can, although we're talking about scalping here, it can be used to hedge. For example, if you've got a core position in a currency or even a stock, you can use this on stocks. If you've got a core position here, maybe you are a rubber band trader, RSI. RSI is really low in the stock. You bought it. It's moved. You've got a good reversal set up. Meets your criteria, your trade plan. You're in a trade, and of course, markets wave. So if you've had a good move and the market is in a retracement, and you don't want to get out of the position, one of the ways you could use scalping is to actually scalp the downside, so your account is still building while you are swing trading this market, whatever that market is. Another way you can use it is if you have got a good move and you're locking in your entry position to protect your account, you could simply just add to it. Keep this core position here. On a pullback, go into another position, manage your stop, see if you can move it, perhaps take some off at that stage, take another pullback, manage your stop, and so on. So you can use scalping in different ways. I have to admit, the most people that come in Scalper School use Scalper School just to get in and out in a session. That's the main reason why they use Scalper School. Because they don't want to sit there, they don't want to walk away from the markets with a trade on or trades on. They prefer to come into the market, get out, and then go and have a cup of tea, go and have a break, or get back to their day jobs. And that's the beauty of this. It just helps you, jump in and out. Okay, so I promised you I wouldn't show you too many slides. That is essentially Scalper School. What I will do is I'll just show you one other aspect of Scalper School. Let me come out of this slide again. Another aspect, we talk about intra-week trading. It's not on that one. Let me do this one. This is again a core method that's used in Scalper School. This dotted line up here, it's not a pivot, it's a key aspect of the way in which this particular market has operated. This is the pound US dollar, and you can see on two occasions, on Monday afternoon and yesterday, we actually hit that level. We just narrowly missed it up there, and this is the reason why I've been focusing on this particular chart and trading it in the room, to try and get a run out to see if we can break these support levels here. I've trailed it and it's not worked, so that's a shame, but I will keep trying using the same setups and see if I can work around that. But yes, so I don't want you thinking that scalping, he's just trying to use a lot of leverage in a very short space of time. No, this is a rules-based system for A, handling the session, and B, handling the week. So it's not the industry norm of scalping. Okay, let me see if I can show you another chart just to make my point. You can see how these, if you look at these main criteria, the two red lines and the dotted line on this chart, you can see how the market is reacting to these levels. This is why this is why we get a very, very high success rate on this, because the way in which we just simply lay down a few key points in a chart is because we discovered that that over all this backtesting, that these are levels that this market will react to most days, and that's the whole point of trading. Trading is about probability. It's not about certainties. So all we're looking for is something that we can do. We can just repeat every day, keep it simple, and try and maximize the income that we can gain from these markets. Let's have a look at the euro. Okay, so this is how the euro is looking in Scalper Score as well. I didn't trade this today. Tried to get a gap fill on this one. I long since stopped trying to do that because I had a couple of stop outs on trying to do that, and so this is rewritten the rule book for me for Forex. I don't know if you personally, anybody in the listening today has been trying to trade this euro, but perfectly honest, I've missed this push to the upside because it's rewritten the Forex rules. There is a gap down there, and I can't find a Forex chart that's gapped and kept the gap for this length of time. I'd be happy to hear from anybody who's done any research on that. But this has trended really well. I've not traded it, I've not made the most of it, and but I have exploited other charts in the meantime. Okay, interesting. Just somebody in our trading room today was he's not actually a scalper. He's a swing trader, but he's in our chat room and was talking about oil today, and he was buying oil over yesterday, anticipating OPEC is going to see oil charge to the upside, and has suffered a little bit of pain, I think, as this is, all you technical traders in the room, which I'm sure you are all technical traders, will see that that is a favourite reversal pattern of mine, and this is just coming back into support. It's too extended. Whatever OPEC have said or done, I'm not interested, but it's all priced in, and oil is sitting in at the moment on a key area of that chart. Okay, well, like I said, I've kept this really simple, and what I'm going to do now is just give you a little bit of introduction to the course. So I'm a trader, I'm not a salesman. I would like you to come to Scalper School. We've got a few places left for next week, and the course runs from Tuesday, Wednesday, Thursday next week, and then when you graduate from Scalper School, I finish on the 1st of June, you get a month included in the fee in our trading room. And it's not just, the trading room runs 3 days a week during the Euro session, from 10 to 8 till 10 o'clock, Tuesday, Wednesday, Thursday. We have a chat room that operates 5 days a week, where we discuss Forex and stocks, and we have daily videos. The weekend video is looking at the bigger picture, plotting the week ahead, and then we have daily videos which show you a little bit about what's happened during the day, and a little more about what to expect on the following trading day. So if you would like to join us on Scalper School next week, I will put a link to this page in the room. And you can register here. I can just get that to work. Now you click on this blue button, that goes to a registration form. There we go. Fill in these details, submit, and then there is the PayPal button there, so you can pay with the security of PayPal behind the transaction. Alright, so if you go on to tradeeasyway.com, get trading courses, down to Scalper School and have a look. Okay, so I'm not going to do what a lot of people do, whack the price up and offer you a false discount. I think that, you know, I put a lot of time into Scalper School. You will get a lot of commitment from me on the course, in the trading room, and through the chat room and the videos. So I think that's a fair price. I think it's a very good price for the amount of effort and contact that you'll have with me. And if you join Scalper School, you will learn our specific criteria, and then you can take that and either trade Forex or indices or both, and of course even commodities as well. So that's the end of my presentation. I'm not going to show you slide after slide after slide. That's what I do. All I'm going to do now is open the floor to questions, and let's see if anybody has got any other information they would like.
Hi, Mike. Okay, thanks for that. Yeah, there's a few questions that have been coming in.
Okay.
Well, questions on your stop loss and the lines that you trade. We're going back to earlier on in your presentation. You must be looking at some of the charts. What do those lines you trade from mean?
Yeah, I'm not prepared to go into that, because that's a fundamental aspect of our scalping system. So I'm afraid you're going to have to join Scalper School if you want to know exactly what those lines are. Otherwise, it's not fair to members, because I'm basically giving away a key aspect of the criteria. So I thought somebody would ask somewhere, but I'm afraid I'm going to have to hold that back.
Stops. What sort of stop losses do you operate on? Can you reveal?
Yeah, I mean, simply on that's easy to answer. If I go back to this pound trade here, if we're entering, like I said, we entered around about the 990 level. Initially, I would keep the stop above. I have to keep the stop out of trouble, but we are just dragging the stop down as we get close to our targets. And like I said, if we're looking to try and get this to break further, to break under this level here, then we will trail it. So initially, we might have a 1-to-1 risk-reward ratio, but then we would drag it down and close it into close to our open or on our open position normally within about 10 to 15 minutes. That's assuming we've not had a nice move and taken profits already. But the reason why we go in with that sort of risk-reward ratio is twofold. A, it's a high probability setup, so we're prepared to go in at 1-to-1 at that stage. And B, quite often we are looking for a bigger move anyway. I mean, the risk-reward ratio here, eyeballing it, I would say in terms of our target, this risk-reward ratio is 2-to-1. Eyeballing it, I think the gap here in relation to the stop we would have had here, I would say is about 2-to-1. But because we were trying to achieve runners, yeah, that's pretty well matched, isn't it? You can actually see, that distance of our stop is more than, because you include the white space in the middle where it's jiggering around, that's more than the reward that we were looking for on this particular trade. So we often narrow our stop within 5-10 minutes of the trade executing. That's the whole point of Scalper School. We're looking for markets that got good momentum. We're looking for markets that meet our strict criteria, and we are making a very calculated decision on what we want to trade. Any other questions?
If we're going through the questions, what is an OTR? Asks Jenny.
Again, that's just that's Scalper School jargon, and deliberately hold that back because I don't want to give any clues to. We worked months and months and months on this. That's this study that we just done, this piece of research that was conducted. I mean, that's about a month's work. So I appreciate that you will be very, that you're here because you're very keen to learn and you want to understand what we're doing. But I've given too much away in presentations in the past, and I felt it's not been fair to people who have gone on, who are members and who are Scalper School graduates. So I am going to be a little aloof and just hold back on answering questions like that, I'm afraid, because the OTR stands for a terminology that will actually sort of show my hand a bit, and I'm not prepared to do that because I don't think it's fair. Well, keep asking, and
get a question that you can answer. Best works on indices or Forex?
Both. It applies to both. It's down to, we would normally look at, for example, in the Euro session, we would trade the DAX and the pound in the Euro session, and I personally would trade the yen pairs and the Dow in the US session. So it works very, very well on indices and Forex. And it also works well on commodities, but I would say particularly the grains and the softs, as they're called, and oil and gold. They do have slightly different time patterns, and if you're not used to those time patterns, then I would be very, very careful about scalping on those markets unless you learn the specific time criteria of those particular markets. So we don't like to sort of shoot around and trade a lot of different markets. We prefer to stick to indices and Forex because they have simpler time periods that allow us to measure our risk more tightly. That doesn't sound very good English, more tightly, never mind.
Okay, thanks for that. OTR stand for, well, we've passed that already. What sort of lot sizes do you typically take? And is there a money back guarantee?
Lot sizes is proportional to your account. So I would normally, sort of accounts I trade, I don't risk more than 1% of my account on a scalp. So lot sizes are going to be relevant to your particular account. We can discuss that. I mean, we discussed that in great detail in the Scalper School itself, because risk management is paramount to everything I do, and I don't think that there's enough time. Most traders, from my experience, don't give anywhere near enough time to risk management. It is so critical. The trouble is, it's a boring subject, so people who are going to talk about risk management are probably not going to get many people attending. But trading should be boring. If you look for the excitement, we're not here as scalpers looking to get enjoyment out of scalping. We are just being very, very mechanical and coming in and out of the market. Did I answer all that? There wasn't another aspect to that question.
It was referring to the money back guarantee aspect.
Oh, money back guarantee? No. You come into Scalper School and you scalp, then you commit to the fee and you commit to your trades.
Just using standard indicators on MT4, is that the platform that you'd be using?
I do use MT4. I would suggest you might want to look at a couple of other packages which you can get free, which are more. I find MT4 a little bit restrictive for what I do. No reason why you shouldn't use MT4. But in Scalper School, I personally use this one, which is Pro Real Time, and you can get Pro Real Time for free if you trade through brokers like IG. So, in answer to your question, you can use MT4. It's not quite as flexible as I would like, and I much prefer this package.
Okay, thanks for that. And do you use a scanner to find the suitable setups to trade?
When it comes to Forex, because I'm not trading a whole big basket of Forex markets, I do what I call data mapping, which is where I would look at the data that's coming up on a particular day and see if that might trigger a move in a particular chart. For example, yesterday we had CAD rates, and sadly I didn't trade the CAD VN, and I should have done because I'm talking about it to members often enough. I think this must be an old level here. This is data mapping is doing no more than looking at the data that's coming up and analysing, applying the criteria to that particular chart of the day. So this, so in answer to your question, I don't scan because I don't need to. Interestingly enough, if you look at the way in which I've just mapped this up, we just hit this breakout area again, and that's just coming up. This is not my criteria. I've just happened to throw this on for the sake of it, just making the point that had I have looked, I should have been looking at the CAD because I knew data was coming out, and I didn't. But there was a setup there. So yeah, the answer to the question is no. I don't use scanners for Forex. I do use scanners for stocks, of course, but I don't use it for Forex and indices.
Okay. Well, let's have a look at questions. What about lot sizes? Did we talk about that? Alan's asking a question about.
Yeah, that's just proportional to your account. It's interesting that people should ask that because, like I said, I think there's a lot of traders out there who don't understand. They understand risk management, but they don't understand it to a deep enough level. I always recommend that everybody reads a book by Tharp. That's T-H-A-R-P. If you're trading the markets and you haven't read Tharp, then I would suggest you go and buy a copy of his book, because the way in which he talks about trading and the way in which he discusses risk management, I think is really, really powerful. His book is called, let me just grab it from my shelf. His book is called Trade Your Way to Financial Freedom. And I thought it was one of the best books I've read, and I always recommend that members go and find that and make sure they digest that.
Okay, I think that money management is the key to trading, says Yat. Yes, I think I would agree with that. Would you, Mike?
I would. It's the whole point of trading. It's all about probabilities. It's the same business model as the insurance industry. As I'm sure most speakers, if not all speakers, will always say at some point in their presentations, that nobody knows where these markets are going to go. I expect stop outs, and so if you are not sure about your position size that you should be using, and not sure about the risk reward ratios and so on that you are prepared to take, then you definitely need to read at least Tharp's book and look out for other courses and programs on risk management. I honestly believe that trading is easy if you have done your work, and the reason why I charge a good fee for this is because I put a lot of effort into this. I've done hundreds of hours of work to develop this system to write the course and make sure everybody is really in tune with the course and understanding the course. So if you haven't done enough training, if you haven't done enough time in study, then don't expect to make money. You know, I spent thousands on courses in the early days. Some of the courses were actually confusing and not good value at all. But the point is that I took them, I did a lot of further reading, a heck of a lot of work and back testing. I asked myself a question a long time ago. Yeah, how can I personally master these markets? What is the trading style that suits me? You know, and how can I control my own trading? These are all valuable questions that, you know, traders, they look at free courses or they pay good money for a course, and then they don't do enough follow-up work. I mean, you wouldn't go to a lawyer who's, you know, just come out of college or, you know, just graduated. Lawyers go through, you know, after they graduate, they do a 2-year intensive certification course, and then they spend 3 years training. So you know, a qualified lawyer is 7 or 8 years in the making. So don't expect to come into trading and, you know, go on a couple of courses or do a lot of, you know, come on free webinars and then expect to go away and make a lot of money, because it just won't happen. You know, invest in yourself, invest in trading, and make sure that you've got the course that's suitable for you, I think, is my advice.
Okay, Mike, I think we'll have to draw it to a close there. It's just about 4 minutes to the hour now, so thank you very much for joining us. And I'll take the presenter role back from you now.
Okay.
And
if anybody wants to ask me, drop me a line from the website, and yeah, thanks very much, and thank you, Simon, and goodbye to everybody.
Okay, thank you, Mike Hamilton, Trade. Many thanks.
Bye.
Okay, there we are. Okay, so moving swiftly on, that was Mike telling us about the Scalp trading school. Obviously, there's a lot in there. I think what Mike's basically saying is, you know, it's hard to talk about it in great detail without giving it away, with sort of undermining the sort of secret strategies that he has. So, you know, understandably, he has to tell you a little bit to whet the appetite, as it were, but not to tell you the whole story. So go ahead to Scalper School if you're interested in getting enrolled there. So we are moving ahead, and unscheduled we have Christian Fromherz from the Tribeca Trade Group. We were scheduled to have Bo Yoder joining us now, but he isn't here. So something has gone wrong along the line, and very unlike Bo. So he normally always there, and I can count on him to jump in. But thankfully, Christian, who was to be speaking after Bo, is available and has agreed to sort of jump in an hour earlier. So what we will do is, we're very grateful to him for doing that. So we will hear from Christian now, and should Bo appear within the hour, we will put him on afterwards. So just to be sure, the person you're going to hear from now is not Bo Yoder. It is Christian Fromherz from the Tribeca Trade Group. So let's go right across there now. Unmute the mic and say, Christian, good afternoon.
Hey there, how are you?
I'm very well, thank you. I'm very well, and thank you for jumping in. I know you weren't expecting to be speaking for over another hour yet, but as I explained to you on email, Bo is just not here. So until we hear from him,
no problem.
We don't know, but good to have you, and thank you for joining us relatively short notice. We've had pretty much a full day webinar. We've been on the air since 8 o'clock our time this morning, and had lots of great strategies, updates to the markets. The sort of currency markets have been a bit flat. Seems to have been the tone. We're heading towards a UK election here in the UK and within the next fortnight. So there's a little bit of excitement about that. But we're hoping you could shine a light on a little bit of activity in the US. Tell us what's going on across the water. Shall we share screens as we normally do, Christian?
Yeah, let me get that. Let me get that going. Let me just see. I always forget how to do this in here. Where is the screen?
I send you the invite, which I'm doing now, and providing you're ready. There we go. Wow, that's a lot of numbers.
Oh yeah, let me switch the screen here. I've got several screens. Let me just try to remember how to do this. So I don't want that one. Let's see.
Do you want me to tell you what we're looking at?
Yeah, you're probably looking at a bunch of numbers, right?
Oh, yeah, lots.
All right, that's not the one. Do you remember? Do you remember how to change screens here? I'm just looking for the option. I can't find it. I've got it. I've got it. All right, there we go. How's that better?
Okay, now we are looking at, yes, okay. So we're looking at the opening slide from your slide pack. Fantastic. Market update, Tribeca Trade Group. Just by way of introduction, Christian, you've been in the city, but you've been on Wall Street, I suppose you describe it as, career in sort of investment banking, and the last, oh, there we are, sorry. Shall I let you explain how you came to be the CEO and founder of Tribeca Trade Group?
Yeah, sure, absolutely, and thanks for the intro. Yeah, I don't mind. I love coming on if you're a American baseball fan. I love being a relief pitcher, and no problem coming in and taking another slot. Good. So yeah, so just a quick background if you're new to me and haven't met me before in one of these, thank you again, Simon, for having me on. I really enjoy coming on and giving my perspective. I always like talking about the markets and what's going on. It's always a bit of a puzzle. It's a puzzle you can basically never solve, but you always feel like you get a little bit close, and when you do, you kind of throw your hands up and you get excited. But yeah, so I started my career on Wall Street. I actually started my career off as a financial advisor at Morgan Stanley, and I moved over to the institutional trading side. I went to the trading side over at Merrill Lynch before it was Bank of America Merrill Lynch, and I did a whole bunch of things, whole bunch of different trading, and I was really lucky in my institutional trading career because I had the ability to trade a lot of different products. So I've traded single stock equities, I've traded ETFs, I've traded futures, I've traded Delta One products, so equity swaps. I used to run the customized index platform before there was an explosion in ETFs. So which really kind of led me over to ETFs. I knew all the mechanics behind creating an index, and back in the day, that's what a lot of hedge funds were doing before there was ETFs. They were customizing their own index to either go long or go short. So I also had the pleasure of trading commodities, some FX and so forth. So a little bit of everything. If you ever hear Delta One trading, it's basically a lot of different products on one trading desk. So I did that for a long time. I was a director of ETF trading at Bank of America Merrill Lynch. And then I decided to kind of go on my own and start my own company and manage my own money. And so what we do at Tribeca Trade Group is, first of all, I manage my own money. All of my subscribers get to see me trade live, both in cash and regular stock, as well as options. So we do a lot of option trading, and I'm going to talk about that and why that's interesting. We kind of monitor and read the tape all day long. For basically, I'm looking for ideas all day long. So I'm reading the tape. I'm looking for very aggressive option activity, and I'll kind of get into that and why that really helps me a lot. And I've got a couple slides that I can show. But my Twitter handle is @CFromhertz. I'm pretty active on Twitter, so if you're new and you're not following me, go ahead and give me a follow, and you'll kind of see the information that I send out. So on a daily basis, because my background is in ETFs, and I really do a lot of analyzing in what goes on in the ETF world, that helps me pick up on trends. So on every day at Twitter, I send out what's happened in terms of inflows and outflows in terms of U.S. ETFs, U.S. equity ETFs, as well as international ETFs. And one of the trends that's been really interesting, so I'm going to talk a little bit about trends, and I'm going to talk about what we do on a daily basis in our trading room and what my approach is at Tribeca Trade Group. And Simon, by any means, if there's any questions, feel free to kind of throw them back, because I want to have as much of a discussion with you guys as possible. But so first things first, yeah. So what I'll do, what trend that we've been seeing in the last few weeks, and almost I would say the last 2 months. Probably I talked about this a little bit about a month ago, but what's been really different is the amount of attention that, obviously in the U.S., it is what it is. We're very focused on U.S. markets. We're focused on ourselves, right? This is how Americans get classified. But we're so focused on U.S. that a lot of times a lot of traders don't look at international markets, and they don't look to see what's going on globally. That's my bread and butter, because that's what I used to trade a lot when I was an institutional trader. Is I not only looked at U.S. markets, but we also used to run an international book. And so if somebody wanted to put a big trade on emerging markets, on Europe and developed markets, Australia, I was able to do that, and I was quite familiar with those markets, and which has really helped me to kind of spot the trend of really a lot of money that's been going into emerging markets and into developed markets. A lot of money has been going into Europe, and a lot of money has been going into Japan since the fourth quarter of 2016, where we saw this trend change. And so really it's been over the last couple weeks, there's been much more money that's been new money being put to work in international places. And in Europe, the fund flows have just been ridiculous. The amount of money that's been being put to work in Europe, much different than we've seen in the last couple of years. And finally, I think the financial media has started to pick up on this in the last couple weeks. We've been talking about it now for the last couple months, but there's just been a lot of money being put to work there, and much different than what we've seen in the last couple years. Just in the last couple days, I could tell you, because literally it was for, I think, 3 weeks in a row, and Simon knows this because I sent him my weekend report that captures all of this. But there was 3 straight weeks of more inflows going into non-U.S. equities versus U.S. in terms of all of the dollar-denominated ETFs that are out there, which is about 1,700 ETFs that I track. So for 3 weeks in a row, we saw more money going into international versus U.S. That's different. That's been much different than it has been in the last few years. Just in the last couple of days, we've started to see some money come back into the U.S. The U.S. markets have really been besides the last couple of days. If we look at I was actually looking at the airlines, which I'll bring up in a minute. But you look at the SPY chart, we're now actually, we've strung together a few days, but for the last weeks before, and we had this big sell-off on Wednesday. But even before this Wednesday, we were just kind of really going in drips and drabs and moving at a very, very slow rate in terms of the U.S. indices. So I have traded futures in my past, but I don't really, trade futures a lot. I think that there's better opportunities out there than trading the major U.S. indices, and I'm going to kind of hone in on that a little bit in this presentation. But you always have to kind of move from one foot to the other in terms of where the opportunities are in this market. So if there's a lot of volatility in the market, which I think we all know that there's not right now, the VIX is back to like what, a 10 at this point. Yeah, I mean, so when the VIX gets to be above 15, I kind of put my index hat on and trade more indices because they're moving faster and there's more opportunities to make money. But right now with the VIX at a 10, I'm really focused on single stocks, and there's a lot of opportunities going on in single stocks. They're not moving together. On any given day, we see either semiconductors outperform, we see China internet companies like Wuba, Momo, Weibo, all these China internet names have been really outperforming. I think that there's an ETF out there called KWeb, which is up 40% right now year to date. So these are the trends that we've been playing in the last couple months. You know, this ETF is now up 40% year to date. So you look at what's in this, Tencent is in there as well. But we've been all over this trend. Baidu is starting to pick up. JD for the last couple of months has been outperforming. So going back to looking at single names, you know, the last week it's kind of been changing a little bit. Semiconductors have been one of the strongest groups that have been out there, and we continue to see a lot of action in this particular group. But I mean, look at this chart. I mean, it doesn't get much better than this chart in the semiconductors, just completely up and to the right at a 45-degree angle. But what's been different the last couple of weeks is we're actually seeing a lot of activity in consumer staples. So take a look at the consumer staples chart now breaking out. So we're actually been seeing a lot of activity in Coca-Cola, Pepsi, Kraft Heinz. This started a couple weeks ago, right when there was I guess it's been more than a couple weeks ago, but back about, I guess, about a month or two ago when Unilever was, there was a rumor about them being taken out. Since then, all of the consumer staples names have kind of gotten out of this, you know, slowly but surely, and especially this last week, we're seeing this move up. We're also seeing this go on quietly in utilities as well, which is intriguing that both these charts look exactly the same, both utilities and consumer staples. So really, the option activity has really picked up in consumer staples. We're seeing all types of orders, and it seems like every other day we're seeing a big chunky order. A couple of days ago it was in Colgate, CL. I mentioned Kraft Heinz, and then we've seen Coca-Cola now on 2 different occasions, some big call buying in the ticker KO. Yesterday there was a colossal order in Pepsi. Pepsi is also has been breaking out. So kind of goes back to the topic of what I want to discuss is, you know, how am I finding these trades? How am I finding these breakouts? Because we're watching unusual option activity. We're basically watching, we're reading the tape, and we're finding these particular trades. Let me just bring up, and I'll give you an example. But for example, this was the trade yesterday in Pepsi. There was 20,000 options that traded yesterday, September 125 options. So, and this is when you see sweep on it, sweep opening, aggressive. So they came in twice, 2 blocks. And you could see, so I took this trade and I got into this trade right around 52 cents, and I've been taking targets up at 82 cents. So, you know, so you look at these charts, you know, Pepsi and what's going on in consumer staples, and it just looks a lot more interesting to me than what the overall indices are doing, even though they've started to pick up the last couple days and break out again, especially with Nasdaq. But let me just jump back to the presentation, if I can find it here. There we go. So, you know, going back to basically, I just want to jump ahead here a little bit, but same thing with financials. You know, financials, if we look at the chart of financials, which has not been my favorite group at all to play. I've been actually ignoring this group because I think it looks really, really choppy, and I just don't want to be involved in it at all. It almost looks like a big head and shoulders pattern. It looks like, you know, your left shoulder, you know, these head and shoulder patterns technically never come out to be exactly perfect, but you got a left shoulder, you got a head, you got a right shoulder. We don't know really how this is going to resolve itself. We don't know if we're going to break back above the 50 and the 100-day moving average, or if we're going to break down to the 200-day moving average. So this is a group that I really have not been wanting to get involved in at all. I think there's just better opportunities. I think there's better opportunities in a couple of those groups that I just mentioned that are starting to break out, as well as technology, which has just been on fire. So I really have not had many positions in financials or in the banks, even though they get so much press coverage in terms of what the banks are doing. They've been chopping since, you know, basically the beginning of the year. They've gone nowhere. However, until we saw about a couple of days ago, we saw a nice order in Goldman Sachs. Take a look at Goldman Sachs. You know, we saw calls basically go up right on the 200-day moving average, which to me is a really nice setup, because if I know the trade is not going to work, you know, all of our trades, you know, all of them are not going to work. It's just the way it happens. But for Goldman, I had a nice defined support of the 200-day moving average, and the trade that went up a couple days ago was really the first activity that we've seen in Goldman Sachs in probably about a month or two. Sorry, this trade alert system is a little bit slow. But we saw some nice September calls that went up. Again, opening trade, aggressive trade, sweep. You could see the implied volatility move up. So I'm kind of just bringing you through the thought process. We actually see some Starbucks options that just went up right now, which Starbucks is breaking out from a multi-year trend. I'll show you the Starbucks chart in a little while. But so the thought process of how we trade at Tribeca Trade Group is I have a very systematic process to the markets. I'm looking, just as as I mentioned, I'm looking for ideas. So just because you know, a chart looks interesting to me, you know, or you know, there's only so many stocks that you could watch. So every time I see something that's really aggressive and different on the tape, what I will do is look at the charts and say, hey, does this fit my model? Does it make sense for me to take this trade? If I can find some nice support, which I did in Goldman, so we put this trade on in Goldman, and it's basically been up a couple days after that. It's pausing a little bit today. Looks like at the 50-day moving average. So I've already taken a little bit of profits. Actually, taken off 2/3 of the trade already since this went up a couple days ago. Basically at the lows. And I'll just kind of break this down for you on the hourly chart. But we basically saw calls go up right around here, right when Goldman was around like 215. So it's gone all the way through to about 220. So that's a pretty nice gain, especially when you're using options for leverage. So that was another trade. And just sticking with this financials, the financials theme, the other thing that we saw was calls go up in Citigroup. So Citi, let me just zoom out of my charts here for a minute, looks a lot different than that XLF chart. This one actually looks like it's trying to break out, and I think it looks a lot healthier than, say, JP Morgan, which looks like it's kind of caught underneath those two moving averages, just like XLF. Wells Fargo, which is another big bank in the U.S., also looks like it's having some trouble here. It does have that support like Goldman did, but we haven't seen it really. For me, the catalyst, you know, could be, okay, I may want to go long Wells Fargo versus the 200-day moving average, but it really kind of pushes me into a trade when we see somebody put up a couple $1 million option premium trade like we did in Goldman. I would rather take that trade knowing that someone is someone else is a big institutional investor is going in on that trade with me. So you know, it makes a difference there, where charts that look identical, where both are at the 200-day moving average, I would rather go after something where somebody is putting down basically a big chip and saying, hey, I like the support and I'm going to go long here. So those are the types of trades that you know, we look at. I don't take every trade that's on the tape. It has to meet my criteria. It has to meet my system. There was a nice trade, nice big block of MAC that went up. MAC is a REIT. Just want to give you an example of something that I didn't take today that was aggressive, and I'll kind of share with you why I didn't take the trade as soon as this trade alert wants to work. Like I said, it's for whatever reason it's hesitating today. So let me just bring up the chart while we're waiting for this trade to come up. But take a look at this trade. So MAC, which is up nicely today, this is a REIT. They're more, so you can see 10,000 September calls went up today. So this does not, you know, if you're a trend follower, which I am, this is not a trade that I want to take. This is a stock that's in a big downtrend. So I would rather not even mess with this stuff. So even though this was an aggressive trade, maybe somebody's thinking that because a lot of the names that have been reporting, especially last night and today, a lot of the retailers that have reported have actually bucked the trend and came out with pretty good earnings, such as Best Buy, Williams-Sonoma that came out last night and this morning, and kind of give a little bit of a lift to retail names. Somebody came in and bought one of these REITs that's tied to shopping malls. But however, it doesn't fit my criteria. It doesn't. It's not in an uptrend. It's in a downtrend. So I look at the two things together. As I mentioned, I'm looking for trade ideas by looking at option volume, and it has to meet my system. It has to meet my criteria, which this does not. It's below the yellow line, the 200-day moving average. I'd pass. And I think that's good to do from time to time because you can't take every trade. You know, it's impossible. So you want to only take trades that fit your system, and that's what we try to teach at Tribeca Trade Group. You know, I'm really looking to give traders an edge in their trading program that they have, and you know, my philosophy is, you know, kind of the old saying, you know, teach a fisherman how to fish. Rather than just feed a guy. So we don't necessarily do that. We're really trying to teach people how to do this and how to set up their own model, their own trading system, because that's what's really important. You know, taking trades and putting on trades is one thing, but having the right trading system is really what it's all about, and defining your risk. So we actually have also another thing that we do. Like I said, you know, it doesn't just because I see a option trade on. As I mentioned, we trade both options and we trade stock. So, you know, just because I see an option trade doesn't mean I necessarily have to buy the call option or the put option. I could actually use that to put on a cash position. So this is a system that I just started a couple months ago, and it's a systematic approach to trading. Every time I put on a trade, I know my stop price right away, and the whole thing is founded upon a trend trading system. So taking some small losses and letting your winners ride. So I've got some really nice winners in here. I've got things like, you know, that are really small positions, like HDP. You know, just basically on a 300 lot, I'm up $800 in this position. IBN, which is an Indian bank, you know, very small position, 350 shares, and it's kind of just been letting this one go since it broke. You know, my signal on this one was we saw a little bit of call activity, but it broke you know, broke out on the 200. Let's see, when did I put this one on? This was March 15th that I put this on. Which was right here, this break of the this retest of the 50-day moving average, and it hasn't broken any major support, which I think is the 100-day moving average. Let's see, well, what do I have this linked to? Yeah, I have this one linked to the 100-day moving average, and it's basically set an ATR below 1.5 ATRs, which is the average true range, how much a stock moves in a given day. And I've got that set below, and as long as it doesn't break the 100-day moving average, I'm going to sit in this trade and let the trend go. So that's the approach to our stock trading as well, and we've been doing pretty well with that. Especially, you know, we've got some positions on here like Lumber Liquidators. That's, again, another name that basically I took this signal with it. You know, this is a company that got into a whole mess of trouble, you know, way back when. If you go back about 5 years, you could see the chart. You know, this was a $120 stock at one point. Real big long base in this stock, and over the last year, since it broke that 200-day moving average, it's, you know, it did one retest, I think, around earnings, and I think I actually got stopped out of the trade on the 50-day moving average. As soon as it reclaimed it, I got back into the trade. Put this trade on at 21.79, now marking at 29. Only just 100 shares, so really nice gain. So we have that type of portfolio, and we have an option portfolio as well that we do. So just to kind of go back to the presentation, you know, you look at, for example, the performance in financials yesterday, which is essentially flat. Look at what Goldman did yesterday, up 1.9%, and look at Citigroup, two areas where we saw call buying. So going back to what I said in the beginning of the presentation, I'm really much more focused on single stocks because I think there's a lot more alpha right now in picking single stocks than the overall movement in the indices. So I use a top-down approach. I'm looking for the sectors or regions around the globe that that are showing some momentum, that are breaking out, and then I drill down into those sectors or into those specific regions around the world and look for what names are starting to have better performance than the other names. I also rely on option activity. So for example, yesterday and I would say over the last week or so, for example, the semiconductor ETF SMH was up about 0.5% yesterday, but look at the performers. We actually saw a call buy right in the beginning day of Cyprus, was up 6.5%. We've been seeing call buying in MRVL, which reports after the close today. MSCC, which was another name that. So here's another example. So best thing I could do is kind of show you guys some examples here. So if I go to yesterday's activity, and I think this is going to, it actually came up pretty good. Some September 50 calls were purchased. So I took a look at that. I'm familiar with this name. I know it's a semiconductor device name. And I looked at the chart in MSCC, and I said, wow, this thing has gone all the way down, after a nice breakout back in towards the end of 2016. It's basically been kind of flatlining and moving down, and it just kind of caught up with the 200-day moving average. Where did we see the calls purchased? Right on the 200-day moving average. So I took this trade. Well, there's some Momo calls. This is a name that's on my watch list. Sorry. Some Momo calls just went up here. This is a name I just got into today. Speaking of China internet names, this is a name that had good earnings and has come down to the 50-day moving average. I just put this trade on this morning. So this is what I want to see. You could see that after a couple days of the name coming in after a big move up, somebody looks like they're looking to buy it right now on the dip. So if I was not giving this presentation right now, I would be buying this. I'm already long in cash, but I would probably be adding an option position right now in this position, because I've been looking for option activity in this name. So again, just going back to what's been the reason why I associate and look at the aggressive option activity, because you'll find that names, it'll help you pick out names, especially ones you could see these examples that I put here from yesterday with the MSCC, which I think sets up really nicely in terms of support. So let me just finish my thought as I got distracted with the Chinese internet play. This is how it is all day, by the way. You start to go over something and you get distracted because you see a big trade on the tape. So I like this trade very much because I've got defined support. Again, really helps me with my trading system to have an area where if the trade doesn't work, it becomes a small loser and not a big loser. So I've got this trade on now, and if it happens to retrace and break back below the 200-day moving average, I will get out of it. But I'm going to ride the trend. I'm going to ride the move up on the 200-day moving average and just kind of let it go and see where it goes. If I'm wrong, which, hey, every trader is going to be wrong, I've got my defined support, and I'm disciplined, and I will get out right on that break of the 200-day moving average. So that's basically what we're doing on a day-to-day basis in terms of trading. We're analyzing the flow that we see on the tape. We're kind of in the morning. I spend about 45 minutes pre-market talking about the most interesting things that are going on around the world, and then we kind of drill down from what we think the overall indices are going to do, and we drill down into the individual sectors, and then further into the individual names, and that's basically how our trading program sets up. And as Simon knows, we do have a newsletter that we send out on the weekends that kind of get traders ready for the market, and we kind of look at a lot of different macro indicators to kind of give us a feel for if the market, the overall market, is due for a pullback, or if it's a good opportunity to stay in your longs or possibly trim some of your longs. So we go through that exercise every weekend with the newsletter that we put out. So I just wanted to pause here to see if there's any questions, because I typically cover a lot of information and I do it quickly. So I just wanted to pause here and see if there's any questions, and in particular, if there's any questions about trend trading, which is basically what we're doing in our room, and using options to help facilitate the trades.
Okay, does anybody have any questions for Christian? Yeah, it says it looks like you've done a lot of software programming, Christian. You're just very familiar with the Bloomberg screen.
Yeah, absolutely. You know, and I build from my days at I build from my days. This is our option port, so you can actually see. This is members only get to see this as well. But yeah, from Excel is just a great thing to learn. I am not a programmer, but I know enough to get by in terms of using. I do pay for a Bloomberg terminal because it allows me to pull so much information, and it allows me to kind of automate my trading as well. One of the major things that I tell our subscribers is that one of the hardest things in trading is you only have one set of eyes. So you need to and it's so nice to be a retail trader in this environment, because 10 or 15 years ago, you didn't have the ability to kind of automate your trading. It just wasn't there. The trading systems are so much better than they used to be. So you could set alerts, which is what I do a lot of times. I look for breakouts and certain things. So basically, I don't take a trade unless it hits an alert. But you could do all this like while the market's closed. You could set alerts for your stop prices. You could set alerts, for soft stops. I don't really put any hard stops in, but if names are breaking down, where a trade begins, just like I mentioned for the 200-day moving average, I've got alerts like just all over the place that will tell me when a trade does not work, because you want to be on top of this stuff. If you're not on top of it, sometimes that's where you can, kind of leak some P&L and you get away from your trading system. But it's just gotten so much better over the years from when I started to trade, showing my age a little bit, but back in like 1998, 1999, where there was, very, very little going on in terms of being able to have automated strategies and so forth. So, I've been very pleased, and it also kind of helped me transition from the institutional world, where I thought, 10 years ago, the institutional traders had such a big advantage over retail traders. I still think there's a little bit, institutional traders still have an advantage, but the gap has narrowed significantly over the last 10 years.
Okay, thank you. Joaquin says, "Good. How much is a Bloomberg terminal every month? Is it something that retail traders could utilize?" I think it's quite pricey, isn't it?
Yeah, it's so this is what pains me. It pains me to talk about it because it is expensive. It's about $2,000 a month.
There we are. And I suppose when you look at it in context, it could pay for itself.
Yeah. So so that's. So I know I'm kind of plugging my training room a lot, but that's one of the resources that I kind of that I allow my traders to see, is to kind of, I give them as much information as possible. So while I've got the terminal and I pay for it, it's an advantage of a trader being in my room, because basically all day long. And I'll just kind of share with you what our chat room looks like, which, we're kind of posting things all day long, but I'll post, we're kind of got some jokes going back and forth here as well, but, I'll post on a given, like things like this. I was talking about that MAC trade, and I'll flash a story from Bloomberg that was talking about mall REITs, which is what the trade that we saw earlier in the MAC that I mentioned. We basically try to connect the dots a lot of times. We say, hey, there's a big trade in MAC. What is it? First of all, it's a name I've never traded before. It's a mall REIT, or it has some exposure to mall REITs, and you start to think about it and you start to put together the puzzle. And I'll look on Bloomberg and I'll kind of see, hey, mall REITs are getting some attention today. Why are they getting attention? Because a couple of the retailers actually had surprise really good earnings, and you kind of connect the dots and you figure out, you don't necessarily have to take the trade just because you figure it out, but you kind of get it. That's why somebody would be buying a mall REIT today, because the retailers. And so I'll connect the dots. Bloomberg helps me do that quite a bit.
Fantastic. And you're offering, well, I don't want to steal your thunder, but I think you've agreed to offer a free trial to round the clock attending.
Yeah, absolutely. So yeah, I mean, I would love to see you guys check this out. Excuse me. But yeah, so basically just for today and tomorrow, because it will expire tomorrow. But you could check us out for a week free. So here's the link. I think Simon has already kind of given that out, but I'll throw this in here.
I did. Yes, it's in the
you got it. Perfect.
There. Yeah, the Tribeca Trade Group. I'll just post it again for anybody that may have missed it. This is good. This is the Sunday night newsletter that you get, and then you're actually giving access to the real-time trade group as well.
Right. Yeah. So I very much, so when I was an institutional trader, I used to actually write a note for, that used to go out to hedge funds. So I do the same thing now, but retail investors get it. So that comes included with your membership. And yeah, so I would love to see you guys check it out for a week. It's no obligation, 1 week free. You could check it out for free. If you don't like it, you obviously can cancel. But we've had a lot of success. I don't do a lot of the free the free weeks because I use some expensive systems, and I have to pay money right off the bat. Things like we use Slack, which is I will say this is a really nice platform to be on, but they charge me per user, so I really don't do a lot of offering out the free trials. I usually discount the first month. So again, first time we're doing it, so by all means take advantage.
I think you've offered a 50% discount before, but this is the first time you actually offered a free peek inside. That's great. How many traders do you have contributing? Is it just yourself, or do you have more? I think there's a team of you, is there not?
Yeah, there's a team. We have two other moderators, and they really complement the room very well because we have one guy, one trader who does a lot of selling premium trades. So he does a lot of like the iron condor trades, which I think is a real good trade to have in mind when the overall market is just kind of grinding and not moving, and trading in a range, which we've certainly seen that happen for like a couple weeks or a month on end. And then I also have another trader who really focuses on the nitty-gritty, and I'll kind of give you an example of that. Focuses on the nitty-gritty. So he basically posts charts all night long, and he looks for setups. And this really helps us because it's a lot of names that a lot of times I've never heard of. And when we talk about the setups, we do our homework for our subscribers. And then when we see an aggressive trade that hits the tape, we're like, hey, well, Pat has already pointed out that Micron is a good setup here, or PI is a good setup. And it really helps us to kind of do the homework myself and kind of give it to our traders in the room so that they're prepared going into the trading week and the trading day. Pat basically does this almost every night, puts out all kinds of charts.
Fantastic. What time is the room open to? Is it US open time, so it would be lunch time for us?
Yeah, so it's so my time Eastern. We open it up at 8:45 in the morning, and then we basically go through. It's basically we start about an hour before the U.S. markets open, and then we go a little bit after the U.S. close. But our room that we use is open 24 hours. So if you're we've got a few traders now that are based in Europe, and it fits them pretty well because they can come in for a couple hours and then they can kind of catch up. We post all of our trades, so it's good for the part-time trader as well as the full-time trader. They're able to adapt pretty well, and if same thing, if somebody's even working half the day full-time and they come in and they're only trading in a couple hours, they could quickly see what trades that I'm taking. So that's the way I've kind of structured it, so it's very easy for traders to kind of catch up. And then we also kind of chit-chat sometimes after hours, like we were talking last night about how crazy this Bitcoin thing is right now. So we were watching Bitcoin last night. I have to confess, I have fear of missing out. I haven't traded Bitcoin, but we were watching this thing, you know, go through, shoot to the moon last night. So we have it up all hours. So sometimes when I'm doing research at night, you know, traders will come and ask me questions, which is probably the best time to ask questions and to learn is when the markets are closed and not moving. So I do some after hours instruction, although my girlfriend is not a big fan of that, but but this is what we're very passionate about the markets. You know, this is my why I decided to leave the institutional world to kind of come and do this on my own. So we're all very dedicated and around after hours.
Certainly are. Any more questions coming in? I know it's been a long day for everyone. Christian, maybe I think next time must have you on maybe a little bit earlier during the day, because of course you're coming on evening time for us, and I am seeing a pattern of the last couple of sessions. The attendance is dropping off a little bit. Has to be said, it's an unusually warm and sunny day here in the UK.
So very nice.
I think after a long, dull, wet winter, everybody's we still got a great attendance. Don't get me wrong, but it's not. I think a lot of barbecues might be getting dragged out the garden sheds as we speak.
Awesome.
So
very good.
But thanks for your Twitter feed. Says yeah, so she must be following you on on Twitter, which is good. What is the Twitter again? Just remind us.
Yeah, sure. It's my first initial C and then my last name. So Fromhertz, Fromhertz.
Put that in there. Fantastic. Okay, well, I think the questions seem to have dried up. So, Christian, I think we'll let you go. We'll say thank you very much, because I know you've jumped in an hour ahead, and it's ruined your trading and cost you a fortune because you didn't get into that trade in China. So sorry for that. But we will hopefully don't send me an invoice for that. Great to hear from you. We will hopefully people will take up the offer for the free trial, because I know it's a good offer. We are putting it in the follow-up email as well, so everybody that has registered for the event, so there's about 900 people that will be actually receiving that email. Hopefully take you up on that. Thanks so much again. Take care, and hopefully we can hear from you again next month.
Thank you very much, Simon, and enjoy the weather while it lasts.
We will. It won't last long, I guarantee you that. See you later.
Take care.
Bye-bye for now. There we go. I think that has drawn us to the close of Around the Clock Trader. Unfortunately, our 12th speaker, Bo Yoder, doesn't appear to be in the room. I don't know what's happened there. Apologies for that. If anybody specifically was coming to see Bo speak today, I'm sure we can follow up with him again. But in the meantime, that draws us to the close of the webinar. Thank you for attending. We'll be back next month with Around the Clock Trader, 22nd of June. Of course, we'll be emailing you the links to the recordings and the links to all the special offers that the speakers have talked about today. But we will have some special feature webinars coming up. Trade Guider Gavin Holmes will be joining us next Wednesday. So I'll send you an email to remind you about that as well as we go. So thank you all again. And if you're in the UK, of course, as we mentioned, it's a sunny evening. So hopefully you can still get out and enjoy the last couple of hours of sunshine. And wherever you are in the world, thank you for joining us, and look forward to having you in a webinar again soon. Many thanks. Bye-bye for now.